Now let us discuss the income tax rates for previous year 23-24 or assessment year 24-25. As you know, for the May 2024 attempt and November 2024 attempt, the previous year that is applicable is 23-24 and assessment year is 24-25. First, we are going to learn the normal tax rates. It means what? Tax rates as per the normal provisions of the Income Tax Act. First, let us start with individual. For an individual, up to 2,50,000, no need to pay the tax. This 2,50,000 is hence called basic exemption limit or the maximum amount not chargeable to tax. Basic exemption limit or maximum amount not chargeable to tax. So up to 2,50,000, no need to pay a tax. Next, if there is a resident individual whose age is 60 years or more, it means what? The resident individual should have completed 60 years of age during the previous year, or his age should be more. In such case, up to 3 lakh rupees, no need to pay any tax. Then, in case of a resident individual whose age is 80 years or more during the previous year, who are also called super senior citizen, they need not pay a tax up to 5 lakh rupees. And I gave you one clarification. If a person is born on or before 1/4/1964, they will be considered as senior citizen. If a person is born on or before 1/4/1994, they will be 1944, they will be considered as super senior citizen. Next, so up to 2,50,000, 3 lakh or 5 lakh, as the case may be, no need to pay the tax. Then above 2,50,000 or 3 lakhs, up to 5 lakhs, 5%, above 5 lakhs, up to 10 lakhs, 20%, no 10% kana, 20%, above 10 lakhs, 30% tax. When it comes to Hindu undivided family, association of person, body of individual and artificial juridical person, above 2,50,000, no tax, above 2 lakh, up to 2,50,000, no tax, above 2,50,000, up to 5 lakhs, 5%, above 5 lakhs, up to 10 lakhs, 20%, and above 10 lakhs, 30% tax. In case of partnership firm, limited liability partnership and local authority, on the entire income, 30% tax. Now, cooperative society. Cooperative society is also association of person. However, the tax rate and the way to tax the cooperative society is different in the Income Tax Act. Hence, we have to follow that special method. In cooperative society, up to 10,000 rupees, 10%, above 10,000, up to 20,000, 20%, above 20,000, 30% tax. Now let's come to company. Company are of two types, domestic and foreign. For a foreign company, 40% tax, and for a domestic company, we have to see what was their turnover in previous year 21-22. If it is up to 400 crores, 25% tax, only 25% tax, and for other domestic companies, 30% tax. Now let's come to surcharge. Surcharge, okay, first and foremost, one point about the tax rate is that the tax rate system is a slab rate system. So every individual, irrespective of their income, will get the benefit of the slab rates. So even if I am earning 2 crores, I will get the benefit of the 2,50,000 slab, 5 lakh slab, 10 lakh slab, etc. Hence it is a slab rate system. Then what is surcharge? Surcharge is a percentage of income tax. So whatever percentage is given, that you should not calculate on income. You have to calculate on income tax. And surcharge, there is no slab rate system. You directly have to calculate the surcharge on the entire tax. Okay. Then if total income is above 50 lakhs up to 1 crore, the surcharge rate is 10%. Total income above 1 crore up to 2 crores, surcharge is 15%. Total income above 2 crores up to 5 crores, 25%. Above 5 crores, how much? 37% surcharge. Then in case of partnership firm, LLP, local authority, if total income is above 1 crore, directly 12% surcharge, only one limit. Next, in case of domestic company and cooperative society, If total income is above 1 crore up to 10 crores, 7%. Total income above 10 crores, 12% surcharge. Then, in case of foreign company, if the total income is above 1 crore but up to 10 crores, only 2% surcharge. Above 10 crores, only 5% surcharge. The surcharge rate is so low because the tax rate is already high. Next, special income under section 115 BBE. So under 115 BBE, the income is taxed at how much? 60% and the surcharge rate is 25%. Now let's come to rebate. Rebate under section 87A is allowed in the normal provision only if 3 conditions are satisfied. What are the 3 conditions? The assessee should be a resident, assessee should be the individual, and the total income should be up to 5 lakh rupees. If all the 3 conditions are satisfied, then the total tax up to rupees 12,500 will be given as rebate. Rebate means what? Rebate means a discount given under the Income Tax Act. However, be very careful that entire tax is not allowed as rebate. Up to how much allowed as rebate? 12,500. Because if there is a special rate of tax, then sometimes the tax can go to more than 12,500 also. In such case, what you have to do? Just reduce 12,500. Balance amount will be the tax payable, and based on that you can calculate health and education cess and complete the answer. Next, what is marginal? Okay, health and education cess. Health and education cess is 4% of income tax plus surcharge. So you have to add both income tax and surcharge, you have to add, and on this figure you have to calculate 4% health and education cess. Sir, what is cess? Cess is nothing but a tax that is collected for specific purpose. So this tax, that is health and education cess, is specifically collected for health and education. Now let's come to marginal relief. Why does marginal relief come? Marginal relief comes when the additional tax is sometimes more than the additional income. Okay? Why does this happen? Because surcharge does not follow slab rate system, it follows direct rate system. That is why there is marginal relief concept. So sometimes what happens, if you go from a slab of one surcharge to another surcharge, then sometimes your income might be only a little bit additional. However, your tax might be huge because of a small addition in income. In such case, the Income Tax Act tells that the additional tax should be restricted to the additional income. Okay, so after restricting whatever excess taxes there, no, that will be allowed as discount or marginal relief. Now, how to calculate the marginal relief? Marginal relief means actual tax minus tax on limit minus total income above the limit. So, if suppose income is coming as 1 crore 1 lakh, it means what? Actual tax will be the tax on 1 crore 1 lakh. Then limit tax will be the tax on the limit, that is surcharge limit, which is nearby 1 crore 1 lakh. What is nearby 1 crore 1 lakh? Limit is 1 crore. So tax on 1 crore minus total income above the limit. So what is the total income above the limit of 1 crore? That is 1 lakh rupees. So actual tax minus tax on limit of surcharge minus total income above the limit. And lastly, rounding off concept. Rounding off of income should be done to the nearest multiple of 10, and the final tax should also be rounded off to the nearest multiple of 10. Fine. There is special surcharge also, special rates of tax also, that we will discuss as and when we are studying those chapters later on. And at the end we will revise it again, once again. So now we are starting to revise the introduction to income tax. So first and foremost, to develop the nation, the government needs two things: power and money. Power comes from the constitution, money can come from three sources. That is government's own ventures or own business, taxes and borrowings. Taxes is the money charged by the government on products, income or activity to meet the common welfare expenses. Taxes can be of two types: direct tax and indirect tax. Direct tax, the example is income tax, and for indirect tax the example is GST. Direct tax is collected directly. It means what? It is charged on income or wealth, whereas indirect tax is collected indirectly by being charged on goods or services. Direct tax, the incidence does not pass to any other person. It means that you cannot recover the direct tax from any other person, but in case of indirect tax, incidence passes to the end consumer, means you can recover the indirect tax from end consumer. Direct tax is a progressive system of taxation, whereas indirect tax is a regressive system of taxation. Progressive means the rich people are taxed more and poor are taxed less, whereas regressive means that everyone is taxed equally. Now let's come to the Constitution. The Constitution gives the power to levy taxes. However, before giving the power, the Constitution also places a restriction via Article 265. The restriction Article 265 says that no tax can be levied except by way of law. Only if there is a law, there can be a tax. Then we have Article 246, which has the 7th schedule, and the 7th schedule has 3 lists: union list, state list, concurrent list. Union list is list 1, which gives the power to the parliament to draft the laws, and in the union list only one of the entries is entry number 82, which says income tax on income other than agricultural income. Does it mean that agricultural income cannot be taxed at all? Answer is no, because income tax on agricultural income is given in the state list. Now let's come to the income tax law. Is Income Tax Act equal to Income Tax Law? Answer is no. Income Tax Law is a much wider term. Income Tax Act is only a component of the Income Tax Law. There are total 5 components. The first component is Income Tax Act. Income Tax Act was passed in the Parliament in the year 1961, and it came to force in 1/4/1962. The Income Tax Act has chapters, sections, schedules. Chapters is nothing but a group of sections, and schedules are nothing but the additional information that is given in the act, whereas sections are only the actual content of the Income Tax Act. There are 298 sections. It means what? Sections numbered from 1 to 298, not 298 number of sections. Now, how to read the section? A section can be read like this. First we have to say section, then subsection, then clause and subclause. This is generally said when 2 subsections are linked with each other. It means what? Only if you read all the subsections together, you will get the complete meaning of the section. However, sometimes 2 subsections are not at all linked with each other. In such case, you cannot call them as subsections, you should directly call them as clause. We saw the example of section number 2, which gives various definitions. Hence, you have to say section 2, clause 1, section 2, clause 2, etc. Now let's come to subclause. Subclause is a subpart of a clause, and then we have provisos and explanations. Proviso generally starts from the word provided. So if the first word is provided in a paragraph, it means that paragraph is a proviso. Such paragraph gives exceptions or conditions to a particular section. Then we have explanation. Explanation gives clarification for a particular section. It gives extra meaning to a particular section, tries to define in detail what the section is trying to say. Then we have the Annual Finance Act. Annual Finance Act is passed in the Parliament every year, and in the year of election, that is Lok Sabha election or general election, it is passed twice. Okay, so in 2024 it is going to be passed twice. Hence it will be called Finance Act number 1 and Finance Act number 2. What is the purpose of this Finance Act? Every year the Finance Act is passed to amend the Income Tax Act. Amend means what? Change the Income Tax Act, and also to give the tax rates. However, can only the Finance Act change the income tax law? Answer is no. Income Tax Act can also be changed through other acts. For example, Taxation Laws Amendment Act. Then we come to income tax rules. Income tax rules are passed by CBDT, that is the Central Board of Direct Taxes, which we also call as Income Tax Department. Why does CBDT give rules? To carry out the purpose of the act. And like sections, even rules have sub-rules, clause, proviso, explanation, etc. So it is structured in the same way like how a section is structured. Now let's come to the fourth component, that is circular and notification. Circular can be passed by CBDT only. However, circular, okay, what is the purpose of circular? To clarify the doubts or to solve certain problems. However, circular gives some meaning related to the provisions. The power of the provisions is not there with the CBDT. It is there only with the government. Hence, the circulars brought by CBDT are binding only on CBDT. It means what? Only for CBDT it is compulsory to follow the circulars, since it is only giving the circulars. However, for assessee it is not binding. It means what? It is not compulsory for us to follow the circulars. We can take benefit of the advantageous circulars. Now let's come to notification. Notification can be passed by central government as well as CBDT. What is the purpose of notification? Central government passes notification to implement the provisions of the act, whereas CBDT passes notification to make the rules or to amend the rules. And notification is binding on everybody. Everyone has to compulsorily follow whatever is given in the notification. Then last leg is decision by courts. If Supreme Court gives a decision, then that decision is not only applicable to the person who are fighting in the Supreme Court, it is also applicable to the entire nation, India. Okay? And hence, Supreme Court decisions are also called as law of the land. Then, High Court decisions are applicable not only to the people who are fighting in the High Court, it is also applicable to the respective state. For example, Madras High Court decision are applicable to all the people who are in the Tamil Nadu jurisdiction. Now, these are the components of income tax law. Now, let's come to the steps to calculate the total income and taxes. I told you, first and foremost, we have to determine what type of a person the assessee is, whether the assessee is an individual or HUF or partnership firm, AOP, BOI, AJP, company, cooperative society, etc. Then, based on the person, we have to find out the residential status, whether the assessee is a resident, ordinarily resident, resident not ordinarily resident, or a non-resident. Because for a resident ordinarily resident, global income is taxable. Wherever you earn the income, it will be taxable in India. For a resident not ordinarily resident, income other than income from foreign source is taxable, and for a non-resident, only Indian income is taxable. Now, based on whatever income is taxable in India, you have to split all the incomes into 5 heads of income. First head of income is salary, second, house property, third one, profit and gains of business or profession, fourth, capital gains, and fifth one is income from other sources. Now, I told you that in Income Tax Act, the concept of income is of net income and not gross income. Hence, you have the benefit to reduce the deductions and claim the exemptions. What is deduction? What is exemption? Deduction is nothing but an expense that is allowed against the income. However, exemptions are the incomes that are not taxable under the Income Tax Act. After all this, if at all the income of some other person is taxable in the hands of assessee, that income should be clubbed in the hands of assessee. And then if at all there is any loss, then you have to see whether you can set off the loss or carry forward such loss. After doing all these adjustment, you will get gross total income. From this gross total income, you can further reduce the deductions that are given under chapter 6A. After this, you will get total income, and you have to round off the total income to the nearest multiple of 10. After this rounding off, you have to apply the tax rates. Now, the tax rates can be of two types. First is normal tax rates, second is special tax rates. Special tax rates are specific rates for some special types of income which is given in different sections. We have already covered one special tax rate, that is undisclosed source of income. Now what about normal tax rates? Normal tax rates can be of two types. One is the default tax regime under section 115 BAC, and second one is the normal provisions. Default tax regime is nothing but a new tax regime which is given under section 115 BAC, where the tax rates are less, however exemptions and deductions are also less. Similarly, in normal tax provision, it means what? The usual regular income tax act provisions, there the tax rates are a little higher, but you get the benefit of more exemptions and deductions. So after applying the tax rates, you have to give the adjustment of surcharge, marginal relief and 87A rebate as applicable. After that, add the health and education cess, which is always 4%. You will get the total tax. From the total tax, you should further reduce taxes that you have already paid in advance, that is advance tax, TDS and TCS. Finally, you will get the final tax, that is payable or refundable. And this final tax also, you have to round off to the nearest multiple of 10. Finally, with all this information, you have to file your income tax return. Fine. So this is the introduction. Now let's come to the basic concepts. We are going to revise the basic concepts chapter in the income tax law. First and foremost, we are going to discuss section number 4. Section number 4 speaks about levy. Income tax is levied on. It means what? Income tax act is applicable on. Applicable on what? Total income of the previous year of every person. Total income of previous year of every person. When it comes to total income, let us discuss a few concepts. First and foremost, income concept. As per the Income Tax Act, income can be regular income also, casual income also. It means what? If you get an income regularly over a period of time regularly, then it's a regular income. Casual income means an income that you are only getting once in a while. For example, you won a lottery and got an income. That is a casual income. In Income Tax Act, both types of incomes are taxable. Then, whether income refers to net income or gross receipts, answer is it refers to net income. It means what? After the gross income, you can reduce the deduction. However, the deductions that you reduce should be as per the Income Tax Act. Then, whether income is taxed on due basis or receipt basis, answer is it changes based on the income or the head of income. Then, capital receipt versus revenue receipt. Why are we learning the difference, sir? Because capital receipt is not at all taxable unless it is mentioned specifically under the Income Tax Act. However, revenue receipts are always taxable unless they are exempt from the Income Tax Act. Then, capital receipt comes from fixed capital, revenue receipt comes from circulating capital. Capital receipt comes from the transfer of capital asset. So if you sell a capital asset and if you get the money, that money will be called capital receipt. Whereas revenue receipt comes from trading assets. For example, stock, you trade stocks. So when you sell the stock and get the money, that money will be called revenue receipt. Capital receipt comes because of the source of income. For example, if you have a house source is the source of income of rent. If you sell the house itself and get the money, then it will be called as capital receipt. However, revenue receipt does not directly come from the source of income. It is the income from the source. Example, rent from the house. Then, capital receipt arises not due to the ordinary course of business. Revenue receipts arise due to the ordinary course of business. Then, if you have a purchase, if you do a purchase not with the intention to resell, if you do not have any intention to resell, but still later on you sell that particular goods and you get the money, then it is called capital receipt. However, if you are having an intention to resell and then you are selling it, then the money received will be called revenue receipt. Then in case of shares, if the shares are acquired and sold as an investor, then it will be called as capital receipt. However, if shares are acquired and sold as a dealer, it will be called revenue receipt. Exception, foreign institutional investors, which we will learn in capital gain chapter. Then example for capital receipts: gift, liquidated damages and compensation on termination of employment. And in case of revenue receipt, sale of stock, receiving rent, receiving interest on loan, receiving salary, etc. All these are examples of revenue receipts. So this is the income concept. Now let's come to the previous year concept. To know more about previous year, firstly you should know the difference between financial year, previous year and assessment year. Financial year means a year starting from 1/4 to 31/3. Okay. Then what is assessment year? Assessment year is a financial year. But what is special about this financial year? It is the year in which the income is taxed or income is assessed. It is always from 1/4 to 31/3, always 12 months. When it comes to previous year is defined under section 3 of the Income Tax Act. Previous year is called the previous year because it is the financial year immediately preceding the assessment year. That is why it is called previous year. It is the year in which the income is earned. Generally, previous year is also from 1st of April to 31st of March. However, in case of a new business or profession, previous year is from the date of setting up of the business or profession till 31st of March. In case of a new source of income, previous year is the date on which the source of income comes into existence till 31st of March. So that is the previous year meaning. Now let's come to previous year for undisclosed sources of income. Sir, what is this undisclosed source of income? Undisclosed source of income means that there is an income which is not disclosed by the assessee, or it is not shown by the assessee in the income tax return or the books of accounts, as the case may be. In such case, what will happen? If there is an undisclosed income which is found out by the assessing officer will ask for explanation. If assessee is able to give satisfactory explanation, then the case will be closed. However, if the assessee is not giving an explanation or not able to give any satisfactory explanation, then assessing officer will treat the income as undisclosed source of income. If the income is treated as undisclosed source, then it is taxed under section 115 BBE. What is the tax rate? 60% tax plus 25% surcharge plus 4% health and education cess. Effectively, it is coming to 78%. And moreover, against this 115 BBE income, that is undisclosed source of income, you cannot adjust the basic exemption limit of 2,50,000, 3 lakhs or 5 lakhs, as the case may be. That you cannot adjust. You cannot claim any deductions against such income. You cannot set off any loss against such income also. You get my point? Now let's come to what are the different types of undisclosed source of income. Number 1, section 68, that speaks about cash credits. Cash credit means a sum that is credited in the books of accounts. So if the assessing officer finds any credit in the books of accounts, he will ask the reason for the credit. If satisfactory explanation is not given or no explanation is given, it will be treated as undisclosed source. Then we saw special points relating to cash credit. What is the special point? If cash credit is in the form of a loan or borrowing, okay, from a person, then assessing officer will not only ask the assessee, assessing officer will also ask the person who gave the loan, from where did you get the money to give this loan? That person who gave the loan should also give satisfactory explanation. If both are not giving satisfactory explanation, or even if any one is not able to give satisfactory explanation, this cash credit will be treated as undisclosed source of income in the hands of assessee. Then when it comes to share capital, share application money, share premium or any such amount, There also, where the assessing officer will ask the assessee will explain. Assessing officer will also ask the person who has given this share capital, they should also explain. If both are not able to explain, then it will be treated as undisclosed source of income. However, there is an exception. What is the exception? If the share capital or share application or share premium is given by a venture capital fund or a venture capital company that is registered by SEBI, then assessing officer need not ask them about explanation. So this is cash credit. Then let's come to section number 69. Unexplained investment. Unexplained investment means what? Assessee has made an investment. For example, he has purchased shares. He has bought a house. Such investment is not disclosed in the books of accounts. In such case, assessing officer will ask for the reason. If no satisfactory explanation is given, it will be treated as undisclosed source of income in the financial year in which the investment is made. Next, section 69A. Unexplained money, bullion, jewelry or any other valuable article or thing, where bullion is nothing but precious metals. If they are not recorded in books of accounts, assessing officer will ask for explanation. If no explanation is given, it will be treated as undisclosed income in the year in which the assessing officer finds out. Okay. Next, section 69B. Section 69B talks about investment, money, bullion, jewelry or any other valuable article or thing whose value exceeds the amount recorded in the books of accounts. It means what? In the books of accounts, value is less, but in real life, the value is more. If the assessing officer finds out, he will ask for reason. If satisfactory explanation is not given, then the difference between the value, it means what? Difference between actual value and book value will be treated as undisclosed source of income in the financial year in which it is found. Next, section 69C, unexplained expenditure. Assessee has made an expenditure which is not there in the books of accounts. Assessing officer will ask for the reason, where did you get the money to do this expense? If he is not able to give satisfactory explanation, this unexplained expenditure will be treated as undisclosed source of income, and against such income, no other expense will be allowed as deduction. Then section 69D, amount borrowed or repaid on hundi. What is hundi? I told you, hundi is nothing but like a bill of exchange or bill discounting transaction, but without involving the bank. Okay, the individuals are the people who do hundi transactions. If there is a borrowing or repayment that is made on hundi, then it should be it should only be through account payee check. If it is other than account payee check, then the entire amount of borrowing or repayment will be treated as undisclosed source. However, one small point, what is that? If one time the hundi transaction is already made as undisclosed source, again on the repayment, it will not be made as undisclosed source, because one income can be taxed only one time. It will not be taxed two times. So this is undisclosed source. Now, income of previous year taxed in the previous year itself. It means what? Need not wait till the next year, assessment year. In this case, previous year and assessment year will be the same. There are 5 cases where income of previous year is taxed in the previous year itself. Number 1, section 172, non-resident shipping business. So if a non-resident is having a shipping business, in such case, the freight of the shipping business will be treated as income. 7.5% of the freight will be taxable. On this you have to calculate the tax. So 7.5% is not the tax kana, it is the income. On that income only you have to calculate the tax. And this taxability is compulsory in nature. It means what? Non-resident shipping business compulsorily have to follow this method. They do not have any other method. Then section 174. Person leaving India during the previous year or shortly after the previous year. It means what? Next year, April 1st week liye, they will leave, like that, with no intention to return back. In such case, assessing officer is having the discretion or the option to go to this person and tax the income of the year till his probable date of departure. Next, section 174A, association of person, body of individual, or artificial juridical person which is formed for a specific purpose. If it is formed for a specific purpose, then assessing officer has the power to come to that association of person, body of individual and AJP and tax the income of the year till their date of dissolution in the same year itself. Next, section 175. If a person is likely to sell, transfer, dispose or part with any asset or property just to avoid the tax, an assessing officer gets to know, then he is having the power to tax that income in the same year itself. Next, section 176, discontinued business. If business itself is discontinued, then assessing officer is having the power to tax the income of the year till the date of discontinuance in the same year itself. So this was the previous year concept. Now we are coming to the detailed concept about person. To know more about person, firstly we should know what is assessment, what is assessee. Assessment means what? Section 2 clause 8 defines assessment as the procedure of determining income by the assessing officer. Assessment can be normal assessment, it can be reassessment. Reassessment means what? Already the assessment is done, but once again it is reopened and assessment is done once again. This assessment procedure is a part of your CA final syllabus. Then section 2 clause 7 defines what is assessee. Very important. Who is assessee? Assessee is a person by whom any tax or any other sum is payable. So the person who is liable to pay tax is the assessee. Other than such person, who and all are assessee? Number 1, proceeding initiated for the assessment of his income or income of other person in respect of whom he is taxable, his loss or such other person's loss, his refund or such other person's refund. So it means what? If proceeding is initiated or any action is initiated by the department, such person against whom that action is initiated will also become assessee. Then deemed assessee is also assessee. Deemed assessee in default will also be assessee. So 4 types of assessee. First one, the tax or any other sum is payable. Second, proceeding is initiated. Third, deemed assessee. Fourth, deemed assessee in default. Then now let's come to person definition. Very important. Section 2 clause 31 defines who and all are included in the definition of person. So person includes individual, Hindu undivided family, partnership firm including limited liability partnership, company, association of person or body of individual, local authority and artificial juridical person. Now one time I want you to repeat all the 7 points. Individual, Hindu undivided family, partnership firm including LLP, company, association of person body of individual, local authority and artificial juridical person. Okay. Now let us see who is individual. Individual means a natural person. It means what? Human beings. If an individual is a minor, then assessment of such minor is done on the guardian. If individual is of unsound mind, the assessment is done on the manager. If individual is no more or he is deceased, then the assessment is done on the legal representative of such individual. Now let's come to Hindu undivided family. Hindu undivided family is formed because of Hindu law. What is HUF? As per Hindu law, HUF is all males lineally descended from a common ancestor including wife and daughter. Hence, only the Indian origin religion, the people who follow Indian origin religions can form a HUF. That is Hindus, Jains, Buddhists and Sikhs. Other than these religions, the other people cannot form Hindu undivided family. Or if they are already in Indian origin religion and they convert to a non-Indian origin religion, they will be out of the Hindu undivided family. In the Hindu undivided family, there are 3 types of members. One is Karta. Karta means what? Head of the family. Then comes co-partners. Co-partners are the members who are having the right to partition in the family or right of property in the family. Then the other members will only be called members. Such members have what rights? They have only the benefit of the expenses by the Hindu undivided family. That is expense relating to food, relating to clothing, etc. etc. Earlier, daughters could not be a part of HUF. However, from 6th of September 2005, even daughters can be a part of a co-parsoner in the Hindu undivided family. Then, wife and daughter-in-law cannot be co-parsoners. Daughter can be co-parsoners. Wife and daughter-in-law cannot be co-parsoners. Why they cannot be co-parsoners? Because they are co-parsoners in their parents' property. Now let's come to School of Hindu Law. There are two schools of Hindu law. Dayabhaga School, Mitakshara School. Dayabhaga School is prevalent in West Bengal and Assam, whereas Mitakshara School is prevalent in the rest of India. Dayabhaga School, no right of property is received till the head of the family dies. Hence, only the father and brothers of father will be co-parsoners since the grandfather is no more. Okay? If father also dies, then only the children of the father will get the right in the property. But in Mitakshara School, right is by birth and not by succession. Hence, even children will be co-parsoners in the property. Now let's come to company. Company, very, very important to know all the meanings of company, domestic company, foreign company, Indian company, etc. Because we have to differentiate it properly to know what and all companies are covered in which category. First and foremost, section 2 clause 17 defines what is a company. As per the company definition, number 1, an Indian company defined under section 2 clause 26 is a company. Number 2, a body corporate under any other law will be considered as a company. For example, a company formed under US laws. Example, Meta Incorporation is also a company as per the Income Tax Act. Number 3, a organization assessed as a company under the Income Tax Act 1922 before 1/4/1970, they will be called company. And lastly, whether an organization is incorporated or not, whether it is Indian or not, if CBDT is declaring that organization as a company, it will be coming under company. Now let's come to what are the different classes of companies. Companies can be of two classes, domestic company, foreign company. Foreign company is defined under section 2 clause 23A of the Income Tax Act, and foreign company means not a domestic company. So what is domestic company? Domestic company is defined under section 2 clause 22A of the Income Tax Act. Domestic company means number 1, Indian company or company which has made arrangement to declare and pay dividend in India out of the income taxable in India. Then what is Indian company? Indian company is defined under section 2 clause 26. An Indian company means a company that is registered under the Companies Act 1956 or 2013 and having registered office in India. Fine. So Indian company means what? Registered under Companies Act 1956 or 2013 and having registered office in India. Apart from this, Indian company also includes the organization that is declared by CBDT as Indian company, and other than that also, if the central government or state government or union territory is forming any company under their laws, those will also be called as companies. And I told you, State Road Transport Corporation, State Financial Corporation is also company. Now let's come to section 2 clause 23, which defines firm. Firm includes limited liability partnership. The definition of partnership firm should be taken from the Partnership Act 1932, and definition of LLP should be taken from the LLP Act 2008. So same definition as per the respective act. However, in income tax, minor will be considered as a partner if minor is admitted only for the benefits of the partnership firm. Now let's discuss the difference between association of person and body of individual. First and foremost, you should know that if at all there is a partnership firm, it will be coming in the firm category. It can never be AOP or BOI. Purida? So partnership firm under Partnership Act or LLP Act will be considered as firm. It will not be considered as AOP BOI. Then other than partnership firm, whatever the other groups are there, no, those groups only will be considered as AOP or BOI. AOP, association of person, BOI, body of individual. From the name itself, we know that only individuals can form BOI, that is body of individuals, whereas other than individual also can form what? Association of person. That is the first difference. What is the second difference? In case you find a group of individuals, the group of individuals can be AOP also, BOI also. Then what is difference? In case of AOP, the group comes together for a common purpose to produce the income. They will earn the income and they only have the rights to the income. However, in case of body of individual, they merely receive the income, but they do not have the rights to use the income. For example, executors and trustees are body of individual. Executors and trustees will merely receive money. Okay, so executors will receive the money for the legal heirs, and trustees will receive the money to give as donation. They cannot use that money for themselves. They can only receive and manage that money. Whereas in association of person, there are three examples: co-heirs, co-legatees, and co-donees. So co-heirs, co-legatees as well as co-donees can use the income that is given to them. Next, explanation to section 2 clause 31 tells that AOP BOI will be considered as a person even if they do not have the intention or if they are not formed for earning an income. So if there is a group of persons, it is not necessary that they should have intention to earn income. Even if they are not having intention, such group can be called as AOP or BOI. Next, local authority. Local authority, I gave you an example, Coimbatore Municipal Corporation. It means an authority which is in control of a municipal or local fund. If the municipal authority or local authority is supplying in its own jurisdiction, then no need to pay the income tax on the income. However, if it is supplying outside the jurisdiction, then income tax is levied on the income. However, if the income is because of water and electricity, no need to tax that income. Lastly, artificial juridical person. Artificial juridical person is a residuary head. It means what? In the previous 6 heads, if a person is not falling in under those categories, then the person will automatically fall under artificial juridical person. Example, idol, statues, deities, universities, and bar council. Now comes the question whether central government and state government are persons. Central government and state governments will not be considered that as persons because in the 6th point, local authority is specifically mentioned. Since it is specifically mentioned, it means what? The act is purposely trying to exclude central government and state government. That is why they are not persons. Fine. With this, we have finished the basic concept chapter also. Now we are going to start revising the residential status chapter, that is chapter number 2 in your institute study material. Residential status chapter is very important when it comes to the exam point of view, because for intermediate definitely a question is going to come from residential status chapter. Firstly, let us learn how to find out the residential status of an individual. To find out residential status of an individual, whether an individual is resident or not, you can find out using section 6 subsection 1 basic conditions. There are 2 basic conditions. If any one of the conditions is satisfied, the individual will be called resident. First basic condition, the stay in India should be 182 days or more in the previous year. Or second basic condition, stay in India should be 60 days or more during the previous year and 365 days or more in the 4 preceding previous years. However, for the second basic condition, there are 4 exceptions, 3 full exception and 1 partial exception. Exception means what? Who and all are covered under the exception need not see the second basic condition at all. If they satisfy the first basic condition, they are resident. If they don't satisfy, they are non-resident. Who are the exceptions? Number 1, Indian citizen who leaves India as a crew member of an Indian ship. Number 2, Indian citizen who leaves India for employment purpose outside India. So these two are the Indian citizens who are leaving India. Now let us talk about visiting India. If an Indian citizen or person of Indian origin is visiting India during the previous year and his total income other than income from foreign source is up to 15 lakhs, then they are covered under exception. However, if there is an Indian citizen or person of Indian origin who is visiting India during the previous year and total income other than income from foreign source is more than 15 lakhs during the previous year, then instead of 60 days, you consider 120 days in the second basic condition and solve the answer. Don't ignore the second basic condition. Instead of 60, you just put 120 and solve the answer. Next, who is deemed resident? Notwithstanding anything contained under 6 subsection 1. Deemed resident is given under which section? Section 6(1)(a). You need to satisfy 4 conditions to become deemed resident. What are the 4 conditions? Number 1, the assessee should be an Indian citizen. Number 2, the total income other than income from foreign source should be more than 15 lakhs. Number 3, he should not be liable to tax in any other country because of his domicile or residence or any other reason. And number 4, he should not be a resident as per 6(1). So if all these 4 conditions are satisfied, such individual will be called deemed resident. Now let us see additional condition to be R-O-N-O-R. Listen, first you have to find out whether an individual is a resident or non-resident. Fine. If an individual is coming as non-resident, then you see whether that non-resident is a deemed resident. Fine. If the non-resident is also a deemed resident, and in case of resident, so resident and deemed resident case lavande, you can have ordinarily resident, not ordinarily resident. How to differentiate between ordinary and not ordinary? Can a non-resident be R-N-O-R? Answer is no. Non-resident cannot be R-N-O-R. Only resident can be R-O-R or R-N-O-R. That is first point. Now, if a person is a resident, you see whether the person is satisfying any one of the 4 conditions. Any one of the 4 conditions. If he satisfies any one, he will be considered resident but not ordinarily resident. However, if he does not satisfy any condition, pavam, he will be considered ROR, resident, ordinarily resident, and he will be stuck and he has to pay the tax on the entire global income. So what are the 4 conditions? Section 6, subsection 6, condition number 1. The person should be a non-resident in at least 9 out of 10 preceding previous years. Condition number 2. Stay in India should be 729 days or less in the 7 preceding previous years. Condition 3. The person should be Indian citizen or person of Indian origin visiting India during the previous year and his total income other than income from foreign source should be more than 15 lakhs. Whose stay in India is between 120 days and 182 days. It means what? 120 days or more but less than 182 days. And lastly, deemed resident. So if any one of the 4 conditions is satisfied, the individual will be R-N-O-R. If no condition satisfied, R-O-R. Fine. Now some special points. What are the special points? Who is a person of Indian origin, sir? Person of Indian origin means a person who himself or either of his parents or either of his grandparents should be born in undivided India. Undivided India means India before partition. So before the date of partition, India, Bangladesh and Pakistan, all the 3 countries combined were called undivided India. Now, what is income from foreign source? Income other than income from foreign source. Income other than income from foreign source means Indian income, that is income received in India, income deemed to be received in India, income accruing or arising in India, income deemed to accrue or arise in India, and number 5, income accrued and received outside India but from a business controlled and profession set up in India. So these 5 incomes are income that is other than income from foreign source. Okay. Next, Residential status has to be determined every year. So every year you have to calculate residential status. Next, stay in India includes the stay in territorial waters. Since territorial water is also a part of India, it will include in stay in India. Continuous stay in India is not compulsory. So if a person is staying in bits and pieces, you have to add all the period of stay together and then find out the answer. Next, very important, date of arrival. It is considered as stay in India. Date of departure also considered as stay in India. Arrival day also India. Departure day also India. You have to count it as stay in India. Next, individual can be resident in more than one country also. So is it possible that individual is resident in more than one country? Answer is yes, very much possible. In such case, what will happen? He might be taxed twice for the same income, correct? But in such case, he can take advantage of double taxation avoidance agreement. Next, concept of resident and citizen are different. In income tax, citizen can be a non-resident also. Non-citizen can be a resident also. Because citizenship is by birth, but resident is by the number of days stayed in India. Totally different concept. Okay. Now let's come to Indian citizens who is a crew member of a foreign bound Indian ship. So if an Indian citizen is a crew member of foreign bound Indian ship, one special provision for them. What is a special provision? Firstly, we have to see whether they are on an eligible voyage. Eligible voyage means what? Voyage that is originated from port in India and destination is outside India, or originated from port outside India and destination is in India. In such case, the period excluded from the stay in India should be from the date of joining in CDC to the date of signing off in CDC. CDC means what? Continuous discharge certificate. It is nothing but a register. So when we enter into the ship, when the crew members are entering, they will join the CDC and then enter into the ship. When they are coming out of the ship, they will sign off from the CDC and come out from the ship. So this is only continuous discharge certificate. So from date of joining to date of signing off should be excluded from India. Excluded from India. Hence, this is the only case where date of joining and date of signing off both are considered outside India. It is not considered in India, it is considered outside India. Fine. So this is a special provision. Now let's come to residential status of HUF, firm, LLP, AOP, BOI, local authority and AJP. For all these persons, you have to see where is the control and management of affairs. If control and management of affairs is fully outside India, then the person is a non-resident. However, if it is fully or even partly in India, then the person will be considered resident. Okay? And in case of HUF, if the HUF is a resident, you also have to find whether HUF is a ROR or RNOR. How to find? If Karta is ROR, HUF is ROR. If Karta is not ROR, HUF will be RNOR, resident but not ordinarily resident. Now let's come to company. In case of company, non-resident company means other than resident company. Non-resident company na yare? Other than resident. Then who is resident? Number 1, Indian company under section 2 clause 26 is a resident, and any other company will be considered as a resident if POEM is in India. What is POEM? Place of effective management. Place of effective management is in India. Place of effective management means the place where the key management and commercial decisions of an entity are made. Now let's come to scope of total income. Scope of total income only tells us why we are calculating the residential status or determining the residential status. It is because for a resident, ordinarily resident, the entire income that he earns in the entire world is taxable. However, for resident but not ordinarily resident, only Indian income and income accrued and received outside India but controlled from India is taxable, and for a non-resident, only Indian income is taxable. Fine. Now, what is Indian income? Indian income means income received in India, income deemed to be received in India, income accruing or arising in India, and income deemed to accrue or arise in India. These four types of income are called Indian income. It is taxable for everyone. ROR also, RNOR also, NR also. Taxable for everyone. Now let's come to the next one. Income accrued and received outside India from a business controlled or profession set up in India. This type of income is taxable for resident but not ordinarily resident. Resident but not ordinarily resident. Now, I also told you what is income other than income from foreign source. So, the first 5 will be considered as income other than income from foreign source. It means what? Income received in India, income deemed to be received in India, income accruing or arising in India, income deemed to accrue or arise in India, and income accrued and received outside India from a business controlled or profession set up in India. These 5 incomes are what? Income other than income from foreign source. This is only taxable for RNOR. Okay. Next. Lastly, income accrued and received outside India and controlled also outside India, and any other foreign income. Number 6 and number 7 are purely foreign incomes, and they are taxable only for resident, ordinarily resident. Taxable only for resident, ordinarily resident. Then we talked about remission. Remission means what? It comes from the word remittance. Remittance means sending the money from one person to another person. Remittance, is it taxable? Answer is no. It is not taxable because it is not earning the income. It is using the already earned income. So, if I am earning my money in Dubai and I am sending that money from Dubai to India, it is called remittance of money from Dubai to India. It is not taxable because I might have already paid the tax. Sir, what if I do not already pay the tax? Is then remittance taxable? Answer is no. Still remittance is not taxable. For example, if I am earning money in Dubai and if I do not pay any income tax in Dubai, later on, if the money is transferred from Dubai to India, which is remittance, is it taxable? Answer is no. Still it is not taxable because remittance is not taxable. Then in case of accrual or receipt, you have to see the first accrual or receipt. And next point paranga, receipt by another person on behalf of assessee will also be considered as receipt. Now listen very carefully. For example, if I am earning some income, okay, I asked my employer to directly send the money to my mother. Fine. Let's say I am working in USA. I am directly asking my employer to send money to my mother who is in India. In such case, my mother is receiving money. On behalf of whom she is receiving the money? On behalf of me only she is receiving the money. Hence, first time the money is received in India, it will be taxable in India since it is income received in India. Next. Foreign income is not income accrued in India just because it is included in balance sheet in India. Listen very carefully. Sometimes what happens is foreign companies are there, no? They are required to make balance sheet in India. In that balance sheet, they should also include whatever foreign countries' balances are there. For example, if a country is there in China as well as India, then in India, they will have to submit their Indian balance sheet. They also have to submit their consolidated balance sheet. Consolidated balance sheet means it will contain India also, China also. Now, just because this balance sheet contains income from China, does it mean that it will be taxable in India? Answer is no. So, just because one foreign income is mentioned in an Indian balance sheet, it does not mean that it will be taxable in India. Fine. Next. Let's see what is the definition of India. India is defined in section 2 clause 25 of the Income Tax Act. It includes territory as per article 1 of the Constitution, then territorial waters, sea bed, subsoil, continental shelf, exclusive economic zone, other specified maritime zone, and the airspace that is above the territory and territorial waters. So this is the definition of India. Then let's see what is income deemed to be received in India. Income deemed to be received in India includes contribution to recognized provident fund greater than 12% of salary, interest in recognized provident fund greater than 9.5% per annum, employer contribution in pension scheme under section 80 CCD, and employer contribution and also interest that is transferred from unrecognized provident fund to recognized provident fund. Next, income accruing or arising in India. I already told you the difference between accrue, due and receipt. So if any activity is done in India by which an income is accruing in India or arising in India. For example, I did employment in India. Because of that, I am getting salary. That salary is income accruing or arising in India. I am doing business in India. Because of this business, I am getting the profit. This profit is income accruing or arising in India. Fine. There is a fixed deposit which is there in India. Because of that from that fixed deposit, the interest is arising. That is also accruing or arising in India. Then one small special point which might be asked in multiple choice question. If a non-resident seafarer also is like crew member of ship, not Indian ship. So if there is a non-resident seafarer, then if he is rendering any service outside India on a foreign going ship that is received in non-resident external account. NRE account means non-resident, please write non-resident external account. Then the salary is not taxable. So one exemption is given. What exemption? If there is a non-resident seafarer. It means what? A crew member who is not a resident and he is rendering service outside India on a foreign going ship. The ship is going outside India and he is rendering service outside India. That money is received in NRE account, non-resident external account. Such amount will not be taxable. Okay, so it is a very specific point. You have to by heart this point in case and there is a multiple choice question or something. Fine. Now let's come to income deemed to accrue or arise in India. So sometimes there will be a confusion whether there is an income it's accruing and arising in India or not. To clear the confusion, the government themselves have given the transactions in section number 9. So whatever is given in section number 9, they are income deemed to accrue or arise in India and hence they will be called Indian income and taxed for everybody. Firstly, let us learn what is income through and from business connection in India. To learn business connection in India, firstly, we should know the difference between business in India versus business with India. If a person is doing business with India, then there is just a shopkeeper-customer relationship. And in such case, the shopkeeper or the business need not pay any tax in India because he is just doing business with Indians. I gave you an example that we are going to US, buying iPhones and coming to India. Or we are ordering iPhones from US to India, so they are sending from their store to India. In such case, Apple is doing business with Indians. Hence, Apple need not pay any tax in India. Now let's come to business in India. Business in India means what? Apple company, they come to India, they open an Apple store and they are doing business here. In such case, on the profits of the Apple store, they have to pay the tax in India. Business in India, business with India. But sometimes what will happen? Some companies will try to cheat the government by doing business in India but showing it as business with India. How will they do it? The first case is through a agent or through a dependent agent. Okay, dependent agent means what? Instead of directly coming to India and doing the business, they will appoint an agent who is controlled by them. They will come to India and do the business on behalf of them. So who is a dependent agent? Number one, a person who is having authority to conclude contracts. Then person who concludes contracts. Number 3, the person who may have principal role in the contract in the name of non-resident, in case of transfer of ownership of non-resident property, in case of granting the right to use of the non-resident property, or the property that the non-resident has right to use. So this non-resident property or non-resident rights, they are giving to someone else. So they are transferring the rights to someone else, this contract. And lastly, provision of service by the non-resident. Next, if a person without authority maintains stock on behalf of non-resident, then also he will be dependent agent. And lastly, person who secures orders for the non-resident or the common control, then also dependent agent. What is common control? I gave you an example, BBK Electronics and OnePlus and Oppo. So BBK Electronics is controlling OnePlus. So if BBK Electronics is securing order for OnePlus through agent, that is also dependent agent. Next, X controlling Y. It means what? OnePlus securing orders for BBK Electronics through dependent agent, that is also covered here. And lastly, both non-resident under the same control. So Oppo and OnePlus both are under the same control of BBK Electronics. So if Oppo is getting order for OnePlus using dependent agent, that is also covered under dependent agent. Now what is the exception to dependent agent? Exception to dependent agent is independent agent. Who is independent agent? Independent agent is a person who does agency in the ordinary course of business. Number 2, he should not work mainly for that non-resident. And number 3, he should not be dependent. If all 3 conditions are satisfied, the person will be called independent agent. And if transactions are done through independent agent, it will not be considered as business connection. Okay. Next, the second type of business connection is significant economic presence. Here there are 2 cases. In both the cases, the companies are actually doing business with India only. But however, the business with India is so significant that the government wants to bring that income under income tax. Okay. What is the first case? If a non-resident is providing goods or services including download of data or software where the payment per person per year exceeds 2 crore rupees, they will be covered under significant economic presence. Hence, from whomever they are collecting more than 2 crores, this entire amount together will be called as significant economic presence. Significant economic presence means business connection. Business connection means what? Deemed to accrue or arise in India and hence taxable in India. And second case, soliciting business through interaction, business or interaction through digital means where the users are above 3 lakhs. So if the person is having more than 3 lakh users and getting business through them, then also it will be considered as significant economic presence. I gave you an example of Facebook. So Facebook is having more than 3 lakh users. Fortnite might be having more than 3 lakh gamers who are there in India. So the revenue that they are earning from the users or gamers will be significant economic presence. And it does not matter whether, so it means what? It does not matter whether or not they are having any agreement in India, they are having any place of business in India, they are rendering any service in India. So even in spite of these 3 conditions, it does not matter whether they are having any place or agreement or they are specifically coming to India and providing. That matter only if the 2 conditions are satisfied, that is more than 2 crore per year per person or more than 3 lakh users, still it will be considered significant economic presence. Now let's come to exception to business connection in India. So there are 5 cases where it will not be considered as business connection. First case is what? Operation not in India. If the operations are not done in India, such operations will not be called will not be called business connection in India. However, there are exceptions. What are the exceptions? There are 3 cases where it will be considered as operation in India. Operation in India. What are the 3 cases? Number 1, income from advertisement shown to Indian customer and Indian computer. Indian customer means whom? Customer who resides in India. And Indian computer means whom? Computer which is having internet protocol address or IP address that is located in India. So income from advertisement shown to Indian customer, Indian computer will be called operation in India. Number 2, income from sale of data collected from Indian customer, Indian computer will be considered as operation in India. And third one, income from sale of goods or services using that data to Indian customer and Indian computer will be considered as operation in India. So operation in India vande business connection, operation not in India vande exception to business connection. Next, if a person is purchasing for the purpose of export, it means what? Import பண்ணிட்டு export பண்றது. Such transactions are not business connection in India. Next, collection of news or views in India for the purpose of transmission outside India. So transmission is done outside India for news and views collected in India. I gave you example of British Broadcasting Corporation. They are coming to India, collecting the news and showing in their country. Such case not covered in business or business connection in India. Next, shooting films in India where the producer is a non-resident who is a non-citizen, or if in case of partnership firm it should have no citizen partner, and in case of company it should not have any citizen shareholder. In such case, if such people are coming to India and shooting the films, income from such films will not be business connection in India. And lastly, activity to display rough diamond in special notified zone for foreign mining companies will not be considered as business connection. Now let's come to the other cases where income is deemed to accrue or arise in India. So firstly we saw business connection. Next, if there is a property in India, then income from such property will be income deemed to accrue or arise in India. இந்தியாவில் ஒரு FD இருக்கு, இந்தியாவில் ஒரு லேண்ட் இருக்கு, இந்தியாவில் ஒரு machinery இருக்கு, whatever property that may be there in India, income from such property will be deemed to accrue or arise. Next, income from asset or source of income that is situated in India. So if there is any asset or any source of income which is there in India, such income will be deemed to accrue or arise. Next, if there is any capital asset situated in India, if you sell that capital asset, then the amount received on sales will be income deemed to accrue or arise in India. For example, there is a land, you have sold that land, then the income from such land, such sales will be deemed to accrue or arise. Next, salary earned in India. If a person is working in India and earning the salary will be deemed to accrue or arise in India. And one more special point, if a person is coming here and working, the rest or vacation period just before or just after the employment period will also be considered as deemed to accrue or arise in India. Even if you render service in India and receive the pension outside India, then such pension also will be deemed to accrue or arise. Next, if Indian government is paying salary to an Indian citizen for service outside India, then it is deemed to accrue or arise in India. I gave you an example, Indian diplomats who are working in foreign country embassy. However, for them, as per section 10 clause 7, perquisites and allowances, that is facilities etc. given to them will be completely exempt. Salary alone taxable, the perquisites and allowances will be exempt. Next, dividend by an Indian company outside India. If Indian company is giving dividend outside India, it is fully deemed to accrue or arise in India. First, let me discuss the last point. If money is paid without consideration means what, Kanna? It is gift, like a gift. If money is paid without consideration by a resident to a resident but not ordinarily resident, or non-corporate non-resident, or a foreign company which is greater than 50,000 rupees, then such amount will also be deemed to accrue or arise in India. Then let's come to interest, royalty and fee for technical services, the last part of this chapter. Now, what is the meaning of royalty? Royalty means a consideration including lump sum consideration but excluding capital gains for transfer of right or license relating to a patent, invention, model, design, secret formula, process, trademark, etc. Then imparting information for using patent, invention, model, design, secret formula, process, trademark, etc. Number 3, using the patent, invention, model, design, secret formula, process, trademark, etc. So 3 points. Then fourth one, imparting industrial, commercial or scientific knowledge. Number 4, usage of industrial, commercial or scientific equipment. Then transfer of right or license relating to copyright work, literary work or artwork, including sale, distribution, exhibition of films. So if you sell films, distribute films, exhibit films, money received will be called what? Royalty. Then services relating to all the above will also be called royalty. Then what is fee for technical service? Fee for managerial service, technical service, consultancy service. Managerial is what? Leadership service or management. Technical means using the special knowledge, and consultancy means giving advice on the subject on which you are an expert. That is called consultancy. So all these 3 services are covered in fee for technical service. It includes the fee for providing technical personnel. I told you, if I am providing you technical service, okay, and I am sending my staff to your place to help you out, in such case, if you pay extra money for that staff, that is also fee for technical service. However, if you are having your own staff, it means what? Your own employee to whom you are giving salary. Is that fee for technical service? Answer is no. Salary is not fee for technical service. And lastly, fee for technical service does not include consideration for construction, assembly and mining. Now, taxability. How to consider it as deemed to accrue or arise in India? All the 3 cases we are discussing interest, royalty, fee for technical service received by a non-resident. Non-resident receive panna enna agapodhu. If government is giving to a non-resident, then it is always deemed to accrue or arise in India. If a resident is giving to a non-resident, then it is deemed to accrue or arise in India, but there are 2 exceptions. 2 exception kuda illa, 1 exception e sollalam. Very, very simple. Enna exception? If the resident is using the interest, fee for technical service and royalty outside India, means outside India business pandradhukagayum use pannalam, they can use for business outside India, or they can also use for any other income outside India. If they are using outside India, then it is not deemed to accrue or arise in India. Then lastly, if a non-resident is paying interest, royalty, fee for technical service to another non-resident, generally it is not taxable, not deemed to accrue or arise in India. However, if the non-resident is using the money borrowed or fee for technical service or royalty for business in India, then it is deemed to accrue or arise in India. And in case of only fee for technical service and royalty, if the person is using for making any other source of income in India, then it is deemed to accrue or arise in India. Here only I told you to be careful about 1 point. What point? In case of money borrowed, that is taking a loan and paying interest. Okay, in case of money borrowed, if a non-resident is taking a loan from another non-resident using in India for earning any other source other than business income, then it is not deemed to accrue or arise in India. I gave you example. Mr. Trump borrowed 1 crore rupees from Mr. Biden to invest in Indian company shares and earn dividend. Okay, then interest paid on loan will not be deemed to accrue or arise in India, because business income kadayade, it is other source of income. Then last point, there is no territorial nexus required for interest, royalty and fee for technical service to be deemed to accrue or arise in India. It means what? It is not at all necessary that the non-resident should stay in India, the non-resident should receive it in India, or non-resident should have any place of business in India. Without that also it can be taxable in India, because we should not see the territorial nexus, we should see where the money is being used, or royalty or fee for technical service is being used. Okay, so with this, residential status also over. Now I want you to clap your hands, because who listen so patiently, continuous. Con-
Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the salary chapter for CA Intermediate Income Tax syllabus, and this will be part 1 of the video. Part 2 of the video, you will get it at the end of this video. You can just click there and see the part 2 of the video also. Now, before beginning the revision lecture, my request to you as usual is to like the video, leave a comment if you find this video helpful, and subscribe to this channel dear, because only if you subscribe you will get future updates from this channel and it will help you in your income tax preparation. And also share it with your friends as much as possible, because sharing is caring. Now let us start with the revision. So first and foremost, let us discuss the concept of salary. So salary arises only if there is employer-employee relationship. So if any amount is received by an assessee due to the employer-employee relationship, then it will be taxable under the salary head of income. Sir, what about salary to partners? Kanna, partners are nothing but part owners of the partnership firm. That is why when a partnership firm is giving salary to the partners, it will not be treated as salary, because there is no employer-employee relationship. When salary is received by partners, it will be taxable under PGBP head of income. Sir, what about salary received by member of parliament and member of legislative assembly? If member of parliament and member of legislative assembly are receiving the salary, then that is not employer-employee relationship, because they are the representatives. They only form the government. That is why when they are receiving the salary, it will be taxable under income from other sources. Now, next question. Sir, whether only full-time salary will be called as salary and part-time salary? Answer is whether it is full-time or part-time, both will be considered as salary if there is an employer-employee relationship. Okay. Sir, what about salary forgone? Sir, if I forgo my salary or if I vittu kuduttify my salary, then such salary forgone will also be taxable. So, for example, if I am telling my employer that you give my salary as donation to some charitable organization, even then, even though I did not receive the salary, still it will be taxable under my hands, because it is an application of income. You get my point? However, in certain cases, central government employees, if they are surrendering their salary, then it will not be taxable. If that special case is there, it will be mentioned in the question itself. You need not worry. Next. Sir, what about tax-free salary? Tax-free salary means what? Employer is paying the tax on the salary given to the employee. So employer himself is so nice that he is paying the tax on the salary also. Even the tax that the employer is paying is also a benefit given to the employee, and hence that will also be called as salary. However, tax paid on the non-monetary perquisites is exempt from tax. Okay. Now, sir, what about place of accrual? See, place of accrual we have already studied in residential status chapter. I told you that if a salary is received in India, it will be taxable in India as Indian income. If the salary is accruing or arising in India, then also it will be taxable in India. Then we also studied that if an Indian government is giving salary to an Indian citizen outside India, then also it will be deemed to accrue or arise in India and hence taxable in India. However, if there is any allowance or perquisite given by the Indian government to the Indian citizen outside India, then that will be completely exempt. All those provisions you have to link and then only study. Okay. Now let's talk about the charging section. The concept of salary is over. Now let us discuss charging section. Like every head of income, even salary head has a charging section and computation section. Charging section is given under section 15 and computation section is given under section 17. So what does the charging section say? Charging section says that salary is taxed on due or receipt, whichever is earlier. So if the salary is due first, then it will be taxed on due. If it is received in advance, then advance salary itself will be taxable. However, once the salary is taxable on due or receipt, later on it can again not be taxable. Hence, for only one amount, one time the assessee needs to pay the tax, double time the assessee need not pay the tax. Next, what is salary? Salary is nothing but the advance salary plus current salary plus arrears of salary. Advance salary, current salary, arrears of salary. All the three put together will be called salary. Now let us come to section 17, which is the computation section. Section 17 has three subsections. Subsection 1 speaks about salary, subsection 2 speaks about perquisites, and subsection 3 speaks about profit in lieu of salary. Firstly, let us see section 17 subsection 1, which speaks about salary. Basically, this section tells that all the different types of amounts that you are receiving from the employer will be called salary. It can be basic salary, it can be allowances, it can be retirement benefits like gratuity, provident fund, etc. So all those things are included in the salary definition. Wages, pension, all those things are included. Next, section 17.2 talks about perquisites. Now, what is perquisite, Kana? To learn perquisite better, we have to know the difference between allowance and perquisite. Firstly, let us see what is allowance. Allowance is a fixed amount given by the employer for a specific purpose. So, for example, my employer is giving me 2000 rupees per month for traveling expenses. This is called allowance. Okay, fixed amount for specific expense, and it does not matter whether I am spending the money or not. Okay, even if I'm not spending the money, still my employer is going to give me 2000 per month. This is called allowance. This is called allowance. Then what is perquisite? Perquisite is a benefit or a facility that is given to the employees. Okay, it can be in cash or it can be in kind, and perquisite will be considered only if the amount is spent by the employer or the employee, as the case may be. So it is not a fixed amount, it is a variable amount depending on what the benefit is given. So for example, if my employer is giving me a car, then it is called a perquisite. If my employer is paying the interest on my loan, then it will be called a perquisite. Like that, what and all benefits are given by the employer to the employee, it will be called as perquisite. So what is different between allowance and perquisite? Allowance will only be in cash. Perquisite can be in cash also, it can be in kind also. Allowance is a fixed amount given for specific purpose. Perquisite is not a fixed amount, it can be a variable amount. Allowance will be called as allowance whether it is spent or not spent. Still it will be called as allowance. But perquisite is called a perquisite only when it is spent or incurred. Okay. Now let us come to section 17 subsection 3, that is profit in lieu of salary. See Kana, there are 5 cases where there is profit in lieu of salary. It means all these 5 cases are generally not called as salary in the common language. However, in the Income Tax Act, it will be called as salary. So what is the first case? Compensation on termination of employment. So for example, I am telling the employee, you take 5 lakh rupees and you leave my organization. This is the compensation given for termination of employment. This is a capital receipt, but still, since it is mentioned here, it will be taxable under salary head of income. Next, compensation on modification in terms of employment. I gave you an example where I am the CEO of the company and now they want to make me the CFO of the company. So they want to bring my position down. So since they are making me the CFO, they are paying me 5 lakh rupees extra. Now this 5 lakh rupees will be called compensation in modification in terms of employment. That is also taxable under salary head of income. Next, any payment that is received from provident fund, gratuity fund, superannuation fund or any other fund, that is also taxable under salary head of income, because even that money is coming due to the employer-employee relationship. Next, keyman insurance policy. I have told you many a times about keyman insurance policy. So when keyman insurance policy maturity amount or withdrawal is received by the assessee, if the assessee is the employee, it will be taxable under the salary head of income. If the assessee is the employer, it will be taxable under PGBP head of income. And if the assessee is other than employer or employee, it will be taxable under income from other sources. Fine. Next, any lump sum consideration or otherwise before joining the employment or after cessation of employment. So before employment or after employment, if any lump sum amount is given to the employee, then that is also called as profit in lieu of salary and it will be taxable under salary head of income. I gave you an example of joining bonus. For example, I am giving a person 10 lakh rupees so that he will come and join my organization. This 10 lakh rupees will be called profit in lieu of salary and it will be taxable under the salary head of income. Okay, now let us talk about the different types of salary. See, we have finished the charging section and we have discussed briefly about the computation section. Now let us see what and all are the items, different items that are covered in salary. Firstly, let us talk about basic salary. Basic salary means what? It is the normal salary, that means periodic payment received from the employer. So monthly what amount is received by the employer, that will be called basic salary. Next, dearness allowance. Dearness allowance. First of all, what did I tell you? Allowance means any amount of fixed amount which is received for a specific purpose. Then what is dearness allowance? Dearness allowance is an allowance received to tackle the inflation. Because over a period of time the prices of the products increase. That is why this is called inflation. Now to tackle the inflation, the employer will give an allowance. This will be called dearness allowance. This dearness allowance is there, no kanna. It can be in terms or not in terms. In terms or not in terms. If dearness allowance is in terms, then generally it forms part of retirement benefits. Dearness allowance in terms forms part of retirement benefits. So in question they can give you dearness allowance in terms also, or they can tell you dearness allowance forming part of retirement benefits also. Both are one and the same. Okay, then dearness allowance can be not in terms. If it is not in terms, then generally it does not form part of retirement benefits. You get my point? Next, let us talk about fees. So if the employer is giving any fees to the employee, then if it is due to employer relationship, that also should be taxable under salary head of income. Next, let's talk about commission. There can be many types of commission that the employer is giving to the employee. However, we should differentiate the commission into two parts. First part is turnover commission. Second part is other than turnover commission. Turnover commission means what? It is a percentage of the turnover. That means if the turnover uh, done by the employee will increase, then the commission will also increase. If the turnover decreases, commission also will decrease. This is called turnover commission. And then all the remaining commission will be called other than turnover commission. Next, let's talk about bonus. See Kanna, bonus means what? It is an additional amount given to the employees, and bonus is always taxable only on receipt basis, not on due basis, only on receipt basis. Now let's talk about advance salary. Advance salary means what? Salary that is received in advance. If salary is received in advance, then it will be taxable then itself. You get my point? Because salary is taxable on due or receipt, whichever is earlier. However, you have to know the difference between advance salary and advance against salary. What did I say? Advance salary and advance against salary. Advance salary means what? Salary received in advance. Then what is advance against salary? Advance against salary means it is a loan given by the employer to the employee, but if the employee is unable to repay the loan, then such loan will be set off against the salary. This is called advance against salary. Hence, if there is advance against salary, no, that you should not add to the salary head of income. That is a loan received by the employee. So you should treat it accordingly. However, if there is advance against salary, one thing you should keep in mind. What is that? That if at all there is no interest or very less interest charge on such advance, then perquisites may arise. That we are going to learn when we are learning the perquisite concept. Okay. Next, arrears of salary. Arrears of salary. Arrears of salary means what? Salary of the past period that is received now. Okay, but if it was taxed then itself, then no need to tax it now. However, then it was, if it was not considered as income, then you consider it as income now. Fine. So what is arrears of salary? Disputed salary or retrospective salary that is received now. If it is already taxed, no need to tax now. If it is not taxed already, then you should tax now. Fine. Now let us talk about deductions. Deductions. There are three deductions, Kanna. All the three deductions are given under section 16. However, remember one point. The section 16 deductions are not allowed in the new tax regime. It is only allowed in the old tax regime.
In section 16, there are three deductions, correct? One is the standard deduction of 50,000 rupees, then entertainment allowance, and the third one is professional tax. We had discussed earlier that all the three deductions were available only in the old tax regime and not under 115 BAC. But now there is a change. What change? The standard deduction will now be available to the new tax regime also. So standard deduction is allowed in both old as well as new. So firstly, what is the deduction? First deduction is standard deduction. So what is the standard deduction? 50,000 rupees or actual salary, whichever is lower. 50,000 or actual salary, whichever is lower. Next deduction is entertainment allowance.
entertainment allowance is the allowance given to the employees for hospitality of the customer. So if VIP or any guest is coming, then to entertain such guest, the allowance is given. This is called entertainment allowance. Now, first and foremost, what you have to do, if entertainment allowance is received by the employee, then you should add it to the salary because it is an allowance, correct? So you should add it to the salary. After that, if it is a government employee, then you can claim deduction. If it is not a government employee, then you cannot claim deduction. But for government employee, what will be the deduction? The deduction will be lower of three amounts. The lower of three amounts. First amount is 1/5 of the basic salary. Second amount is actual entertainment allowance received. And third amount is 5,000 rupees per annum, whichever is lower. So 1/5 of basic salary, entertainment allowance actually received, or 5,000 rupees, whichever is lower, will be allowed as deduction. Now let us talk about professional tax. Kanna, what is professional tax? Professional tax is a tax on employment that is levied by the state government. Generally, it is a maximum of 2,500 rupees. Now, if professional tax is paid by the employer, if professional tax is paid by the employer, then first add it to the salary and later on claim it as a deduction. Okay. However, if professional tax is directly paid by the employee, then directly claim it as deduction. No need to add to the salary. Okay. Entire professional tax can be claimed as deduction. You get my point. Now we have discussed the deduction. Now let us come to retirement benefits. The different types of retirement benefits. So first retirement benefit that we are going to discuss is gratuity. It is what? Gratuity. So what is gratuity? Gratuity is a voluntary payment that is received in appreciation for employees' services. So if employee is working for 5 years or 10 years in an organization, then the employer happily gives him a lump sum amount. This is called gratuity. But nowadays, gratuity is not voluntary. Now it has become mandatory. Okay. Now, how to tax gratuity? Let us see. Generally, gratuity should be added to the salary because it is a benefit received due to employer-employee relationship. However, exemption is available under section 10 clause 10. Exemption is available under section 10 clause 10. Now what does 10 clause 10 say? Firstly, if at all the gratuity amount is received during service, that is during the employment period, then it is fully taxable. Then when will the exemption come? The exemption will come only if the gratuity is received on death, retirement, termination of service, resignation, and incapacitation. Death, retirement, termination, resignation, or incapacitation. Only then the gratuity will be exempt. Now, how to calculate the exemption? Firstly, you have to see whether the employee is a government employee or not a government employee. If the government employee is receiving the gratuity, then it is fully exempt. If other than government employee is receiving the gratuity, then you should see whether the employee is covered under Payment of Gratuity Act or not covered under Payment of Gratuity Act. If the employee is covered under Payment of Gratuity Act, then how to calculate the exemption? Let us see. Firstly, you have to calculate three amounts, and the lower of the three amount will be the exemption. So first amount, how to calculate? 15 divided by 26 multiplied by salary per month into number of years of service rounded off. What did I say? 15 divided by 26 into salary per month into number of years of service rounded off. Now what is this salary? Salary means basic plus DA terms. Basic salary plus DA, not DA terms. Basic salary plus DA. That is the salary definition. Okay. So 15 divided by 26 multiplied by basic salary plus dearness allowance multiplied by number of years of service rounded off. Now about this rounded off, I told you a special concept, that if there is exact 6 months, so for example 10 years and 6 months, then logically you should round off to what? You should round off to 11 years. But in Income Tax Act, if it is exactly 10 years and 6 months, then you have to do lower rounding. Lower rounding means what? You have to write it as 10 years only. However, if it is 10 years and 4 months, then what you will write? You will write it as 10 years. And if it is 10 years and 7 months, then what you will write? You will write it as 11 years. Okay. So other than exact 6 months, normal rounding will apply. But if it is exact 6 months, then you have to do lower rounding. That is the concept in the income tax law. So number of years of service you have to round off. Fine. One second. So how to calculate the gratuity exemption? If the employee is covered under Payment of Gratuity Act, then number 1, 15 divided by 26 multiplied by basic salary plus dearness allowance per month. And what salary you should take? You should take the latest salary, okay, multiplied by number of years of service, round off. So you should take the number of years of service and you should round it off. Then second amount is actual gratuity received, and third amount is 20 lakh rupees, whichever is lower. It will give you the exemption. Balance amount will be taxable. Fine. Now let us see, what if the employee is not covered under Payment of Gratuity Act. If an employee is not covered under Payment of Gratuity Act, then the exemption will be lower of the three terms. First amount is what? 1 by 2. 1 by 2 into average salary multiplied by number of years of service completed. 1 by 2 into average salary multiplied by number of years of service completed. Now here, what is salary? Here the salaried meaning changes. The salary is basic salary plus DA terms plus commission turnover. Basic salary, DA terms, commission turnover. And here you should not take the latest salary. You should take the average salary. How to find out the average? To find out the average, you have to take the 10 months preceding the month of retirement. 10 months preceding the month of retirement. So for example, if the retirement has happened on 11/11/2022, then how to calculate the 10 months? It will be from 1/1/2022 to 31/10/2022. 31/10/2022. So from the 11 you have to come to the preceding month, and the 10 months preceding the month of the retirement you have to see what is the salary received, then find out the average salary per month. So what will be the amount? The total salary that is received from January till October divided by 10. Okay, you will get the average salary. And here listen, here it is given that it is number of years of service completed. Number of years of service completed means what? One second. Number of years of services completed means what? That if there is any fraction, you should ignore the fraction. If there is any fraction, ignore the fraction. So if even if it is 10 years and 11 months, it will be considered as what? It will be considered as 10 years only, because only 10 years is completed. Fine. Now how to calculate the exemption? Let us see once again. If the employee is not covered under Payment of Gratuity Act, then number 1, find out 1 by 2 multiplied by average salary. And here salary means basic plus DA terms plus commission turnover multiplied by number of years of service completed. Okay. Second amount will be actual gratuity, and third amount will be 20 lakh rupees. Whichever is lower will be the exemption. Balance amount will be the taxable amount. Okay. Now let us discuss some special points. What are special points? If retirement gratuity is received by the members of defense, then it is completely exempt. Next, if gratuity is received from 2 or more employers, or if already some gratuity has been exempt, then already received exemption should be reduced from the limit. So what I am trying to tell, that in the entire lifetime the employee can only claim a maximum of 20 lakh rupees as exemption. So if already, let's say, he has claimed 4 lakhs as exemption, then maximum how much he can claim now? 20 minus 4, that is 16 lakhs. You get my point? Okay. Now let us discuss pension. What is pension? Pension is periodic payment received for past service. Periodic payment received for past service. Generally, pension is received in annuity form. Annuity form means what? Monthly, monthly, or quarterly, quarterly, or yearly, yearly. That is in regular intervals. However, if the pension is received in annuity form, it will be fully taxable. It will be fully taxable. Then when can we claim exemption on pension? We can claim exemption on pension only if there is commutation. Only if there is commutation. Commutation means what? If an employee gives up a part of the pension or the entire pension to receive a lump sum amount, then it is called commutation. For example, if employee is giving up 25% of the pension of 2000 rupees per month, okay, and he is receiving how much? 30,000 rupees lump sum amount. This is called commutation. This is called commutation. So look here, if commutation of pension is there, then exemption is available under section, one second. If commutation of pension is there, then exemption is available under section 10 clause 10a. 10 clause 10a. How to calculate the exemption? Firstly, you have to see whether the employee is receiving gratuity or does not receive gratuity. If the employee is receiving gratuity, then what will be the exemption? Exemption will be full pension multiplied by 1 by 3. Full pension multiplied by 1 by 3. Sir, what is this full pension? Kanna, full pension means if you give up the entire pension amount, how much lump sum you will receive, that is called full pension. See here, in the example that I told you, if 25% of the pension is given up, 30,000 rupees is received, correct? So, if 100% is given up, how much will be received? Answer is 30,000 divided by 25%, that is 1,20,000. So, this 1,20,000 only will be called as full pension. This 1,20,000 is called full pension. So how to calculate full pension? Full pension is equal to commuted pension Full pension is equal to commuted pension multiplied by commutation percentage. Commuted pension multiplied by commutation percentage. Okay, so if the employee is receiving gratuity, then exemption will be full pension into 1 by 3. If employee does not receive gratuity, then the exemption will be full pension multiplied by 1 by 2. Okay, and now let us see some special points about pension. Firstly, if any commuted pension is received from the annuity plan of LIC, that is Life Insurance Corporation, it is fully exempt. Next, if any commutation pension is received by a High Court or Supreme Court judge, then also it is fully exempt. Okay, and here be very careful. In commutation of pension, there is no concept of salary definition. While calculating, there is no concept of salary definition at all. You just have to see full pension and you have to calculate 1 by 3 or 1 by 2 as the case may be. Fine. Now let us talk about leave encashment. Leave encashment means what? Encashment of leave that is not availed. So for example, if employee is getting, let's say, 30 days per year 30 days per year as leave, but he has taken leave of only 12 days. Okay, so balance how much? Balance is 18 days leave he has not taken. Now if the employer is very happy that he has not taken leave for 18 days, so for this 18 days he is giving extra salary. This extra salary is only called leave encashment. Hence, we have to see how to treat the leave encashment. If leave encashment is received during the employment, then it is fully taxable. Now, what about retirement? If leave encashment is received on retirement, then exemption is available under section 10 clause 10AA. How to calculate the exemption? Firstly, you have to see whether it is a government employee or not. For a government employee, entire amount is fully exempt. Entire leave encashment is fully exempt. Then what about other employees? For other employees, you have to calculate the lower of 4 items. First item is what? 10 months multiplied by average salary per month. 10 months multiplied by average salary per month. Here what is the salary? Here also salary is basic salary plus dearness allowance in terms plus commission turnover. Basic plus DA terms plus commission turnover. Now here how to find the average? Generally I told you before that average means average before the month of retirement, but in this section average means average before the date of retirement. So for example, see here, and here also average is average of 10 months. Okay, so for example, if an employee is retiring on 11/11/2022, then for what period you have to find the average? From 1/11/1/2022 till 11/11/2022, that is 10 months. So see the salary received during this period and divide it by 10 months, you will find out the average. After finding the average, you have to multiply it by 10, you will get the first amount. Then what is the second amount? Second amount means leave equivalent divided by 30 multiplied by average salary. Leave equivalent multiplied by 30 divided by 30 multiplied by average salary. Now how to calculate leave equivalent? Leave equivalent is equal to earned leave minus actual leave. Earned leave minus actual leave. However, make sure that if the earned leave is above 30 days per year, then reduce it to 30 days per completed year. Reduce it to 30 days per completed year. Only maximum that much earned leave you have to take. Balance amount will be actual leave. Earned leave minus actual leave will give you leave equivalent. Then how to calculate the amount? Leave equivalent divided by 30 into average salary. Then third amount will be actual leave encashment. Fourth amount is 3 lakh rupees. You have to see whichever is lower, that will be allowed as exemption. Balance amount will be taxable.
Next change is there in leave encashment. In leave encashment, earlier the limit was 3 lakh rupees, that is in section 1010AA. It was 3 lakh rupees. Now that limit has been increased to 25 lakh rupees. Okay.
Now let's talk about voluntary retirement scheme or VRS. VRS or voluntary retirement scheme. Now what is voluntary retirement scheme? Amount received on voluntary retirement. So an employer will tell that I am offering you 5 lakh rupees. If you want, you can take this 5 lakh rupees and voluntarily you can retire from my organization. This is called voluntary retirement. Now for the voluntary retirement, exemption is available under section 10 clause 10C. However, if the exemption has to be claimed, then the undertaking giving the voluntary retirement should be eligible undertaking and all the conditions must be satisfied. If the undertaking is not an eligible undertaking or conditions are not satisfied, then the VRS amount will be fully taxable. Okay. Now let us see what is an eligible undertaking. Eligible undertaking means generally any company, cooperative society, central government, state government, local authority, IIT, IIM, government university, etc. Then what are the conditions? Condition number 1. The employee who is receiving the voluntary retirement scheme amount should complete at least 10 years of service, or he should at least have 40 years of age. At least 10 years of service or 40 years of age. However, this condition alone is not applicable to PSU, that is public sector undertaking. Next condition, director of company or cooperative society are not eligible for exemption. Number 3, the purpose of the VRS should be overall reduction in the strength of the employees. Condition number 4, vacancy from the VRS should not be filled up. So if any employee is taking the VRS and leaving the organization, on behalf of that employee, I should not employ some other person in his post. That post should remain vacant. Then retiring employee shall not be employed in any other concern with the same management. So if an employee is taking the VRS amount and leaving the organization, I should not hire him in any other organization also where I am doing the management. Okay. Next, only up to the prescribed limits. This prescribed limits only we are going to learn now. So all these conditions only if they are satisfied, only then exemption is available under VRS scheme. Okay, that is 1010C. However, if in questions it is not clear whether the undertaking is an eligible undertaking or whether the conditions are satisfied or not, then you assume that the undertaking is eligible and conditions are satisfied and you do the calculation. Okay, so how to do the calculation? You have to calculate 4 amounts. Out of the 4, whichever is lower will be the exemption, balance amount will be taxable. So first amount will be what? Salary per month multiplied by 3 months multiplied by number of years of service completed. So what is the salary? Here also salary means basic salary plus DA terms plus commission turnover. So what is it? Basic salary plus DA terms plus commission turnover. It is the salary per month. You have to take multiply into 3 months multiplied by number of years of service completed. Next, second amount, how to calculate? Salary, that is basic salary plus DA terms plus commission turnover multiplied by balance months of the service left. Then number third one is actual VRS on number 5, 5 lakh rupees, whichever is lower. So whichever is lower will be exempt, balance amount will be taxable. Now listen carefully. VRS exemption is a once in a lifetime exemption. So if once an employee has claimed the VRS exemption earlier, it will not be allowed once again. Now let us talk about retrenchment compensation. Retrenchment means what? Compulsorily, it is the reduction in the number of employees. The employees are not getting the choice. They are asked to leave the organization forcefully. Since the employees are leaving the organization forcefully, there is an act called Industrial Disputes Act of 1947, and that act tells that the employer must give a compensation to the employee. Hence, for this compensation that is received by the employee, exemption is available under section 10 clause 10b. How to calculate the exemption? Number 1, compensation as per the Industrial Disputes Act. Number 2, actual compensation received by the employer. Or number 3, 5 lakh rupees, whichever is lower will be exempt, balance amount will be taxable. Okay. Now let us talk about provident fund. Provident fund. So what there are four types of provident fund, Kanna. First provident fund is recognized provident fund, then unrecognized provident fund, third one is statutory provident fund, and fourth one is public provident fund. Sir, what is recognized provident fund? Recognized provident fund means a provident fund that has satisfied the conditions that are given in Employee Provident Fund and Miscellaneous Provisions Act of 1952, and the Income Tax Commissioner has given recognition. Income Tax Commissioner has given recognition. Then what is unrecognized provident fund? A provident fund that is not recognized by Income Tax Commissioner. Then what is statutory provident fund? Statutory provident fund is a provident fund which is governed by the Provident Fund Act of 1925, and generally it applies to government employees. So where the government employees are there, they are depositing their amount in the statutory provident fund. Next, what is public provident fund? Public provident fund is a provident fund for the people who are not the employees. It is for self-employed people. So where there is no employer-employee relationship, there public provident fund will arise. So let's say I am not an employee of an organization, still I can contribute my money in public provident fund. It is governed by Public Provident Fund Act of 1968. Okay. Now what is superannuation fund? Superannuation fund is also a retirement benefit like a provident fund only. Superannuation fund also can be approved or unapproved. Approved means what? It is approved by Income Tax Commissioner. Unapproved means it is not approved by Income Tax Commissioner. Now all these funds are there. No, let us see how to treat these funds. First and foremost, let us discuss about different parts. What are the parts that we are going to discuss? Firstly, we are going to discuss about employer contribution, then we will discuss employee contribution, then interest received during in the fund, and then maturity amount. Maturity means what? The withdrawal from the fund. Okay, so firstly let us talk about statutory provident fund. In a statutory provident fund, when the employer is contributing, then the entire contribution is fully exempt but subject to section 17(2)(7). Subject to section 17(2)(7). What is 17(2)(7)? We are going to learn in a little while. Okay, so employer contribution fully exempt, then employee contribution you have to ignore. Why to ignore employee contribution? Because see Kanna, when employee is giving contribution to the fund, he is giving from his own pocket, so it is not an income. That is why you ignore the amount, because it is application of income. However, there is a section called section 80C that we are going to learn in the deduction chapter. There we will learn that in section number 80C, the employee contribution is allowed as deduction. Fine. Next, let's talk about interest. So if any interest is credited in the statutory provident fund, it is fully exempt, and even the maturity amount is fully exempt under section 10 clause 11. Section 10 clause 11. But this is also subject to another section that we are going to learn in some time. So now let us talk about recognized provident fund. In recognized provident fund, no Kanna, the employer contribution is there, no, up to 12% of the salary it is exempt. More than 12% of the salary if it goes, then the excess amount will be taxable in that year itself as taxable perquisites. Now what is salary? Salary here also it means basic salary plus DA terms plus commission turnover. Basic salary, DA terms, commission turnover. Okay, so up to 12% of the salary exempt. More than 12% means what? The excess amount is going to be taxable, and this also exemption is subject to section 17(2)(7), which we are going to learn in some time. Now what about employee contribution? Employee contribution you should ignore because it is an application of income. However, deduction can be claimed for employee contribution under section 80C. Okay. Next, if the interest is up to 9.5% per annum, it is fully exempt. However, if it is above 9.5% per annum, it will be taxable. Okay, during that year itself. Next, maturity amount is also exempt under section 10 clause 12. However, there is a condition. Recognized provident fund maturity will be exempt only if the employee is a member of that recognized provident fund at least for 5 years. At least for how many years? 5 years. If within 5 years if the amount is withdrawn, then it will be fully taxable, and even that recognized provident fund will deduct the TDS, that you should link in TDS chapter. They will deduct the TDS and balance amount only they will pay to the employee. Okay. Now for this 5-year rule, no, there are certain exceptions. It means if the employee is covered in the exception, then he need not see that 5-year rule. It will still be exempt. So what are the exception? Number one, if the funds are transferred from the old employer's recognized provident fund to new employer's recognized provident fund, then you need not see the 5-year rule. If the amount is transferred from old employer's recognized provident fund to the new employer's NPS, that is National Pension Scheme under section 80 CCD, then also you need not see this 5-year rule. And second part, if any of the three conditions are satisfied, then also you need not see the 5-year rule. What are the three conditions? Number one, due to ill health. If due to ill health of the employee, if the employee has to leave the organization. Number two, if due to discontinuance of employer's business, he is withdrawing the money from the recognized provident fund. And number three, due to any other reason beyond the control of the employee, if he is receiving the money from the recognized provident fund. In such case, you need not consider the 5-year rule. Even if the withdrawal is within 5 years, it will be fully exempt. Okay, but other than these conditions, you have to see the 5-year rule. If it is within 5 years, it will be exempt. It will be taxable. If it is after 5 years, it will be exempt. Okay. Now, let us talk about unrecognized provident fund. In unrecognized provident fund, if employer is contributing, it is not taxable. If employee is contributing, you have to ignore since it is application of income. And unrecognized provident fund is there, no? In that, if employee is contributing, then also he will not get the deduction under ATC since it is unrecognized. Next, interest also is not taxable. However, maturity amount is taxable. The maturity amount or the withdrawal amount, you have to divide it into 4 parts. What are the 4 parts? Employer contribution, employee contribution, interest on employer contribution, and interest on employee contribution. Now listen, employer contribution and interest on employer contribution will be taxable under the salary head of income in the year of maturity or in the year of withdrawal. Then employee contribution will not be taxed because it is an application of income. And then interest on employee contribution will be taxed under income from other sources head of income. You get my point? Now listen, even for recognized provident fund, if the 5-year rule is not satisfied and also if the assessee is not there in the any of the conditions, then what will happen? I told you that the amount will be taxable. How to tax the amount? The amount is taxable just like the unrecognized provident fund. Recognized provident fund amount will be taxable just like the unrecognized provident fund if the 5-year rule is not followed. You get my point? However, if any amount is already taxed, it will not be taxed once again. Okay. Next, public provident fund. See, in public provident fund nokana, employer contribution will not apply at all because there is no concept of employer-employee relationship for PPF. Next, what about employee contribution? See, if I am contributing to the public provident fund, then you have to ignore the contribution since it is an application of income. However, I can claim a deduction under section 80C. Next, interest on PPF is fully exempt and maturity amount is also fully exempt from tax. Now let us talk about approved superannuation fund. In approved superannuation fund also, the employer contribution is fully exempt subject to section 17(2)(7), which we are going to learn in some time. Then employee contribution you can ignore. Interest on employer contribution or employee contribution is fully exempt and even maturity amount is exempt under section 10 clause 13. Then unapproved superannuation fund is taxable the same as unrecognized provident fund. So for both of them you have to treat the same way. You get my point? Sir, now let us talk about section 17(2)(7). What does section 17(2)(7) say? The section 17(2)(7) says that aggregate of the amount of employer contribution to any of the following funds in excess of 7.5 lakh rupees will be considered as perquisite. So if employer is contributing more than 7.5 lakh rupees to recognized provident fund, NPS, that is National Pension Scheme or new pension scheme, or new pension system trust, whatever the name may be, if it is contributed, or approved superannuation fund, then if the total amount is more than 7.5 lakhs, it will be taxable. Greater than 7.5 lakhs, it will be taxable. What will be the taxable? Excess amount will be taxable, Kanna. What will be taxable? Excess amount will be taxable. One second. Excess amount will be taxable. So for example, if the employer is contributing, listen here, if the employer is contributing 5 lakh rupees to recognized provident fund and then 5 lakh rupees to approved superannuation fund, then both of them together is how much? 10 lakh rupees. It is 10 lakh rupees. Is 10 lakh greater than 7.5 lakhs? Answer is yes. So the balance amount, that is 2.5 lakhs, will be taxable. This will be taxable. Okay, so if amount or aggregate of amount in recognized provident fund, NPS under section 80 CCD, and number 3 approved superannuation fund, if it is exceeding 7.5 lakh rupees, then the excess amount will be taxable during the year. Okay, and not only this, the interest that is received on this excess amount is there, no, this 2.5 lakh rupees, on this 2.5 lakh rupees, if any income is received, if any income is received, one second, then such income also will be taxable. Now how to calculate the income? See Kanna, in section 17 to 7a it is given that on such amount, that is amount over 7.5 lakh rupees, whatever income is received, that also will be taxable. Now how to calculate that income? How to calculate that income? Let us see. To calculate that income, the Income Tax Act has given you formula. What is the formula? Formula is given under Rule 3B. Rule 3B. So what is the formula? TP is equal to PC divided by 2 multiplied by R into, plus PC1 plus TP1 multiplied by R. What did I say? TP. What is TP, Kanna? TP means taxable perquisite. TP means taxable perquisite. What is PC? PC means contribution. Okay. PC means contribution during the year. Contribution during the previous year, which is in excess of 7.5 lakh rupees. PC means what? Contribution during the previous year, that is in excess of 7.5 lakh rupees. Then what is PC1? PC1 is the contribution in excess of 7.5 lakh rupees in all the previous years on or after 1/4/2020. PC1 means what? The contribution to the funds. What are the funds? The recognized provident fund, approved superannuation fund, and NPS. In all these three funds, if the contribution is more than 7.5 lakh rupees in all the preceding previous years on or after 1/4/2020, then it will be called as PC1. It will be called as PC1. Then what is TP1? TP1 will be the taxable perquisites of all the preceding previous years that would have been calculated. Now what is R? R is equal to I divided by F average. I divided by F average. Now what is I? I means income. I means income. Income from all the three funds during the previous year. I means income from all the three funds during the previous year. Then what is F average? F average means what? Fund average. F average means fund average. Fund average means opening balance of all the three funds combined plus closing balance of all the three funds combined divided by 2. So F average means what? Opening balance of all the three funds combined. What are the three funds? Recognized Provident Fund, NPS, and approved superannuation fund. All the three funds combined, what is the opening balance plus closing balance divided by 2. Like that you have to find the F average. So now let me repeat the formula. How to calculate the taxable perquisite? Taxable perquisite is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. Okay, like this you have to find out the taxable perquisite. If you are solving one question that is there in the study material relating to this concept, you will be even more clear. Okay, now let us talk about one more section. And what is the section? Now this section relates to employee contribution. First we were talking about employer contribution, that is more than 7.5 lakh rupees. Now there is one more section which talks about employee contribution, and it says that if the employee is contributing in the provident fund, if the employee is contributing in the provident fund and if the employee contribution is more than 2.5 lakh rupees, then the amount that is more than 2.5 lakh rupees, no, on that whatever income is received, that will be taxable. So listen here, if at all an employee is there, okay, an employee is contributing 4 lakh rupees, 4 lakh rupees to provident fund. This is called employee contribution. Can employee contribution be taxable? Never. Employee contribution will never be taxable because it is an application of income. Now what am I talking about? I am talking about the interest on employee contribution. So listen here, on this 4 lakh rupees, okay, on the first 2.5 lakh rupees you will receive an interest, and the balance 1.5 lakh rupees you will receive an interest. On the first 2.5 lakh rupees, whatever you receive as interest will be exempt, which we have already studied. Then on the balance 1.5 lakh rupees, whatever interest is received, that will be taxable. That will be taxable as perquisites. Okay, it will be taxable. So now, so what did I tell? If the employee is contributing more than 2.5 lakh rupees to a provident fund, then income on such excess contribution will be taxable. However, this limit of 2.5 lakh rupees will become 5 lakh rupees if there is no employer contribution. So listen here, in this example that I told you, I am assuming that there is some employer contribution. If in the same example, if the employer is not contributing any money, then the limit will become how much? The limit will become 5 lakhs. In such case, this entire 4 lakhs is there, no? On this, the income will be exempt since it is within 5 lakhs. So what did I tell? See, listen one more time, very, very important provision. If the employee is contributing more than 2.5 lakh rupees, then income on such employee contribution will be taxable. However, if there is no employer contribution, then this limit of 2.5 lakh rupees will become how much? It will become 5 lakh rupees. It will become 5 lakh rupees. And this provision has been applicable from 1/4/2021. From 1/4/2021. Before this, entire amount used to be exempt, but from 1/4/2021 it is taxable. So now the employee has to maintain two accounts. What are the two accounts? Taxable contribution account and non-taxable contribution account. In taxable contribution account, what and all will come? From 1/4/2021 onwards, whatever is the employee contribution that is more than 2.5 lakhs or 5 lakhs as the case may be, that will be coming under taxable contribution account, and interest on such amount also will be coming under taxable contribution amount. Then whatever is the balance amount will be coming under non-taxable contribution account. So this is taxable and non-taxable contribution account as per rule 9D. So employee should start maintaining both these accounts from previous year 21-22 onwards for the employee contribution. So I hope you are clear with the provident fund concept. And even this provident fund concept, you have to be very, very thorough because it will be linked even with the deduction chapter, that is under section 80C, and also 80CCD, the new pension scheme that you are learning. And then in PGBP also we have learned from the employer point of view that what and all amount the employer is paying will also be allowed as deduction subject to certain rules and conditions that are given in the PGBP chapter. So I hope you are clear with all the retirement benefits. You are clear. Now let us talk about allowances. Now let us talk about allowances. So in allowance is there, no Kanna? What did I tell you? Allowance means a fixed amount received for a specific purpose. Now in allowances there are three types of allowance: fully exempt allowance, partly exempt allowance, and fully taxable allowance. Now fully exempt allowance means what? First and foremost, any allowance given to High Court or Supreme Court judge will be fully exempt. Then sumptuary allowance given to High Court or Supreme Court judge will be fully exempt. Then Compensatory allowance given to judge as per Article 222 of the Constitution will be fully exempt. Then any allowance, salary or perquisite, whatever, if it is given by United Nations organization, that will be completely exempt. Then Section 10 Clause 7 says that if perquisites and allowances are given by an Indian government to an Indian citizen outside India, then it is fully exempt. And then if some specific allowances are given to present or retired members of the UPSC, then also it is fully exempt. Then what about taxable allowances? See Kana, we are going to learn about fully exempt and partly exempt allowances. All the remaining allowances will be fully taxable. Hence I am not discussing fully taxable allowances. Now let us discuss partly exempt allowance. Partly exempt allowance is given under section 10 clause 14 and 10 clause 13a. First let us discuss section 10 clause 13a. Section 10 clause 13a discusses about house rent allowance, that is HRA. However, remember one point, section 1013a, that is house rent allowance exemption, it is not allowed to an employee who is choosing section 115 BAC. So in new tax regime this exemption is not allowed. Now let us talk about what about the old tax regime? The old tax regime can claim exemption under section 10 clause 13a. How to calculate the exemption? Number 1, 40% or 50% of the salary. 40% or 50% of the salary. 40% in case of non-metro city, 50% in case of metro city. What is metro city? Mumbai, Delhi, Chennai, Kolkata. Okay. Then how to calculate the salary? See here also salary means basic salary plus DA terms plus commission turnover. Basic salary, DA terms and commission turnover. And for what period you have to take the salary, Kanna? You have to take for the period for which the employee is staying in that rented accommodation. The period for which employee is staying in the rented accommodation. Then second amount will be actual HRA received, and third amount will be rent paid minus 10% of the salary. Then you have to see whichever is lower, it will be allowed as exemption. Balance amount will be taxable. Okay. Now let us come to section 10 clause 14. In section 10 clause 14, firstly let us discuss section 10 clause 14 subclass 1. Section 10 clause 14 subclass 1 tells that any allowance that is received, okay, if the amount is spent for official purpose, then whatever amount is spent for official purpose will be fully exempt. Whatever amount spent for official purpose will be fully exempt. So for example, if I am getting an allowance of 10,000 rupees and 8,000 rupees I have spent for official purpose, then 8,000 will be exempt, balance 2,000 will be taxable. Now what are the allowances covered in this section? Let us see. Firstly is conveyance allowance. Conveyance allowance. Conveyance allowance means what? Within the city if I am traveling, then it is called conveyance. Allowance received for conveyance is called conveyance allowance. Next, uniform allowance. Uniform allowance is the allowance given to stitch uniform. Number 3, research allowance. Research allowance is an allowance given by educational or research institution for research or training purposes. So amount received for research or training will be called research allowance. Next, daily allowance. Daily allowance means what? If I am going out of town, if that out of town, if I am spending for food and stay etc., for that whatever allowance that I am getting, it is called daily allowance. Then helper allowance. Helper allowance means if my employer is giving me allowance to keep a helper, and this helper should only be for official work, okay, then such allowance is called helper allowance. And then last one is traveling allowance. Traveling allowance means if I am traveling from one city to another city, for that travel ticket if I am getting an allowance, then such allowance is called traveling allowance. So what are the 6 allowances? Conveyance allowance, uniform allowance, research allowance, daily allowance, helper allowance and travel allowance. All these 6 allowances, if I am spending for official purpose, entire amount spent will be allowed as exemption. Balance amount will be taxable. Balance will be taxable. Okay. Next, let us talk about section 10 clause 14 subclass 2. See, in section 10 clause 14 subclass 2 Nokana, there is a minor difference. What is the difference? Here, the exemption does not depend on whether you are spending the money or not spending the money. It is dependent on the limit. Okay, it is dependent on the limit. So, how much ever limit is there, that much exemption will be given. If the income is above the limit, then the balance amount will be taxable. See, for example, if I am getting tribal area, scheduled area or agency area allowance, then limit is what? 200 per month. So if I'm getting an allowance of 500 per month, if let's say I'm getting an allowance of 500 per month, then if I'm getting an allowance of 500 per month, then 200 will be exempt and balance 300 will be taxable. 200 will be exempt, balance 300 will be taxable. You get my point. Next, transport system allowance. Transport system allowance means what? It is a daily allowance given to transport system employees. Who are transport system employees? An employee who is working in the transport system like bus or trucks or railways, etc., etc. If the employees are working in transport system, they will receive transport system allowance. The transport system allowance, how to calculate the exemption? Exemption is 70% of the allowance or 10,000 per month, whichever is lower. Balance amount will be taxable. Okay. However, remember one point: if a transport system employee is receiving daily allowance also, in such case transport system allowance will not be exempt. Okay. Next, let's talk about transport allowance. What is transport allowance? Transport allowance is the allowance given for traveling from home to workplace, workplace to home, home to workplace, workplace to home. This exemption is only given to specially abled people. Who are the specially abled people? Blind, deaf, dumb and handicapped. Blind, deaf, dumb and handicapped people get the benefit of exemption of rupees 3200 per month. Maximum how much? 3200 per month. All the others, it is fully taxable. Okay. Now let's talk about underground allowance. Means allowance given for the employees for going underground. For example, in mining, etc. So the allowance is 800 rupees per month. Exemption is 800 per month. If it is more than 800, excess amount is going to be taxable. Next, children education allowance. It is an allowance given for the education of the child of the employee. It is exempt up to 100 per month per child, maximum 2 children. Next, hostel allowance for children is exempt for up to 300 per month per child, maximum 2 children. Now let's talk about hilly area allowance. Hilly area allowance is a allowance given based for the hilly area, hilly regions, and it depends on the hilly region how much allowance is given. Now let's talk about the allowances for given to the armed forces like the RB, Navy, Air Force, CRPF, etc., etc. If they are getting island duty allowance, that means going to island and doing the duty, then maximum 3250 per month is exempt. Next, high altitude allowance. If the armed forces are going to a high altitude and doing the duty, for example Ladakh, etc., then if the height is within 9,000 to 15,000 feet above sea level, then 1060 per month will be the exemption, maximum exemption. And if the height is above 15,000 feet, then the maximum exemption will be 1600 rupees per month. Next, if the armed forces is receiving border area, remote area or disturbed area allowance also, then also depending on the area, exemption can be claimed. Next, compensatory field area allowance. Compensatory field area allowance exemption is given up to 2600 rupees per month. For compensatory modified field area allowance, exemption given is up to 1000 rupees per month. For special compensatory highly active field area allowance, okay, the compensation is up to, the exemption is up to 4200 rupees per month. For counter insurgency allowance, the exemption is up to 3900 rupees per month. So all these limits are there, and this compensatory modified, special compensatory and counter insurgency allowance, for all these four allowances, that is the last four allowances, exemption is not available if border area allowance is claimed as exemption. If border area allowance is claimed as exemption. So these are the exemptions that are there in section 14, section 10, clause 14, subclause 2. Now let's talk about a special point. In the new tax regime under section 115 BAC, all these allowances under section 10 clause 14 are not allowed. However, four allowances are still allowed. What are the four allowances? Daily allowance, conveyance allowance, traveling allowance and transport allowance. Daily allowance, conveyance allowance, traveling allowance and transport allowance are applicable or are exempt for new tax also, old tax also. For both of them, exemption can be claimed. All the remaining allowances, exemption can be claimed only if the employee is choosing old tax. For the new tax under 115 BAC, it is not applicable. So I hope you are clear with the allowances. So we have discussed so many concepts in this video: concept of salary, charging section, okay, computation section. Then we discussed the different types of salary. Then we discussed the deductions, retirement benefits, and also the allowances. I hope you are clear with the concept. The perquisites part and the remaining concept we will discuss in part number 2. So see you in part number 2, dear. Keep learning, keep revising. Take care. Bye bye. Hello everyone, I am CA Prateek and you are watching the second part of the revision lecture for the salary head of income for CA intermediate examinations. Okay, and we are going to be discussing about perquisites. But before starting the revision lecture, I would like to ask you something. I saw in my video analytics that only 30% of the people who are watching my revision videos have subscribed to the channel. If you are one of the 70% who have not subscribed, you know who you are. So I would request you to subscribe to the channel so that in the future, whenever some useful video is popping up, you will be updated and you will be able to take the benefit of the same. Okay. So now let us start with the revision. Let us quickly revise the salary chapter. Okay. So firstly, in perquisites, I told you that there are fully exempt perquisites, partly exempt perquisites, and taxable perquisites. So let us see what are the fully exempt perquisites. These are the facilities which are given by employer to employee for which there is no tax in the hands of employee. Number 1. Telephone or mobile bills of the employee paid by the employer. Number 2. If employer pays any tax on the non-monetary perquisites, then such tax will not be added to the perquisite value. Okay, it is exempt. Next, section 10 clause 7. If the Indian government is giving perquisites to an Indian citizen working outside India, then such perquisites are totally exempt from tax. Similar point we also saw in the allowances. Okay. Then any conveyance given to High Court or Supreme Court judge is exempt from tax. Next, any goods sold by the employer to the employee at a reasonable price is exempt from tax. Next, any transport facility given by the employer to the employee is totally exempt. That is transport facility from office to home and home to office. Now, you should be very careful that if transport allowance is given to the employee, it is fully taxable. It is only exempt for the specially abled people, that is blind, deaf, dumb and handicapped, up to rupees 3200 per month. However, if other than allowance, if directly the facility is given, it is fully exempt. So you should be very careful to differentiate between allowances and perquisites. Okay. Next, if any training is given to employees, then also it is exempt because usually training is for official purposes. Now let us see the partly exempt perquisites. Okay. So before discussing the partly exempt perquisites, I would like to tell you something that if you see any question about perquisites, if any amount is recovered back from the employee, then you should reduce such amount from the perquisite value. I am not going to tell you again and again. So whenever you see a question where the employee is paying some amount to the employer for perquisites, then find the total perquisite value and reduce the value recovered from the employee from the perquisite to find the net value. Okay. Now first let us start leave travel concession. So first special point about leave travel concession is that it is not available, that is the exemption for leave travel concession is not available for the employees who are opting section 115 BAC, that is new tax regime. Okay. Now let us see exemption under section 10 clause 5. Okay. Firstly, if travel for leave travel concession is by mode of air, then the exemption will be economy fare of the national carrier, that is Air India, or the actual expenses whichever is lower. If it is for any other mode other than air, then you should see whether railway service is available or not. Okay. Here you should be very careful. For example, if I am an employee, I am getting LTC and I am traveling from Coimbatore to Chennai. Okay, even though I am traveling by bus, still you should only compare it with the railway fare. Okay, so whether I travel by train or not, it does not matter. If a train exists, you should compare the train value with the transport value. So here you should be very careful. That is why I drew the danger symbol. Okay, so First class railway fare or actual expense, whichever is lower, will be the exemption for leave travel concession. Next, if between origin and destination, if railway service is not available, then you should see whether a recognized transport system exists or not. If recognized transport system exists, for example, a government bus is there between origin and destination, then you should compare the deluxe class fare of such recognized transport system with the actual expenses, and whichever is lower will be the leave travel concession exemption. Next, if recognized public transport system does not exist, then you should take the first class railway fare for the similar distance or actual expenses, whichever is lower. Now keep in mind that you should compare this railway fare, deluxe class fare, airfare, etc. with the shortest route from the origin to the destination. Don't take a longer route because that is cheating. Okay. Now, sir, is this leave travel concession available only for the employee? Answer is no. It is available for the family members also. Who are the family members? First, spouse, and then children, and parents, brothers, and sisters if they are dependent on the employee. Who are the family members? Spouse, that is husband or wife, then children, and parents, brothers, sisters if they are dependent on the employee. Okay. Now for children, there is a special point in leave travel concession, that leave travel concession exemption is available only for a maximum of 2 children born after 110-1998. Okay. So if before 110-1998, those children you should not count. For all the children you can give the exemption. You should see only the children born after 110-1998. If they are born after 110-1998, maximum 2 children will get the benefit of exemption. However, if after 110-1998 only one child was born, and after that one child being born there were twins being born, okay, that is multiple births in the same delivery, in such case you can take the benefit of LTC for those children as well. Okay, so you should be very thorough with this point. Next, leave travel concession is available only for 2 years in a 4-year block. Okay, so what is the current block? The current block is 1/1/2018 to 31/12/2021. So within this 4-year period you can claim the LTC only 2 times. However, if you are not able to claim LTC one time, or if you are not at all able to claim LTC, you can carry forward one LTC to the next block, and in the next block you can take the benefit of LTC 3 times. Okay, leave travel concession. Sir, but if I am not taking benefit of LTC at all, can I carry forward 2 LTC? Answer is no. Maximum only 1 LTC can be carried forward to the next block. Okay. So, leave travel concession to High Court and Supreme Court judges is exempt without any condition. And be very careful that LTC benefit is available only if the employee is traveling within India. Within India. If employee is traveling outside India, no exemption will be given. Okay. Then one more special point, this leave travel concession can be given after retirement or termination of service also. Okay. So I hope you are thorough with LTC. Now let's go to medical facility. Firstly, let us see about treatment in India. If treatment in India, okay, and treatment is given to the employee or their family members, okay, who are the family members? Family members means same as LTC, that is that is spouse, children, and parents, brothers, sisters if they are dependent. However, for medical facility, they are telling since it is for treatment purpose, we will not limit the number of children. How many number of children are there? Everyone is allowed for the exemption. Okay, wow. So now, if treatment is within India, exemption is given for the medical facility provided by the employer to the employee. Okay, if medical treatment is done in either the employer's hospital or medical treatment is done in government hospital, that is a government hospital or a hospital of the local authority or a hospital approved by the government, and then if the disease is a prescribed disease and medical certificate is available. So sometimes what may happen is for some prescribed diseases the treatment will not be available in a government hospital. So for prescribed diseases, even if it is done in a private hospital, still the exemption will be available. Okay, wow.
Now, one more point has been added, that is point number 4, and that is If the treatment is relating to COVID-19, then the amount given by employer to employee or the treatment given by employer to employee will be exempt perquisite. It will not be taxable. However, there are some conditions given by central government. Earlier they were not available, but now the conditions are also available. So what are the conditions, Kanna? The condition is that the employee should submit the following documents to the employer. What are the documents? Number one, COVID-19 positive report of the employee or the family member for whom the treatment has been done. Number two, necessary documents of medical treatment within 6 months of the COVID positive report. So the treatment must be done within 6 months of testing positive for COVID, and for that the documents must be available and to be submitted to the employer. And number three, certification in respect of all the expenditure incurred on treatment. So the documents relating to the expenditure incurred should also be given to the employer. If all these three conditions are satisfied or all these three documents are given, only then the perquisite given by employer to the employee will not be taxed.
All other type of treatment is taxable. Okay. Now let us see what will happen if treatment is outside India. If treatment is outside India, then treatment is allowed as exemption for employee and family members as well. Okay. However, for the travel and stay, okay, for the treatment and stay and travel, exemption will be available only for one patient and one attendant. Okay. So if there is more than one attendant, for the second or third attendant, the exemption will not be available. Okay. Now for the purpose of treatment and stay, if the total expense is more than the RBI limit, then amount up to the RBI limit only will be allowed as exemption. Okay. So for treatment and stay, you should see the RBI limit. If the amount is within the RBI limit, entire amount allowed as exemption. If it is more than the RBI limit, only the RBI limit, okay, will be allowed as exemption. Now let's come to travel. Travel expenses given by the employer, it is also exempt perquisite. However, it is exempt only if the gross total income of the employee should be up to 2 lakh rupees without including this particular perquisite. Okay. So travel expense is also exempt, but only for small employees whose gross total income is up to rupees 2 lakhs. Now, exempt insurance. Even insurance paid by employer to employee, it is also exempt in certain cases. Number one, health insurance given by the employer. If this health insurance is as per section 36, then it will be exempt for the employee as well. Okay, section 36 you should link with the PGBP chapter. Now, if any reimbursement of health insurance is done by the employer, even that is exempt perquisites in the hands of employee. This health insurance we can take from the section 80D, where we are going to learn about health insurance, medical insurance, and you are going to learn it in the deduction chapter. Okay, and this benefit alone, it is allowed for employee and family members as well. Okay, all the other insurance benefit is only for the employee. Next, if employer takes a personal accident policy for the employee, then that is also exempt in the hands of employee. Next, if the employer does a staff group insurance scheme, okay, staff group insurance, then that is also exempt in the hands of employee as perquisites. Now, some special points. Life insurance is taxable. If life insurance is paid by the employer, it is fully taxable. Okay. Next, family means who? Spouse, children, parents, brothers, sisters if they are dependent. Okay, similar to leave travel concession. However, here the children limit is not there. Next, hospital includes any dispensary or nursing home as well. Fine. Now let us come to education. Okay, if employer is bearing the cost of education of the employee, it is fully exempt in the hands of employee. Okay, no tax. However, if employer is bearing the cost of education of the employee's children, then if two conditions are satisfied, then the cost of education will be exempt perquisite. Okay, what are the two conditions? Number one, the institution should be the employer institution or a tie-up institution. Okay, employer institution or a tie-up institution. Sir, what is tie-up institution? I gave you an example. If Tata company has tied up with Delhi Public School, Then if Tata employees are studying in Delhi public school, then it is a tie-up institution. Okay, and the value of education should be only up to 1000 rupees per month per child. 1000 rupees per month per child in that institution. So the fees of Delhi public school should only be up to 1000 rupees per month per child. Okay. For the employees of Tata, it will be free. However, for the other students also, it should be 1000 per month per child. Sir, what will happen if it is more than 1000 per month per child? The full amount will be taxable. Full amount will be taxable. Okay. So if both the conditions are satisfied, full amount exempt. If both conditions, even if one of the condition is not satisfied, the entire amount is going to be taxable as perquisites in the hands of the employee. Okay. And now for other people, if education facility is given for any other family member like spouse, okay, parents, brother, sister, friends, anyone, then it is fully taxable in the hands of employee. Okay, are you able to understand? Now next, free tickets or passes to transport employees. So if free tickets or passes are given to transport employees, then it is exempt in the hands of the employees of airlines and railway. Airlines and railway. However, if it is given for any other employee in any organization, the ticket amount is fully taxable. Okay. Next, food expense. If alcoholic beverage is given to the employee by the employer, fully taxable. However, for any other food or any non-alcoholic beverages, okay, you should see whether the area is a remote area. If the area is a remote area, then the entire amount of food given by the employer to the employee will be exempt in the hands of employee. Okay. However, if it is not a remote area, then tea, coffee, snacks, refreshments, etc. Okay, given during office, it is fully exempt. However, if a full meal is given, that is lunch, dinner, etc., then in such case, exemption is given up to rupees 50 per meal if it is given directly by the employer or if the employer gives some vouchers. If employee gives some vouchers, okay, wow, that too up to rupees 50. Sir, what if it is more than rupees 50? The additional amount is going to be taxable. Up to rupees 50 it is going to be exempt. Okay, so be careful. Next, club recreation, etc. So if club recreation, etc., if it is extended to all the employees of the organization and if it is for health or sports, okay, if it is for health or sports, then it is fully exempt in the hands of employees. However, if it is not extended to all the employees or if it is not health or sports, then you should see whether it is a corporate membership or not corporate membership. If it is a corporate membership, it means what? For example, an employer is giving a bulk amount, a lump sum amount to a club, for example, Gymkhana Club. If employer is giving a lump sum amount to Gymkhana Club for the club membership for all the members of employees combined, then it is called corporate membership. In such case, you cannot find out how much amount is spent for which employee. Okay. Hence, this initial membership cost, that is initial expenses, will not be considered as perquisites, but the balance amount that is paid by employer will be considered as perquisite and it is fully taxable. Okay. Then for the other types of membership, the amount borne by the employer is taxable as perquisites. Okay. Now, you should see whether a club or recreation facility is for official purposes. If it is for official purposes, it is fully exempt. No need to add it in the perquisite value. However, if it is for official purposes, you should satisfy certain condition. What are the condition? That the club facility or recreation facility should be fully for official purpose. Number 2, complete details of the expenses should be maintained by the employer. Okay. And number 3, employer should give a certificate to the employee that this expense was only used for official purposes. Okay. These three conditions you are going to see in credit card expenses as well and motor car facility as well. Okay, so remember these points. This will come in three places, in credit card and in also motor car. Fine. Now let us see the other perquisites. Firstly, rent free accommodation. Very easy, at the same time very important as well. So if rent free accommodation is given by the employer to a government employee, Then how to calculate the perquisite value? Perquisite value will be the license fee prescribed by the government. License fee prescribed by government, and you should reduce the rent borne by the employee. This I already told you. If employee is giving back any amount to the employer, you should reduce it from the perquisite value. Okay. Now, if there is any other employee, okay, other than government employee, and it also includes the government employees in non-government organization, government employees deputed in non-government organization. Sir, why sir government employees in non-government organization are coming here? It is because when government employees are in non-government organization, they are not staying in government facility. In such case, license fee will not be available. Hence, you should see these limits. Okay, wow. So for government employee, we saw other limit. Now for other employees, we are going to see the limit. Okay. So if it is other than government employee, you should see whether the house in which the employee is staying, it is the employer's property or not employer's property. If it is the employer's property, you should take 7.5%, 10% or 15% of the salary as the case may be. 7.5% should be taken if the population of the city is up to 10 lakh people. Okay, 10% of the salary if the population is more than 10 lakh but up to 25 lakhs, and 15% of the salary if the population is greater than 25 lakhs. Okay, you get my point? Okay, now what is the salary? The salary definition you have to remember by heart thoroughly. I gave you a mnemonic, that is ABBCDM minus AAPP. So what and all you should include in salary? Number 1, taxable allowances. Number 2, basic salary. Number 3, bonus. Number 4, commission, can be any commission. Number 5, dearness allowance forming part of terms of employment, or dearness allowance for retirement benefit. Okay, so dearness allowance in terms only you have to add, not in terms you should not include. Okay, then next one is any other monetary payment given by the employer to the employee. So all these amounts should be added. However, we should not include certain amounts in the salary. What are those? Number 1, advance salary. Number 2, arrears of salary. Number 3, retirement benefits like provident fund, gratuity, etc. And number 4, perquisites. So 4 should not be included in salary. The remaining should be included in salary. So what is the salary definition? One more time. Okay, very, very important. Number 1, taxable allowance, then basic salary, then bonus, commission, dearness allowance in terms, and then monetary payment. However, we should not include advance salary, arrears of salary, retirement benefits like provident fund, etc., and then perquisites. Fine. So this is the definition of salary. So if it is the employer's property, you should take 7.5% or 10% or 15% of the salary as the case may be, and reduce the rent if any recovered from the employee. If it is other than the employer's property, then you should take 15% of the salary or rent paid by the employer, whichever is lower. 15% of the salary or rent paid by employer, whichever is lower, it will be the perquisite value, and if any rent is recovered from the employee, it should be reduced. Okay.
Now let us discuss the update from May 2024 examination onwards. For the previous year 23-24, now the rules or the rates of rent-free accommodations have changed. Okay, so for previous year 23-24. But now listen very carefully, because in the amendment lecture I have taught you to see only the new provisions, but since this new provision is coming into effect from 1/9/2023 onwards, hence till 31st of August 2023 the old provisions are also applicable. Hence you have to study both old provisions and new provisions. Listen to me very, very carefully. If you are writing your examination in May 2024 or later on, and if previous year 23-24 is applicable for your examination, then you have to study both old provision as well as new provision. The old provision I had discussed just now before this. Now I am going to discuss the new provision, and I will also tell you an example by which you can clearly understand how to calculate using both the provisions. So from 1/9/2023, that is from the 1st of September onwards, the new rates have come for rent-free accommodation perquisite calculation. What are those new rates? Let us see. If the property is other than employer's property, then instead of 15%, now the rate is 10%. And in case of employer's property, then now we should not see the population up to 10 lakhs, up to 25 lakhs and up more than 25 lakhs. Instead of that, we have to see the population up to 15 lakhs, more than 15 lakhs, up to 40 lakhs and then greater than 40 lakhs. And for that also the rate have changed. What is the updated rate, sir? The updated rate is, if the population is up to 15 lakhs, then you have to take 5% of salary. If the population is more than 15 lakhs up to 40 lakhs, then you have to take 7.5% of salary. And if the population is more than 40 lakhs, then you have to take 10% of the salary. Hence, sir, should I remember both the rates? Answer is yes. You have to remember both the rates because you are caught in between the transition provision. So up to 31st of August 2023 there are different rates, and from 1st of September 2023 onwards there are different rates. Now sir, if I get a question in the examination, how will I solve the question? Let us see an example. So for example, the employer has given a rent-free accommodation to a employee in Chennai. Now what is the population of Chennai? Is it more than 25 lakhs? Answer is yes. Also, is it more than 40 lakhs? Then also answer is yes. So more than 40 lakhs is the population. And let us assume no rent is recovered from the employee. And the salary of the employee is 50,000 rupees per month. Now in such case, how to calculate the perquisite of rent-free accommodation? Now for the first 5 months, that is April, May, June, July and August, for the first 5 months the old rates were applicable. So now for the population of Chennai, what is the percentage of salary that we have to take as perquisite? Answer is 15%. Till 31st of October we have to take how much? 15%. Now, so we will take 15% for 5 months. Similarly, in the new provision, that is from 1st of September 2023 onwards, how much percentage is it? Answer is 10% for the population of more than 40 lakhs. So we will take 10%. So 50,000 multiplied by 10% into 7 months comes to 35,000, and the total is how much? 72,500. So like this you have to do a calculation of perquisite if the employee is staying in employer's property throughout the year. Sometimes the question might ease your calculation and tell that the employer property is only occupied from 1st of September 2023 onwards. In such case, you should apply only the new provisions. Sometimes the question also might tell you that the employee was staying in the employer's property only till 31st of August 2023. In such case, you have to apply the old rates and old provision. And if in both the periods the employee is staying, then you have to do the calculation like this. I hope you are clear with the rent-free accommodation here itself. So instead of striking down the old provision, I want you to have the old provision. So learn that also and learn the new provision also. If you want, you can pause this video and then note down the new provisions then and there in the same page itself, so you can compare both of them and study. Fine.
Then if furniture is also provided along with accommodation, then you should add the furniture as perquisite also. If it is the employer's furniture, you should take 10% of the cost of furniture. 10% of the cost of furniture, not WDV. Okay. Then if it is any other person's furniture, take the higher charges paid by the employer, and that will be the taxable perks. Okay. Now some special points. Sir, there is a transfer of the employee, okay, and because of the transfer, one house is given by the employer in the old place as well and in the new place as well. So if there are two accommodations given by the employer, then in such case, for the first 90 days, okay, consider only the lower amount as taxable perks and the higher value will be exempt. Okay, wow. If two houses are given by employer to the employee, then the value of the lower house, okay, that the lower value should be considered as perquisite, higher value should be ignored. And after 90 days, what will happen? Both the accommodation should be considered as perquisites. Okay, so that is up to 90 days, one house exemption is allowed. After 90 days, both houses should be considered in taxable perquisites. Next, very important, salary should be taken only for the time during which the employee is occupying the accommodation. So the period during which the employee is staying in the house, only that period you should consider. Okay. Next, salary is rent free accommodation. It is fully exempt for High Court and Supreme Court judge, member of parliament, union minister, and leader of opposition. So it is fully exempt for these special people. Next, very small special point, not very important, that if the employee is in mining, oil exploration, power generation, offshore or onshore site, then in such case, if three conditions are satisfied, that is, the accommodation should be up to 800 feet, the accommodation should be at least 8 kilometers away from the municipality, and it should be at least 40 kilometers away from a town where the population is more than 20,000. So if all the conditions are satisfied, then such rent-free accommodation is also fully exempt. Okay, wow. However, this is not a very important point. You just go through it once so that if in case it comes in exam, you are able to answer. Okay, next, hotel benefit. Taxable perquisite will be 24% of the salary. Okay, what are we seeing? Hotel benefit, that is hotel given by employer to employee, hotel rooms I mean. Okay, so 24% of the salary or rent paid by the employer, whichever is lower, will be the taxable perquisites, and if any amount is recovered from the employee, you should reduce it. However, if there is a transfer of employee from one place to another place, then this hotel benefit is exempt up to 15 days. Up to 15 days fully exempt, more than 15 days fully taxable. More than 15 days fully taxable. Now let us see motor car. Motor car. Motor car, we should see whether it is used for official purpose or personal purpose or partly official, partly personal purposes. Firstly, let us see official purpose. So, if employer gives a motor car to the employee and if it is used for official purpose, the amount is fully exempt. There is no need to tax any perquisite. Okay. However, for official purposes, you remember the three conditions that we studied in club recreation, that should be applied here also. Only if the conditions are satisfied, the official purpose car will be exempt from taxable perquisite. Okay. Now, personal purpose. If motor car is used for personal purpose by the employee, then you should see whether the car is the employer's car or hired car. If the car is employer's car, then 10% of the cost of the car will be taxable perquisite. Okay, if it is a hired car, then the higher charges paid by the employer will be taxable perquisite. Okay. However, you should also add the driver salary if any paid by the employer, and running and maintenance expense if any paid by the employer. Okay, would be used for personal purpose. Now let us see the tricky part, that is partly official, partly personal purposes. First, let us see for the employer car, employer's car. Okay, so if the running and firstly the employer is giving the car, employee is using the car. Okay, so if running and maintenance expenses is paid by the employer, okay, then what will be the value of perquisite? The value of perquisite will be 1800 per month if the car is up to 1600 cc, or 2400 per month if the car is more than 1600 cc. Okay, if the car is the employer's car and running and maintenance expense is paid by the employee, then 600 per month will be the value of perks if the car is up to 1100 cc, and 900 per month will be the value of perks is the if the car is more than 1600 cc. Okay, now let us see what will happen if the car is the employee's car. If the car is the employee's car and running and maintenance expense is also paid by the employee, you no need to tax any perquisite because the entire amount is borne by the employee. Employer is not giving anything, so no need to add perks. However, if the car is employee's car and running maintenance expense is paid by the employer, okay, then what you should do? First, you should take charges paid by employer. Okay, charges paid by employer, and then you should reduce 1800 per month or 2400 per month as the case may be for a small car or big car. You will find the answer. That answer will be perquisites. However, Sometimes the employee will say that this 1800 per month or 2400 per month is a very small amount. I want to subtract a bigger amount. In such case, there is a clause that if the conditions for official purpose are satisfied, that is, the employee is able to tell that I am using this much amount for official purposes, then such amount can be subtracted here instead of this 1800 or 2400 per month. Okay, so I'll tell again so that you don't get confused. Firstly, there is an employee's car and running and maintenance expense is paid by the employer. In such case, what we should do, take the charges paid by employer. Okay, from that you reduce 1800 per month or 2400 per month. Then the amount which you get as the answer will be the taxable perquisite. However, sometimes the employee wants to reduce a bigger amount. Okay, in such case, the Income Tax Act is telling if you are able to satisfy the conditions, that is, the car should be used for official purpose, employer should maintain the details of all the official purposes, okay, and third, employer should give a certificate that it is used for official purpose. In such case, that official purpose amount can be reduced here and the final amount will be called taxable perquisites. Okay, next, above all this, if driver salary is paid by employer, okay, add 900 per month to the value of perquisites. Okay, then one more special point, sir, if there is more than one car which is used for partly official, partly personal purpose, then what to do? Then only one car can be treated as partly official, partly personal purpose. Remaining all the cars should be treated as fully personal cars. Okay. Now, let us see loan. If loan is given by the employer to the employee at a nil rate of interest or at a concessional rate of interest, okay, then you should find the perquisite. What is the perquisite, sir? It is the loan value into multiplied by SBI interest rate on the first day of the previous year minus actual interest rate. SBI interest rate minus actual interest rate into the loan value will give you the taxable perquisites. Okay, and if the loan value is reduced each and every month, okay, or in between the year if it is reduced, then this calculation that I have told you, this you have to do every month end and then find the total answer. You will get the taxable perquisites. However, this perks will not be taxable if the value of the loan, interest value of the loan is up to rupees 20,000 or the loan is given for a specified disease like cancer, tuberculosis, etc. Okay. And one more point, you should link this loan at concessional rate with advance against salary. Okay, I already told you the difference between advance salary and advance against salary. Advance salary should be added to the salary. Advance against salary should be treated as loan amount. Okay, so if advance against salary is there, you link it with this particular perquisite and find the value of the perquisite. Okay, next, gift, voucher, token, etc. So if any gift, voucher or token is given from the employer to the employee, then you should see whether the gift is in cash or in kind. If it is in cash, it is fully taxable. If it is in kind, if the value is below 5,000, if the value is below 5,000, it is fully exempt. If the value is 5,000 or more, it is fully taxable. Okay, not that up to 5,000 taxable, more than 5,000 exempt, not like nothing like that. If it is either fully exempt or fully taxable. Okay, and here be very careful, even if it is exact 5,000 rupees, it is going to be fully taxable, and this you are going to link with income from other sources when we are going to learn section 56 to 10. Okay, wow. In 56 to 10, okay, if there is employer employee relationship, you should see taxable perquisite. If there is no employer employee relationship, you should see 56 to 10. Fine. Now, travel, tour, accommodation, etc. If travel, tour, accommodation facility is given as leave travel concession, then refer the leave travel concession. If it is other than leave travel concession, you should see whether the tour is given for official purpose and or not for official purposes. If it is given for official purpose, the amount spent for the employee is fully exempt. The amount spent for the family members is fully taxable. It is fully taxable as perquisites. Okay. Now, if amount is not spent for official purposes, then if the tour is offered to all the employees, then the amount incurred by the employer is perquisite. Okay, very very simple. However, if the tour is offered only to some particular employees, then perquisite value will be the value offered by other agencies to the public. Fine. Now, one more special point, if an official tour is extended as a vacation, then the amount spent for the vacation period will be taxable as perquisites. Okay. Now let us come to specified security, that is sweat equity, like for example ESOP, etc. Okay. ESOP means what? Employee stock option plan. So sir, what are these specified securities? These are nothing but shares offered at a concessional price. Okay. In such case, the taxable perquisite will be fair market value on the date of exercise minus the issue price. Okay. This fair market value we should take on the date of exercise. Sir, how to find the fair market value? Very very simple. Firstly, you should see whether the shares are recognized in stock exchange or not recognized in stock exchange. If it is recognized in stock exchange, you should take the average of the opening balance and closing balance in the date of exercise in the highest volume stock exchange. Okay. So if there is Bombay Stock Exchange or National Stock Exchange, you should see where the volume was highest, and on that day, okay, that is the exercise date, you should see the opening balance and closing balance. You should find the average. This average will be the fair market value. However, if on the date of exercise no trading took place in the stock exchange, then what should we do? Then the fair market will be the closing price, not average price, closing price on the date on which the trading took place previously. So you should find the previous date in which trading took place. On that day, in the highest volume stock exchange, take the closing price. Okay. Now, if in question you are getting both buying price as well as selling price, then consider the selling price. Fine. Now, sir, what to do if it is not recognized in stock exchange? If it is not recognized in stock exchange, you should find out the value determined by merchant bankers, and that will be the fair market value. This value can be on the exercise date, and if on the exercise date it is not available, the value determined within 180 days previously. Within previous 180 days should be taken as the fair market value. Okay. Now, tax. Now there is an amendment. Okay, what is the amendment? The amendment is for the employees of eligible startup. Okay, so I'll go through it quickly. If there is a tax on perquisite of specified securities and sweat equity shares, okay, in the year of exercising option, okay, generally tax on perquisite is levied in the year in which the option is exercised. However, where the shares or on securities or shares are allotted by eligible startup, then perquisite will be taxable in a different year. What is that year? It is between 3 dates whichever is earlier. It is within 3 dates whichever is earlier. What are the 3 dates? Number 1, after the expiry of 48 months from the end of relevant assessment year, or the year in which the sale of security or the share is made by the assessee, or number 3, the year in which the assessee ceases to be the employee of the employer. So generally what happens, the amount of sweat equity, okay, is taxable as perquisite in the year in which the employee exercises the option. However, if the employee is the employee of an eligible startup, okay, then in such case the taxability will come in the year which is earlier of the 3 periods. What are the 3 periods? Number 1, the expiry of 48 months from the end of relevant assessment year. Number 2, the year in which the sale of shares or security is made by the assessee. And number 3, the year in which the assessee ceases to be the employee. Okay, whichever is earlier. In such year, the amount is going to be taxable. Okay, a theory question may come about this clause in your examination, so be thorough with it. In the class I have also given you an example, so I hope you are clear. Okay, now let us see use of movable assets. Okay, so if movable assets are given by the employer to the employee for the purpose of usage, then you should see whether it is computer or laptop. If it is computer or laptop etc., then it is fully exempt. No need to have perquisite taxable. Okay, wow. Because computer laptops are usually only given for official purposes. Now, if it is other than computer laptop, you should see whether the asset is owned by the employer or hired by the employer. If it is owned by the employer, the taxable perquisite will be 10% of the cost. However, if it is hired by the employer, then it will be the higher charges paid by the employer. Okay. Now, next perquisite, transfer of movable asset. So if there is any movable asset which the employer has permanently given to the employee. Okay. Okay. For example, the employer has a laptop. The employee has given the laptop to the employer has given the laptop to the employee permanently. Okay. In such case, the taxable perquisite will be the WDV of that particular asset minus any consideration if received from the employee. Okay. How to calculate the depreciation to find out the WDV? Firstly, in case of laptops or computers, you should do 50% WDV method depreciation. Okay. Then in case of car, you should do 20% WDV method depreciation, and in case of any other asset, 10% straight line method of depreciation. 10% straight line method of depreciation. And remember, depreciation should be done only for the completed years. Okay, wow. So if an asset was used for 5 years and 10 months, find the depreciation only for 5 years. Okay, ignore the 10 months. Next, other taxable perquisites. So whatever we have discussed now, we have discussed how to value the perquisite. For any other amount which is coming as perquisite, you should see what is the amount incurred by the employer, or the fair market value of such perquisite, as the case may be, will be the value of the perquisite, and that will be taxable in the hands of employee. Okay. For example, gas, electricity, water supply. So if any gas, electricity or water supply is given by the employer to the employee, then you should see what is the value of such gas, electricity, water supply. That will be the taxable perquisites. Then free domestic help. If any free domestic help or personal attendant is given by employer to employee, then you should see what is the salary paid to that domestic help. It will be the taxable perks. Next, credit card expenses. If any credit card expense is paid by employer, okay, then in such case the entire amount paid by the employer will be taxable perquisites. However, if it is used for official purposes, then you should see whether the conditions are satisfied. What are the conditions, sir? Number 1, that it should be used for official purpose. Number 2, employer should maintain a record of all the amounts spent for official purpose. Number 3, employer should give a certificate to the employee that it was used for official purpose. If all the three are satisfied, then such credit card expense need not be taxable as perquisite. Next, payment of any obligation by the employer. Very important. Okay, wow. Payment of any obligation by the employer. Okay, if any obligation is met by the employer, okay, for example, employee needs has any obligation, for example, paying the internet bill, giving salary to the domestic help, okay, etc. If any obligation is met by the employer, then in such case the entire amount is fully taxable. What is the entire amount? The amount paid by employer, it is fully taxable as perquisites, and it is taxable for every employee. Okay, and then any other perquisites. Sir, now let us learn about specified and non-specified employees. Specified and non-specified employees. Sir, who are specified employees? Specified employees are the big employees. Sir, what is the definition? Number 1, directors are specified employees. Number 2, any employee having 20% or more voting power in the organization. Employer's organization is a specified employee. And number 3, any employee getting a salary of more than 50,000 rupees per year. 50,000 rupees per year. Okay, and this salary should be the salary excluding the non-monetary perks, and you should reduce the deductions. So if the salary is less than 50,000, which is very rare, in such case that employee is considered a big employee. So for specified employees, some benefits are not given, okay, which we have already discussed. However, for non-specified employees, okay, that is small employees, Certain facilities are fully exempt. Certain facilities are fully exempt. What are those facilities? Number 1, education facility, fully exempt. Number 2, transport facility, that is giving free tickets to the employees, fully exempt. Number 3, giving a free domestic help, that is a gardener, sweeper, watchman, or any personal attendant, that is also fully exempt. And then number 4, any gas, electricity, or water supply given by employer to employee, fully exempt. And number 5, motor car facility given by employer to employee is fully exempt. So we have already studied these facilities, correct? That we have seen whether it is taxable or exempt. So all of that we have studied before. It is only for specified employees, whereas in case of non-specified employees, the entire amount is going to be exempt from tax. Okay. However, be very careful. I already told you, only facility is exempt. The reimbursement given by employer to the employee, it is not exempt, because it is an obligation of the employee met by the employer. Okay, only the facility is exempt. Reimbursement of the amount from the employer to employee, it is not exempt, because such reimbursement, it is the obligation of the employee met by the employer. Fine. Next, relief under section 89. Okay, it is the relief under section 89 is given for arrear salary or arrear pension. So what is arrear salary? Arrear salary means any disputed or retrospective salary of the past period that is received in the current period. Okay, for that a relief is given under section 89, and in class I also told you why such relief is given. So now we will just see the steps. Firstly, we have to calculate the tax for all the assessment years. Okay, that is the current assessment year and all the arrear assessment years, including arrear and excluding arrear. Okay, so find out all the taxes, then find the arrear tax. Sir, how to find the arrear tax? Arrear tax is equal to tax including arrear minus tax excluding arrears. Okay, later on find the relief. What is the relief? Relief is arrear tax in the current assessment year minus the aggregate of the arrear taxes in that assessment years. Okay, you will find the relief value. Such relief value should be reduced from the tax amount to find the final tax. Okay, in this relief under section 89, only if you do the question you will be able to be clear. I think the question is question number 24 in the study material. Illustration 24. Do solve that question to be clear with the concept. Now one more final concept of pay scale. Sir, when you see the question paper, you may find the wordings like this: 10,000, 1,000, 13,000, 1,500, 16,000, 2,000, 20,000, etc. like this. So what does this mean? This means it is called a pay scale. So it means that initially the salary is going to be 10,000, then it is going to increase by 1,000 every year till it reaches 13,000. After it reaches 13,000, it is going to increase by 1,500 every year till it reaches 16,000. You get my point? So this is called pay scale. So you should find the pay scale for every year, and then whichever year you are asked to find the salary, you can take the pay scale from that particular year and find the salary. For example, in the above pay scale, the salary for previous year 2021 is how much? 3 months into 14,500 and 9 months into 16,000. So total amount is 1,87,500. So this was the concept of pay scale. So keep learning, keep revising. See you in the next video. Till then, take care. Bye bye.
Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly thoroughly revise the income from house property chapter for CA Intermediate Income Tax Examination. And as usual, my humble request to you is to like this video and subscribe this channel, because I will be motivated to keep on posting videos like this. Now coming to the subject, I usually tell my students that income from house property and set off and carry forward are two chapters where the theory will seem very simple, but when you are actually solving the questions only, you will know the practical difficulty. So as soon as you are finishing this video, go to the study material, solve all the questions, and then you will be thorough for the examination. Now coming to the chapter, Like any other head of income, even for house property, there is a charging section and there is a computation section. The charging section is section 22, which says that for income from house property to arise, there should be a house property. The assessee should be the owner of the house property, and the property should not be used for assessee's own business or profession. Okay, so from this, I want to clarify 2 points for you. Number one, if the property is used for assessee's own business or own profession, then you ignore such property. And number two, if the assessee's business itself is giving house property on rent, then it will be covered under PGBP chapter kana, not under house property chapter. Fine? Okay. Now let us discuss what is house property. House property means building or land appurtenant thereto. Building means permanent structure. Land appurtenant means land or facilities or features that are attached to the building. For example, parking lot, swimming pool, garden, statues, etc. All these are land appurtenant. Now, what are the types of house property? There are two major types kana. LOP, SOP. LOP means let out property. It means the property that has been given on rent. And SOP means self-occupied property. Self-occupied property means property in which the assessee himself is residing, or he is not able to reside because he is living in some other city in a property which does not belong to him. So this is self-occupied property. In income tax, up to 2 self-occupied properties are fully exempt, no problem. But if a assessee is having more than 2 self-occupied properties, then any 2 can be claimed as exempt and the remaining will become DLOP, that is deemed to be let out property. This deemed to be let out property brings a notional income concept in income tax. It means what? Even though the assessee has not given that property on rent, still a notional rent will be calculated and tax will be charged on such rent. That also we will see how to calculate. Okay. Now, sir, what if house property is outside India? If house property is outside India, then for resident, ordinarily resident, the rent is fully taxable because global income is taxable. For RNOR and NR, that is resident, not ordinarily resident and non-resident, the rent will be taxable only if it is received in India. Okay. Now, owner. Sir, who is the owner? The owner is the person who is entitled to receive the income from property. So, if I am having the right to receive the income, then I only will be considered as owner. Number 2, it includes deemed owner under section 27, which we are going to discuss in some time. Next, registration of sale deed is not compulsory. So, it is not necessary that sale deed should be there. Then only I will be considered as owner. It is not compulsory. Next, sir, what if owner of building and owner of land are two separate people? Then you only focus on owner of building kana, because that is building is only house property. Next, what if there is a disputed property? There is a confusion as to who is the owner of the property. In such case, income tax department will decide the owner. And ownership should be in the previous year, need not be there in the assessment year. Means when I am receiving the rent, at that time I am the owner, it is enough. Later on, if I am not the owner, it is not a problem. Okay. Then exception of ownership is arrears of rent and unrealized rent. This I will be discussing along with arrear and unrealized concept. Now let's come to deemed owner concept. Section 27 gives 6 points of deemed ownership. Point number 1. If a person transfers the house property to spouse means what? Husband or wife. Okay, without consideration or for inadequate consideration, then the transferor will be considered as deemed owner of the property. But however, there is an exception where there is agreement to live apart, then this provision will not apply. For example, if I transfer my house property to my wife without consideration or for inadequate consideration, then also I will only be considered as deemed owner of the property. But if me and my wife are having an official agreement to live separately, in such case this provision will not apply. Next, transfer to a minor child without or for inadequate consideration. So if I am transferring my property to my minor child without consideration or for inadequate consideration, then also I will only be considered as deemed owner of the property. Okay, here also there is an exception. Minor married daughter. If property is transferred to minor married daughter, then this concept will not apply. Next, holder of impartible estate. So, for example, there are two people kanna, A and B. They both are jointly owning a property, but both do not know what is their share in the property. Hence, both A and B together will be considered as association of person. This association of person will be the deemed owner of the property and tax should be paid by the AOP. You get my point? Next, members of cooperative society, company, etc. Sometimes what happens no kanna, there is an apartment or housing society where there are many flats. This flat is generally in the name of a company. Okay, all the flats are in the name of the company, and the people who are shareholders of the flat are only the people who are living in the flat. Hence, the people who are shareholder will be considered as deemed owner. Okay, so the shareholders of the company, or if it is a cooperative society, then the members of the cooperative society will be considered as deemed owner of the property. Next, if the possession of the property is transferred to another person, then also the person who is receiving the possession will be considered as deemed owner if three conditions are satisfied as per Transfer of Property Act, TOPA. So what are the three conditions? Possession is transferred. Number 2, sale consideration is paid or promised to be paid. And number 3, even though sale deed is not executed, some other document should be executed. Okay, so if these three conditions are satisfied, if someone is giving me the possession of their property, I will become the deemed owner of the property. Okay, next, right to property for at least 12 years. So for example, a person is giving me their property for a 12-year lease. Okay, in such case, I will be called the deemed owner of the property. Next, so now we are thorough with the the charging section. Let us jump to the computation section. To compute income from house property, there are certain steps kanna. What are the steps? First, you have to compare municipal value and fair rent. Whichever is higher, you have to compare it with the standard rent. Whichever is lower among them will be called as expected rent. This expected rent you have to compare it with the actual rent and you will get the GAV or gross annual value. This GAV, from this you can reduce municipal taxes and you will get the NAV, that is net annual value. From net annual value, you can further reduce section 24A standard deduction of 30% and section 24B interest on housing loan. And lastly, you will get income or loss from house property. Now let us see what is the meaning of these terms. Firstly, what is municipal value? Municipal value means the value of rent that is decided by the municipal authority. Next, sir, what is fair rent? Fair rent, or it is also called reasonable rent. It means the rent of a similar property in the same area. Okay, these two you are only going to compare and you are going to take the higher value. This higher value you are going to compare with standard rent. What is standard rent? Standard rent means in certain areas there is an act called Rent Control Act. Such act will fix what should be the maximum rent in that area. This maximum rent only will be called as standard rent. So the higher of municipal value and fair rent, you are going to compare with standard rent and you are going to take whichever is lower. This lower value will be called as expected rent. Correct? Now this expected rent you will be comparing with actual rent. What is actual rent? Actual rent means rent received plus rent receivable minus unrealized rent. Sir, unrealized rent means what? Bad debts. Correct? But to reduce this unrealized rent, you have to satisfy rule 4 conditions. Rule 4 conditions. What are the 4 conditions? That number 1, the tenancy should be bona fide. It means the tenancy should be a genuine tenancy. Number 2, the tenant should have vacated the property. Okay, if you want to reduce the unrealized rent, you should make sure the tenant should have vacated the property, or if he is not vacating, you should at least take steps for him to vacate the property. Number 3, after vacating him from the property, you should not keep him as tenant in some other property. So tenant should not be occupying any other property of the assessee. And number 4, you should take reasonable steps to recover the rent. For example, sending legal notice, etc. So if rule 4 conditions are satisfied, only then assessee can reduce this unrealized rent from the actual rent. Okay, wow. So now you have to compare expected rent and actual rent. Whichever is higher will become the gross annual value, correct? From this gross annual value, you can reduce municipal taxes. Sir, what is this municipal taxes? Municipal tax means tax that is collected from municipal authority or municipality or corporation or cantonment board or local authority, by whatever name it is called, the taxes that are collected. Okay, and tax can be of many types: property tax, house tax, water tax, local tax, sewerage tax, drainage tax, etc., garbage tax, etc., etc. All these are municipal taxes. Now be very careful. Municipal taxes can only be taken as deduction if it is paid by the owner. If the tenant is paying municipal tax, you cannot take the deduction. Moreover, municipal tax is fully allowed on payment basis. Fully allowed on payment basis. Fully allowed on payment basis. It means what? If I am not paying the municipal tax, I will not get the deduction. Sir, what if I pay the municipal tax for 5 years? Can I take entire amount as deduction? Answer is yes. If I pay for 5 years also, I can take the entire amount as deduction. So it is allowed on payment basis. Now, in the question, if municipal tax is given in percentage form, then take the percentage of municipal value. Next, sir, what if property is outside India? Then for that property, for that local authority, if you are paying any tax, it will be called as municipal taxes. Okay. Sir, if GAV is 0, then municipal tax deduction will also be 0. If GAV is 0, you cannot reduce the municipal taxes. Okay. So see here, when I come to this computation, if there is a self-occupied property in Okana, then always, since there is no rent, the GAV will be 0. Okay. And you cannot take municipal taxes as deduction. So there is only one deduction that will be allowed, which is the interest deduction under section 24B. Because of this self-occupied property, the income from house property will either be negative or it will be 0. Moreover, if the assessee is choosing default tax regime under section 115 BAC, then this interest will not be allowed as deduction. Hence, if the assessee is choosing section 115 BAC, then income from self-occupied property will always be 0. Okay. Now let us talk about the deductions, other deductions. Firstly, standard deduction. Section 24A means standard deduction, which is flat 30% of NAV. So take the NAV, take 30% of NAV, it is allowed as deduction. But since this 30% is allowed as deduction, the act will not allow any other deduction. So for example, if you are doing any repair, insurance, painting or any other carpenter work, any expense that is done on the house property will not be allowed as deduction because there is a standard deduction. Okay. Next, interest on housing loan. It is allowed as deduction. However, this interest on housing loan, as I told you, for self-occupied property alone, it is not allowed in section 115 BAC, that is default tax regime. This you have to be very careful. Sir, what is this interest on housing loan? If you have taken a loan for the purpose of acquisition, construction, repair, renovation or reconstruction, for these 5 purposes, then interest on such loan can be allowed as deduction. Fine. Sir, can unpaid purchase price be treated as loan? Answer is yes. Sir, what is this unpaid purchase price? For example, A has purchased a property from B. Okay, so A has to make the payment of rupees 1 crore for the property. Now what did A do? A only paid 20 lakhs and balance 80 lakhs. A told that please treat it as loan and I will slowly pay you. Okay, so this 80 lakhs is the unpaid purchase price. This also will be treated as housing loan. Okay, and interest on such loan can be allowed as deduction. Next, what if there is a loan taken to repay the above loan? For example, I took a housing loan from Canara Bank, but now I am not satisfied with Canara Bank, so I want to close that loan and take another loan from State Bank of India. In such case, if I take a loan from State Bank of India and repay this loan from Canara Bank, then the new State Bank of India loan also will be considered as housing loan. Okay, or yes, housing loan. Next, sir, can I only take loan from banks? Answer is no. You can take loan from your friends also, relative also, anything is fine. Okay, interest will be allowed as deduction. Next, sir, what is interest on interest? For example, if you have paid the loan late, you have to pay some extra interest or penal interest. This penal interest will not be allowed as deduction. Next, interest is allowed on accrual basis. So this only I tell all my students. Municipal taxes fully allowed on payment basis. Interest only allowed on accrual basis. Interest is only allowed on accrual basis. So for example, if February month interest you have paid in April, then with this February month interest be allowed in, for example, for February 2024 you have paid the interest in April 2024. Okay, it will be allowed in accrual basis. So even though you paid the payment in the next year, still it will be allowed in 23-24 because interest is allowed on accrual basis. Now one special point, if you have taken a loan from outside India, then while paying the interest you have to deduct the TDS. If you do not deduct the TDS, such interest will not be allowed as deduction. Okay. Now, sir, there are some limits for this interest deduction. What are these limits? Let us see. Firstly, let's talk about LOP and DLOP, let out property and deemed to be let out property. For this, there is no limit on interest. Whatever interest is paid on housing loan or is accrued on housing loan, you can claim it as deduction. But when it comes to self-occupied property, there is a limit. What is the limit? The limit is 30,000. The limit is 30,000. But if you satisfy 4 conditions, you can increase this limit to 2 lakh rupees. Okay, what are the 4 conditions? Number 1, the loan should be taken for either purchase or construction. Condition number 2, the loan should be taken on or after 1/4/1999. Number 3, if it is taken for construction, then the assessee should complete the construction within 5 years from the end of the year in which the loan has been taken. And number 4, an interest certificate should be taken from the loan provider. See, this interest certificate point is there, no Kanna. This point will not be mentioned in many of your questions. Hence, it is necessary that you put an assumption that the assessee has received an interest certificate, and then only you can say that all the 4 conditions are satisfied. Okay, so this you keep in mind. So if all 4 conditions are satisfied, higher amount of 2 lakhs can be claimed as deduction. Now, this interest deduction is there, no Kanna. This is per person. Hence, if the person is having more than 2 self-occupied property and more than 2 loans, then for all the loans combined, the maximum limit will be 2 lakh rupees. Okay, I will give you an example. For example, let's say conditions is there are 2 self-occupied property. Condition is satisfied for first property, not satisfied for second property. Okay, so for first property, maximum deduction can be 2 lakh rupees because conditions are satisfied. For second property, maximum deduction can be how much? 30,000 rupees. But both combined together, can you claim 2 lakh 30,000? Answer is no. Both combined also you can claim only 2 lakh rupees as deduction maximum, because this 2 lakh rupees deduction is for a person. It is not for the property. Okay, so this you have to be very, very careful and mark a danger symbol here so that you do not make any silly mistake. Fine. Now, sir, what is this pre-construction or pre-acquisition period? Let me tell you, Kanna. So let's say for financial year 23-24, the construction got completed on 31 July 2023. Okay, so whatever period is there before the year in which the acquisition or construction got completed is called pre-construction or pre-acquisition period. So when the construction got completed 31st of July, so what is pre-acquisition period? Before the year. So before this point, whatever interest is there will be considered as pre-acquisition or pre-construction interest. Now this pre-acquisition or pre-construction interest will be allowed as deduction in 5 equal annual installments. So for example, this pre-acquisition interest is 5 lakh rupees. So how it will be allowed? 5 lakh divided by 5 is equal to 1 lakh. So for 5 years, every year you can claim 1 lakh rupee as deduction, which is called pre-construction or pre-acquisition deduction. But here also you be very careful. See, this 1 lakh rupee is allowed as deduction. No, this also is included in that 2 lakh rupee limit. Okay, so even pre-construction interest or pre-acquisition interest should be included in that limit, and maximum you can claim 2 lakh rupees only if it is a self-occupied property. Okay, so with respect to 115 BAC, you be very careful. If it is a LOP, DLOP, no problem. But if it is a SOP, then you cannot claim any interest on housing loan as deduction. And also one more point, very important. If you have a loss from house property, you can do intra-head adjustment, but you cannot do inter-head adjustment. In old scheme, you can do inter-head adjustment up to 2 lakh rupees. But in new scheme, you cannot do any inter-head adjustment. Fine. So first you do intra-head, then directly it will go to carry forward. Fine. This point I will again discuss in the set off and carry forward chapter. Then it will be very clear. Okay. Now let us come back to this and let us fully finish off this computation. So in self-occupied property, you can only claim the deduction of interest on housing loan and you will get loss from house property. But if there is a new scheme, that is section 115 BAC, which is the default tax regime, then SOP case, income from house property will always be 0. Then in LOP case, all the figures will be there and you have to do the calculation. But when it comes to DLOP, that is deemed to be let out property, in such case there will be no actual rent. Hence the expected rent only will become GAV. Expected rent will become GAV. Also one more point Kanna. In question, sir, what if they gave me municipal value but they did not give me any fair rent? Fair rent is not given in question. So what should I do? Then don't consider fair rent, directly take municipal value in the next step. Okay, sir, I took municipal value in the next step. Now the question does not give me standard rent also. What to do? If standard rent is also not there, then directly take this municipal value as expected rent. Okay, so if any value is missing, then you ignore that step and go to the next step directly. Fine. So this is the basic calculation of income from house property. Now let us discuss all the special concepts. Firstly, let us discuss the concept of vacancy. Sir, vacancy means what? Vacancy means the house property is available for rent, but no one has come and occupied the house property. Okay, that is only called vacancy. So in case of vacancy, what to do? In such case, don't do that expected rent with actual rent comparison. Instead, what you will do, see here, in case of vacancy, you are not going to compare expected rent and actual rent. Then what are you going to compare? You compare expected rent with actual rent plus vacancy rent. Actual rent plus vacancy rent and see whichever is higher. If expected rent is higher, take expected rent as GAV. But if actual rent plus vacancy rent is higher, then take actual rent as GAV. So while comparison, you should add the vacancy rent, but while taking the answer, you take only the actual rent. Okay. So here you have to be very careful. There is a logic behind this also, which I have taken in class, but that I will not be going to discuss here. So when it comes to vacancy, don't do expected rent or actual rent, whichever is higher. Instead, you compare expected rent plus vacancy rent with, actual rent plus vacancy rent with expected rent. If actual rent plus vacancy rent is higher, then actual rent is GAV. If expected rent is higher, then expected rent is GAV. Fine. So while comparison, you take the vacancy rent, but while putting the GAV, you take only the actual rent. Fine. Now, so what if there are more than two self-occupied property? If there are more than two self-occupied property, then you have to solve the questions in different combinations. For example, if there are three properties, A, B and C, then first assume that B and C are self-occupied and A is DLOP, that is deemed to be let out property. Then find the answer. Similarly, find the answer if A and B are self-occupied and C is DLOP, and then A and C are self-occupied property and B is deemed to be let out property. Then in all the three answers, see in which answer the income is the lowest, and that lowest income will only be the final answer. For this, you will not be able to understand by seeing this video. Only when you are solving that question which is there in the study material, you will be understanding the concept. Okay, so assume all the house properties are DLOP and find the income from house property. Then you have to solve the question multiple times to find which is the most beneficial answer. Now, sir, what if a property is partly let out and partly self-occupied area wise? For example, there is a house property and there are two floors. One floor is given on rent, one floor is self-occupied. In such case, what to do? Very simple. Both floors, you treat it as separate house property and solve the question. So treat each area like a separate property. So you have to divide the municipal value, the municipal taxes, fair rent, standard rent, everything you have to divide based on area. Area basis you have to divide, but don't divide the actual rent, because actual rent is coming only for the rented portion, correct? So don't divide the actual rent and then solve the question. Very simple. Now, what if the house property is partly let out and partly self-occupied time wise? For example, for 6 months it was self-occupied property, remaining 6 months it was let out property. In such case, what to do? Very simple, Kanna. Just treat it as a let out property and solve the question. Done. Next. Sir, what if property is acquired in between the year? If property is acquired in between the year, then take municipal value, fair rent, standard rent, etc. on proportionate basis. Okay, so only for, let's say, if you have acquired after 5 months, then for balance 7 months only you have to take the municipal value, fair rent, etc. But don't divide the municipal taxes, because municipal taxes is allowed on payment basis. So if you are paying even in the last 7 months, take the entire amount as deduction. Similarly, don't divide the interest, because interest is fully paid only by the assessee. So don't divide this interest also. Next, section 25A, arrears of rent and unrealized rent. Sir, what is arrear of rent? Arrear of rent means a disputed rent of the past that is received in the current period. Okay, and unrealized rent means bad debts of rent which is received now. Okay, so recovery of arrears of rent and unrealized rent means there was arrear of rent and unrealized rent and now it has been received. In such case, in the year of recovery, it should be taxed under income from house property if it was not taxed earlier. If it was taxed earlier, then ignore it. But if it was not taxed earlier, then in the year of recovery you have to tax it. Okay. These both are taxable even if assessee is not the owner. So for example, I was the owner of the property in 2021. Okay, that time there was an unrealized rent of 2 lakh rupees. Now in 2024, I am not the owner, but I have received this 2 lakh rupees. Even though I am not the owner, still this 2 lakh rupees will be taxed under income from house property. That is why before itself I told you that arrears of rent and unrealized rent recovery is exception to ownership concept. Okay. Now, sir, how will we tax this recovery of arrears of rent and unrealized rent? Very simple. Take the entire value and you can allow 24A standard deduction of 30%. So the balance 70% will be taxable under income from house property. Okay. And since standard deduction is allowed, no other expense will be allowed, like legal expense, etc. Nothing will be allowed as deduction. Now let us discuss joint ownership or co-ownership. Sir, what happens when more than one person is owner of a same property? In such case, you have to see whether share is definite and ascertainable. Okay, it means what? That you can easily determine what is the share of the different joint owners or co-owners. If you cannot determine the shares, then all the co-owners together will be called as AOP and the AOP will be taxed. Okay, which I discussed when I told you about holder of impartible estate. But this taxation of AOP is not there in your syllabus. Okay, in your syllabus you have only the cases where the share is definite and ascertainable. So for example, there is a property where there are two owners, A and B, and A is the 50% owner, B is also 50% owner. This means share is definite and ascertainable. You know what percentage is owned by whom. In such case, when it comes to DLOP or LOP, you calculate for the entire property, and at the end you divide the answer in the ownership ratio. Okay, and when it comes to self-occupied property, you calculate the income from house property separately, because both these co-owners will get the benefit of the interest deduction. Okay, for example, there is a house where there is a single house where A is the 50% owner, B is the 50% owner. Sir, if A has paid an interest of 2 lakh rupees and B also has paid an interest of 2 lakh rupees, then how much interest will be allowed? Answer is 4 lakhs will be allowed totally, because A also has a maximum limit of 2 lakhs, B also has a maximum limit of 2 lakhs if all the conditions are satisfied. Okay, in case of SOP. Now let's talk about composite rent. Composite rent means the property is given on rent along with some additional features or additional assets. In such case, you have to ask the question, Karna, is it possible to let out the property without the additional asset? If the answer is no, for example, hotel. In the hotel, when the hotel is giving a room on rent, they compulsorily have to give bed also and other facilities also. Without bed, no one is going to take the hotel room for rent. In such case, entire rent will be taxed under PGBP or income from other sources chapter. But if it is possible to give on rent without the additional assets, for example, you can give a flat on rent to another person without giving them the furniture. In such case, you have to see whether the agreement is separable. It means what? Whether the agreement mentions the building rent separately and furniture rent separately. In such case, if agreement is separable, then the building rent will be taxed under house property and furniture rent will be taxed under PGBP or IFOS. But if the agreement is not separable, then the entire rent will be taxable under PGBP or IFOS. Okay, so this is the composite rent concept. Very simple. Now let us discuss a couple more points. Sir, what if I give commercial property on rent? Is that also covered under house property? Answer is yes. So if I am having a house and if I am giving on rent, that is also house property. If I am having a shop and if I am giving that shop on rent, that is also income from house property. So it does not differentiate between commercial property and residential property. Next, sir, if I'm doing the business of giving property on rent, in such case, there will not be any income from house property. You have to see PGBP chapter. This I told you before itself. And then lastly, when it comes to builder, there is a special provision. What is the provision? See here, Kanna. Let's say a builder made a very big building where there are so many flats. Okay. Now, it will take some time for the builder to sell these flats. Fine. Now, till then, these buildings will be house property. Correct? And it will be considered as DLOP, and the builder has to pay tax under income from house property on all the unsold flats. Correct? So now to escape from this, the government has given a relief, or the Income Tax Act has given a relief, that in the years of construction plus 2 years from the end of the year in which construction gets completed, the builder need not pay tax on such house property. But however, after this 2-year period is completed and still if any flat is unsold, then it will be treated as deemed to be let out property and the builder should pay the house property tax. Okay, it will be treated as income and the builder should pay the tax. I think all the provisions under house property are covered. With this, you will be thorough with the provisions, quickly solve the questions, and this chapter will be completely finished for your examination. See you in the next video, dear. Till then, take care. Bye bye.
Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. From this video onwards, we are going to start revising the profit and gains of business or profession chapter, or as we all call it, the PGBP chapter for CA Intermediate Income Tax syllabus. Okay, But as usual, before beginning the lecture, my request to you is to like this video, and if you haven't subscribed yet, please subscribe to this channel and share it with your friends also, so that more and more students can get benefit of these revision lecture series. Okay, now without further ado, let us begin the revision. So we are going to revise the PGBP chapter. This PGBP chapter is the chapter number unit number 3 of chapter number 4 in your institute study material, and in my notes it is chapter number 9. Firstly, let us start with the definition of business and definition of profession. So definition of business is given in section 2 clause 13, which tells that business includes trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture. Then what is profession? Profession is given in section 2 clause 36, where it is told that profession includes vocation. So normally what we mean by profession, that is definitely profession, but profession also includes vocation. Vocation is any occupation that requires a special knowledge. Now let us see what is meaning of profit or gain as per PGBP chapter. Number 1, profit can be in cash also, or it can be in kind also. Both are considered as PGBP. So if at all I receive a profit in kind, then I should take the cash value of that kind. For example, if a client has given me a laptop worth rupees 1 lakh as my fees, then my profit is going to be how much? 1 lakh rupees. Okay. Next, capital receipts are taxable under PGBP only if it is specifically provided under PGBP chapter. Then voluntary receipts received in the course of business or profession will also be considered as PGBP. For example, a lawyer is getting money from beneficiary and a lawyer is getting money from client, that is definitely PGBP. But if some other person is also getting benefited by the services of lawyer and giving money to the lawyer, that is also PGBP. Then applications of gains is immaterial. For example, if I ask my client to not give me the fees but to give the entire money to charity, then also that entire money will be taxable as PGBP, because giving to charity is application of money, it is spending the money. So whatever money I am receiving will definitely be told as PGBP. Where I spend the money does not matter at all. My income will be treated as PGBP. Then income can be legal income also, illegal income also. So even if I am having a business of kidnapping, that income will be taxable under PGBP. Okay. Next, PGBP is the aggregate of profits of all businesses. So it is not necessary that only one business should be considered as business and other business should be considered as other sources. Okay, that is not the concept. What is the concept? A person can have more than one business also. Okay, in such case, find out the profit of each and every business, then add all the profit together. The entire amount is called PGBP income. Okay, so it is the aggregate of profits of all the businesses. Then profit means net profit and not the gross receipts. However, the net profit you have to find using the rules that are given in PGBP. Okay, by using the computation section. So firstly, let us talk about charging section, section number 28. As usual, every head of income has a charging section and a computation section. Charging section is given under section 28. And what are the points in charging section? Let us see. Number 1, income from business or profession. So first point itself is what? Income from business or profession is called PGBP. What is second one? Any compensation or any other payment due to or received by, number 1, person managing the affairs of an Indian company or Indian affairs of a foreign company. I gave you an example of director receiving sitting fees from a company. This will be covered under PGBP. Number 2, agency or termination of agency. So if I am doing agency, that will also consider PGBP, and if my agency is terminated and I am receiving any money, that is also considered as PGBP. Next, if I am receiving money from the government, for example, for some government contracts, then the money received is also considered as PGBP. And last one, if any business terms are either terminated, means cancelled, or modified, then for termination or modification, if I am receiving any money, that is also PGBP. Next, if there is any trade, professional or commercial association and such trade, professional or commercial association is giving service to its members and receiving the money, then the money received is called PGBP. Okay, I gave you an example of Codicia when I was taking the classes. Even Sidco, I told you. Next, export incentives. What is export incentives? Any incentive received for the purpose of export. So if either the export incentive is sold and profit is received, or any export incentive is directly received, both are considered as PGBP income. What are the export incentive? Number 1, profit on sale of import entitlement, profit on sale of duty entitlement passbook scheme, profit on sale of duty free replenishment certificate, then cash assistance received against exports, and then duty drawbacks. Next, if you receive any benefit or perquisite related to the business, then also it is considered as PGBP. I told you that my company has given me a free trip to Maldives if I sell 1 lakh laptops of the company. Okay. Next, if a partner receives any remuneration from a partnership firm, that is also PGBP. It is not salary, because partner is not the employee of a partnership firm. Partner is a part owner of the partnership firm. Next, sum received for not carrying out any activity. So if I am receiving any money for not carrying out any activity, that is also PGBP. And sum received for not sharing any know-how, patent, copyright, trademark, etc. is also PGBP income. Then if I receive any sum under Keyman insurance policy, that is also PGBP. See, Keyman insurance sum is actually taxable in three different types of head. If the employee is receiving Keyman insurance policy money, then it will be taxable under salary head of income. If the employer company or employer assessee is getting the money, it will be taxable under PGBP. And if any other person is getting the money, it will be taxable under income from other sources. Okay, so this was the charging section. Now before going to the computation section, let us discuss about accounting aspect. So section 145 subsection 1 speaks about accounting, and it says that for PGBP and IFOS, that is profit and gains of business or profession and income from other sources, the assessee definitely needs to follow either of two methods of accounting. So what are the two methods of accounting? Cash system and mercantile system. Cash system means payment basis of accounting. Mercantile system means accrual basis of accounting. Payment basis and accrual basis. However, for two types of incomes, no need to follow method of accounting. For two types of incomes, no need to follow method of accounting. What are the two types? It is given in section 145B, and the two types of incomes are: number 1, interest on compensation and enhanced compensation, and number 2, subsidy or incentive etc. received from the government. So for these two types of incomes, they are always taxable on receipt basis. You need not see method of accounting, always taxable in receipt basis. Okay. Next, section 145 subsection 2. All the assessees have to follow compulsorily income computation disclosure standards, ICDS. They have to follow what? ICDS. It is nothing but accounting standard, but for income tax purposes. However, for CA intermediate, it is not there in the syllabus, so you need not worry much. Just know that all assessees have to follow ICDS. But who are the two types of assessee who need not follow ICDS? Number 1, any individual or HUF who is not liable for tax audit under section 44AB need not follow ICDS. And number 2, any assessee who is following the cash system of accounting also need not follow ICDS. Hence, ICDS is applicable only to mercantile system, not applicable to cash system. Okay. Now let us come to section 44AA, compulsorily maintaining books of accounts. First and foremost, if at all you are required to maintain books of accounts, for how much time you should maintain books of accounts? Answer is maintain the assessment year books of accounts, maintain the previous year books of accounts, and 6 years preceding the previous year also we have to maintain the books of accounts. Next, section 44AA subsection 1 gives a list of the professionals, and those professionals are compulsorily required to maintain books of accounts. Who are the professionals? Number 1, legal, then medical, engineering, architecture, accountancy, which includes chartered accountancy, technical consultancy, interior decoration, film artist, and director, actor, singer, composer, all are there in film artist. Okay. Company secretary and information technology profession. Let me repeat it once again: legal, medical, engineering, architecture, accountancy, technical consultancy, interior decoration, film artist, company secretary, and information technology profession. So all these are professionals who are compulsorily required to maintain their books of accounts. Then section 44AA subsection 2. Apart from these professionals, who and all are compulsorily required to maintain books? Let us see. First and foremost, let us talk about individual and HUF. So if individual or HUF who is having an existing business, means the business which was there in the previous year or before the previous year itself it was started, okay, then for such business, if the income is more than 2,50,000 or turnover is more than 25 lakhs in any of the three preceding previous years, in any of the three preceding previous years, that means even if one is satisfied, then that individual or HUF is compulsorily required to maintain books of accounts. And then if it is a new business or profession, what is new business or profession? It means that business or profession started during the previous year itself. In such case, if the income is likely to exceed 2,50,000 or turnover is likely to exceed 25 lakhs, then also the assessee has to compulsorily maintain books of accounts. Okay. Next, for all the assessees other than individual or HUF, what is the limit? If the income is more than 1,20,000 or turnover is more than 10 lakhs in any of the three preceding previous years, in such case they should compulsorily maintain books. And if it's a new business or profession, if income likely to be more than 1,20,000 or turnover is likely to be more than 10 lakhs in the previous year, then also they have to compulsorily maintain books of accounts. Next, if a person has violated or is showing less than the presumptive income under section 44 ADA, section 44 AE or section 44 AD, then also they have to compulsorily maintain books of accounts. And not only that, if a person has come out of 44 AD, then for the next 5 years also he has to compulsorily maintain books of accounts. Okay, now comes the question, what books of accounts should be maintained by the assessee? Answer is such books of accounts which will enable the assessing officer to determine the total income. What are the books of accounts? Such books of accounts which will enable the assessing officer to determine the total income. However, if for all the professionals referred under section 44 AA subsection 1, that is what? Legal, medical, engineering, accountancy, all those professionals, okay, if at all their gross receipts is more than 1,50,000 in all the three preceding previous years, or in new case of new business or profession, it is likely to exceed 1,50,000. In such case, such professional should maintain prescribed books of accounts. Okay, be clear with the difference. Generally, all the professions should compulsorily maintain books of accounts. Such books of accounts which will enable the assessing officer to determine the total income. However, if in all the three preceding previous years, okay, if in all the three preceding previous years the income is more than 1 lakh, gross receipts is more than 1,50,000, or in case of new profession the gross receipts is likely to exceed 1,50,000, in such case they should maintain prescribed books of accounts. What are the prescribed books? It is given under rule 6F, and the prescribed books are cash book, journal, ledger, all the sale bills more than 25 rupees, and all the purchase and expense vouchers more than 50 rupees. Okay. Apart from that, if a professional is a medical professional, he also should maintain all the above plus a daily case register, of which the format is given in form 3C, and inventory of medicines as on the first day and last day of the previous year. Okay. Now comes the question, sir, where to maintain the books of accounts? Answer very simple. Maintain in the principal place of business. Maintain books of accounts in the principal place of business. Now let us talk about the computation section. We have finished the charging section. Now let's come to computation section. Computation section is given under section 29, and it is very simple. Computation section of PGBP tells that follow section number 30 to section number 43D. What should we do? Follow section 30 to section 43D. That's it. Now let me talk about an important concept. Okay, in PGBP, see Kanna, certain incomes are allowed as deduction, certain incomes are not allowed as deduction. Okay, so there are two methods, main methods by which they can ask you a PGBP question. One is what? Direct method, and one is what? Indirect method. In direct method, what will happen? The question will give you a list of incomes and it will also give you a list of expenses. So whatever income is taxable under PGBP, you add them. Whatever expenses can be claimed as deduction, you reduce them. Then you will get the income under PGBP. But this is very simple. Hence, institute generally asks the tougher method, and that is indirect method. In indirect method, what will happen? The exam question will give you net profit, and from that net profit you have to do reverse calculation to find out the PGBP income. Reverse calculation. Now listen very carefully, very important, because here you can make silly mistake. So how to do reverse calculation, sir? Number one, firstly, let us see all the transaction. So let's say A is a transaction where the income as per P&L account is 70,000, but as per income tax it is an exempt income. So what should we do? If in P&L account it is given as income, it means it would have been added in the profit, correct? It would have been added while finding out the net profit. But in income tax it is not considered as an income. So now what you should do? You should reduce it from the net profit. Hence you should reduce that 70,000 from the net profit. Then next, B. B is a transaction of 50,000 rupees. It is considered as income under PGBP and it is also taxable under income tax law. See, if a transaction is an income under profit and loss account and is also taxable under income tax law, then what you have to do? You need not do anything, because while calculating the 65,000 net profit, already it has been considered as an income. Hence, what you should do? Ignore such transaction. Fine. Next. Now let's come to transaction C. Transaction C is a income of 20,000 as per profit and loss account, but in income tax law 25,000 is taxable under PGBP. Hence, since while finding the profit 20,000 has already been considered as income, so now what you should do? The remaining 5,000 rupees you consider it as an income now. Hence 5,000 rupees you add it to the net profit. Next transaction, transaction D. Transaction D is an income of 30,000 as per P&L account, and as per income tax only 10,000 is taxable in PGBP. So in P&L income is how much? 30,000. As per PGBP income is how much? 10,000. So the difference of 20,000, what you should do? You should reduce it. You should reduce it, because 30,000 has been added, but you should add only 10,000 in PGBP. That is why reverse the 20,000. Hence reduce the 20,000. You get my point? Next, there is an item E which is 5,000 in the profit and loss account, but in PGBP it is not taxable. It is taxable in income from other sources. That is why what you should do? Reduce that 5,000 from net profit, okay, while calculating PGBP income, and add that income in income from other sources head of income. Fine. Next, transaction F. Transaction F is a transaction that is taxable under PGBP, but it is not mentioned in the P&L account. Since it is not mentioned in the P&L account, it will not be present in the net profit. So now what you have to do? You have to add it to the net profit, since it is a taxable income. Okay. Next, let us see transaction T. Transaction T is a allowed expenditure of 15,000, but it is nowhere mentioned in the profit and loss account. Since it is not mentioned in the profit and loss account, it would not have been reduced while calculating the net profit. So now what you have to do? You reduce it. Since already it was not reduced, so now you reduce it to find out the PGBP income. Next, transaction number V. Transaction V is a expense of 5,000 which is there in profit and loss account. However, this expense is allowed as a deduction in capital gains chapter and not PGBP chapter. So now what you have to do? Add it back from the profit in PGBP and reduce it as a deduction under capital gain chapter. Next, transaction W. Transaction W is a item of 10,000 in P&L account. However, in income tax it is not allowed as deduction. Not allowed as deduction. Since it is not allowed as deduction, so now what you have to do? You add it back. You add it back. Fine. You have to reverse the transaction. Hence, you add it back. Transaction X is an expense of 25,000 in the profit and loss account. However, only 10,000 is allowed as PGBP. 20,000 has been reduced while finding the net profit, but you should reduce how much? Only 10,000. So balance 15,000, you add it back to reverse the transaction. You get my point? Next, Transaction Y. Transaction Y is a 30,000 expense in P&L account, and the same 30,000 is also allowed as an expense in PGBP chapter. So now what you have to do? You need not do anything. Just ignore it. Just ignore it, because while finding the net profit, already it has been reduced. Okay. Next, transaction Z. Transaction Z is 40,000 as per profit and loss account. However, 50,000 is allowed as deduction under PGBP. Hence, while finding the net profit, 40,000 has been reduced. But in PGBP, how much you should reduce? 50,000. So extra 10,000 is there, no? That you reduce now. Already 40,000 has been reduced, so 10,000 more you reduce now. So after doing all these adjustment, you will get the PGBP income. This is called indirect method, and I have told you all these transactions because I don't want you to do silly mistake in the examination. Okay, you will know all the provisions, dear, but if you go to the examination hall and if you are not able to do this calculation properly, then learning all the entire provisions is a waste of time. Okay, so be thorough in this method as to how to calculate the PGBP income. Now let us come back to the computation provisions. Firstly, let us talk about deductions, and the first deduction that we are going to learn is section number 30. Section number 30 talks about rent, rates and taxes, repairs and insurance done to building. Insurance done to building. So who will get the expenditure deduction? The owner of the building will get the expense as deduction, or the tenant will get? Answer is whoever is spending the money will get the deduction. Let it be owner or let it be tenant. It does not matter. But what are the rules? Number 1, the building must be used for business. Building must be used for business. Rule number 2, if it is partly used for business or partly used for other purpose, then allow the proportionate expenditure in PGBP. Okay, the proportionate expenditure which relates to business will only be allowed under PGBP. Next, if it is a sublet premises. Sublet premises means what? If we take a building on rent and the same building we are giving to some other person on rent, this is called subletting or subtenancy. In such case, the net amount of rent, if it is positive amount, it will be taxable under PGBP. It will be deduction under PGBP. If it is negative, treat it as an income under PGBP. The net amount will be treated as income or expenditure as the case may be. Okay, if the rent received is more than the rent that is paid, then the net amount will be income. If the rent paid is more than the rent received, then the net amount will be considered as expense. Okay, now you cannot give rent to your own self. If you are paying rent to your own self, then it is not allowed as deduction under PGBP. Similarly, rent received from myself, okay, will not be considered as income under income from house property also. Next, partners premises. If a partnership firm is paying rent to the partner, then only reasonable rent will be allowed as deduction. Excessive rent will not be allowed as deduction. Next, if a capital expenditure is incurred, then increase the capital expenditure in the cost of the asset and you claim the depreciation on the enhanced cost. You cannot directly claim it as deduction. You get my point? However, if a tenant is making capital expenditure, he cannot claim deduction, correct? Then what to do? If a tenant is making a capital expenditure, that capital expenditure will be considered as deemed building, and on such deemed building he can claim depreciation. Okay, as usual. You get my point? Next, let us see section number 31. Section 31 speaks about repairs and insurance of plant and machinery and furniture. Repairs and insurance of plant and machinery and furniture. Sir, what about rent and rates and taxes? They are covered in section number 37. They are not covered here. Okay, so repairs and insurance of machinery, plant and furniture. Here also, as usual, only if the asset is used for business, it will be allowed as deduction. Next, if it is partly used for business and partly used for other purposes, then only the proportionate amount which is used for business will be allowed as deduction. Then, if it is a repair, okay, then renewal renovation is only allowed as deduction. Replacement or reconstruction is considered as capital expenditure and hence not allowed as deduction. So what about capital expenditure? Since capital expenditure is not allowed as deduction, it can be added to the cost of the plant and machinery, and on the added cost you can claim depreciation. You can claim depreciation. Fine. Now let us talk about the most biggest section in the PGBP chapter, that is depreciation. Section number 32 speaks about depreciation. To claim depreciation under the Income Tax Act, you have to satisfy three major conditions. What are the conditions? Condition number 1, assessee should be the owner of the asset. Condition number 2, the asset should be used for business or profession. And condition number 3, the asset should be a depreciable asset. Asset should be a depreciable asset. Now, for the owner, let us see a few points. First and foremost, lessor. In case of a lease transaction, let it be finance lease or operating lease, it does not matter. In a lease transaction, the lessor is only the owner of the asset, hence the lessor gets the benefit of depreciation. Next, if I am only having a part ownership in a building, then in my part only the depreciation is going to be allowed. Not only building, in any depreciable asset, if I am owning only a part of the asset, then only on my part I can claim depreciation. Next, building owner need not be the owner of the land. If the landowner is separate, building owner is separate, we are concerned only about the owner of building, because depreciation is only allowed on building, it is not allowed on the land. Okay. Next, depreciation is allowed even if the owner is not the user. Hence, even if my asset is given on hire or lease to someone else, still it will be considered as usage for the purpose of business and I will get the depreciation. Okay. Next, asset should be used for business or profession, and use includes passive use also. Even in the previous sections, deduction includes usage even if the usage is for passive use. What is passive use? Passive use means not actively using the asset. It means even if the asset is present in the business, it will be considered as usage. For example, fire extinguisher, tools and spares, and standby machinery, standby plant and machinery. Next, if an asset is used for partly business, partly other purpose, then allow the proportionate depreciation. Allow only the proportionate depreciation. However, only such proportionate depreciation should be reduced from the cost of the asset. Reduced from cost of the asset. So it means what? It means, for example, if you are having a plant and machinery of 1 lakh rupees, okay, and let's say building of 1 lakh rupees. So what is the depreciation? 10,000. Let's say the building only 40% is used for business. So how much is allowed depreciation? It is 4,000. Okay, this 4,000 only you should reduce from the cost of the asset. So 1 lakh minus 4,000 depreciation. Okay, what will be the closing WDV? It will be 96,000. You get my point? I hope you are clear. Now let us come to the third condition. Okay, and it is that asset should be a depreciable asset. The asset should be depreciable asset. Okay, now what is depreciable asset? Depreciable asset can be of two types. One is tangible asset and number two is intangible assets. There are three classes of tangible asset. Class number 1 is called building, class number 2 is called plant and machinery, and class number 3 is called furniture. So building, plant and machinery and furniture. Then class number 4, intangible asset itself, is class number 4, and intangible asset includes know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature. Okay, not being goodwill of business or profession. Not being goodwill of business or profession. See Kanna, what is not a capital asset? Know-how, patent, copyright. What is an intangible asset? Sorry, what is an intangible asset? Know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature, but not being goodwill of business or profession. Hence, goodwill of business or goodwill of profession will not be considered as intangible asset. Since it is not intangible asset, it is not a depreciable asset. Since it is not a depreciable asset, the assessee cannot claim depreciation on goodwill. Cannot claim depreciation of goodwill. This is a new provision. Okay. Now let us come to calculation of depreciation. How to calculate depreciation, Kanna? Firstly, you have to see what is the business of the assessee. Whether the assessee is engaged in the business of generation or generation and distribution of power. Okay. If at all the assessee is engaged in the business of generation or generation and distribution of power, then the assessee has an option to choose between straight line method and WDV method. straight line and WDV. All the other assessees have to compulsorily choose only WDV method, written down value method. Now in straight line method, it is a separate asset system, which means it is a normal system. Depreciation is calculated for each and every asset separately. Okay, then how to calculate depreciation? Very simple. Depreciation is equal to depreciation rate into actual cost multiplied by actual cost. Okay, however, since straight line method is not a very popular method, that is why the depreciation rate you need not memorize. The institute will give it to you in the question itself. Institute will give in the question itself. Now let's come to WDV method. In WDV method, what system is followed? Answer is block of asset system is followed. Block of asset system. Sir, what is this block of asset system? Block of asset means all the asset belonging to a same class and same rate. Same class and same rate. What is class? Class we have already seen. There are 4 classes of asset. What are the 4 classes? Building, plant and machinery, furniture and intangible assets. So there are 4 classes. Now let's come to what is the rate of depreciation for WDV method. Rate of depreciation for WDV method, let us study. Firstly, let us talk about building. The rate of depreciation for building used for residential purpose but other than hotel or boarding house is how much? 5%. Then what about not for residential purpose? If it is not used for residential purpose, which means what? It is used for commercial purpose, then the rate of depreciation is 10%. And for hotel and boarding house also, rate of depreciation is what? 10%. Next, if the building is used for a water supply project or water treatment system, or if the building is any temporary erection, then in such case the rate of depreciation is 40%. Next class, for furniture, and furniture includes electrical fittings, okay, wiring, switches, etc. are also included in furniture. So what is rate of depreciation for furniture? It is 10%. Next, for plant and machinery, the general rate of depreciation is 15%. General rate is what? 15%. However, if a plant and machinery is a motor car, in such case the rate of depreciation is 15%. But if the motor car was purchased and used between 23rd of August 2019 till 31st of March 2020, then on such car alone the rate of depreciation is how much? 30%. Next, let us talk about motor vehicles given on hire. So if a motor vehicle, which means what? Motor car, then tempo, truck, lorry, etc. whatever it may be, if it is given on hire, then normally the rate of depreciation is how much? 30%. However, if the motor vehicle was acquired and used between 23rd of August 2019 till 31st of March 2020, then the rate of depreciation is 45%. 45%. And this higher rate of depreciation is there, no? For this 23rd of August till 31st of March, this is not only in the first year. For each and every year, this higher rate of depreciation is allowed as deduction. Okay. Next, for ships and boats, the rate of depreciation is 20%. For molds that are used in rubber factory or plastic goods factory, it is 30%. For semiconductor industry, plant and machinery, rate of depreciation is 30%. For a computer, and computer not only includes computer includes scanner, software, laptop, printer, CPU, okay, mouse, keyboard, everything is included in the meaning of computer. So for the computer, rate of depreciation is 40%. For life-saving medical equipment also it is 40%. For pollution control equipment it is 40%. For windmill or generator on wind energy it is 40%. For aeroplane or aero engine also it is 40%. Then for a water supply project or water treatment system, if it is a building also 40%, if it is a plant and machinery also 40%. Then books are also covered in the meaning of plant and machinery, and that is why rate of depreciation is 40%. Now let's come to intangible asset. So class 4 is intangible asset. Rate of depreciation for intangible asset is 25%. Now listen very carefully, Gana. See, there is computer, okay, and there is books. Can computer and books, both of them together, come in a single block? Answer is yes, because computer is also plant and machinery at 40% depreciation. Book is also plant and machinery at 40% depreciation. So both are considered a single block. Add all of them together and find the depreciation separately. Okay, now let me ask you one more question. Can commercial building and furniture be considered as same block? See, furniture is there and then commercial building is there. Depreciation on furniture is how much? 10%. Depreciation on commercial building is how much? 10%. Now can both of them be combined into a same block? Answer is no, because furniture is a different class and building is a different class. So class also should be same, depreciation rate also should be same. If both are same, all the assets can be combined to a single block and find out the depreciation only for the block of the asset. Block of the asset. Okay, one second. Now see, listen. See Kana, depreciation is mandatory. Depreciation is mandatory. So whether or not you claim depreciation as deduction, you definitely have to reduce the value of depreciation from the WDV of the fixed asset year after year. I told you that while calculating presumptive income, we do not get the benefit of depreciation deduction because all the deductions are deemed to be allowed. Then in such case, should we reduce the value of fixed asset? Answer is yes. Okay. Next, no depreciation is given on land and no depreciation is given on goodwill of business or profession because both are considered to be appreciating and not depreciating. Okay, this third line is there. If at all this is there in the material, please cut it. Next, what about plant? What is the meaning of plant? Plant includes, it means generally what you are thinking as plant and machinery, that is definitely plant and machinery. Apart from that, ships, books, vehicles, okay, scientific apparatus, surgical equipment is also plant and machinery. However, plant and machinery does not include tea bushes, livestock, building, furniture, animals, human body and stock. So what is included? Ships, books, vehicles, scientific apparatus and surgical equipment is included. What is not included? Tea bushes, livestock, building, furniture, animals, human body and stock not included. Building also, what generally you consider as building, that is definitely building. Apart from that, road is also considered as building, bridges also considered as building, culverts, wells and tubes. So all of these are also considered as building. Okay, and after that also, if a capital expenditure is incurred by tenant, that is also considered as deemed building, which I already told you. Okay, now see, goodwill of business or profession is not eligible for depreciation from previous year 2021 onwards. That is from 1/4/2020, assessee cannot claim depreciation on goodwill of business or profession. Okay, now let's come back to the chart. See, what did I tell you? What is a block of asset? Block of asset means all the assets of a same class and same rate. So now how to calculate the depreciation? Depreciation is equal to depreciation rate multiplied by actual cost. Depreciation rate into actual cost or WDV as the case may be. So first year means you have to put the rate on the actual cost. After the first year you have to put the rate on the WDV. Fine. That is the depreciation. We have discussed in detail what is the depreciation rate. Now let us discuss what is actual cost. Actual cost. So what is actual cost, Kanna? Number one second. Any amount paid to purchase the asset will be called actual cost. Correct? Purchase price is only generally actual cost. Apart from that, see, listen. Trial run expenditure. If any trial run is done on the capital asset, then increase the value of trial run expenditure on the actual cost, reduce the value of trial run income from the actual cost. Then if there are taxes paid on that particular asset and if no credit is available, then include it in the cost. Fine. I told you if GST credit is available, don't include it. If credit is not available, include it in the cost. Next, if interest is paid on the loan for taking the fixed asset. So if for buying that depreciable asset, if you have taken a loan, then the interest that you pay on the loan should be added to the value of the depreciable asset till that asset is put to use. So till the asset is put to use, add the interest to the cost. After the asset is put to use, claim the interest as deduction. Claim the interest as deduction. Next, if there is any subsidy received from the government or any other person, then reduce it from the value of the cost. Reduce it from the value of cost. One more thing, if at all you are receiving subsidy for multiple assets together, then proportionately reduce the value of all the assets. Okay. Next, if any payment, okay, is made to a person in a day exceeding 10,000 rupees in any mode other than account pay check, account pay bank draft, electronic clearing system, or any other prescribed modes. What is this any other prescribed modes? Any other prescribed modes means, listen, any other prescribed mode means credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, and Bhim Aadhaar Pay. So, in what and all payment modes is accepted? If a payment is made over 10,000, exact 10,000 not counted, only if it is exceeding 10,000 you have to check. Okay, if it is up to 10,000 it is allowed karna. If it is exceeding 10,000, then if the payment is made to a person in a day in any mode other than account pay check, account pay bank draft, or electronic clearing system, or any other prescribed mode, then such payment should not be included in the cost of the asset. You get my point? So by doing all these transactions calculation, you will find out the value of the actual cost. On this actual cost value only you have to find out the depreciation. Now there are some special cases also which are relating to actual cost. Let us see those special cases quickly. First is special case. Okay, asset is used for business after it is used for scientific research. So after using for scientific research, if you are converting the scientific research asset into business, then the actual cost will be reduced by the scientific research deduction claimed. So basically if you claimed a deduction of 100 lakhs on the assets whose value was 100 lakhs, then the cost of the asset will become 0. Okay, next, inventory converted into capital asset and used for business or profession. So if I converted my stock into my capital asset, in such case the fair market value on the date of conversion will be considered as the cost of the capital asset. However, the difference between the cost and the fair market value will be considered as PGBP income. So for example, if I am having a building and I am a builder, so for a builder, building is a stock, correct? So I have constructed this building for 80 lakh rupees. However, now I am converting this building into my capital asset for 1 crore, because the fair market value was how much? 1 crore. Hence 1 crore will be considered as the cost of the capital asset. However, the difference between this 1 crore and 80 lakhs, that is 20 lakhs, will be considered as my PGBP income. PGBP income. Next, asset is acquired by way of gift or will or inheritance. So if asset is received by gift or inheritance, in such case the cost will be the cost of the previous owner minus the depreciation that would have been allowable. Okay, would have been allowable to the assessee as if the asset was the only asset in the relevant block of asset. So firstly take the cost of the previous owner. Okay, for example it is 1 crore, then take the cost as 1 crore, then reduce the depreciation that would have been allowed every year. Then after that whatever value you get will be the cost for your business, will be the cost of capital asset. However, if you are also incurring any expenditure, let's say any expenditure for freight or installation, for example 2 lakhs, then that also should be included in the cost. So if you are receiving any asset by way of gift or inheritance, then the cost is the cost of previous owner minus the depreciation that would have been allowed. And also if an assessee is spending his own money for the purpose of freight or installation etc., then also he can add it to the cost. Next, second hand asset. Second hand asset, I told you in class that when I am purchasing a second hand asset I can do a fraud. Okay, so that is why what will happen, the assessing officer is having the power. So for example, if I am purchasing a second hand asset for 50 lakh rupees, but the assessing officer thinks that the value of the asset is only 10 lakh rupees. So what he will do, he will take permission from the joint commissioner and he will change the value of the asset from 50 lakhs to 10 lakhs if he thinks that I am doing a fraud. Okay. So assessing officer is having the power with the permission of joint commissioner. Now let us see reacquisition of asset. Reacquisition of asset means what? I am selling my own asset and then buying it back from the person from whom I have sold. For example, I sold an asset of WDV 2 lakh rupees and I sold it for 2 lakhs and I bought it back for 10 lakhs. So now can I start claiming depreciation on 10 lakh rupees, which is my purchase price? Answer is no, because this section is telling that 10 lakhs or 2 lakhs, whichever is lower, will be considered as my cost. So what is given? Actual cost will be the actual cost when he first acquired minus the depreciation allowable, or the actual price for which the asset is reacquired, whichever is less. Okay, so in my case 2 lakhs or 10 lakhs, my existing WDV, or 10 lakh rupees, the price for which I have purchased, whichever is lower will be considered as my cost. Okay, next, acquisition of asset previously owned by any person to whom such asset is given or on lease or hire or otherwise. See now, listen. Now there is a person B who has sold an asset to person A for 55,000 and then got it back for lease. Got it back for lease from A. Okay. However, in the hands of B, the WDV of that asset was 50,000. WDV was 50,000. So in the hands of A, now what is going to be the cost? A is who? New owner. A is the new owner of the asset. Now the cost in the hands of A will be 50,000, which is what? WDV in the hands of B. Okay, listen one more time. If B is giving an asset to A and then the same asset he has got on lease from A. So now who is the new owner? A is the new owner. Okay. So what will be the cost in the hands of A? Answer is cost in the hands of A will be WDV in the hands of B, which is 50,000. You get my point? That is the answer. Now let us come to next provision. Building previously the property of an assessee. So if I am having a building which is an old building and now I have started using the building for the purpose of my business, then will it become a depreciable asset? Answer is yes. So now what will be the cost of such building? Answer is cost of the building will be the cost to purchase the building minus the depreciation that would have been allowed otherwise. So what I will do, if I had purchased the building in 1819, then reduce the depreciation for 1819, 1920 and 2021. So what is the balance amount? That is 72.9. This only will be considered as the cost of the building in my business in previous year 21-22. You get my point? Like this similar provision only we studied for asset received as gift or inheritance. Okay, similar provision. But listen very carefully. This provision is there, no? This is applicable only for building. It is not applicable for any other asset. Hence, we have seen a question also. For example, I am having a car of 5,25,000 and I purchased this car 3 years back. Now, in the current year, previous year 21-22, I am bringing this car into my business. So, what will be the cost of the car? The cost of the car will be 5,25,000 only, as usual. So, for building only, you need to do this special calculation. For other than building, you need not do this special calculation. Next, let us come to capitalization of interest paid. This we have already seen. Then this one also we have already seen. Subsidy also we have already seen. Next, any asset is acquired outside India by an assessee being a non-resident and such asset is brought by him to India. So for example, this provision is there, no? This is same as the building provision. So for example, if I am a non-resident and I am having an asset outside India, now I want to use that asset in the business in India. That is why I imported that asset. I took that asset from outside India and brought it to India. In such case, what will be the cost of the asset? Answer is the cost of the asset will be the actual cost minus depreciation that would have been allowed. Same as building. So I have to see for how much I had purchased that plant and machinery or the asset. For example, there is a plant and machinery which I am bringing to India and starting to use for the purpose of business, and let's say it cost 1 crore. Okay, then I have to reduce the depreciation in the respective years from the year of purchase till the current year, and then what is the remaining value, that only I can take it as the cost in my business. Okay, I hope you are clear. Next, capital asset on which deduction is allowable under section 35 AD. So if in 35 AD deduction is already allowed for a capital asset, then cost of such asset in the business is going to be nil. Cost of asset is going to be nil. Now what if within 8 years itself a capital asset is transferred from specified business under 35 AD to a non-specified business? If an asset is transferred from specified business to a non-specified business, then what will happen? Then the cost of such asset will be the actual cost minus depreciation that would have been allowed in the business. So this is also similar to that NRI calculation, okay, and building calculation. So what I should do, if there is an asset which I used for 35 AD specified business, and within 8 years if I am converting that asset to a normal business or non-specified business, in such case the cost of asset is going to be the actual cost minus depreciation that would have been allowed in the past years. So the net amount will become my cost. I hope you are clear with all these provisions of actual cost. Now let's come back to PGBP chapter. Okay, see, listen. Now let's come back to the chart of depreciation. See, in depreciation we learned in WDV method what is depreciation? The depreciation rate into the actual cost or WDV as the case may be. So now we have discussed in detail about the rate and we have discussed in detail about the cost. Now what will happen if all the assets cease to exist, or or the selling price of the block is more than the value of the block? Selling price of an asset is more than the value of the block. In such case, okay, listen. Okay, I'll repeat it once again. In case of depreciable asset, if the entire block of value is no more, if the entire block is no more, all the assets are either sold or destroyed or anything has happened to the assets, so now assets are no more, or if the selling price of an asset or a group of asset is more than the value of the block itself, in such case capital gains will arise. Capital gains will arise. This capital gains we are going to revise in the capital gain chapter. We will revise in the capital gain chapter. Similarly, in SLM method also either terminal depreciation or balancing charge or capital gain can arise, that we will be discussing in the capital gain chapter. Now let us see the concept of 180 days. So in depreciation as per income tax, we do not calculate proportionate depreciation for the number of days it is used. We only do 180 days concept. It means what? If an asset is used for less than 180 days in the year of purchase, then half rate of depreciation. If the asset is used for 180 days or more, then full rate of depreciation. Very, very simple. So depreciation can either be half rate or full rate. If the asset is used for 180 days or more, full rate of depreciation. If the asset is used for less than 180 days in the year of purchase, then what? Half rate of depreciation. Okay, and be very, very careful. I have given it here in the year of purchase. So for example, see, listen Karna, if I have purchased a furniture in 31st of March, which is what? Previous year 2021. 31st of March 2021, which is previous year 2021, and then I have started using the furniture only on 1st of November in the year 21-22. So in the previous year I purchased, okay, and during 21-22 I have used it for less than 180 days. So in such case, what will be the rate of depreciation? Answer is the rate of depreciation will be the full rate of depreciation, that is 10%. You get my point? So here don't get confused. Only in the same year if I am purchasing and using for less than 180 days, in such case half rate of depreciation. If I bought in the previous years itself and in the current year I am using it for less than 180 days, in such case full rate of depreciation. So here what? Full rate. Okay, if you want you can pause the video, see this example, you will be getting an idea. Okay, next. Now let's come to other concepts in depreciation and let us discuss additional depreciation. What is additional depreciation? See Kanna, first and foremost, the concept of additional depreciation is only allowed for WDV method. Okay, in straight line method, no additional depreciation is allowed. And one more thing, it is not allowed for any SSE who is opting for the new tax regime under section 115 BAC. Only for old tax regime it is applicable. Okay, and I am going to speak only about 20% additional depreciation, this 35% additional depreciation, and one more section, that is 32 AD investment allowance. So this is not so important provision, so hence you can read it once from the notes, but for our exam point of view, since it is not so important, I am not revising. But does it mean that you should skip it? Answer is no. Definitely don't skip it, see it at least one time and go, so that if at all a theory question is asked, you can answer it. Okay, now how to calculate additional depreciation? First and foremost, if the conditions are satisfied and if the asset is not covered in the exception, then you can claim additional depreciation of 20%. Okay, what are the condition? Number 1, the asset should be a new plant and machinery. Asset should be new plant and machinery. Number 2, assessee should be engaged in business of manufacture or production or generation, transmission or distribution of power. Okay, and manufacture includes printing and publishing. So what is the first condition? The asset should be a new plant and machinery. So for old plant and machinery, is additional depreciation allowed? Answer is no. For any asset other than plant and machinery, let's say building or furniture, is additional depreciation allowed? Answer is no. Okay, that is the first point you have to note. And then next point is that assessee should definitely be engaged in manufacturing or production or generation or transmission or distribution of power or printing and publishing. Only for these businesses additional depreciation is allowed. If not, it is not allowed. Now what are the exception? Exception number 1, additional depreciation is not allowed for ship or aircraft. Number 2, it is not allowed for a used plant and machinery, only allowed for new plant and machinery. Number 3, it is not allowed if the plant and machinery is installed in the office premises or residential accommodation or guest house. Number 4, no additional depreciation for office appliances. Next, no additional depreciation for road transport vehicle. And last but not the least, any plant and machinery for which the entire cost is already allowed as deduction, for example under section 35 or 35 AD, then in such case no additional depreciation for such plant and machinery. I already told you, Income Tax Act gives benefit only one time for one amount. Okay, so if already deduction has been claimed in any other section like 35 or 35 AD, then on such asset depreciation or additional depreciation cannot be claimed. Additional depreciation cannot be claimed. Can depreciation be claimed? No. Depreciation also will not be claimed because the cost of the asset is going to become zero. We already learnt in actual cost concept. Fine. So this is the concept of additional depreciation. In additional depreciation also 180 days concept applies Karna. If the asset is used for less than 180 days in the year of purchase, provide half additional depreciation, that is 10% in the first year, and give remaining half, that is remaining 10% in the next year. Okay. However, if the asset is used for 180 days or more, provide the full depreciation in the first year itself. You get my point? Now, one more point. Additional depreciation is allowed only once. So this 20% extra is there, no? This can be claimed only in the first year. It is not going to be given year after year. It is given only one time. Fine. So that you be careful. Now let us see what happens to depreciation in case of succession. So if there is succession, what is succession Karna? Succession means if a firm or sole proprietorship has become a company, or if a private company or unlisted public company has become a LLP, or there is an amalgamation or demerger. These are the 4 cases of succession. So if a succession has happened, then what to do? Calculate the depreciation as if no succession has happened. First calculate the depreciation in the normal way and then distribute the depreciation between the predecessor and successor based on the number of days actually used. Based on the number of days actually used by them. Okay, very simple. Now let's come to hire purchase system. Hire purchase system. So there are two types of system. One is installment system and one is hire purchase system. Installment system means what? Ownership is transferred in the first installment itself. In such case, what to do? In such case, treat it as a normal transaction. The entire amount, that is the sum total of all the installments put together, will be considered as cost of the asset and start claiming depreciation from the first year itself. Okay. Next, what about hire purchase system? Hire purchase system is the system in which the ownership is transferred in the last installment. In such case, what you have to do? We have to take two components. One is depreciation and one is hire purchase deduction. How to calculate depreciation? Easy, Kanna. What? Take the purchase price. What is the purchase price? Value of asset on the agreement date. So for example, if I am buying a car worth rupees 2 lakhs, I am buying a car worth rupees 2 lakhs. Fine. However, I am paying an installment of 10,000 for 24 months to buy that car. 10,000 rupees as installment for 24 months to buy that car for 2 years. Now what to do? See, listen, this 2 lakh rupees will be considered as the value of the car, and on the 2 lakh rupees car value, I can start claiming the depreciation from the first year itself. Okay. Then what about hire purchase deduction? Okay. Hire purchase deduction is very simple. Put the total 2,40,000, okay, into number of years. See, what is the sum total of all the installments? 2,40,000 minus value of asset. What is the value of asset? 2 lakh rupees divided by number of years. So for 2 years, if an hire purchase is done, take the number of years. So you will get the amount, that is 20,000. 20,000 is the value of hire purchase deduction. You get my point? So very simple. What is hire purchase deduction? Sum of installments minus value of asset as on agreement date divided by number of years of agreement. Very simple. Now let's come to method to calculate the depreciation. What is the method of calculating depreciation? Very simple, Kanna. First and foremost, take the opening WDV, then add additions during the year and then reduce the sale during the year. You will find the net amount. This net amount is there, no? You divide into three parts. Part number 1, asset not put to use. Then part number 2, asset purchased and put to use for less than 180 days during the previous year. And also, if at all there is a sale which is happening out of less than 180-day purchase, that you reduce here itself. Okay. Generally, this is not given for interlevel, but still if it is given, you reduce it here itself. On this value, you provide half depreciation, and on the balance value, you provide full depreciation. You get my point? So divide into three parts. Number 1, not put to use. Not put to use means no depreciation. Then part number 2, put to use for less than 180 days in the year of purchase. So for that you have to provide half depreciation, and for the balancing amount you have to provide full depreciation. So add all of this together, you will get the total depreciation. Reduce total depreciation from the cost of the asset. Then also, if it is a new plant and machinery for an assessee who is engaged in manufacture, etc., then reduce the additional depreciation also from the cost of the asset. You get my point? So this is the method of calculating depreciation. After reducing depreciation, you will get the closing WDV. The remaining concepts we will discuss in part 2 and part 3 of the revision lecture series for PGBP. See you then, dear. Till then, take care. Bye bye. Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. This is the second part of the revision lecture series in which we are going to revise PGBP chapter, that is Profit and Gains from Business or Profession chapter for CA Intermediate Income Tax Syllabus. Okay, well? So now before beginning the revision, as usual, my request to you is please like this video. Let's have a target of 100 likes in this particular video. Please subscribe to this channel and share it with your friends, because sharing is caring. In the first part of the revision lecture series, we had discussed the definition of business, definition of profession, what is the meaning of profit, and also about the charging section. Then we discussed that there are two methods of accounting, correct? Cash system and mercantile system. And then also what is the compulsory maintenance of books of accounts section. Then later on we started with the computation section. In computation we started with the deduction, and we discussed section number 30, 31 and 32. In this video we are going to discuss all the remaining deductions, then all the disallowances, deemed profits and other aspects. such as change in exchange rates, tax audit, and presumptive income. Fine. And then what will be left out? Speculation, 35 AD specified business, special economic zone, agricultural income, and alternate minimum tax. All these special concepts will be discussed in the next part of the PGBP revision, that is part 3. So now let us start with part 2 revision without any further disturbance. Okay, firstly let us start with section number 35. Section number 35 speaks about deduction that is given on expenditure incurred on scientific research. 35 is for scientific research. Scientific research can be of two types. One is in-house research and second one is contribution. What is in-house research, Kanna? If the assessee is himself doing the scientific research, it is called in-house research. Any assessee can claim the benefit of in-house research. And what is the deduction that is allowed? Number one, revenue expenditure is fully allowed as deduction, and capital expenditure other than land also fully allowed as deduction. Revenue expense fully allowed, capital expense other than land fully allowed as deduction. And not only this, even prior period expenses allowed as deduction. First, what is prior period? Prior period means the period till 3 years from the commencement of business. 3 years before the commencement of business period is called prior period. During this period, if the assessee incurs any revenue expenditure in the form of salary or direct material, then 100% allowed as deduction. And then even capital expenditure other than land, prior period also allowed as deduction. Now let us come to contribution. See Kanna, contribution is allowed as deduction only if the assessee is in the old tax regime. If the assessee has followed the new tax regime under section 115 BAC, then it is not allowed as deduction. Now let's come to what is the contribution. Contribution given to a notified and approved research association, university, or college for scientific research or social statistical research, 100% will be allowed as deduction. Then if contribution is given to IIT, national laboratory, universities, etc., then also 100% is deduction. Then if scientific research expenditure is given to company which is registered in India with the objective of doing research, then also 100% amount is allowed as deduction. See Kana, I told you if the contribution is made, then it should be made to notified and approved research association, university, or college. Now what happens if you have given the contribution and later on that approval was withdrawn? In such case, still deduction will be given, because deduction cannot be denied merely because approval was withdrawn after contribution. So while making the contribution, make sure that the organization is approved. Later on, it is not your problem. You can still claim the deduction. Now let us talk about sale of scientific research asset. Sale of scientific research asset. Okay. Now, if the scientific research asset is used in the business and then later on it is sold, then how to calculate PGBP income? PGBP is equal to selling price. Sorry, now what we are saying, without using in business. If without using in the business, scientific research asset is sold, that means it is just used for scientific research and later on it is sold. In such case, two types of income will arise: PGBP income and capital gain income. What is the PGBP income? PGBP income will be selling price or deduction that was claimed under section 35 earlier, whichever is lower. Then what will be the capital gain income? Capital gain income is equal to selling price minus cost price. However, capital gain will arise only if it is a positive figure. If it is a negative figure, then no capital gain. Okay. Now let us talk about scientific research asset which was used in the business and then later on it was sold. If at all scientific research asset is brought into the business, then add it to the block of the asset and the cost of such asset will become zero. It is nil. And when the asset is sold, follow section number 50. That is the section which talks about capital gain on depreciable assets. You get my point? So this was section number 35, scientific research. Now let us discuss the remaining 35 series deduction. Firstly, section 35 CCA, okay, is the deduction given to all the assessees for rural development program or urban poverty eradication program. 100% is allowed as deduction. Next, all the assessees can also get the benefit of section 35 CCC. What is CCC? Agricultural Extension Project. Okay. However, if the assessee has opted for section 115 BAC, then this CCC deduction is not allowed. Okay. So agriculture extension project, and also for land and building, this CCC deduction is not allowed. Fine. So for whom and all it is allowed? It is allowed for any assessee. Number 2, it is allowed for what? Agriculture extension project. The entire amount is allowed as deduction, but land and building is not allowed as deduction. And if a assessee has opted for 115 BAC also, it is not allowed as deduction. Moreover, the assessee should maintain separate books of accounts audited by a chartered accountant for this agriculture extension project. The SSE should also make a note of the agricultural project and the financial allocation in the various areas, and then also get a certificate of approval from the Ministry of Agriculture. So if all these conditions are satisfied, 100% of expense other than land and building can be claimed as deduction. Fine. Next, section 35 CCD. Section 35 CCD gives deduction only to companies, only for companies. So what is the deduction? If the company is having a skill development program, then the entire value spent on the skill development program other than land and building will be allowed as deduction. So 35 CCD skill development program, the deduction is given only to companies, and 100% is allowed as deduction except land and building. Fine. Now let us talk about 35D and 35 DDA. 35D talks about preliminary expense. 35 DDA talks about voluntary retirement scheme. Both these expenses fully are allowed as deduction for 5 years, in a period of 5 years. So preliminary expense as well as VRS expense, the entire amount, let's say the amount is 1 crore, then 20 lakh rupees, that is 1 crore divided by 5, will be allowed for 5 years continuously. Okay. Now what if while claiming the deduction in 5 years, in between there was any amalgamation, demerger or succession? In such case, the remaining deduction is allowed to the new undertaking. So which means what? After 2 years, let's say there was an amalgamation. Then for the first 2 years, old company will claim the deduction. For the remaining 3 years, new company will claim the deduction. You get my point? Now let us learn in detail about section 35D, which is preliminary expense. Preliminary expense. First and foremost, preliminary expense is allowed only to a resident. It is not allowed to a non-resident or a foreign company. That is point number 1. Then, see, listen. What is preliminary expense? Preliminary expense allowed as deduction will be actual expense, but the maximum limit will be what? 5% of the cost of project. Hence, actual preliminary expense up to a maximum of 5% of the cost of project will be allowed as deduction. That is why I have written 5% of cost of project or actual expense, whichever is lower. Now, what is actual expense? Actual expense means feasibility report preparation, project report preparation, conducting market survey, having engineering services, and then legal charges for drafting any agreement. What is actual expense? Feasibility report, project report, market survey, engineering services, and then legal charges for drafting agreements. So this is actual expense. Now what is cost of project? Cost of project means cost invested in the fixed asset of the new project. So whatever money is invested in the fixed asset, it is called cost of project. And the what is the upper limit? It is 5% of the cost of project. Now when it comes to Indian companies, they are having two more benefits for preliminary expenditure. So first benefit is what? First benefit is, as their upper limit, they can choose 5% of cost of project or 5% of capital employed. That is why I have written 5% of cost of project or 5% of capital employed, whichever is higher. Whichever is higher, or actual expense, whichever is lower, will be allowed as deduction. Now what is this capital employed? Capital employed means issued share capital plus long-term borrowings plus debentures on the last day of the commencement or extension. Issued share capital, long-term borrowings and debentures on the last day of the year of commencement or extension But this capital expenditure is capital employed is there, no, it will not include reserves and surplus and security premium. It does not include reserves and surplus, security premium. And what is the second benefit given to Indian company? Second benefit is that for a company, five more expenses are allowed as actual expense. What are they? Number one, legal charges to draft the article of association and memorandum of association. Number two, printing expenses relating to article of association and memorandum of association. Number 3, fees for registering the company under the Companies Act. Number 4, issue for public subscription or issue of debentures. And number 5, any other item as may be prescribed. Okay, so 5 extra actual expense allowed as deduction under section 35D. Okay.
Expenses. Now in preliminary expense also, one minor procedural change is there, Kanna. So what is that change? The change is that we have already learned that in case of this section, only certain expenses are allowed as deduction. What are those expenses? Feasibility report, project report, market survey, engineering services, and legal charges. So these 5 types of expenses are allowed as deduction. Certain other expenses are also allowed in case of company, that also we had discussed. Now in the first 4 expenses, no Kanna, feasibility report, project report, market survey, and engineering services, earlier the deduction was given only if the prior permission is taken for making these expenses, or if CBDT has given approval to certain vendor and from that vendor you had purchased these relevant items or made the relevant expenditure. So it was a very tedious task for the income tax department, because each and every time it has to give approvals and permissions for incurring these expenditure. So now to get rid of that problem, what they have done, the government has, the Income Tax Act has introduced a self-declaration basis of getting the expenses deducted. What is that self-declaration basis? The assessee has to furnish a statement containing the particulars of the above expenditure within the prescribed period to the prescribed income tax authority in the prescribed form and prescribed manner. So now what they are telling, earlier what we used to do, let us see. Earlier, let's say Mr. A wants to claim preliminary expenses as deduction. So what he will do, he will go to the income tax department and he will tell that I want to make so and so expense. So either income tax department will give permission, or they would have already given permission or approval to a certain number of vendors, and they will tell that with these vendors you can do that expenditure. So each and every time the person has to go to the department and get the permission or approval for the expenses. Now no need for all this. Now what Mr. A has to do, Mr. A can directly incur the expense, and after incurring the expense, Mr. A should submit the details. The details can be submitted in the income tax portal itself in the login, and it should be submitted at least 1 month before the due date to file the return of income. So self declaration is enough, no prior approval is necessary. Please write here, within 1 month before the due date to file the return of income. So the prescribed period is what? Before 1 month before the, within 1 month before the due date to file the return of income. For what expenses, Kanna? Feasibility report, project report, market survey, and engineering services.
Then 35D, one more last point, which is all these actual expenses should compulsorily be audited by a chartered accountant. So basically 35D means what? 35D means preliminary expense. Preliminary expense is a deduction which is not allowed for foreign companies and non-resident. It is allowed only for resident and Indian companies. Now how much amount is allowed? The entire amount is allowed subject to the limits which I am going to tell now, and it is allowed for 5 years. So the entire amount divided by 5, you have to apply it in 5 years consecutively. Now what is allowed as deduction? 5% of cost of project or actual expense, whichever is lower, is allowed as deduction. But for an Indian company, how you should calculate? 5% of cost of project or 5% capital employed, whichever is higher, or actual expense, whichever is lower, will be allowed as deduction. Now all the meanings you see yourself now. Now let's come to section number 36, which speaks about general deduction. General deduction. Firstly, let us talk about insurance premium on stock and stores. So if you have taken an insurance on stock, the premium is allowed. However, you have to make the premium you on payment basis. The premium is allowed only on payment basis. So only if you pay during the year, it will be allowed as deduction. And now listen. Now coming to payment, let us first discuss section number 43B.
Section 43B, deduction on actual payment basis. This section contains a list of totally 9 deductions that are allowed as a deduction only if it is actually paid by the assessee. The first 8 are having different rules and the last one is a new provision that is having slightly different rules. So first let us study the first 8 types of deduction. Okay, so the first 8 deductions are allowed as a deduction only if it is actually paid by the assessee on or before the due date to file the return of income. If it is not paid, it is not allowed as deduction. If it is paid on or before the due date, it will be allowed as deduction in the same previous year. But if it is paid later on, then it will be allowed in that year. Let us understand this with the help of an example. Let's say in previous year 23-24, as on 31st of March 2024, the bonus payable to the employee was 1,50,000. Okay, and let us assume the due date for this assessee is 31st of July. The payment of 1 lakh rupees was made on 30th June and the payment of the balance 50,000 rupees was made on 30th of August. Okay, when is the due date? 31st of July. Fine. Since this payment of 1 lakh is made within the due date of filing return of income, this 1 lakh will be allowed as deduction in previous year 23-24 itself, or you can say assessment year 24-25. However, this balance 50,000 payment was made after the due date, hence this will be allowed in previous year 24-25 and assessment year 25-26. Now I hope you are able to get the point. So now let us discuss what are those different types of payments which are allowed only like this. Firstly, any tax, duty, cess or fee payable. So if there is any tax payable to the government, then it is allowed as a deduction only if it is paid on or before the due date to file the return of income. For example, you can claim STT, security transaction tax, as a deduction only if it is actually paid within the due date to file return of income. Next, there are 3 types of interest which is only allowed as deduction if it is actually paid within the due date. First is interest to scheduled bank or cooperative bank. Number 2, interest to public financial institutions like State Financial Corporation or State Industrial Investment Corporation. And number 3, interest to notified classes of NBFCs. So not all the NBFCs are covered here, only the NBFCs that are notified by the government are covered here. If it is notified, it will be given in the question, so don't worry. So 3 types of interest are covered in this section. Only if this interest is actually paid on or before the due date to file return of income, it will be allowed as deduction. And one special point is also there about this interest. See here Kanna, if this interest is not paid and is later converted to loan, the unpaid interest, if it is later converted to loan, then such interest will be allowed as deduction only if that loan is payable. So let me give you an example. Let's say an amount of 2 lakh rupees as interest was to be paid. Now this 2 lakh rupees, the assessee was not able to pay this interest, so the bank converted this 2 lakh also to a loan. Okay, now this interest of 2 lakh will be allowed as deduction only when this loan is repaid. So till this loan is repaid, this interest will not be allowed as deduction. In the year in which this loan is paid, the interest will be allowed as deduction. That is the special point. Then next 3 let us discuss. The 3 are related to employees. So what 3 deductions related to employees is allowed only if it is paid on or before the due date to file the return of income. First is bonus or commission paid to employees. Second is leave salary paid to employees. And third is employer contribution to welfare fund. For employee contribution, there is separate rules Kanna. Now we are talking only about the employer contribution. So bonus or commission, leave salary and employer contribution are allowed as deduction only if it is paid within the due date to file the return of income. Okay. Then payment made to railway authorities for reusing railway assets. It is allowed as deduction only if it is paid within the due date to file return of income. By putting this section, the central government is assuring that the Indian Railways will get their payments on time. Now last point, which is a slightly different point with slightly different rules, and it is a new provision, very important from the examination point of view, and it is sum payable to MSME, that is micro or small enterprise, not medium enterprise, only micro or small enterprise beyond the time limit as per MSMED Act. Okay, so the first 8 points that we discussed are allowed as deduction if it is actually paid on or before the due date to file return of income. However, these payments to micro or small enterprise will be allowed as deduction only if it is paid within the due date that is specified in the MSMED Act. Okay, so the assessee has to make the payment as per the due date of the MSMED Act. If it is paid within the due date, it is allowed as deduction. If it is not paid, it will not be allowed as deduction. If it is paid late, then it will be allowed in that year. Okay. So now first let us discuss what is micro and what is small enterprise. So micro and small enterprise firstly should only be manufacturers and service providers. What? Manufacturers and service providers. So traders are not included in micro and small enterprise. Next, the investment in their plant and machinery or equipment should be up to 10 crores and turnover should be up to 50 crores. Since both micro and small enterprise are covered in same provisions, that's why you just see whether the person to whom the payment is made is their investment in plant and machinery up to 10 crores and turnover is up to 50 crores. If it is covered, then the such enterprise will be covered under the micro or small enterprise, and payment made to them should be within the due date specified in the MSMED Act of 2006. Now what is the due date of payment as per MSMED Act? See here, if assessee is making the payment for goods or services to a micro or small enterprise, then you should see whether there is an agreement or no agreement. If there is agreement, then the payment should be made within the date as per the agreement or 45 days, whichever is earlier. Date as per agreement or 45 days, whichever is earlier. And if there is no agreement, then the payment should be made within the 15 days time period. Okay, and from when should you start counting this number of days? You should start counting the days from the date of acceptance of goods or services or deemed acceptance of goods or services. Okay, so this is the MSMED Act provision. The first 8 are allowed as deduction only if it is paid within the due date to file the return of income, but the payment to micro or small enterprise who are manufacturer or service provider whose turnover should be within 50 crores and investment in plant and machinery should be within 10 crores, then the payment should be made within the time limit specified in the MSMED Act, which is 15 days or date of agreement or 45 days as the case may be. If the payment is made within the time limit, then amount is allowed as deduction. If payment is not made within the time limit, then if it is allowed as deduction in the year in which the payment is made. That is why I told you. Let me give you one small example. Let's say there is no agreement and the date on which the goods are accepted is 1st of January 2024. So in such case, the 15-day period will end within 15th of January 2024. Let's say the payment is made on 17th of January 2024. So is this payment within the due date as per MSMED Act? Answer is no. It is beyond the due date. However, the payment is made within 23-24 itself. That is why it will be allowed as deduction in 23-24. But what if the same payment is made on 1st of April 2024? In such case, it will not be allowed in 23-24. It will be allowed in 24-25. If you need more clarity on this section, please visit the amendment lecture that I have uploaded for May 2024 examination. There I have explained it in a crystal clear format, but since this is a revision lecture, I am completing this quickly.
Now let us discuss section number 36. See, first point is what? Insurance on stock. So if insurance is taken on stock, the premium will be allowed, but only on payment basis. See, here I have written payment basis. Payment basis means what? It should be paid within that year itself. If it is paid within the previous year itself, it will be allowed as deduction. Next, premium on life of cattle. Premium on life of cattle also only allowed on payment basis, means if you pay it will be allowed, if you do not pay it will not be allowed during the year, and it is allowed only to Federal Milk Cooperative Society. Okay, example Amul. It is allowed only to Federal Milk Cooperative Society. Next, employee health insurance premium. So if you are taking any health insurance for employees, then the premium amount is allowed as deduction. However, it is allowed only on payment basis. It means during the year itself you have to pay it. Fine. And it is payable, it is allowed if it is paid in any mode other than cash. So other than cash, in any mode it can be paid. Next, let us talk about salary related deductions. Number one, bonus or commission. Bonus or commission is allowed as deduction. However, it is allowed on actual payment basis. Actual payment basis means what? Section 43B, which means that bonus or commission should be paid on or before the due date of filing return of income. Next, section number 3614, employer contribution to funds. So employer contribution is only allowed if the contribution is made to approved superannuation fund or approved gratuity fund or recognized provident fund or statutory provident fund or pension scheme under section 80 CCD. So what is allowed? Approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund and pension scheme under section 80 CCD. Only these are allowed as deduction to the employer. Moreover, the contribution to 80 CCD only up to a maximum of 10% of salary will be allowed as deduction. And what is salary? Salary means basic plus DA terms. Basic plus DA terms. So that is employer contribution that is allowed. And we already learnt that employer contribution is allowed under section 43B on actual payment basis. It means the entire amount will be allowed as deduction only if it is paid on or before the due date to file the return of income. Okay, now let us talk about employee contribution. Employee contribution is allowed as a deduction only if it is paid on or before the due date of the respective fund. Okay, of the fund. For example, if there is a provident fund and for March month the due date is 15th of April, then only if it is paid on or before 15th of April it will be allowed as deduction. If not, it will not be allowed as deduction. Okay, next, section number 36 subsection 1 clause 3, interest. Interest on borrowings is allowed as deduction only if the borrowings is used in the business. If borrowings is not used in the business, interest is not allowed as deduction. Sir, what if the loan is taken on a depreciable asset or a fixed asset? So in such case, the interest up to the asset is put to use, you add it to the cost of the asset. After the asset is put to use, that interest you claim as a deduction under section 36. Okay, now let's talk about bad debts. Bad debts are allowed as deduction only if the bad debts have become irrecoverable, and moreover only if it was treated as an income earlier. I told you that sales would have been treated as a income earlier. That is why if the sundry debtors are becoming bad debts, then it will be allowed as deduction. However, loan given was not treated as income earlier. That is why if a loan will become bad debts, it will not be allowed as deduction. So only if it was treated as income earlier, it will be allowed. If not, it will not be allowed. Okay. Now let's talk about STT and CTT. What is STT? Security transaction tax. What is CTT? Commodity transaction tax. Both are allowed as deduction under PGBP and they are allowed on actual payment basis because it is a tax. Tax is allowed on actual payment basis, means pay it on or before the due date to file the return of income. Okay. Now be very careful. STT CTT is allowed in PGBP but it is not allowed in capital gain. Okay. Now let's talk about other deductions. Firstly, what is discount on zero coupon bonds? Discount on zero coupon bonds. So if zero coupon bonds are issued at a discount, then the discount value will be allowed proportionately as a deduction. Okay. So allowed on pro rata basis. So how to calculate the deduction? Total discount divided by total number of months, okay, of the bond into total number of months during the previous year. Total discount divided by total number of months of the bond multiplied by total number of months during the previous year. Now what is animal allowance? Animal allowance means if an animal is there, if it becomes useless or if the animal dies, in such case the actual cost incurred to buy that animal minus the selling price of the animal or the insurance claim received for the animal will be allowed as deduction. Next, promoting family planning. See, family planning is done by the individual, but promoting the family planning expense is allowed only to companies. It is allowed only to companies. If it is a revenue expenditure, fully allowed. If it is a capital expenditure, allowed in 5 equal annual installments. So this was section number 36. Now let us come to section 37. 37 tells that whatever expense is there, it is related to business, then it will be allowed. Okay. However, losses will not be allowed as deduction. Prior period expenses will not be allowed as deduction. Earlier we have discussed 2 or 3 places where prior period expense is allowed. Only there it will be allowed. Nowhere else it will be allowed as deduction. Okay. Personal expenses not allowed. Capital expenditure not allowed. Contingent liability also not allowed. So for example, if I am having provision for bad and doubtful debts, it will not be allowed as deduction. Next, premium on keyman insurance policy is allowed as deduction. Okay, it is allowed as deduction. Then any illegal expenditure will not be allowed as deduction. If I have paid any fine or penalty for a breach of law, it will not be allowed. So for example, if I have breached the pollution control law, it will not be allowed. If I have given any freebies to medical practitioner, it will not be allowed. Referral commissioner referral commission paid by laboratory to the doctors is also not allowed as deduction. However, if I breach a contract and then if I am paying any money, then it is allowed as deduction. For example, I had given a lift. I had actually purchased the lift. For that I gave an advance. Now I broke the contract, so the advance was forfeited. Hence, this advance money that I have paid will be for breach of contract and it will be allowed as deduction. So breach of law not allowed as deduction, breach of contract allowed as deduction. Okay.
In section number 37, now an explanation is added. What is section number 37, Kanna? It is the general deduction. That is, if any amount is there and that is spent for the purpose of business or profession, then that amount will be allowed as an expense. In that, I had taught you that any illegal expenditure will not be allowed as expense, okay, or will not be allowed as deduction. But in this now, an explanation has been added. What is the explanation? Number 1. There was a confusion whether if this illegal expenditure is not allowed if it is illegal in India, or also if it is illegal outside India, it will not be allowed. Answer is, if the offense is prohibited by law in India or outside India, it will not be allowed as deduction. Hence, for example, if I am incurring an expenditure in USA, and in USA if it is an illegal expenditure, then such expenditure will not be allowed as deduction. Okay. Point number 2. Providing benefit or perquisite where acceptance of such benefit or perquisite is a violation of law. This we had already discussed in class, but it is now also added as an explanation. And what is that? It means that if I am giving any benefit or perquisite to someone, and the person, if they are receiving the benefit or perquisite, if that is a violation of law, then such expenditure will not be allowed. We discussed an example in class also. For example, a medicine company or pharma company is giving commission or perquisite. It can be commission, gift, or anything they are giving to doctors. Okay. So for a medicine company, they giving commission is a business expenditure only. However, for doctors, it is illegal to accept such commission or perquisite. Hence, this commission or perquisite will not be allowed as deduction. You get my point? And next, to compound any offense in India or outside India. Okay. So if any amount is paid for compounding of offense, that also will not be allowed as deduction. Sir, what is compounding? Compounding means if you are doing any activities that is illegal, but you are paying some extra money to make it legal, that is called compounding. So for example, if you are allowed to construct only 2500 square feet, okay, but you constructed 3000 square feet of building, correct? So what you did, 500 square feet extra you constructed, which was illegal, unapproved construction you did. But then What happened? You paid penalty of, let's say, rupees 1 lakh to make this 500 square feet as legal. This type of transaction is called compounding. So if something is illegal before, you are paying some extra money as fine to make it legal. It is called compounding. Such type of amount is also not allowed as expenditure. So these three types of amounts are not allowed as deduction under PGBP. This is the explanation under section 30.
CSR expenditure, that is corporate social responsibility, not allowed as deduction because it is considered as application of income. Application of income. Then if contribution is made to political party, it is not allowed as deduction here. It will be allowed as deduction in the deduction chapter. Okay, wow. Then dividend paid is not allowed as deduction. Then even if any advertisement is made in the souvenir, brochure, pamphlet, newspaper, in etc. of a political party, then such advertisement expense also will not be allowed as deduction. Okay, even if it is related to the business. So now we saw till section number 37. Now let us start with the sections of disallowances. Disallowances means all the expenditure which will not be allowed as deduction. Firstly, let us discuss section 40 subsection A. Okay, so if payment is made outside India or within India to a non-resident without deducting the TDS, or the TDS is deducted but not paid within the due date to file the return of income, then in such case the amount of expenditure is fully disallowed. And similarly, if payment is made in India to a resident without deducting the TDS, or TDS is deducted but not paid within the due date to file return of income, then 30% of the expenditure is disallowed. Hence, if you are making a payment on which TDS is required to be deducted, then deduct the TDS and pay it to the government on or before due date to file the return of income. Only after that you should make payment to the person concerned. If you are not deducting the TDS or deducting but not depositing it to the government, in such case what will happen? The amount in case of non-resident receiver is fully disallowed. If you are paying to a resident, then 30% is disallowed. What if you have paid after the due date of filing return of income? In such case, in the respective year, that is in the year in which you have paid the TDS, will be allowed as deduction. And also, listen, if the payee, that is the person who is receiving the amount, has paid the taxes correctly, the payee has filed the return of income and also has given a CA certificate in which the CA has told, chartered accountant has told, that the amount has been received and the taxes have been paid correctly. In such case, if all these three conditions are satisfied, then the year in which such CA certificate is given, the amount will be allowed as deduction. So I am repeating once again, this is very important. If you are making any payment, if the assessee is making any payment on which TDS is required to be deducted, okay, in such case if the assessee has not deducted the TDS or not deducted but not deposited to the government within the due date to file the return of income, then if the payment is made to a non-resident, entire amount not allowed as deduction. If payment is made to a resident, then 30% is not allowed as deduction. Okay, however, if it is paid in the later years, then it will be allowed as a deduction in the later years. Similarly, if later on the person who is receiving the payment has paid the taxes correctly, has filed his return of income and also is giving a chartered accountant certificate, in such case in that year it will be allowed as deduction. You get my point? Next, any income tax is not allowed as deduction, or tax on PGBP or even interest on income tax is not allowed as deduction. Next, if state government undertaking is paying any money to the state government, then such money is not allowed as deduction. Then, if salary is payable outside India, then for sure TDS has to be deducted. If TDS is not deducted, then the salary is not allowed as deduction. Next, if the person is paying tax on non-monetary perquisites, then it is not allowed as deduction because it is also not considered as income in the hands of employees. Okay, next is section 40b series. 40b series talks about 40b series talks about interest on capital and remuneration given to partners of a partnership firm. Okay, firstly, let us talk about interest on capital. What are the three rules? Number one, interest on capital is allowed only if it is authorized by the partnership deed. Number two, only if the authorization is after the date of the deed. And then number three, maximum 12% simple interest only allowed as deduction. So what are the three things? See Kana, actual interest or interest as per partnership deed or 12%, whichever is lower will be allowed as deduction. You get my point? Now let us come to remuneration given to partners. Remuneration only given to working partners will be allowed as deduction. If remuneration is given to other partners like sleeping partner, dormant partner, investing partner, etc., it is not allowed as deduction. Then remuneration is only allowed if it is written in the partnership deed and if it is authorized after the date of the deed and only if it is within the limits that I am going to mention below. What are the limits? See, firstly, you have to find out what is the book profit. Book profit is the net profit after the interest on capital but before partner salary. After interest on capital, before partner salary. Okay. Now, for if the book profit is up to 3 lakhs, then 1,50,000 or 90% of book profit, whichever is higher, will be allowed as deduction. Okay. Maximum limit is what? If, okay. So hence let me repeat it once again. If what is book profit? Book profit means net profit after the interest on capital but before partner salary. So now if the book profit is up to 3 lakh rupees, then 1 lakh 50 or 90% of the book profit, whichever is higher, will be allowed as deduction. If book profit is more than 3 lakh rupees, then how to calculate? On the first 3 lakhs, take 90% of the book profit and on the remaining amount take 60% of the book profit. Then combined both of them, you will get the maximum limit. See, I have given you an example also. See here, if 2 lakh rupees is the loss, if 2 lakh rupees is the book loss, let's say, then maximum 1,50,000 will be allowed as deduction. If 1 lakh rupee is the book profit, in such case 1,50,000 or 90,000, whichever is higher. Hence 1,50,000 will be allowed as deduction. What if the book profit is 250? If the book profit is 2,50,000, then what will be allowed as deduction? 1,50,000 or 90%, which is 2,25,000, whichever is higher. So the answer is what? 2,25,000. Now what if the book profit is 10 lakh rupees? In such case, on the first 3 lakh take 90%, that is 2,70,000, and on the balance amount take 60%, that is 4,20,000. Then add both of them. This is upper limit. Okay. So if the partner's salary or partner remuneration is within these limits, then it is allowed. If it is above these limit, then maximum only this much will be allowed as deduction. You get my point? So this is the upper limit to claim the 40B deduction. Now let's talk about some special point. Okay. If a partner is receiving an interest in the representative capacity or a partner or member in the representative capacity is receiving interest in the individual capacity, in such case you need not see the limits of interest. If you are not understanding this point, no problem, forget it. We will move on to the next point. Section 40BA. Section 40BA, one second. Section 40BA tells that any payment made by an AOP or BOI to the member will be allowed as deduction. Now let's come to section 40 big A series. Section 40A subsection 2, related party transaction. If any payment is made to a related party, then unreasonable amount or excessive amount will not be allowed as deduction. Okay, hence only the reasonable amount or the fair amount will be allowed as deduction. Now who are these related party? Related party can be a relative or an associate. For an individual, the relative means spouse, brothers, sister, lineal ascendant or lineal descendant. For other than individual, for a company, relative is a director and his relatives. For a partnership firm or LLP, the relative is a partner or his relatives. For an AOP, BOI or AJP, the relative will be a member or his relatives. And then, okay, that this much only. Next, what is an associate? An associate is a concern in which a person or a relative is having substantial interest. Substantial interest means what? 20% voting power or 20% profit sharing. 20% voting power in case of companies or 20% profit sharing ratio in case of other than companies is called substantial interest. So if I am having a substantial interest, or if I am having if I am a relative, in such case any expenditure made to a listen. So if I am making any payment to a related party, or if I am making a payment to any associate, in such case, if the payment is reasonable, it will be allowed. If it is unreasonable, only the reasonable part will be allowed as deduction. Excess amount will not be allowed as deduction. Now let's come to section 40A3, which is very important. If any payment above 10,000 rupees, okay, above 10,000, not exact 10,000, above 10,000 is made to a person in a day in any mode other than account pay check, account pay bank draft, electronic clearing system, or credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, or Bheem Aadhaar Pay. So in any mode other than all these modes, then it will not be allowed as deduction. However, for the purpose of transport expense or freight expense, the limit is 35,000 and not 10,000. And if retirement benefit is given to employees, then the limit is 50,000 and not 10,000. However, if a transaction is covered in Rule 6DD, then you need not see this provision at all. What is Rule 6DD? It means if any payment is made to the government or RBI or cooperative banks or primary agricultural credit society or LIC. So if payment is made to all these people, in such case you can make unauthorized payments or unprescribed payments also. So to the government, if I want, I can pay 20,000 in cash also. It is not a problem. Okay. Or to RBI also I can pay the cash, to cooperative society, etc., cooperative banks, etc., I can pay the cash, not a problem. Next, if there is an employee who is posted in a place for 15 days or more with no bank or authorized dealer or money changer, in such case also payment of more than 10,000 is allowed as deduction, even if it is other than prescribed modes. Then if I am making a payment to my agent and my agent is making a payment in all the transaction which is covered in Rule 6DD, then me giving money to my agent is also allowed as is considered as payment under Rule 6DD. Fine. Next, payment by means of. So if I am making payment by means of letter of credit, mail or telegraphic transfer, bank account to bank account transaction, bill of exchange, or even book adjustment. Book adjustment means what? I have to give you 50,000, you have to give me 40,000. So I will set off the 40,000 and balance 10,000 only I will give you. This is called book adjustment. So this is also allowed even if it is not through prescribed modes. Next, if you are making any payment to purchase agricultural produce or forest produce, animal husbandry or dairy product, poultry farming, fish or fish products, horticulture or apiculture, or manufacturing in the cottage industry without using of power. In all these cases, if you are giving money to the producer, okay, that is direct farmer or producer, in such case the amount is allowed even if it is other than prescribed modes. But what if you are paying to any other person? For example, you are buying all these products from Amazon. In such case you have to pay only through prescribed modes. You get my point? Next, if a payment is made in a village or a town where there is no banking facility, there also payment can be made in any mode other than prescribed modes. It will be allowed as deduction. Now let's come to next disallowance. Provision for gratuity is allowed only if gratuity is actually payable. So if gratuity is actually going to be paid to the employees, provision will be allowed. If not, provision will not be allowed. Next, contribution for welfare funds other than those mentioned in section 36 will not be allowed as deduction. So what are other than those? For example, contribution to unrecognized provident fund not allowed. Contribution to unapproved superannuation fund not allowed as deduction. Like that. Okay. Now let's come to next provision, deemed profit. Deemed profit. What is deemed profit? There are four cases. Case number one, remission or cessation of trading liability. So, if there is any amount which was earlier treated as deduction, but now it cannot be treated as deduction. In such case, you have to make it a income. For example, last year in March, there was a rent payable that was 20,000. But in the previous year, what happened is that entire rent was paid in cash in a single day itself. In that case, since the amount is more than 10,000 to a person in a day in any mode other than prescribed modes, hence it will not be allowed as deduction. Correct? That is why what you have to do, since you had treated this rent as expense in the preceding previous year, now treat it as an income in the previous year. This is only called remission or cessation of trading liability. It means any amount that was treated as expense earlier and now you realize that that will not be allowed as expense, hence now you should treat it as income to reverse the transaction. That is remission or cessation of trading liability. Next, balancing charge also in case of SLM assets will be allowed as deduction. Okay. Next, if a sale of capital asset is used, if a capital asset was used for scientific research and then sold, that is also deemed income. And then if bad debts were allowed as deduction and later on if they are recovered, then they will also be deemed as income. So very simple. Now let's come to other aspects. First of all, change in exchange rate. So for example, I bought a machinery for $1,000. Okay, that time dollar rate was 90 rupees. Later on in the next year, when I paid the value, okay, was 92 rupees per dollar. That is why I paid 2000 rupees extra. In such case, that extra payment of 2000 rupees can be added to the cost of the asset. That is only given. Hence, if there is any change in exchange rate, then increasing or decreasing the liability will be adjusted in the cost of the capital expenditure. Very simple. Now let's come to section 44AB, that is tax audit. Tax audit is applicable to whom? Number 1. If the turnover of a business exceeds 100 lakh rupees, then tax audit is compulsory. However, this 100 lakhs or 1 crore will be considered as 10 crores if two conditions are satisfied. What are the two conditions? Number 1, aggregate cash receipts is up to 5% of the total receipts during the previous year, and aggregate cash payments is up to 5% of the total payments during the previous year. Okay, if both these conditions are satisfied, then the limit will be 10 crores instead of 1 crore. Fine. Next, if gross receipts exceed 50 lakhs in case of profession, then such profession has to compulsorily get the tax audit done. Next, if the profit is lower than the presumptive income under section 44AE, 44ADA or 44AD, then also compulsorily do tax audit. Moreover, if 44AD has not been taken, okay, after taking it in the previous year, later on if 44AD has not been taken, then in such case for the next 5 years also compulsorily do tax audit. Okay. However, one relief is been given in case of 44AD and 44ADA. If the income itself is lower than the presumptive income itself is lower than basic exemption limit, then no need to do tax audit. Fine. Who will do tax audit? Answer is chartered accountant will do the tax audit. Next, what is the tax audit form? Form 3CA, 3CB and 3CD. If an organization or assessee is already subject to audit under any other act, in such case the form will be 3CA and 3CD. If the assessee is not subject to audit under any other law, then the audit form will be 3CB, 3CD. Okay. Now what is the due date for tax audit? Due date is 1 month prior to the due date of return of income under section 139 subsection 1. So what is the due date for return of income? It is 31st October. So what is 1 month before 31st of October? It is 30th of September. Hence due date for tax audit is what? 30th of September. Next, even in section 10AA, 35AD, 35D, 50B, 80JJAA and AMT, in all these sections also we will see that a chartered accountant report is compulsory. There also the due date will be 1 month prior to the due date of furnishing return of income. Okay. Now if tax audit is not done, what is the penalty? Penalty is 0.5% of turnover or 1,50,000, whichever is less. Now let's come to presumptive income. Firstly, let us discuss section number 44 AD. Who is eligible for 44 AD? Only a resident individual HUF and partnership firm, not being an LLP, are eligible for 44 AD. So who is eligible? Resident individual HUF firm other than LLP. Okay, with a turnover of up to 2 crores. If turnover is more than 2 crores, a person cannot opt for 44 AD.
But now there is a higher limit of up to 3 crores. So if the turnover is more than 2 crores and within 3 crores, then you have to satisfy one condition. What is the condition? The condition is that the total cash receipt should be within 5% of the total turnover or gross receipts. And in this case, even if there is a check or bank draft which is not an account pay check or not an account pay bank draft, then it will be considered as cash. Okay, so here I can also tell you total cash receipts plus, or you can, if you want, you can write this. Okay, total cash receipts plus non account payee check plus non account payee bank draft. Should be within 5% of total turnover or total gross receipts during the year.
Now, if you have chosen the scheme of 44 AD, you have to show presumptive rate of income. Presumptive rate means 8% in case of non-banking transaction and 6% in case of prescribed modes. So 6% in case of prescribed modes, 8% in case of other than prescribed modes. So for example, if my turnover is 1 crore 80 lakhs, okay, and if 1 crore is in prescribed modes, I will take 6% of 1 crore, and balance 80 lakhs which will not be in prescribed modes, I will take 8%. Then both of them I will add together and the total value will be called presumptive income. On this presumptive income, all the deductions are deemed to be allowed. No further deduction will be allowed. It means this is only the final profit. Okay. Now, what if the actual profit is higher than the deemed income itself? In such case, show that higher profit. Okay. Higher than the presumptive income itself. In such case, show the higher profit. So, for example, let's say my presumptive income has come to 12 lakh 40,000, but actual profit is 13 lakhs. In such case, what I should show as presumptive income? Answer is 13 lakhs. If the actual profit itself is higher than the presumptive income, show the actual profit. That's what I'm trying to say. Next, all the deductions are deemed to be allowed. Okay, one second. Okay, all deductions are deemed to be allowed. No need to maintain books of accounts and audit. So if at all an assessee is choosing the presumptive income section of 44 AD, then the assessee need not maintain books of accounts. Also, assessee need not get the books of accounts audited from a chartered accountant under 44 AB. However, section 44 AD will not be applicable to number 1, the persons who are eligible for other presumptive sections, that is 44 ADA and 44 AE. So if I am eligible for 44 ADA, I cannot opt for 44 AD, or if I am eligible for 44 AE, then also I cannot opt for 44 AD. Then if any assessee is getting an income of commission or brokerage, then also 44 AD is not possible. So in the P&L account, if you are finding any commission income or brokerage income, don't choose 44 AD. Then if an assessee is engaged in agency business, he also cannot opt for 44 AD. And then last, if a person is showing lower profit for 44 AD till 5 years after such year. So what is the clause? See Karna, if 44 AD has been opted once, assessee has to compulsorily take it for 5 more years. If not, the scheme is not applicable for 5 more years. You get my point? So for example, in year 1 if I took 44 AD, then in year 2, year 3, year 4, year 5 and year 6, compulsorily I should take 44 AD again and again. If at all I do not take it in between the year, for example in year 5 I did not choose 44 AD, then what will happen? Then for 5 more years, that is year 6, 7, 8, 9 and 10, compulsorily I cannot go for 44 AD. I have to get my books of accounts audited and also maintain the books of accounts compulsorily. Okay. Next, in 44 AD there is one more benefit. Advance tax need to be paid only in one installment, that is at the year end. Okay. And if 44 AD is not taken, however, if income is below the basic exemption limit, then no need to do tax audit. Okay. Now let's come to section 44 ADA, which speaks about profession. Okay. Now here also there is an amendment. Who can opt for section 44 ADA? Answer is resident individual or partnership firm other than LLP. Resident individual or partnership firm other than LLP. Hence now LLP cannot opt for 44 ADA section. Okay.
In section 44 ADA also, there is a higher limit of 75 lakhs. We have learned that the limit is 50 lakhs. Now, the assessee can also claim a higher limit of 75 lakhs if the total cash receipts is within 5% of the total turnover or gross receipts. In this case, there will be only gross receipts.
Who are covered under section 44 AA can choose section 44 ADA. What is 44 ADA? 44 ADA tells that show a presumptive income of 50% of the gross receipts. Okay, or such higher sum. If the actual profit is higher, then show the higher profit. If actual profit is lower, then show at least 50% as the profit. Then you can come in this 44 ADA section. After showing this presumptive income, all deductions are deemed to be allowed, means no further deduction will be allowed. If this presumptive income is chosen, then no need to maintain books of accounts, no need to do tax audit. Okay, and then even for advance tax, only one installment needs to be paid at the year end. Okay, if 44 ADA has not been chosen, what did I tell you? Tax audit is compulsory. However, if income itself is below basic exemption limit, then tax audit is not compulsory. Okay. Next, let's talk about section 44 AE. Who can opt for section 44 AE? Any person who is the owner of goods carriages up to 10 vehicles at any time during the previous year. At any time during the previous year, maximum how many vehicles I should have? 10 vehicles. Only then I can come in this section. What if during the previous year I have 11 vehicles just for one day? Even if for one day alone I am having more than 10 vehicles, I cannot come in this section. Okay, that is the first point. Now let us see how to calculate presumptive income. Number one, we have to differentiate the vehicles between heavy vehicle and not heavy vehicle. So heavy vehicle means what? A vehicle whose gross vehicle weight is more than 12 tons or 12,000 kilos. Not heavy vehicle means gross weight is up to 12 tons or 12,000 kilos. Okay. Gross vehicle weight means vehicle weight plus load weight. Now, for heavy vehicle, how to calculate the presumptive income? It is 1000 per month per ton or part of a ton of vehicle weight. For not heavy vehicle, how to calculate? It is 7000 per month per vehicle. 7000 per vehicle per month. Then after finding both of them, add both of them together, you will get the total presumptive income. Okay. Now, for this 44A, there is one more benefit. What is the benefit? The benefit is that 40B is still allowed even after the deemed income, presumptive income. So, for example, if the presumptive income is 5 lakh rupees, after this 5 lakhs, I can again allow 40B. What is 40B? Interest on capital and remuneration paid by partner to the partnership firm. It can be allowed as deduction even after the presumptive income. Okay. If presumptive income is chosen, what to do? No need to account, don't need to maintain books of accounts, no need to get the tax audit done. Okay. That is the benefit. Now, here be very careful. Here usage is not considered, here ownership is considered. That is why even if I am having a truck, okay, and the truck I am not using at all during the year, still I have to calculate the presumptive income for that truck. You get my point? So ownership is only important, usage is not important in this section. Okay, I hope you are clear with the presumptive income section also. So the remaining provisions we will discuss in part 3 of the PGBP revision series. So see you in the next video, dear. Till then, take care. Bye bye. Hello everyone, I am CA Prateek and you are watching the third part of the revision lecture for the PGBP chapter for CA Intermediate examinations. Let us get straight into the video. Basic parts of the PGBP we had discussed in the first two parts of the revision lecture. In this video we are going to discuss about the special businesses. Firstly, let us start with speculative business. Sir, what is speculative business? Speculative business is a business where there is purchase or sale of commodities, including stocks and shares, without the delivery. So, if there is no delivery in the purchase or sale of commodities, stocks or shares, etc., then it is called speculative business. For example, intraday trading of shares. It comes under speculative business. It means a business which plays purely on price difference, that is speculation. Okay, now why is this speculation business special, sir? Because loss of the speculation business can be set off only against the profit of the speculation business, and speculation business can be carried, loss can be carried forward only for a period of 4 years, which you are going to link with the set off and carry forward chapter. Now be very careful, dear students, because if you find any words such as derivatives, futures, options, currency futures, forward contract, hedging contract, etc. at recognized stock exchange, then don't confuse it to be speculative business. It is actually normal business. Okay. Now let's come to section 35 AD. Section 35 AD is a deduction which is allowed for some specified businesses. However, 35 AD benefit is not allowed for the assessees who are choosing the option of the new tax regime under section 115 BAC. So very important. Now, what are the specified businesses? What are the specified businesses? There are 14 specified businesses. Number 1, cold chain facility for agricultural produce. Number 2, warehousing for agricultural produce. Number 3, warehousing for sugar. Number 4, laying of natural gas, crude or petroleum oil pipeline network. However, this business is there, no, natural gas, crude, petroleum oil pipeline network. This is allowed only if it is an Indian company and if the company makes the pipeline available for the others, okay, to use the pipeline. Next, number 5, slurry pipeline to transport the iron ore. Number 6, a hotel which is of 2-star or above category, means 2-star, 3-star, 4-star, 5-star hotel which is in India. Next, hospital with at least 100 beds in India. Number 8, housing project for slum redevelopment. Number 9, housing project for affordable housing. Number 10, inland container depot or container freight station. Number 11, semiconductor wafer fabrication manufacturing unit. Number 12, new infrastructure facility in public-private partnership mode. And number 13, production of fertilizer. And finally, number 14, beekeeping and production of honey and beeswax. So all these 14 businesses are called specified businesses. Sir, what is the benefit given to specified business? The benefit given to specified business is that it can claim 100% of the deduction, okay, of the capital expenditure also in the year of commencement. It can also claim 100% deduction on the prior period expenses. Okay, so very big deduction is given. However, section 35 AD benefit is optional. This is an amendment which is applicable for May 21 exam onwards. Section 35 AD benefit is now an optional benefit. Okay. Next, however, 35 AD benefit, that is 100% deduction on the capital expenditure and even prior period expenditure, it is not available if the expenditure is for goodwill, financial instrument or land. So no benefit for goodwill, no benefit for financial instrument, no benefit for land. Okay. Then again, no benefit of section 35 AD deduction is given if the payment, that is the expenditure, it is made to a person in a day, exceeding rupees 10,000 in any mode other than account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode like credit card, debit card, net banking, IMPS, UPI, Bhim Aadhaar Pay, okay, NEFT, RTGS, etc. So the payment to procure the capital assets should only be via the prescribed modes. If it is not in the prescribed mode and the payment is more than 10,000 to a person in a day, then such amount is not eligible for the deduction. Okay. Then the business should be a new business. It should not be commencing by splitting up or reconstruction of an existing business. Then if 35 AD is allowed, then on the same amount, the deduction like 10AA and income based deduction under chapter 6A are not going to be allowed as deduction. Okay. Then in case of plant and machinery, only new plant and machinery is allowed for deduction. However, if old plant and machinery is within 20% of the total plant and machinery, then old plant and machinery will be considered as new plant and machinery. Hence, deduction is allowed for old also. And one more thing, if there is an imported plant and machinery, that is a plant and machinery which was used outside India and now it is brought into India, it is also considered as new plant and machinery if no depreciation has been claimed on such plant and machinery. Okay. So this was new plant and machinery. Next, if there is any loss, okay, after if there is any loss from the specified business, then it can be set off only against the profit of specified business, and loss of specified business can be carried forward for infinite number of years. Okay. Then if an assessee claims the benefit of section 35 AD deduction for the purchase of certain asset, then that asset has to be used in the specified business for at least 8 years. Okay. If it is sold or destroyed within 8 years, then the amount received on sale or the amount received by the insurance company will be treated as income under PGBP. And one more thing, if before 8 years itself the assessee uses the 35 AD specified asset in a business other than the specified business, then the PGBP income will be deduction claimed under section 35 AD earlier minus depreciation that would have been allowed had the 35 AD deduction not claimed, okay, will be the income under PGBP. I'll repeat once again, if the assessee uses the 35 AD asset before 8 years itself in a non-specified business, then PGBP income will arise. What is the PGBP income? PGBP income is deduction which is already claimed under section 35 AD minus the depreciation that would have been allowed on such asset. Okay. And this same amount that will become the PGBP will also become the cost of the asset for the business, that is non-specified business, for claiming depreciation. Okay. I hope you get my point. Similarly, this income is not applicable for sick industrial company. So if a company is a sick industrial company, then even though it transfers its asset from a specified business to a non-specified business, no need to tax any income. Okay. So I hope you are clear with section 35 AD. Very important, sir. Do solve the questions under section 35 AD to be thorough with the provision. Now let us see. Okay, let us first see section 10AA. Section 10AA, deduction for special economic zone. The section 10AA deduction for special economic zone is also not available for section 115 BAC, that is the assessee who is choosing the new tax regime. Okay. Firstly, who is eligible for SEZ deduction? Firstly, a person should be manufacturing or producing or providing services. Okay. And the assessee should be defined as an entrepreneur as per section 2J of the Special Economic Zone Act of 2005. Only then the assessee is eligible. Then there are certain conditions to claim the SEZ deduction. First condition in sir. First condition, the manufacture or production or service should begin between 1/4/2005 till 31/3/2020. Okay. However, there is an amendment which has been added which is telling that even though the service providing or production or manufacture did not begin within 31/3/2020, if the assessee has got the letter of approval required under the Special Economic Zone Act, then also the deduction is available to such assessee. Okay, next, the unit in the SEZ should be a new unit. It should not be by splitting up or reconstruction of an existing business. However, if an assessee is covered under section 33B, then this condition is not applicable. Okay, not so important, ignore it. Now, in here also, the condition is that only new plant and machinery should be used. However, old plant and machinery is allowed if the old plant and machinery is within 20% of the total plant and machinery. And if a plant and machinery is imported from outside India to India, even though it is a used one, it will be considered as new if no depreciation has been claimed on such plant and machinery. Okay, so the same point we learnt in 35 AD also, we are learning in 10 AA also. And here you have to get a report of a chartered accountant certifying the correctness of the deduction under section 10 AA. Only then, after all these conditions are satisfied, 10 AA deduction can be availed by the assessee. Now let us see how to calculate the deduction. Deduction under 10 AA is equal to export turnover of the SEZ unit divided by total turnover of the SEZ unit multiplied by profit of the SEZ unit. So export turnover divided by total turnover into profit of the SEZ unit. Okay, be very careful. So in the first 5 years of the business, 100% of the above amount, that is the formula amount, will be allowed as deduction. In the next 5 years, 50% will be allowed as deduction, and in the further 5 years, 50% will be allowed as deduction, subject to the condition that the amount should be transferred to SEZ reinvestment reserve account. So what will be the deduction in the year 11 to year 15? Amount transferred to SEZ reinvestment reserve or 50%, whichever is lower. Now, export turnover means what? The consideration for export brought into India. Total turnover means what? Total turnover of the SEZ unit. From all these turnover, you should reduce if there is any freight, telecom or insurance to deliver or render the service outside India, or if there is any expense in foreign exchange to render the service outside India. Okay, export turnover, total turnover and profit should be taken only of the SEZ unit. So here you have to be very careful. Then if there is on-site development of computer software or service outside India, it will be considered as deemed export. Next, if there is any loss that is to be brought forward, then you have to reduce that loss from the eligible deduction and only the remaining deduction can be claimed by the assessee. Fine. Now, condition for further 5 years. So if the assessee wants to claim the deduction under in year 11 to year 15, then amount has to be transferred to SEZ reinvestment reserve account. This SEZ reinvestment reserve account is nothing but a provision created in the balance sheet. So the money will be lying with the assessee only. It should not be deposited in any bank or anything. The money will be with the assessee only. However, it should be separately kept as SEZ reinvestment reserve account. And this SEZ reinvestment reserve account money should be used to buy a new plant and machinery. Okay, within 3 years from the end of the previous year in which the reserve was created. Okay, then the particulars of the above should be submitted along with the return of income. Now I told you that the SEZ reinvestment reserve money should be kept by the assessee safely. Okay, the assessee should not use this money to give dividend. The assessee should not remit this money outside India, and the assessee should not remit the money outside India for creating an asset outside India. Okay, if the amount is misutilized, means if it is used for one of the three purposes, then such amount will be deemed as PGBP in the year of misutilization. And if within 3 years the assessee is not able to purchase any plant and machinery, then after 3 years that amount will become deemed PGBP, that is profit and gains of business or profession. So
there are changes in section 10AA, that is the section relating to SEZ. In your study material, it is given in the deduction chapter, but I am taking it along with PGBP chapter itself. So now itself you make the changes. So in section 10AA, sir, what change is there? There are three minor changes, Kanna. What are the changes? Number 1. The section 10AA deduction can be claimed only if the income tax return is filed within the due date. Okay, so within the due date to file return of income, the assessee should file the return. If not, then 10AA deduction will not be allowed. Then next update, it is that we have seen this export turnover, correct? Export turnover. Sir, what is this export turnover? Export turnover will only be considered as the convertible foreign exchange brought into India within 6 months from the end of the previous year or within further period as permitted by RBI. So what is considered as export turnover? Export turnover will only be the consideration which is in convertible foreign exchange. So it should be in foreign exchange, and that foreign exchange also should be brought within India within 6 months. Within 6 months from the end of the year, and if RBI gives further permission or further extension, then within that extended period it should be brought into India. Next, consideration is deemed to be received in India where export turnover is credited in a separate bank account maintained for that purpose outside India with the approval of RBI. So what they are telling now, listen here. Let's say a person is doing export to USA. From India to USA, let us take example of Mr. A, correct? So in USA, let's say the turnover made from India to USA is $1 crore, US dollar. Now what does the RBI tell? What does the act tell? The act tells that this 1 crore US dollar should come within 6 months from end of year. It should come to India, but sometimes it is not feasible to bring that money back to India. Maybe it might be required to be there in the US also for further expenditure. So what this person Mr. A will do, Mr. A will take permission from RBI and he will tell that I will maintain separate bank account in USA. Okay, please grant me permission that whatever money I put it in the separate bank account in USA, it should be considered as money received in India. If RBI gives the permission, then such money also will be treated as it is received in India or it is brought back to India.
Okay, other points not so important. So this was deduction under special economic zone. So since there is an amendment, you read this section carefully, there is a chance that it can come in examination. So now let us come to the next topic, that is agricultural income. So I told you that the constitution has not given the right to the parliament to tax agricultural income. The power is with state legislature. So Income Tax Act provides exemption on agricultural income via section 10 clause 1. 10 clause 1 provides exemption on agricultural income, but for that you should know what is agricultural income. Okay, first, agricultural income is defined under section 2 clause 1a. What is agricultural income? Number 1, rent or revenue received from a agricultural land. Okay, the land should be in India and it should be used for agriculture purpose. If the land is outside India, then that income is not eligible for the exemption under section 10 clause 1. Okay, so be very careful. So if a land is in USA and if I am getting agricultural income from USA agricultural land, the income is not exempt. It is very much taxable in India. Okay, now ownership is not necessary to get the rent. Okay, I told you example of subtenancy. So if I am getting the land on rent and I am giving the same land on rent to another person, then the rent that I am receiving, okay, it is also agricultural income if the land is a agricultural land. Next, number 2, any income received from the agricultural land by the activity of agriculture is called agriculture income. Example, plowing, sowing the seeds, etc. And also one special point, that Income from nursery, it is also agricultural income. Then if there is any process which is done to make the produce fit for the market, it is also agricultural income. I told you example of the process of removing the chaff from the paddy crops to get the rice. So this process, the income earned by doing the process is agricultural income. And finally, sale of agriculture produce. If raw crops are sold, example tomato, so if tomato is sold, then the money received from the sale of tomato is agricultural income. However, if the crops are sold after processing, you have to see whether the process was compulsory for sale or process was not compulsory for sale. If the process was compulsory for sale, for example rice cannot be sold in a raw form as paddy. Rice has to be processed. Okay, the paddy crops are processed and rice is sold. Okay, so hence when rice is sold, the process is compulsory for sale, hence it is agricultural income. However, if process is not compulsory for sale, example tomato ketchup, tomato can be sold directly also. However, if tomato is converted into ketchup and sold in the market, then it contains business income also, it contains agricultural income also. Sir, how are we going to differentiate both? Answer is using rule number 7. Rule number 7. In rule number 7, agricultural income, how to find agricultural income? Agricultural income is fair market value of the agricultural produce minus cost of agricultural produce. You will get the agriculture income. Then how to find the business income? Business income is equal to sale of the final product minus fair market value of agricultural produce that we had taken earlier minus any further cost that is done for agriculture. So I gave you example of tomato. If the example, the fair market value of tomato is 10 rupees, cost of tomato is 4 rupees, then agricultural income is 6 rupees. Then if selling price of tomato ketchup is 50, okay, in that you have to reduce the fair market value of tomato, that is 10, and further cost to make the tomato ketchup, that is 30 rupees. Hence 10 rupees will be business income. That is how we divided 16 rupees total income into business income of 10 and agricultural income of 6. Okay, I hope you are clear with the example. Now let's come to composite income, that is section 7a, section 7b and rule 7a, rule 7b and rule 8 of the income tax rules. Rule 7a talks about rubber, latex, crepice, senex, etc. In such case, A is to B, that is agriculture is to business, will be 65 is to 35. 65% agriculture income, 35% business income. In case of rule 7b, which talks about coffee, there are two categories. If coffee is grown and cured, then the ratio is 75-25. 75 agriculture, 25 business. If the coffee is grown, cured, roasted and grounded, then agriculture 60, business 40. So the ratio is 60-40. Sir, what will happen if the coffee is only roasted and grounded? If it is only roasted and grounded, then it is purely business income. Okay. Then rule 8 talks about tea. For tea, the ratio is 60-40. 60% agriculture income, 40% business income. Then I told you one special point. In case of these composite incomes, that is 7a, 7b and 8, the full depreciation has to be reduced from the cost of the asset, okay, to find the WDV. Next, so first, what is the agricultural income? Rent from the agricultural land. Second, income from the agricultural land, okay, and third point is income from farmhouse. Sir, what is a farmhouse? Farmhouse is a building which is on the agricultural land or in the immediate vicinity of the agricultural land, means it is just touching the boundary. Okay, income from farmhouse will be considered as agricultural income only if the farmhouse is used as a dwelling, that is a residence for farmers, or it is used for storage of the agricultural produce, else it will not be allowed as agricultural income. So now in all these points related to agricultural income, we spoke about agricultural land. Let us discuss what is agricultural land. Very simple, sir. Any land on which the agriculture is done is called agricultural land. Okay. This agricultural land can be a rural agricultural land or urban agricultural land. Now, what is a rural agricultural land? Agricultural land in a rural area is called rural agricultural land. Okay. Then what is urban agricultural land? Any agricultural land which is in the urban area, and it should be assessed to land revenue, and it should be assessed to land revenue only if both the conditions are satisfied. It will be called agricultural land. So rural area na enna, if a land is in rural area, it will be considered rural agricultural land. But if the agricultural land is in urban area, it will be called as an agricultural land only if it is assessed to the land revenue. Okay, chitta, dangal, patta, etc, etc. Now, what is urban area? What is urban area? Urban area is an area with the population of 10,000 people or more as per the last census. 10,000 people or more. Then one more point. Okay, I gave you the example of Coimbatore. So if the population of Coimbatore is 10,000 or more, Coimbatore will be called urban area. If the population of Coimbatore is more than 10,000 up to 1 lakh people, the 2-kilometer area outside Coimbatore will also be called as urban area. If the population of Coimbatore is more than 1 lakh up to 10 lakh people, then the 6-kilometer area outside Coimbatore will also be called urban area. If the population of Coimbatore is more than 10 lakhs, then the 8 kilometers area outside the boundary of Coimbatore will also be called urban area. Okay, so I hope you are clear by seeing this circle and diagram. Fine. Next, I gave you some examples of agriculture and non-agriculture income. Sir, rent received from land for grazing cattle is agriculture. Sale of seeds, agriculture. Sale from flowers, creepers like money plant, etc., agriculture. Sale of bamboo, agriculture. However, income from milk of cattle or milk products, not agriculture. Livestock, not agriculture. Poultry, dairy farming, fishery also not agriculture. Basically, any income which is got from animals and not crops, it will not be called agricultural income. Then, for selling the agricultural produce, if I give any commission, that is also not agriculture income. Then, if I sell forest products like timber, etc., that is also not agricultural income. And if an agricultural company pays dividend to its shareholder, then the dividend received will not be called agriculture income. Okay. So those are the examples. Then in agricultural income, we studied the concept of partial integration. Partial integration. I told you in class that the government is not happy by giving so many benefits to the people. Okay, the government is telling you are getting the benefit of basic exemption limit also, you are getting the benefit of slab rate also, and you are getting the benefit of agriculture income exemption also. So they cannot tolerate this. Hence what they are doing, they are telling that whatever agriculture income is earned, that much they will block it in the slab. That much slab rate benefit will not be given to the assessee. Okay, I gave you detailed example in class. Let us see what are the conditions when this partial integration concept will apply. Partial integration concept will apply only if all the three conditions are satisfied. Condition number 1, the agricultural income should be greater than 5,000 rupees. Number 2, non-agricultural income should be greater than the basic exemption limit. And number 3, the assessee should be enjoying the benefit of basic exemption limit. So who are such assessees? Individual, HUF, AOP, BOI and AJP, that is artificial juridical person. So if all the three conditions are satisfied, you have to do partial integration. How to do partial integration? Step number 1. Compute the tax of agriculture income plus non-agricultural income. Step number 2. Compute the tax of agricultural income plus basic exemption limit. Okay. Step number 3. The total tax is equal to step 1 minus step 2. And then step number 4. You should add the surcharge, education cess, or reduce the 87A rebate if any. Okay, so like this you should do partial integration. So with this, agricultural income comes to an end. Now let us discuss the final concept, that is the concept of alternate minimum tax, AMT. Alternate minimum tax. I told you, right? The government is not happy when the assessees claim so many benefits. So an assessee who is claiming either the benefit of section 35 AD or section 10 AA or income based deductions under 80 IA to 80 RRB, then for such assessees alternate minimum tax is applicable. Okay, let us see what is alternate minimum tax. Firstly, it is non-obstante clause, means this section will override all the other provisions of the income tax law. Next, it is applicable to all the assessees except company. Sir, why not company? Because for the companies, MAT is applicable. MAT we will study in CA final. Okay. Now, for the assessees for whom the AMT is applicable, have to pay the AMT on adjusted total income, that is ATI, or the regular income tax, whichever is higher. So alternate minimum tax or regular income tax, whichever is higher, should be paid as AMT. Okay. What is the rate of AMT? It is 18.5 percentage of the adjusted total income, and in case of IFSC, that is International Financial Service Center, it is 9 percentage of adjusted total income. After finding this 18.5 percentage or 9 percentage, above that you should add 4 percentage education cess surcharge, etc. Okay. Now, how to calculate adjusted total income? Adjusted total income is basically the total income on which you should reverse all the deductions under section 35 AD, 10 AA and income based deductions. You have to reverse them. So how to reverse them, sir? First take the total income, okay, then add back the deductions which have been claimed under section 10 AA, then income based deduction under chapter 6A, that is 80 IA to 80 RRB, and then deduction under section 35 AD. So add them back. However, if 35 AD deduction will not be claimed, then the assessee can claim depreciation, correct? So the depreciation which would have been claimed should be reduced from this answer. So the final amount that is received will be adjusted total income. So what you should do? Total income, add back the deduction claimed under section 10 AA, okay, chapter 6A deductions, that is income based deductions, and then 35 AD deduction, and then reduce the depreciation on the 35 AD assets that would have been available. Okay, you will get the adjusted total income. On this ATI you should calculate 18.5 percentage. Now I will talk about AMT credit. Sir, I told you that actual income tax or alternate minimum tax, whichever is higher, should be paid by the assessee. So the assessee goes to the government and is telling the government that this is pure injustice. You are doing wrong. First, because of the deduction, my tax has become so low, and now you are not giving me the benefit of the lower tax. You are asking me to pay the alternate minimum tax. So the government is telling, chill bro, I will give you this alternate minimum tax as credit. Hence, whenever alternate minimum tax is greater than the regular income tax, then the difference will be available as AMT credit. This AMT credit can be carried forward for a period of 15 years. And when can you set off this AMT credit? It can be set off when regular income tax is greater than AMT, but it is restricted to the excess of regular income tax over AMT. So I gave you an example where the AMT is, let's say the AMT is how much? 18 lakhs, okay, and the regular income tax is how much? Only 4 lakhs. Then how much will be the AMT credit? The AMT credit will be 14 lakhs. Correct? That is the excess of AMT over regular income tax. How much should be actually paid to the government in the year? AMT should be paid to the government during the year. This 14 lakhs can be carried forward for 15 years. Correct? Finally, let's say after 3 or 4 years, let's say the actual income tax is 10 lakhs and the AMT is only 7 lakhs. Actual income tax 10 lakhs, AMT is only 7 lakhs. Then how much is the difference? Difference is 3 lakhs. So they are telling This 3 lakhs difference can be set off using this 14 lakhs credit. So this 14 lakhs will become 11 lakhs and this 3 lakhs can be set off. The balance, that is 7 lakhs, need to be paid to the government. And if there is a year in which AMT is not applicable, so let's say income tax is 10 lakhs and AMT itself is not applicable, hence it's 0, then this credit of 11 lakhs can be used to set off this entire income tax of 10 lakhs and nothing needs to be paid by the assessee. Okay. So read the provisions carefully. Sir, will the government give any interest over AMT? Answer is not at all. No interest on AMT credit. Okay. Any other provision like advance tax, interest under section 234 A, B, C, etc. should be calculated on AMT. If AMT is applicable, then advance tax and interest should be calculated on the AMT credit, not on the actual income tax. So be very careful. And in your examination, it is not necessary that the examiner will tell you directly to calculate the AMT. You should see whether AMT is applicable or not in the question and you have to find the answer. Okay, so question can be hidden one also. Next, who is exempt from AMT? Who need not pay alternate minimum tax? Firstly, we discussed companies are exempt from AMT because for them MAT is applicable. Next, any assessee who does not claim any deduction under 10AA 35 AD or income based deduction, for them also AMT is not applicable. Okay, then any individual, HUF, AOP, BOI or artificial juridical person whose adjusted total income is up to 20 lakhs, for them also AMT is not applicable. So if adjusted total income is above 20 lakhs, AMT applicable, up to 20 lakhs, AMT not applicable. Then even if AMT is not applicable, AMT credit is available, it can be set off against the regular income tax, which I already told you. Then, if AMT is applicable, assessee should get a report from a chartered accountant certifying the computation of AMT and adjusted total income. What is the due date of this report? It is 1 month before the due date to furnish return of income as per section 44 AB. Okay, tax audit. So these were the provision of AMT credit. Okay, so in detail I have given you the revision lecture for PGBP chapter. I hope you are thorough with it. Solve as many questions as possible so that you do not make any silly mistakes. Keep preparing. Okay, take care. See you in the next video. Till then, bye bye. Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise part 1 of the capital gains chapter for CA Intermediate Income Tax Examinations. And as usual, before beginning the revision, my humble request to you is to like this video, comment if you find this video helpful, subscribe to this channel dear if you have not already subscribed, and share it with your friends so that as many students as possible can get the benefit of this revision lecture series. So now without further ado, let us begin the revision. As usual, like any other head of income, even the capital gains head has a charging section and a computation section. The charging section is section 45 subsection 1 of the Income Tax Act, and it tells that capital gains is chargeable on transfer of capital asset in the year of transfer. So when does capital gain arise? When there is a transfer of a capital asset in the year of transfer. So now, firstly, let us discuss what is capital asset. Section 2 clause 14 defines a capital asset. Section 2 clause 14 defines a capital asset. Now, what is a capital asset? Capital asset is a property of any kind. Capital asset is a property of any kind. It can be movable, immovable, tangible, intangible, it does not matter. So, a property of any kind, movable, immovable, tangible, intangible, whether or not connected with the business or profession, is called a capital asset. So all kinds of property are included in capital asset. However, there are 6 exceptions to capital asset. What are the exception? Exception number 1 is stock in trade. So if there is any stock in trade, consumable stores or raw materials that are held for business or profession, then that is an exception to capital asset. It means that stock will not be considered as capital asset. However, except B. Now what is B point? B point tells that if a foreign institutional investor or a FII is having any stock, okay, as securities, then such stock will also be considered as capital asset. That is why if any foreign institutional investor is having a security as per the SEBI guidelines, it will always be considered as a capital asset. Whether it is stock or not a stock, it does not matter. Now let us come to other exceptions to capital asset. Exception number 2 is personal effects. Sir, what is personal effect? Personal effect means any movable property of personal nature. Movable property, personal nature. However, for personal effect also there are 6 exception. Personal effect is itself a exception. For that also there are 6 more exception. It means it is exception to exception. It means whatever I am going to tell now, it is included in the meaning of capital asset. What are included? Answer is JAD pass. What is JAD pass? JAD pass means jewelry, archaeological collection, drawing, painting, any other work of art and sculptures. Tell once again, jewelry, archaeological collection, drawings, paintings, any other work of art and sculptures. All these 6 items will be called capital asset. Even though they are personal effect, still they will be called capital asset. Okay, next third exception. What is the third exception? Rural agricultural land. So rural agricultural land is exception to capital asset. It means it is not a capital asset. Hence, if a rural agricultural land is transferred, no capital gains will arise. Next, specified gold bonds, that are 6.5 gold bonds, 6.5% gold bonds 1977, 7% gold bonds 1980, National Defense Gold Bond 1980. These will not be considered as capital asset. Then special bearer bonds of 1991 will not be considered as capital asset. Next, if there is a gold deposit bond under Gold Deposit Scheme 1999 or Gold Monetization Scheme 2015, then such bonds also will not be called as capital asset. And also we will learn in income from other sources that interest received on gold monetization scheme bond will be completely exempt. Then there is a new type of capital asset. What is the new type? That is unit linked insurance plan. So if a unit linked insurance plan is there on which on or after 1/2/2021, 1st of February 2021, if the premium paid per policy or aggregate of all policy combined during the year 2,50,000 or more, in such more than 2,50,000, in such case such unit linked insurance policy will also be considered as capital asset. So now let me summarize capital asset once again for you all. Very important definition karna. So what is a capital asset? A capital asset is a property of any kind, whether movable, immovable, tangible, intangible, whether or not connected with the business or profession. However, there are 6 exceptions. Exception number 1 is stock, consumable stores or raw materials used for business. Exception number 2 is personal effects. What is personal effects? Movable property of personal nature. However, there are 6 exceptions to personal effect. What are they? Jewelry, archaeological collection, drawing, painting, any other work of art and sculpture. So all these 6 items, even though they are personal effect, will be considered as capital asset. All the other personal effect will not be considered as capital asset. For example, if I am having a mobile phone for personal use, it is not a capital asset. I am having a car for personal use, it is not a capital asset. I am having a pen for personal use, this is not a capital asset. Then rural agricultural land is not a capital asset. Specified gold bonds, that is 6.5% gold bonds 1977, 7% gold bonds 1980, National Defense Gold Bond 1980 are not a capital asset. Special bearer bonds of 1991 will not be a capital asset. Gold deposit bond under Gold Deposit Scheme 1999 and Gold Monetization Scheme 2015 will not be called capital asset. Then if there is any security that is held by foreign institutional investor as per SEBI guidelines, it will always be called as capital asset. Okay. Then if there is a unit linked insurance policy on or after 1 February 2021, if the premium is more than 2,50,000 per policy or aggregate of all policy combined during the year, then such policy will be called capital asset. You get my point? So that is the definition of capital expenditure, capital asset. Now let us come to transfer. Sir, what is transfer? Transfer is defined under section 2 clause 47 of the Income Tax Act, where transfer includes sale, exchange, relinquishment. Relinquishment means what? To give up. Okay. And then extinguishment of any right, means any right is extinguished or given up and the right is given to some other person. For example, a license is transferred from one person to another person. This is called extinguishment of any right. Then compulsory acquisition is also transfer. So if government is coming and compulsorily acquiring the property of assessee, that will be called transfer. If capital asset is converted into stock in trade, it will be called transfer. Then even if possession of the property is given for a part performance of a contract, that will also be called transfer. A classic example is joint development agreement. Then, if there is any transaction which is having the effect of transferring or enabling the enjoyment of immovable property, that is also called transfer. This point I linked it with the house property chapter where we learned the deemed owner concept, in which I told you that if at all there is a apartment, that apartment is in the name of a cooperative society. The members are of the cooperative society will be the owner of the apartment. So when the member is transferring the membership from one person to another person, then the person who is receiving the membership will also receive the flat in the apartment, correct? Hence, when the membership is transferred from one person to another person, it is also means that the flat is transferred from one person to another person, hence it will be called transfer. Okay, then redemption of zero coupon bond. If zero coupon bond is redeemed, that also will be called transfer. So what are included in transfer? Sale, exchange, relinquishment, extinguishment of any right, compulsory acquisition, conversion of capital asset into stock in trade, then giving possession of the property in part performance of a contract, transaction having the effect of enabling or transferring the enjoyment of immovable property, and then redemption of zero coupon bond. So this is the transfer definition. However, now there are many transactions that are not regarded as transfer at all. It is given under section number 47. So whatever is given under section 47 will not be regarded as transfer. If it is not a transfer, no capital gains will arise. Okay, so now what are the section transaction? Number one, full or partial partition of HUF. So if HUF or Hindu undivided family, if the property is partitioned, then the capital gains will not arise in the hands of HUF. Next, if there is any gift or irrevocable trust also, there will not be any transfer. However, if sweat equity shares or ESOPs or specified security are given from the employer to the employee, that will be called transfer. Okay. Then, if holding company is giving to 100% Indian subsidiary company, it is not a transfer. Subsidiary company is giving to 100% Indian holding company, it is not a transfer. Amalgamating company is giving to Indian amalgamated company, then also it is not a transfer. Now what is amalgamation karna? Amalgamation is where one or more companies join together to form a new company. It is called amalgamation. What are the conditions for amalgamation as per Income Tax Act? Condition number 1. All the property of the amalgamating company should become the property of amalgamated company. All the liabilities of amalgamating company should become the liability of amalgamated company. And shareholders having at least 3/4 shareholding in the amalgamating company should get the share in amalgamated company. So from old company to new company. So when amalgamating company is transferring any asset to Indian amalgamated company, then it is not regarded as transfer. Next, if demerged company is transferring the asset to Indian resulting company, then also it is not regarded as transfer. Now what is demerger? Demerger means where one or more undertakings of a company is coming out of the company to form a new company. I gave you an example. For example, there is Titan company. Titan company is having three brands, correct? Titan, Fast Track, and Tanishq. Let's say Tanishq is coming out of Titan to form a new company called Tanishq Limited. This is called demerger. This is called demerger. Now, when demerger is there, some conditions should be satisfied for it to be called as demerger as per the Income Tax Act. What are the condition? Condition number 1. The transfer should take place as a going concern. It means when the new company is coming out, that is when Tanishq Limited is coming out of Titan, then Tanishq Limited should be a going concern company. Means its business should continue normally. Okay. Then all the property of the undertaking being demerged should become the property of the resulting company. All the liabilities of the undertaking being demerged should become the liabilities of the resulting company. The property and liability should be transferred at book value, not revalue. Okay. Then shareholders having at least 3/4 shareholding in the demerged undertaking should get the shareholding in the resulting company. If all these conditions are satisfied, then the transaction will be called demerger. And if demerged company is transferring the asset to Indian resulting company, then it is a transaction not regarded as transfer. Capital gains will not arise. Okay. Next, if shares are issued by resulting company when demerger took place. So see, listen here, Tanishq Limited will come out from Titan and form a new company. So old shareholders of Titan Limited will get the new shares of Tanishq Limited. When these old shares are converted to new shares, it is not called as transfer. Similarly, when shares are issued by amalgamated company, when amalgamation takes place. So when amalgamation is happening, old shareholders should quit their shares and they will get the new shares. This conversion from old shares to new shares will not be called as capital gain, or capital will not be called as transfer, and hence capital gain will not arise. Next, if there is any rupee denominated bond and if it is transferred outside India from one non-resident to another non-resident, then also capital gain will not arise because it is a transaction not regarded as transfer. If a government security is transferred from one non-resident to another non-resident outside India, then also it is a transaction not regarded as transfer. Next, if there is any sovereign gold bond issued by RBI, and if an individual is redeeming the sovereign gold bond, then such transaction will not be regarded as transfer. However, before the redemption, if individual is selling the bond to some other person, then it is very much transfer. Okay. Next, transferring jewelry, archaeological collection, drawing, painting, any other work of art, sculptures, photographs, etc. to National Museum, art gallery or public museum will not be considered as transfer. Next, if any bond, debenture stock or deposit certificate is converted into shares or debentures, then also it is not a transfer. Next, if preference shares are converted to equity shares, it is not a transfer. Next, if capital asset is transferred under reverse mortgage, then also it is not a transfer. What is reverse mortgage? Reverse mortgage is a system where a senior citizen is giving his house or his land and building to a bank to receive the money from the bank. The money can be received as a loan for up to 20 years also. It can be received as a monthly, quarterly or annual installment also. Okay. So when the senior citizen is giving the property to the bank, it is not regarded as transfer. Similarly, when the bank is giving money to the senior citizen, that entire money received by the senior citizen will be exempt under section 10 clause 43. However, later on, as I told you, if the bank will sell that property to someone else, then capital gain will arise normally. Okay. Next, listen here. If there is a consolidating scheme of mutual fund or consolidating plan of mutual fund, then also it is a not regarded as transfer. However, you have to make sure that two or more equity plans should convert to form a new equity plan, or two or more debt plans should combine to form a new debt plan. Only then this will not be regarded as transfer. However, if there is any other case, like for example, if equity and debt are mixed together, then it will be regarded as transfer. You get my point? So all these transactions are transaction not regarded as transfer. There is one more transaction also which we learnt in section number 46, that is distribution of assets on liquidation by a company. That is also transaction not regarded as a transfer. It is discussed in section number 46. Okay, so now we are clear with the charging section. So charging section says that transfer of capital asset in the year of transfer, if it is done, then capital gains will arise. We learned what is capital asset, we learned what is transfer, we learned what are all the transactions that are not regarded as transfer. Now let us see the computation section. Computation section is given under section number 48 of the Income Tax Act. First and foremost, you have to be clear. Sir, who has to pay the capital gains? Answer is Kanna. The transferor has to pay the capital gain. So if I am transferring my capital asset to some other person, I will give the capital asset and I will get the money. Correct? So I am the person who have to pay tax under capital gains. The transferor will pay the tax under capital gains. Now how to compute the capital gain? Firstly, you have to take the full value of consideration, FVOC, full value of consideration. Full value of consideration is nothing but sale price. Sale price. Okay. Then from that you have to reduce the transfer expense. Transfer expense means what, Kana? Any expense that is relating to the transfer. So for example, if I am selling my building, I am giving some brokerage expense to the broker for the purpose of selling the building. In such case, this brokerage will be called transfer expenses. But be clear with one point, security transaction tax will not be allowed as transfer expense. Okay. Then after reducing the transfer expense, you will get the net consideration. From the net consideration, you have to reduce cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement. After doing this, you will find the short term or long term capital gain or capital loss. From that you can reduce section 54 series exemption. Then finally you will find the taxable capital gains. Okay, so first what you have to do, take the full value of consideration, reduce the transfer expense. After reducing transfer expense, you will get net consideration. From the net consideration, you have to reduce cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement. After that, you will get the short term or long term capital gain or capital loss. From that, you can reduce the 54 series exemption. You will find out the taxable capital gains. Fine. So now let us see all the concepts one by one. Firstly, let us discuss the full value of consideration. In full value of consideration, there is only one concept, that is the concept of specified security. See here, in case of sweat equity or ESOP given to the employee, full value of consideration should be taken as fair market value on the date of transfer. So when the employer is giving the ESOP to the employee, then capital gains will arise in the hands of employer. For calculating such capital gain, full value of consideration should be taken as fair market value of the shares that are given to the employee on the date of exercise. Okay. Then I also told you, when the employee is receiving the shares, he has to pay tax under perquisite calculation under salary head of income, correct? And further, when the employee is transferring the shares to some other person, then the cost also will be that fair market value only. I hope that you are all able to recollect, and as and when we are discussing, we will also discuss all those points. So full value of consideration we discussed. After that, we have to discuss about cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement. But before knowing about indexation and everything, we have to know the concept of period of holding. So let us see the concept of period of holding. Sir, what is period of holding? Period of holding means period from starting from the period starting from the date of acquisition till the date of transfer. Date of acquisition till date of transfer. So when I purchase the asset till the time when I sell the asset, that entire time period will be called as period of holding. However, period of holding can be different in some special cases. Those cases also we will discuss one by one. Now, why are we discussing period of holding? Because based on the period of holding only, we can differentiate an asset between a long-term capital asset and short-term capital asset. Sir, what is long-term capital asset? Kanna, long-term capital asset means any asset other than short-term capital asset. Then what is short-term capital asset? In short-term capital asset, you have three categories. 1 year category, 2 year category and 3 year category. Sir, what is the 1 year category? 1 year category means any listed security other than units. Number 2, units of equity oriented fund and UTI. It can be listed or unlisted, it does not matter. And number 3, zero coupon bonds. So what are covered in 1 year category? Number 1, listed security other than units. Number 2, units of equity oriented fund and UTI, both listed as well as unlisted. And number 3, zero coupon bonds. So for all these three types of asset, if the asset is held for up to 12 months, it will be called as short-term capital asset. If it is held for more than 12 months, it will be called as long-term capital asset. Now let us come to 24-month category or 2-year category. In this case, there are two items. Number 1, unlisted shares. Unlisted shares. And number 2, land or building or both. So in those two, that is unlisted shares and land or building or both, if it is held for up to 2 years, it will be called as short-term capital asset. If it is held for more than 2 years, it will be called as long-term capital asset. Now let's come to 36-month category. All the remaining capital assets will be covered under 36-month category, including units of debt-oriented fund and also unlisted securities other than shares. Okay. So all the capital assets that are other than 12-month and 24-month category will be covered in 36-month category. So if it is held up to 36 months, it will be called short term. More than 36 months, it will be called long term capital asset. And one more special point I told you, if at all a land and building are sold together, in that case, if the land is long term, then for that land alone calculate the long term capital gain. If the building is short term, then for building you can calculate short term capital gain, calculate separately. Okay. Then now comes the question, why are we discussing about period of holding? Why should we know whether an asset is a long term capital asset or short term capital asset? Answer is there are two reasons, Kanna. First reason is the benefit of indexation is allowed only for long term capital asset, and second Reason is that if the long-term capital asset is transferred, then the capital gain or capital loss will be called long-term capital gain or long-term capital loss. If the short-term capital asset is transferred, then the capital gain or loss will be called short-term capital gain or short-term capital loss. So firstly, let us discuss about indexation. I told you that long-term capital asset will get the benefit of indexation.
What is indexation? Indexation is the process to find out the actual cost of acquisition as on the date of transfer in case of a long-term capital asset. To do indexation, we can use index numbers that are given under the Income Tax Act itself. For example, for 2001-2002, the indexation starts and the number is 100, which is the base number, and for previous year 23-24 or assessment year 24-25, the index number is 348. Sir, do we have to remember other year index number? Answer is not required, Karna. If any other year is given in the question, the index number for that year also will be given in the question itself. So how to find out the indexed cost of acquisition? Very simple. Indexed cost of acquisition is equal to cost of acquisition, which is nothing but the cost of purchase in most cases, multiplied by cost inflation index in the year of transfer. So for example, if the transfer is in the previous year 23-24, then here you have to take the cost inflation index as how much? 348. Okay, divided by cost inflation index in the year which is first held, or cost inflation index of 2001-2002, whichever is later. Sir, first held means what? First held means the date of purchase. The year of purchase is only the first held. In certain cases, the first held might change. That we will be discussing later on. And I have also told, or cost inflation index of 2001-2002, whichever is later. Sir, why are we doing this step 2001-2002, whichever is later? Because the indexation starts from 2001-2002. So if the asset is purchased before 2001-2002, that is, if the asset is purchased before 1/4/2001, in such case you have to take the cost inflation index of 2001-2002 only. But since you are taking the cost inflation index of 2001-2002, you have to also take the purchase price as on 2001-2002. That is why the Income Tax Act is also giving the assessee a benefit. What is the benefit? If the asset is purchased before 1/4/2001, then the assessee has the option to take fair market value as on 1/4/2001 or actual cost of acquisition, whichever is higher, as the cost of acquisition in this formula. Okay. So if the asset is purchased before 1/4/2001, then what you are going to do? Take the fair market value as on 1/4/2001 or actual cost, whichever is higher, will become the cost of acquisition. Here there is only one special point. Sir, what if there is a land or building or both purchased before 1/4/2001? In such case, you should also consider the stamp duty value, because it is given that fair market value as on 1/4/2001 should not exceed the stamp duty value. So maximum value you can take is stamp duty value. So in case of land or building or both, what you are going to do? If land or building or both is purchased before 1/4/2001, then take the fair market value or stamp duty value, whichever is lower. Okay, then whichever is lower or actual purchase price, whichever is higher, you take as the cost of acquisition. Fine, and then use it in the indexation formula to find out the indexed cost of acquisition. Now let us talk about another point. One more point is that the cost of acquisition or of the asset or cost of improvement thereto would not include the deductions claimed on interest under section 24B under the provisions of the chapter or under the provisions of the chapter 6A, that is 80EE or 80EEA. So what is given? Listen here, Karna. Sometimes what happens, to purchase a house, you take a housing loan, correct? For this housing loan, you will pay an interest. Fine. This interest, you can claim it as deduction in the Income Tax Act under section 24B, and you can also claim it as a deduction under chapter 6A under 80EEA and 80EE, correct? And 80EE. If you are claiming this interest as deduction under section 24B or 80EE or 80EEA, then this interest you should not add it in the cost of acquisition. Okay. This is applicable for long term capital asset also, short term capital asset also. So this you have to keep in mind. Now let us talk about improvement. Improvement means what? Any addition that is done in the capital asset. Now how to do indexation on improvement? Very simple kanna. Indexed cost of improvement is equal to total cost of improvement multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. Very simple. Sir, here why are we not doing cost inflation index of 2001, 2002, whichever is later? Answer is because we have to ignore all the cost of improvement that is done before 2001, 2002. What you have to do? If at all there is any improvement done before 1/4/2001, then ignore it. Why we should ignore it? Because while doing indexed cost of acquisition itself, it is already included in the fair market value. It is already included in the fair market value. That is why you have to ignore it. You get my point? So once again, in short, let me tell about indexation. How, if there is a long term capital asset, then you have to do indexation for the cost of acquisition also, for the cost of improvement also. How to find out the indexed cost of acquisition? Answer is cost of acquisition multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year first held, or cost inflation index of 2001 2002, whichever is later. Fine. In case of any asset that is purchased before 1/4/2001, you have to take fair market value as on 1/4/2001 or actual cost, whichever is higher, as the cost of acquisition. In case of land or building or both, if the land or building or both is purchased before 1/4/2001, then you should make sure that the fair market value does not exceed the stamp duty value. Then if at all any interest is claimed as deduction in the Income Tax Act, such interest you should not add it in the cost of acquisition or cost of improvement. Now when it comes to cost of improvement, how to find the indexed cost of improvement? Cost of improvement multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of improvement will give you indexed cost of improvement. Now very special point, if at all there is any improvement done before 1/4/2001, you have to ignore it. Okay, ignore it.
Okay, now there are 4 cases where indexation will not apply even though it is a long-term capital asset. What are the 4 cases? Case number 1, section number 112A. In section 112A, indexation will not apply. Second, for bonds and debentures also indexation will not apply because the value of bonds and debenture does not increase over time. However, for capital indexation bond and sovereign gold bond, for these two bonds alone, you have to apply indexation. Next, if a non-resident is purchasing and selling the shares or debentures of an Indian company in foreign currency, then what you have to do? Then you have to calculate the capital gain also in foreign currency and then convert the capital gain into Indian currency and do not apply indexation. So what did I tell? If there is a non-resident who is purchasing and selling the shares of an Indian company or debentures of an Indian company in foreign currency, then find out the capital gain also in foreign currency and convert it later on into Indian currency, but don't do indexation. Okay, next in section number 50B, that is slump sale, also indexation concept will not apply. Indexation will not apply. So 4 cases where indexation will not apply. Number 1, 112A. Number 2, bonds and debentures other than capital indexation bond and sovereign gold bond. Number 3, if a non-resident is purchasing or selling the Indian shares or Indian debentures in foreign currency. And number 4, section 50B, that is slump sale. So in 4 cases, indexation will not apply. Now we know the concept of indexation. Now let us discuss in detail the concept of cost of acquisition. So what is cost of acquisition, Karna? Very simple. Cost of acquisition means purchase price. Generally, cost of acquisition means what? Purchase price. Now let us discuss special cases of cost of acquisition. Firstly, let us discuss about intangible assets. So what are the intangible assets? Number 1, goodwill of business or profession. Number 2, trademark. Then right to manufacture, produce or process any article or thing, which is nothing but patent or copyright. Then right to carry on any business or profession, which is nothing but license, tenancy rights, stage carriage permits and lumars. Goodwill of business or profession, trademark, right to manufacture, produce or process any article or thing, right to carry on any business or profession, tenancy rights, stage carriage permits, that is the carriage permit from going from one state to another state given to a stage carriage. Okay, for example, a truck is having state permit, that is called stage carriage permit. And then loomars. Loomars means what? Handloom machine is given to people for using for n number of hours. It is called loom hours. So all these intangible asset, how to find out the cost of acquisition? Number one, if the intangible asset is purchased, then take the purchase cost. If it is purchased, then take the purchase cost. If it is self-generated, then take the cost as 0. If it is self-generated, take the cost as 0. And if it is other than purchase, it means if the intangible asset is received free of cost. If the intangible asset is received free of cost, then take the cost of previous owner. Okay, take cost of previous owner. And goodwill we already discussed in PGBP chapter, that now what has happened, goodwill depreciation will not be allowed from 1/4/2020 onwards. Hence, if goodwill of business or profession is there which was treated as depreciable asset till previous year 1920, then what will be the cost of acquisition of goodwill? Cost of acquisition will be purchase price of goodwill reduced by the depreciation that was claimed till previous year 1920. In short, the WDV as on 1/4/2020 will become the cost of acquisition. Okay, for goodwill. Now, one special point is that for intangible asset, there is no benefit of fair market value as on 1/4/2001. So for intangible asset, even if the intangible asset is purchased before 1/4/2001, just take the purchase price. No need to consider the fair market value. And one more thing, if there is any intangible asset which is not covered in the list that we have mentioned in section number 55 now, then for such intangible asset, you cannot determine the cost of acquisition, and that is why the computation will fail and no capital gains will arise, as per BC Srinivasa Shetty case. So as per BC Srinivasa Shetty case, if there is any intangible asset on which cost of acquisition cannot be determined, then even the capital gains cannot be determined, and hence no capital gain will be taxable. Okay, so now we have discussed the intangible asset. One more point about intangible asset is that if there is any improvement in the intangible asset, cost of improvement, it means any capital expenditure is incurred for the intangible asset, then take the value of such improvement as 0. Always take the value of improvement as 0 for intangible assets. Okay, I hope you are clear. Now let's talk about the other capital assets. Firstly, for different points that I am going to discuss, I want you to know the concept. What is concept number 1? Concept number 1 is that if the assessee is receiving any asset free of cost and he does not pay any tax for it, then the cost of acquisition can be taken as the cost of the previous owner. Period of holding also take it from the previous owner. But indexation alone, there are two methods. For indexation, take it from the previous owner as per Manjula J. Shah case, or if you are following the Income Tax Act, you have to take it from the current owner. So what did I tell? If an assessee is receiving a capital asset free of cost and does not pay any tax for it, okay, in such case, cost of acquisition can be taken as cost of previous owner, period of holding can be taken from previous owner, but indexation should be taken from current owner. However, only in Manjula J. Shah case, you can take indexation also from the previous owner itself. Okay, I discussed also. Am I able to find? One second. See here. So, for example, if an asset is purchased in 2003 for 2 crore rupees, okay, listen here. Let's say a father is there. A father gave an asset to his son in 2018. That asset was purchased by the father in 2003 for 2 crores. Okay, the son got the asset free of cost from the father. Then the son has sold the asset to Mr. X in 2022 for 5 crore rupees. So now what will be the cost of acquisition in the hands of son? In the hands of son, cost of acquisition will be the cost of previous owner. That is the cost to his father. Hence it will be 2 crores. Cost of acquisition will be how much? 2 crores. Then what will be the period of holding? Period of holding also should be taken from the previous owner. That means from 2003 onwards till 2022 you have to take the period of holding. But what about indexation? In indexation there are two methods: normal method, Manjula J. Shah case method. So what is the normal method? In normal method you have to take the cost of acquisition of previous owner, then multiplied by the cost of acquisition in the year of transfer, but divide it in the cost of acquisition of for cost inflation index in the year it which it is first held, that is 2018. So normal method is what? Take the 2 crores multiplied by 317, that is the cost inflation index in the year of transfer, divided by cost inflation index of 2018 and not 2003. This is the normal method. Means take cost inflation index from current owner. But there was a case in Bombay High Court which is applicable only to Maharashtra state, the case of Manjula Jesha. In Manjula Jesha case, what will happen? You have to take cost of acquisition from previous owner, okay, multiplied by cost inflation index in the year of transfer and divided by cost inflation index also from the previous owner itself, that is from 2003. So in Manjula Jesha case, cost inflation index will apply from previous owner, but in any other case it will apply from current owner. In your exams, which method you should apply? Answer is you are free to apply whatever method you want, but you should also mention that there is another method in the examination answer. My suggestion is to follow the normal method and put a note and write that alternatively even Manjula Jesha case method can be followed to calculate the indexed cost of acquisition. Okay.
Now, along with this concept, you should also keep in mind the concept of the newly added provisions of electronic gold receipt, that is, gold converted into electronic gold receipt or electronic gold receipt converted into gold. Now, in such case, what happens whenever electronic gold receipt is converted into gold or gold is converted into electronic gold receipt? In such case, it is a transaction not regarded as transfer. It is a transaction not regarded as transfer, hence capital gain does not arise. Hence, in such cases also, the same concept will apply. The period of holding of gold in case of gold converted into EGR will also include the period for which the gold is held prior to the date of conversion. Similarly, the cost of acquisition of the EGR also will be the cost of gold in the hands of the person in whose name the EGR is issued. Similarly, whenever EGR is converted into gold, then what will happen? The period of holding of EGR will also include the period for which the EGR is held prior to the conversion. So that period of holding of EGR will also include the period of holding of gold. Similarly, the cost of acquisition of gold will be the cost of acquisition of EGR in the hands of such person.
So next concept number 2. Concept number 2. What is concept number 2? If assessee's old asset is converted into new asset, then cost of the old asset will become the cost of acquisition of the new asset. Period of holding also should be taken from the old asset. Indexation also should be taken from the old asset. Okay. For example, preference shares converted into equity shares, etc. etc. Next, concept number 3. If assessee has paid the tax, okay, on income and he is getting an asset, in such case the value of that asset that was considered for the income calculation will become the cost of acquisition of that asset in the hands of assessee. If the assessee has paid the tax while receiving the asset, then the amount considered as value of asset while calculating the income will be taken as the cost of the acquisition. Period of holding and indexation should be taken from the day on which the assessee is receiving the asset. So for example, I gave you an example of ESOPs, correct? So when employee is receiving the ESOP, he will pay the tax under salary head of income as perquisites, correct? To calculate the perquisite, what was the fair market value of the shares that was taken will become the cost of acquisition of the shares in the hands of employee for future calculation. Similarly, under 56.210, that is for the gift if it is received for any inadequate consideration or no consideration, the value of the asset considered as fair market value while receiving the asset will become the cost of acquisition of that asset for future calculation. Okay. Similarly, if a stock is converted into capital asset, then on the fair market value of the stock, tax is paid under PGBP head of income. That is why the fair market value of such stock will become the cost of acquisition for capital gain purposes. You get my point? I hope you are clear. So concept number 4. If previous owner cannot be determined by the assessee. Then what to do? In such case, take the fair market value on the date on which the asset became the property of the assessee, and from that day itself you start calculating the period of holding and indexation also. Okay. Now let us see the cases in the study material one by one so that you will become very clear. So see here, in all the cases that I am going to tell now, you have to take the cost of previous owner as per the concept. See here, distribution of assets on full or partial partition of HUF, then any gift or will that is received, any succession, inheritance or devolution, any distribution of assets on the liquidation of company, any transfer to a revocable or irrevocable asset, if any holding company is transferring to 100% Indian subsidiary, if any amalgamating company is transferring to amalgamated, demerged company transferring to resulting, and also if individual is converting his property into HUF property, in such case also the when the property comes in the hands of HUF, the cost of the property will be the cost of the previous owner. That is the cost of individual. Okay, conversion of individual of his separate property to HUF property. Then I told you about Manjula J. Shah case. Now let us see the next case. Listen here. So in the scheme of amalgamation, when the old shares, that is the shares of amalgamating company, are converted into shares of amalgamated company, then cost of acquisition will be the cost of acquisition of the old shares. That is the cost of acquisition in the shares of amalgamating company. Now let's talk about conversion of bonds, debenture stock or deposit certificate into shares or debentures. In such case also, the cost of acquisition of the old shares will become the cost of acquisition of the new securities. Okay, old security will become the cost of acquisition of new security. Next, if there is any specified security or sweat equity shares, I already told you, cost of acquisition should be taken as fair market value, which has been taken into account for perquisite calculation. Next, if any equity shares is received at the time of conversion of preference shares. So if preference shares is converted into equity shares, then cost of acquisition of the new equity shares will be the cost of acquisition of the preference shares. Okay. Next, if cost, what will be the cost of acquisition of shares received in resulting company in the scheme of demerger? See, I gave you an example, Nokana. See here, Titan Limited is there. Old Titan Limited, it is having two brands, that is Tanishq and Titan. So now Tanishq is coming out of Titan and forming a new company, Tanishq Limited, and balance will be called New Titan Limited. Okay, so from old Titan, two companies are coming out. New Titan and Tanishq. In such case, this is called demerger, correct? Now, how to find out the value of the Tanishq company shares, that is New Tanishq Limited shares? New Tanishq Limited shares value will be A multiplied by B divided by C. What is A multiplied by B divided by C? A is cost of acquisition of shares held in the demerged company. B is the net book value of assets transferred in demerger, and C will be the net worth of the demerged company. So in my given example, how to calculate the value of the new Tanishq company shares? It will be what? Cost of old Titan company shares multiplied by value of assets transferred to Tanishq divided by net worth of old Titan company shares or Titan company. So how to calculate the cost of new Tanishq shares? It will be cost of old Titan shares multiplied by value of asset transferred to Tanishq divided by net worth of old Titan. Net worth of old Titan. How to calculate the net worth? Net worth means aggregate of paid up share capital and general reserve. Aggregate of paid up share capital and general reserve. Now comes the question, what will be the value of new Titan shares? What will be the value of new Titan shares? Very simple. The value of old Titan shares minus value of the Tanishq company shares will be the value of new Titan shares. Very simple. Correct? I hope you are able to understand. Next, cost of acquisition of the property subject to tax under section 56(2)(10). So if already tax is paid under 56(2)(10), then the fair market value considered for 56(2)(10) will become the cost of the acquisition. Next, cost of acquisition in case of section 45(5)(a), that is joint development agreement. This we will discuss in joint development agreement concept itself. Next, this also I told you what will happen when capital asset which was used as inventory is converted into capital asset. When stock is converted into capital asset, what will happen? Fair market value on date of conversion will be treated as cost of acquisition of capital asset. Now let us see remaining points. Then we discussed about financial assets. So financial asset means what? The different types of securities. In case of financial asset, what will be the cost of acquisition? Very simple. Cost of acquisition will be the purchase price. Now let us talk about right shares. What is the right shares? I gave you an example in class. For example, Infosys Limited. Infosys company is there. It will give exclusive right to its old shareholders to buy the new shares, because if it is not giving the exclusive right, the shareholders will get very angry. So it will get the exclusive rights. So now when Infosys is giving me exclusive right, there are three options that can happen. Listen here. So let's say I am the shareholder. Infosys is giving me the right to buy the Infosys shares for 690 rupees. In such case, what I can do? Option number 1. I will give 690 rupees to Infosys and I will get the shares. Correct? This is called exercising the right. This is called what? Exercising the right. Next, I will not do anything at all, so my rights will lapse. It will get expired and nothing will happen. But generally, this will not happen because I am having option number 3. What is the option number 3? Option number 3 is called renouncement of right. Renouncement of right means what? This right I will give to some other person. Let's say I am having the right to buy the Infosys company shares. This right I am giving to Mr. X for 10 rupees. This right I am giving to Mr. X for 10 rupees. This is called renouncing the right. Now Mr. X will get the right from me and then he will pay 690 rupees to Infosys and he will get the Infosys company shares. So these are the three type of transaction. Now let us see what happens in this transaction. Firstly, if right is exercised, it means what? I am buying the Infosys company shares myself. In such case, the amount of 690 rupees paid to Infosys will be the cost of acquisition and period of holding should be calculated from the date on which I am receiving the shares. That is from the date of allotment. Okay. Now what will happen when right is renounced? So when I have renounced my right, that is I have given my right to Mr. X, in such case cost of acquisition will be 0 because Infosys is giving me the right free of cost. Hence the cost will be 0. Selling price will be what? Selling price will be 10 rupees. So the capital gain will be 10 rupees. Okay. And the period of holding should be calculated from the date on which Infosys has given me the offer till the date on which I am selling that right to some other person. Okay. Next, right acquired. Right acquired means what? When Mr. X is receiving the right from me, in such case, what will be the cost of acquisition? Answer is, cost of acquisition is the amount paid to the right seller. That is, in our example, it is 10 rupees. And then you should also include amount given to company, that is 690 rupees. So total cost will be how much? 700. So he is paying how much rupees? 700 rupees to get the Infosys company shares. 10 rupees he is paying me and 690 he is giving to Infosys company. So total 700. And what will be the period of holding? Period of holding should be taken from the date of allotment of the shares. Okay, this is the concept of right shares. Now let us discuss bonus shares. So bonus shares means what? The company is giving shares free of cost to the existing shareholders. Existing shareholders. I gave you an example. If Infosys is giving a bonus of 2:1, it means 2 bonus shares are given for every 1 share that is held by the assessee. If bonus shares are given before 1/4/2001, then take the fair market value on 1/4/2001 as the cost of acquisition. If the bonus share is received after 1/4/2001, on or after 1/4/2001, then cost of acquisition will be 0. Cost of acquisition will be how much? 0. Okay. For other capital asset, we have already discussed how to find out the cost of acquisition and cost of improvement. So now you know all about cost of acquisition, cost of improvement, full value of consideration, transfer expenses. So you will easily be able to find out the capital gains. Let us see one illustration quickly. See here. An asset is there, capital asset. It is purchased on 1/7/1996 for 50 lakh rupees. Improvement is done on 1/8/1999 for 10 lakh rupees. Another improvement is done on 1/9/2017 for 5 lakhs. Cost inflation index of 1718 is 272. Fair market value of capital asset as on 1/4/2001 is 70 lakhs. Capital asset is sold on 5th of June for 3 crores. Transfer expense is 1 lakh. So now how to calculate the capital gain? Firstly, take the full value of consideration. It is how much? 3 crore rupees. From that, you have to reduce the transfer expense. Transfer expense is how much? 1 lakh. After reducing, you will get the net consideration. Net consideration is how much? 2 crore 99 lakhs. From the net consideration, you have to see now whether the asset is a long-term capital asset or short-term capital asset. See, the asset was purchased in 1/7/1996. Hence, it is held for more than 3 years. Since the period of holding is more than 3 years, it is definitely a long-term capital asset. Since it's a long-term capital asset, indexation will apply. Now, you have to see whether the asset is purchased before 1/4/2001 or on or after 1/4/2001. If it is purchased before 1/4/2001, then the cost of acquisition of the asset will be the actual cost or fair market value as on 1/4/2001, whichever is higher. So what is the actual cost? Answer is 50 lakhs. What is the fair market value as on 1/4/2001? Answer is 70 lakhs. So whichever is higher, answer is 70 lakhs. So take 70 lakhs as the cost of acquisition. Now multiply it by the cost inflation index in the year of transfer. For previous year 21-22, the cost inflation index is 317 divided by cost inflation index in the year in which it is first held or 2001-2002, whichever is later. That is why we have taken cost inflation index of 2001-2002 as 100. Okay. So after doing this, you will find the indexed cost of acquisition. Next, let's find the indexed cost of improvement. Now, what and all are the improvement? First, see, improvement is done on 1/8/1999. Should you consider this improvement? Answer is no. You should not consider this improvement because if any improvement is done before 1/4/2001, you should ignore it because it is included in the fair market value of 70 lakhs. Okay, it is already included in this 70 lakhs, so you should ignore it. Now there is one more improvement done after 1/4/2001, which is what? 5 lakh rupees done on 1/9/2017. For this you have to find indexed cost of improvement, which is what? Take the value of improvement, multiply it by the cost inflation index in the year of transfer and divide it by cost inflation index in the year of improvement. So you will find the indexed value of improvement. So reduce both of them, you will find the long-term capital gain. You get my point? It can be a loss also, and if it's a short-term asset, it will be called short-term capital gain. And if at all there is any 54 series exemption, that exemption benefit also can be availed by the assessee. So in this video, we had discussed the basics of capital gain calculation. All the points which is related to capital gain calculation are covered. The remaining special concepts, there are many special concepts in capital gain chapter that we will be discussing in the next revision video, dear. So see you in the next one. Till then, take care. Bye bye. Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to revise the remaining concepts of the capital gain chapter. This is part 2 of the revision lecture. If you have not watched part 1 yet, I would recommend you to first watch part 1 of the lecture and then continue with part 2. Fine. Now before beginning the revision, my as usual request to you is to like this video, subscribe this channel to keep getting updates, and also leave a comment if you found this video helpful. So now without further ado, let us start with the revision. So first special concept is that we are discussing will be the exceptions to the charging section of capital gains. What does the charging section of capital gain say? That there should be a transfer of a capital asset and capital gain will arise in the year of transfer. But there are a few cases where capital gain will not arise in the year of transfer, but it will arise in some other year. Okay, so what are those cases? Let us see one by one. So first case is section 45 subsection 1a. Section 45 subsection 1a talks about insurance claim received for damage or destruction of a capital asset. If a capital asset is destroyed due to fire, flood, earthquake, tsunami, riot, civil disturbance, enemy attack, or any other natural calamity, then if the insurance claim is received, so what will be the year in which transfer happened? The year in which transfer happened will be the year in which the capital asset was destroyed, because even destruction is transfer. Okay. However, the capital gains will be taxable in the year in which the insurance claim is received by the assessee. So how to calculate the capital gain? Take the full value of consideration as the insurance claim received. Insurance claim can be in money form also, or it can be in asset also. Take, if it is in asset form, take the fair market value of the asset as full value of consideration. Then as usual, reduce the transfer expense, cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement, you will find the short term or long term capital gain. Okay, if at all no insurance claim is received, if no insurance claim is received, there will not be any capital gain. Fine. Now let us come to section 45 subsection 2, conversion of capital asset into stock in trade. So when a capital asset is converted into stock in trade, then the transfer arises when the conversion takes place. The transfer arises when the conversion takes place, but capital gain will be taxable in the year in which the stock is sold. In the year in which the stock is sold. And if a part of stock is sold, then only for that part of stock only capital gain will be arising in the year in which such part is sold. So how to calculate the capital gain? First, take full value of consideration as the fair market value on the date of conversion. Then you have to reduce as usual cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement, and you will find out the capital gain. This fair market value only will become the cost of the stock in PGBP income. Okay, so while how to calculate PGBP income? PGBP income will be selling price of the stock minus fair market value on the date of conversion. We will get the PGBP income. Now both capital gain income as well as PGBP income, both of them will be taxable in the year in which the stock is sold. In the year in which stock is sold. Okay, then what about the reverse case? What about when stock is converted into capital asset? So when stock is converted into capital asset, what happens? Firstly, you have to find out the PGBP. PGBP will be what? For calculating PGBP, take the selling price as fair market value on the date of conversion, and cost price should be taken as the actual cost price. You will get the PGBP income. Here no kanna, PGBP income is taxable in the year of conversion itself. It is taxable in the year of conversion itself. Then what about capital gain? In capital gain, full value of consideration will be as usual, the selling price, and then you have to reduce the cost of acquisition. What is the cost of acquisition? Cost of acquisition will be fair market value as on conversion date that you took for PGBP calculation. Okay, and then you have to reduce it, then you can find the capital gain. Capital gain will be taxable in the year of transfer. So now both cases we have seen, conversion of capital asset to stock in trade and stock in trade to capital asset, how it will affect in the assessee's head of income. Now let us discuss section 45 subsection 5, that is compensation on compulsory acquisition. Kana, what is compulsory acquisition? When the government is coming and compulsorily acquiring the property of the assessee, it is called compulsory acquisition, and it is also a transfer. So hence when government is acquiring the property, the assessee whose property has been acquired by the government has to pay tax under capital gains. Okay, now there is section 10 clause 37 which is providing an exemption. What is an exemption? If at all the land that is compulsorily acquired is an urban agricultural land, if the land that is compulsorily acquired is an urban agricultural land, and if three conditions are satisfied, then the compensation on compulsory acquisition will be fully exempt. What are the three conditions? Condition number 1, this exemption is available only for individual and HUF. Condition number 2, the agricultural land shall be used at least for 2 years, either by the individual himself or by the parents or by the HUF. It should be used for agricultural purpose at least for 2 years. And third one, the consideration should be determined and approved by the RBI or the central government as the case may be. If all these three conditions are satisfied, then compensation received on compulsory acquisition of urban agricultural land is fully exempt under section 10 clause 37. The remaining provisions, the remaining cases where compulsory acquisition money is received, it will be fully taxable under capital gain. However, listen, when does the transfer take place? The transfer takes place when the land or building is compulsorily acquired by the government. However, the capital gains tax will be payable in the year in which the compensation is received by the government. And in compensation also there are two types Kanna. One is initial compensation and one more is enhanced compensation. What is initial compensation? Initial compensation means the government themselves are coming and giving the compensation. It is called initial compensation. If initial compensation is received in installment, then entire amount will be taxable in the year in which the first installment is received. I gave you example also. So for example, if in initial compensation I am getting 40 lakhs in year 1, okay, then 50 lakhs in year 2, In such case, what will happen? The entire amount of 90 lakhs will be taxable in the year 1 itself. The entire amount will be taxable in the year in which the first installment is received. Now let's talk about enhanced compensation. Enhanced compensation means what? The assessee is going to court against the government, and then the court is asking the government to pay some extra compensation. This extra compensation is called enhanced compensation. Enhanced compensation is always taxable as and when received. So if, for example, in year 1 40 lakhs is received, then 40 lakhs will be taxed in year 1. In year 2, if 45 lakhs extra is received, then this 45 lakhs will be taxable in year 2. So in that year it will be taxable. Enhanced compensation. And enhanced compensation also can be due to interim order, or it can be due to final order. If enhanced compensation is received due to interim order, then it is not taxable in that year. It is taxable only in the year in which the final order is passed. In which the final order is passed. You get my point? Now, how to calculate the capital gain? Capital gain, you take full value of consideration as the entire initial compensation. From that initial compensation, you can reduce, as usual, transfer expense, cost of acquisition, indexed cost of acquisition, cost of improvement, or indexed cost of improvement, as the case may be, and you will find out the long term or short term capital gain. Now let's come to enhanced compensation. When the enhanced compensation is received, full value of consideration will be the enhanced compensation amount. But you cannot reduce the cost of acquisition, because cost you already reduced while calculating the capital gain on initial compensation. That is why you cannot reduce it once again. So what you can reduce? You can reduce only the transfer expenses. For example, the litigation expense, the expense that you are giving to court of law or you are giving to lawyer, that is transfer expense. You can reduce it, and only on the remaining amount it will be considered as long term or short term capital gain or capital loss. Okay, so this is how you have to calculate. And one more point, if an assessee is getting enhanced compensation, he might also get interest on enhanced compensation. Such interest on enhanced compensation is also taxable in the year of receipt. It is covered in income from other sources chapter, and 50% standard deduction is allowed against the interest on enhanced compensation, that we will learn in income from other sources chapter. Now let us come to the remaining next types of provision. Firstly, let us see what will happen when there is transfer of X security in a demat account. Now listen here. Earlier, there used to be a system of physical shares, means shares was received as share certificate. So when I sell the share certificate, I will receive the money and I will pay the tax under capital gain. But now what has happened? Shares are coming in digital form in dematerialized account, okay, or demat account. And now I have to approach a broker. Let's say I am approaching a broker named Zerodha. Zerodha is only buying the shares on my behalf, and he is keeping the shares with himself. Now, on paper, Zerodha is the owner of the shares. However, I am only the beneficial owner of the shares because I have only bought the shares through Zerodha. That is why capital gain is applicable in the hands of beneficial owner. That is in my hands. Zerodha need not pay any capital gain. I only have to pay capital gain because I am buying the shares through Zerodha. You get my point? Now, when it comes to demat account, it is very difficult to differentiate the securities from one another because all the securities are mixed up and stored together in digital form. That is why when we are selling the security, when we cannot track which security we are selling. That is why in case of sale of security, we have to calculate the selling price, the cost of acquisition using the FIFO method. So cost of acquisition and period of holding in case of demat securities are calculated using FIFO method. What is FIFO method? First in, first out method. First in, first out method. And what if there are more than one demat account? If there are more than one demat account, then for every demat account you have to calculate the FIFO method separately. Okay, FIFO method separately. Now let's come to section 45 subsection 3. What happens when capital asset is transferred from partner to a partnership firm or from a member to AOP BOI? So if a partner transfers a capital asset to a partnership firm or member transfers to AOP BOI, then capital gains is taxable in the hands of the transferor, that is the member or a partner, member or partner. Full value of consideration should not be taken as the sale value. Full value of consideration should be taken as the amount recorded in the books of the partnership firm AOP or BOI. You get my point? So take the full value of consideration as amount recorded in the books. If at all it is a case of immovable property, which is transferred from partner to partnership firm or member to AOP BOI, then if stamp duty value is more than the amount recorded in books, take the stamp duty value as full value of consideration. If stamp duty value is more than the amount recorded in books, take the stamp duty value as full value of consideration. Now let us see the reverse case. Section 45 subsection 4. What happens when capital asset from a partnership firm AOP or BOI is transferred to a partner or a member, as the case may be? In such case, the firm or the AOP BOI has to pay the tax under capital gain. For that, take the full value of consideration as fair market value on the date of transfer. What is the full value of consideration? Fair market value on the date of transfer. Now let us come to next section, that is section number 46, distribution of assets by a company on liquidation. So what is liquidation? Liquidation means, in simple terms, the company is closing down. Hence, when the company is closing down and after all the liability is over, whatever balance asset it is having, it will distribute the assets to its shareholders. The balance asset, it will distribute to the shareholders. Now listen here. When, let's say, this is the balance sheet of the company. Here, general reserve is there. What is general reserve? It is nothing but accumulated profit. Okay, accumulated profit. So general reserve is there. Let's say the general reserve is 100 crores. Okay, and let's say there are assets worth 200 crores. Assets worth 200 crores, and for this company there are four shareholders, namely A, B, C and D. So now all the liabilities are over and this asset worth 200 crores are distributed to A, B, C and D of 25 crores each. 25 crores each. So what is this called? This is called distributing the asset on liquidation. Distributing the asset on liquidation. Now listen very carefully. When the company is giving its asset on liquidation to the shareholder, then this asset is transferred to the shareholder, correct? So should the company pay capital gain? Answer is no. Company need not pay any capital gain because this transaction is not regarded as transfer. As per section number 47, this transaction is not regarded as transfer, so the company need not pay any capital gain. But when the shareholders are receiving the assets, the shareholder has to pay two types of tax. The shareholder has to pay two types of tax. Okay, first is what? Deemed dividend. Deemed dividend. Deemed dividend we will learn in income from other sources chapter. There also I will be telling you the same point, that when a company is giving its assets to the shareholder on liquidation, then to the extent of accumulated profit, the distribution of shares will be called deemed dividend. Now listen here. This asset is how much? 200 crores. General reserve is how much? 100 crores. So it is 50%. That is why whatever asset is distributed, out of these assets, 50% will be from accumulated profit and balance 50% will not be from accumulated profit. Hence listen here, 12.5 crores, which is 50%, will be deemed as dividend. Balance 15% and it will be taxable in income from other sources. 12.5%, it means the distribution of asset up to the accumulated profit of the company will be called as deemed dividend and it will be taxable in income from other sources chapter. Now what about the balance 50%, that is 12.5 crores? This 12.5 crores will become the full value of consideration. Will become the full value of consideration. But why sir full value of consideration? Because see Kanna, when the company is closing down, the shareholder will lose his shares. The shareholder will lose his shares. So this is also transfer because the shares are getting elapsed. It is relinquishment. It is also transfer. Since it is a transfer, for the shares that are going away, the full value of consideration will be the money, extra money that is received by the company, that is 12.5 crores. From this, he can reduce the cost of acquisition, indexed cost of acquisition, cost of improvement or indexed cost of improvement as the case may be, and he will find the capital gain or capital loss. You get my point? Sir, what if over and above the accumulated profit no money is received? If over and above the accumulated profit, if no money is received, then there will not be any capital gains also in the hands of shareholder. You get my point? So listen here, now you will be able to understand. See here, when capital assets are distributed by the company, in the hands of company, distribution is not a transfer and hence no capital gains tax will arise. But when the shareholder is getting the amount, distribution attributable to the accumulated profit of the company will be deemed dividend under section 222C, and it will be taxable under income from other sources. Then whatever is the balance amount, that is the money received plus fair market value of the asset distributed minus deemed dividend under section 222C, will become the full value of consideration for capital gain purposes. This is the concept of liquidation. Now let's come to section 46A, which talks about buyback. Sir, what is buyback? Kanna, when the company is buying its own shares back from the shareholders, it is called buyback. So for example, Infosys company is announcing buyback. It means what? It will buy its own shares, that is Infosys shares from the shareholders, it will buy and it will give money to the shareholders. This is called buyback. So now there are two types of buyback treatment. Firstly, we will see for domestic company, then other than domestic company. If there is a domestic company, it can be listed or unlisted, it does not matter. If it's a domestic company, then what happens? When the company is giving the money to the shareholder, then from that money it has to pay buyback tax. So listen here once again. Listen. If there is a company, the company is giving money to shareholder. Okay, and shareholder is giving the shares back to the company. Then on this money, the company has to pay buyback tax. So what is buyback tax? Buyback tax is equal to 20% plus 12% surcharge plus 4% health and education cess. What did I tell? 20% plus 12% surcharge plus 4% health and education cess. So totally it will come to 23.296%. This is called buyback tax. So company will pay the buyback tax and balance amount only it will give to the shareholders. Now listen here. See, shareholders are getting the money from the company, correct? Shareholders are getting the money from the company and they are giving the shares. Shareholders are getting the money and giving the shares. Hence the shareholders have to pay the tax under capital gain, correct? But since the company has already paid buyback tax, no capital gain will arise in the hands of shareholder. The capital gain is exempt under section 10 clause 34A. So shareholders need not pay any capital gain tax. It is fully exempt under section 10 clause 34A because the company is paying buyback tax in case of domestic company. Now what about other than domestic company? If a company is other than domestic company, then while giving the money to the shareholder, company will not pay any buyback tax, but shareholder has to pay tax under capital gains. How will he pay tax under capital gain? Full value of consideration will be the money received by the company minus cost of acquisition will be the purchase price of the shares. By doing this, he will calculate the capital gain. On such capital gain, he has to pay the tax under capital gain head of income. You get my point? Then even in case of ESOPs bought back by the company, if the company is buying back the specified security and giving the money to the employee, in such case, the company need not pay any tax. When the employee is giving the shares back to the company, the employee need to pay the tax under capital gains. Okay, so how to calculate the buyback tax? Buyback tax will be calculated on the buyback amount. What is the buyback amount? Buyback price minus issue price. So do buyback price minus issue price. On that you have to calculate 20% tax plus 12% surcharge plus 4% health and education cess. You get my point? I hope you are clear with buyback provisions. Now let us come to section 50B, slump sale. Very important kana, section 50B, slump sale. What is slump sale? Slump sale means an entire undertaking of a company is sold as it is to another company, okay, for a lump sum consideration without giving individual value to each and every asset. So I give you an example. See here, Titan Limited is there, no? It is having a brand called Tanishq. This Tanishq brand, if it is selling to Kalyan Jewelers, then it is called slump sale. And from Kalyan Jewelers, it is receiving 1000 crore rupees. From Kalyan Jewelers, it is receiving 1000 crore rupees. And what are the value of the assets that are transferred to Kalyan Jewelers? The value of the assets of Tanishq Limited transferred to Kalyan Jewelers is 800 crores. 800 crores. So listen to me once again. Titan is having a brand called Tanishq. This brand of Tanishq, it is selling to Kalyan Jewelers For how much? 1000 crores. But what is the value of the assets that are there in Tanishq? It is 800 crores. 800 crores. This type of transaction is called slump sale. Slump sale. Now, how to calculate the capital gain in case of slump sale? Firstly, you have to take full value of consideration. For full value of consideration, earlier you used to take lump sum consideration, but now you should not take lump sum consideration. What you should take? You should take fair market value as per Rule 11 UAE. Fair market value as per Rule 11 UAE. What is fair market value as per 11 UAE? Very simple. It is fair market value number 1 or fair market value number 2, whichever is higher. Fair market value 1 or fair market value 2, whichever is higher. Sir, what is fair market value 1? Fair market value 1 is fair market value of the assets that are transferred. Fair market value of the assets that are transferred. What is fair market value 2? Fair market value 2 will be the fair market value of the consideration that is received. So in my example, see, what is fair market value 1? Fair market value 1 will be called 800 crores because it is the value of assets of Tanishq that are transferred from Titan to Kalyan. Okay. Then what is FMV2? Fair market value 2 will be 1000 crores because this is the fair market value of the money that is given from Kalyan to Titan. You get my point? So whichever is higher. In my case, which is higher? Answer is 1000 crores. So 1000 crores will become full value of consideration. From full value of consideration, you have to reduce the transfer expenses. You will get the net consideration. From net consideration, you have to reduce the cost of acquisition. Now, sir, what is the cost of acquisition? Cost of acquisition is the net worth of the undertaking. Net worth of the undertaking. In my example, it is the net worth of Tanishq. Net worth of Tanishq will be the cost of acquisition. Now, how to calculate the net worth? Very simple, Kana. Net worth means asset minus liability. Net worth means what? Asset minus liability. So, in case of asset, if the asset is a depreciable asset, then don't take the book value, take the WDV, opening WDV as per Income Tax Act. In case of depreciable asset, don't take the book value, take the opening WDV as per Income Tax Act. In case of other than depreciable asset, take the book value. However, in the book value, if there is any revaluation, then remove the effect of revaluation. You should not consider revaluation while taking the net worth. Okay, so if there is any revaluation, you should remove the effect of revaluation. Then you have to reduce liability. Sir, how to take the liability? Take the liabilities at book value. So if you do asset minus liability, you will get the net worth. This net worth only will become cost of acquisition. It will become cost of acquisition. Sir, what if this net worth is negative? If this net worth is negative, don't take the negative value. Take the net worth as 0. If it is negative, take it as 0. Okay. Next, one more special point. If at all the assets contain any asset on which section 35 AD deduction is claimed. What is 35 AD deduction? Specified business deduction. All those things, for hotel, hospital of above 100 beds, and then warehouse for agricultural storage, cold chain facility, all those businesses. For all those businesses, if you have claimed the deduction under section 35 AD, then for such asset alone, you should take the value as 0 while calculating the net worth. Okay. Next, listen. How to find out whether the undertaking is a short term or long term? If the undertaking is held for up to 3 years, it will be short term capital asset. If it is held for more than 3 years, it will be called long term capital asset. How to calculate the period of holding? Period of holding should be taken from the date of incorporation or date of purchase till the date of slump sale. Till the date of slump sale. However, while calculating long-term capital gain, if at all the capital asset is a long-term capital asset, should you do indexation? Answer is no. You should not do any indexation for slump sale calculation. No indexation is allowed. Okay. Then if slump sale is calculated, if slump sale transaction is done, then report of a chartered accountant is compulsory, indicating and certifying the computation of net worth. Okay. So this is the provision of slump sale. One more time, just quickly I will go through slump sale, okay, because it is very important. What is slump sale? Slump sale means an undertaking as it is transferred to another company for a lump sum consideration without assigning individual value of asset. How to calculate capital gain? Capital gain, in that you have to take full value of consideration. What is full value of consideration? FMV1 or FMV2, whichever is higher. FMV1 means the fair market value of the asset transferred. FMV2 is the fair market value of the consideration that is received. Take whichever is higher, and that higher value will become full value of consideration. From that you have to reduce the transfer expense, you will get the net consideration. From the net consideration you have to reduce the cost of acquisition. How to calculate cost of acquisition? You have to calculate the net worth. What is net worth? Net worth is asset minus liability. So in case of asset, if it is a depreciable asset, take the opening WDV as per Income Tax Act. If it is other than depreciable asset, take the book value but do not take revaluation. Then if it is an asset on which 35 AD deduction has been claimed, take the value of the asset as 0. Then what about liability? Take the value of liability as book value. After you reduce asset minus liability, you will get net worth. If the net worth is positive, consider the positive value as cost of acquisition. If it is negative, then take the cost of acquisition as 0. Fine. If the undertaking is held for more than 3 years, it will be called long term. If it is up to 3 years, it will be called short term. However, if it is long term, there is no benefit of indexation. You get my point? I hope you are clear with section 50B slum sale. Now let us discuss section number 50C, that is cases where stamp duty value will be considered as full value of consideration. Listen Karna, when land or building or both is transferred from one person to another person, then if stamp duty value of the property is up to 110% of the sale consideration, then take full value of consideration as the sale consideration. However, if stamp duty value is more than 110% of sale consideration also, take full value of consideration as stamp duty value. For this, the detailed explanation I have given in class, but I am not going there once again. So listen very carefully. If stamp duty value is just up to 110% of sale consideration, full value of consideration can be taken as usual, sale consideration. But if stamp duty value is even more than 110% of sale consideration, take full value of consideration as the stamp duty value. Now comes the question, the sale consideration is there, no? The stamp duty value is there, no? Should it be taken on registration date or agreement date? Generally, you have to take the registration date. However, if on or before the date of agreement, if any consideration, it can be full consideration or part consideration, if it is received through account pay check, account pay bank draft, or electronic clearing system or any other prescribed mode, then you take the date of agreement. What did I say? Generally, take the stamp duty value as on the registration date. However, if on or before the date of agreement, if full or part consideration is paid through account pay check, account pay bank draft, or electronic clearing system or any other prescribed mode, in such case take the agreement date. Now listen here. Sometimes what will happen is the assessee will not be satisfied with the stamp duty value. He will think that the stamp duty value is a very high sum. So what he will do? He will request the assessing officer, and assessing officer will transfer the matter to valuation officer. He will transfer the matter to valuation officer. If valuation officer derives the value, and if that value is more than the SDV, stamp duty value, then no need to worry, take the full value of consideration as stamp duty value. But if the value derived by valuation officer is less than the stamp duty value, then full value of consideration will become value derived by valuation officer. It means the benefit can be taken by the assessee, but if there is any loss, it means you can ignore. So if valuation officer increases the amount, then you ignore it. But if he decreases the amount, you can take the benefit, and that value you can take as full value of consideration. You get my point? I hope you are clear. Now let us discuss about section 43 CA. Section number 43 CA. 43 CA is for PGBP chapter. It is the section in PGBP chapter. Then why are we discussing it here? Because, see, listen here. Section 50C deals with immovable property which are capital asset. 50C deals only with capital asset. And 43 CA deals with stock in trade. Deals with stock in trade. All the provisions in 50C and 43 CA both are one and the same. There is no change at all. Both the provisions 43 CA and 50C both are same. However, there is one small change in section 43 CA. One small change, that is the amendment brought out by Finance Act 2021. I told you, no, 110%, 110%. Listen here. If at all it is a case of 43 CA, it means what? A builder is having the stock as immovable property, and if the builder is selling the stock, then instead of this 110%, you can take 120 percentage. Instead of this 110 percentage, you can take 120 percentage where the builder is selling his stock. Okay, but this 120 percentage you can take it only if three conditions are satisfied. Only if three conditions are satisfied. What are the three conditions? Condition number one, the builder should transfer a residential unit between the period 12th November 2020 till 30th June 2021. Residential unit should be transferred between 12th November 2020 to 30th June 2021. Then condition number two, it should be a first time allotment. It should be a first time allotment. And condition number three, that the consideration received should be up to 2 crores. Consideration received should be up to 2 crores. If all these three conditions are satisfied, then when the builder is giving his immobile property, that is the stock, to the person who is receiving the property, then on the amount received he can take the tolerance band as 20 percentage. That means in this calculation he can do the calculation using 120 percentage of the sale consideration. You get my point? So this is a special point for section 43 CA alone, where the immovable property is a stock in trade. Fine. What is residential unit? Residential unit is nothing but a flat or apartment, etc. That means it is an independent housing unit where there are separate facility for living, cooking, sanitary requirement, which are separated from all the other residential units within the building. Okay, so I hope you are clear. Now let us discuss section number 50 CA, full value of consideration in case of unquoted shares. So if they are unquoted shares means what? Unlisted shares or listed but rarely traded shares. So in case of unquoted shares, if the sale consideration is less than the fair market value, then full value of consideration will become the fair market value. If sale consideration is less than the fair market value, full value of consideration will be considered as fair market value. Now let's come to section 50D. Section 50D is what? If sale consideration cannot be determined. Sir, what if sale consideration itself cannot be determined? For example, I sold my house and I asked the buyer of the house to give me food throughout my life. To give me food throughout my life. In such case, I cannot calculate the value of the consideration that I received. In such case, I should take the fair market value of the asset that is transferred as the full value of consideration. On the date of transfer, whatever is the fair market value, I should take it as the full value of consideration. Now let us come to advance money forfeited, that is section number 51. If any advance money is forfeited on or after 1/4/2014, then it is fully taxable in the income from other sources head of income in the year in which the advance is forfeited. However, if any advance was forfeited before 1/4/2014, then you have to reduce such advance from the cost of acquisition. Reduce from advance from the cost of acquisition. Okay. Next, section 55A, reference to valuation officer. This is not so important, but however you give a reading of this section also. Next, capital gain at special rates. Now let us discuss the special rates for capital gain. Firstly, let us discuss about long-term capital gain. Generally, long-term capital gain is taxable under section 112. Long-term capital gain is taxable under section 112. Okay, what is the tax rate of 112? Answer is 20 percentage. What is tax rate? 20 percentage. However, if there is a resident individual or HUF, such resident individual or HUF can take the benefit of basic exemption limit also against the long term capital gain. However, if there is any person other than resident individual or HUF, such person cannot take the benefit of basic exemption limit against long term capital gain. You get my point? Next, if there is any long-term capital gain from listed security other than units and also zero coupon bonds which are not covered in section 112A, in such case the tax rate will be 10% without indexation or 20% with indexation, whichever is lower. What is the tax rate? 10% without indexation or 20% with indexation, whichever is lower. Now let's talk about a special case where a non-resident or a foreign company is having a long-term capital gain from unlisted shares of closely held company. If a non-resident or a foreign company is having long-term capital gain from unlisted shares of closely held company, then tax rate is 10% without indexation. 10% without indexation. So this is the normal rate of tax for long-term capital gain. long-term capital gain is never taxed at normal tax rate. It will be taxed under section 112 at 20%. At 20%. Resident individual HUF can take the benefit of basic exemption limit. Other than resident individual HUF cannot take the benefit of basic exemption limit. Now let's come to short-term capital gain. Short-term capital gain is taxed normally at the normal tax rate. Normally, short-term capital gain is taxed at normal tax rates. Now we are going to learn two new sections, that is section 111A and 112A, which are special tax rates for long-term and short-term capital gain. Firstly, let me discuss that against 111A, 111A, 112 as well as 112A, against all these three sections, chapter 6A deduction will not be allowed. Chapter 6A deduction is not allowed against any special rate income. Okay. Next, basic exemption limit cannot be adjusted except in case of resident individual and HUF. And third one, for 112A alone, 87A rebate also will not be allowed. For 112A, 87A rebate will not be allowed. Now let us discuss what is given in section 111A. 111A talks about short-term capital gain on certain assets. What are those certain assets? Those certain assets are number 1, equity shares of a company, units of equity oriented fund, and units of business trust on whom STT is paid on transfer. If there is any equity share of a company, units of equity oriented fund, or unit of business trust on which STT, that is security transaction tax, is paid on transfer, then on such asset, if there is any short term capital gain, that short term capital gain is covered under section 111A and it will be taxed at 15%. It will be taxed at 15%. Okay. Next, however, if it is a case of international financial service center, then you need not see this short security transaction tax and all. Okay. Now let's come to section 112A, which talks about long-term capital gain on certain assets. Now what are the certain assets? Similarly here also, if there is any long-term capital gain on transfer of number 1, equity shares of a company, okay, units of business trust, units of equity oriented fund on which STT is paid on transfer, then they are also covered here in section 112A. But here one small change is there. Listen here. In case of equity share of a company, no, STT should also have been paid on acquisition. So in case of equity shares, if STT is paid on acquisition as well as transfer, only such equity share will be covered under 112A. Okay. Now, Kanna, what is the tax rate in 112A? The tax rate is 10% in excess of 1 lakh rupees. 10% is in excess of 1 lakh rupees. So for example, if 15 lakh rupees is the long term capital gain, then you have to reduce 1 lakh. Then what is the balance amount? On that you can apply 10%. So the tax will be 1.4 lakhs. You get my point? And there is no indexation benefit allowed for section 112A. I already told you that indexation will not be allowed. What did I tell? There are 4 cases where indexation is not allowed. In the previous video I have told you. What are the 4 cases? Case number 1 is indexation is not allowed for section 112A. Indexation is not allowed for section 50B, that is slum sale. Then indexation is not allowed for bonds and debentures other than capital indexation bonds or sovereign gold bonds. And then indexation is also not allowed where a non-resident is purchasing and selling the shares or debentures of an Indian company in foreign currency. Okay, so you should recollect all those and link everything together. Now let's come to a special concept of cost of acquisition. Cost of acquisition for 112A. Sir, in 112A there is a special concept for calculating the cost of acquisition because of grandfathering. Because of grandfathering. What is grandfathering? Grandfathering is before 1 February 2018, what used to happen is whatever transaction was covered under section 112A used to be fully exempt. But on or after 1 February 2018, what happened is, after 1 February 2018, what happened is 1 lakh rupees was exempt, and above 1 lakh rupees, whatever amount is there, it will be taxable as 10%, which we already studied. So the people got very angry. So what did the finance minister do? Finance minister told that up to 31/1/2018, that is the grandfathering date, up to 31/1/2018, whatever is the capital gain that is earned, it will be fully exempt. So now to include that grandfathering inside this provision, you have to calculate the cost of acquisition in a different style. Okay, so listen here. If any share or any security is acquired on or after 1 February 2018, then the cost of acquisition will be the actual cost of acquisition, which is nothing but purchase price. However, if any security is acquired before 1 February 2018, that is up to 31/1/2018, then what you should do? You should do step number 1. Fair market value on 31/1/2018 or full value of consideration, whichever is lower. Then take the whichever is lower amount and actual cost of acquisition, whichever is higher. This will only become the cost of acquisition. This will become the cost of acquisition. So for example, if fair market value as on 31/1/2018 is 35 rupees, sale value is 50 rupees, then take whichever is lower. Which is lower? 35. Then take whichever is lower, which is 35, and actual cost, that is 25, whichever is higher. Hence this 35 rupees will become the cost of acquisition. It will become cost of acquisition. Once again, I am not going in detail of the concept of grandfathering. I hope that you are remembering what is the concept. Now comes the question, sir, how to calculate this fair market value? How to calculate fair market value? Very simple, Kana. In case of listed security, fair market value will be the highest price quoted on 31/1/2018 on the recognized stock exchange. And if no trading took place on 31/1/2018, then see the preceding date in which the trading has taken place. On that day, what was the highest price will become the fair market value for this section. Next, what about units? In case of units, fair market value will be the NAV of unit as on 31/1/2018. Now let's talk about unlisted security. If the shares are unlisted as on 31/1/2018, then how to calculate the fair market value? You have to calculate by normal indexation. So cost of acquisition multiplied by cost inflation index of 1718, that is 272, divided by cost inflation index in the year in which it is first held, or cost inflation index of 2001 2002, whichever is later. If you're not able to remember all this, just ignore, it is not that important. Okay, so you have to find out the fair market value. Using the fair market value, you have to find out the cost of acquisition. That cost of acquisition only you have to use while calculating the capital gain under 112A. I hope you are clear with section 112A. Now let us move on to the next concept, that is the concept of section 54 series exemption. 54 series exemption. There are 6 exemption sections that are covered for your syllabus. Firstly, let us discuss section number 54. If one exemption you are able to understand thoroughly, all the remaining will become very simple. So first exemption, listen very carefully. When will the exemption apply? When there is a capital gain on sale of residential property and it is used for residential purpose. So for whom and all is this section applicable? It is applicable only for individual and HUF. What is the nature of asset that is transferred? It should be a long-term capital asset, being a residential house property, being land or building appurtenant thereto. So listen here. If an individual or HUF is having a long-term capital asset being a house property, and if that house property is transferred, and after that, if new asset is purchased, what should be the new asset? New asset should also be a residential house property. In such case, exemption will be allowed. When will the exemption be allowed? If an individual or HUF is having a long-term capital asset being a house property, if they are selling the house property and buying another residential house property, then exemption is available. And now listen here. If the capital gain amount is up to 2 crores, then the assessee can buy up to 2 house properties. Up to 2 house property. But if the capital gain value is above 2 crores, then the assessee can buy only one residential house property. And one more thing, this 2 house property point is there, no? This benefit can be taken only once in a lifetime. Once in a lifetime. Now let us see the time limit. I told you that new house property has to be purchased, correct? When to purchase this new house property? Answer is -1 +2 +3. -1 +2 +3. It means what? New house property should either be purchased within 1 year before or up to 2 years after the date of transfer. And if the new house property is being constructed, it should be constructed within 3 years from the date of transfer. So -1 +2 +3. If there is a new house, that new house should be purchased either 1 year within 1 year before or within 2 years after the date of transfer, and if it is being constructed, it should be constructed within 3 years from the date of transfer. Only then the exemption will be allowed. Okay. Next, deposit scheme. Deposit scheme. Now listen, Kanna. I told you that there is a time limit up to 3 years, 2 years or 3 years as the case may be. Correct? Now, when the return of income is being filed by the assessee, how will the government know whether the person is going to invest in a new house or not? It will be very difficult for the government to know. So what does the government tell? The government will tell you deposit the money of capital gain in capital gain account scheme. You deposit the money of the capital gain in capital gain account scheme. This is nothing but a special bank account. It is a special bank account in which the assessee has to deposit the capital gain. If the assessee is depositing the capital gain in the account scheme, it should be deposited within the due date of filing return of income. It should be deposited within due date of filing return of income. Then this deposit amount should be used only for that new house, constructing new house or purchasing new house within the time limit. What is the time limit? -1 +2 +3. Okay, within the new house, within the time limit, the assessee should use the money which is there in the deposit scheme to buy or construct the new house. If the assessee is not able to use the money, then the capital gain which was already exempt in that year will again become taxable. In which the time limit expires. So listen again, once again, very important. In section number 54, what the assessee has to do, if the assessee is selling the long-term capital asset being a residential house, okay, and he is purchasing another residential house, then exemption is available. What is the time limit to purchase or construct the new residential house? It is -1 +2 +3. Means within 1 year before or within 2 years after he should purchase the house, or within 3 years after the date of transfer, he should complete the construction. Now, during the year of transfer, it is very difficult to know whether the assessee will be investing or not. That is why the government is telling you invest the entire capital gain account in the capital gain account scheme, which is nothing but a special bank account. In this special bank account, money will be deposited. Then assessee can use the money only for the specific purpose, that is buying the new house. Correct? If the money is not used within the time limit, then what will happen? Then when the time limit is expiring, in that year, the capital gain which was exempt earlier will become taxable once again. It will become taxable once again. I hope you are clear. Now, how to calculate the exemption? The exemption will be the capital gain amount, or the cost of the new asset, or the amount deposited in the capital gain amount account scheme, whichever is lower. You get my point? Next, now listen very carefully. The new asset should not be transferred up to 3 years. What did I tell you? The assessee should buy a new house, correct? Buy or construct a new house within 1 year before, 2 years after, or 3 years after. This new house is there, no? He should keep it at least for 3 years. He should keep it at least for 3 years. If he is not keeping it for 3 years, then what will happen? Then if new asset is transferred within 3 years from the date of purchase or construction, then the cost of the new asset will be reduced by the exempted capital gain. Whatever was the capital gain that was exempt earlier, you reduce it from the cost of that new property. Reduce it from the cost of new property. You get my point? So I hope you are clear with section number 54. If this you are clear, all the others will become very simple. Now let us discuss next section, that is section 54B. Capital gain on sale of urban agricultural land and used for buying another agricultural land. This section is also applicable only for individual and HUF, and it does not matter whether the urban agricultural land is a short-term or long-term capital asset. It does not matter. But what matters? The urban agricultural land should be used by the individual or his parents for agricultural purpose during 2 years before the date of transfer. Now listen very carefully. There should be an individual or HUF. That individual or HUF is having a urban agricultural land which they should be using for agriculture purpose at least 2 years before the date of transfer. 2 years before the date of transfer. Now, if they are selling this agricultural land and buying a new agricultural land, okay, the new agricultural land can be rural also, it can be urban also, it does not matter, then exemption is allowed. What is the time limit to buy the new agricultural land? Answer is +2. 2 years. From 2 years within the date of transfer, the new agricultural land can be purchased. If the new agricultural land is purchased, then what will be the capital gain exemption? The exemption will be capital gain amount or cost of new asset or amount deposited in the capital gain account scheme, whichever is lower. So here also capital gain account scheme is applicable as usual. Next, this new agricultural land also should not be transferred for at least 3 years. So the assessee should keep this new agricultural land at least for 3 years. If it is transferred, then cost of acquisition of the new asset will be reduced by the exempt capital gain. You get my point? Next, section number 54D, compulsory acquisition of industrial land and building. So if this exemption section is applicable to all assessees and it does not matter whether it's a short term or long term capital asset. So listen here. If there is a compulsory acquisition of land or building which was used by the assessee for the business of industrial undertaking, which was used by the business of for the business of industrial undertaking during 2 years prior to the date of transfer. Prior to the date of transfer for 2 years at least, if the assessee was using the land or building or both for industrial undertaking, and if it is compulsorily acquired by the government, in such case after compulsory acquisition, after receiving the compensation, with that compensation if they are buying another new land or building or both for industrial undertaking, then the amount of capital gain will be exempt. Okay. What is the time limit to buy the new land or building? Answer is +3. Within 3 years from the date of receipt of compensation. So when they receive that compensation for compulsory acquisition, from that date onwards up to 3 years, within 3 years they have to buy new land or building or both for industrial undertaking. If they are buying, then their capital gain will be exempt. What will be the exemption? Answer is capital gain or cost of the new land or building or both, or deposit amount in the capital gain account scheme, whichever is lower. So hence in this section also, since 3 year is the time limit, capital gain account scheme will be applicable. Okay, deposit scheme will be applicable. Now let's talk about the next section, that is section number 54 EC. Section 54 EC also very simple, investment in certain bonds. The section 54 EC is applicable to all assessees and it is applicable only in case of long-term capital asset, long-term capital gains which arises on transfer of land or building or both. So if an assessee is having land or building or both, and if the assessee is transferring such land or building or both being a long-term capital asset, then if the assessee is buying bonds, if the assessee is buying bonds, then the value of such bond can be claimed as exemption. What are all the different types of bonds? Answer is National Highway Authority of India bonds, Rural Electrification Corporation Limited bonds, Power Finance Corporation Limited bonds, Indian Railway Finance Corporation Limited bonds. So NHAI, RECL, PFCL, RFCL. NHAI, RECL, PFCL, RFCL. If the bonds of these four companies, any of these four companies are purchased and the bonds lock-in period is 5 years, you cannot take the money out of the bond for at least 5 years. In such case, up to 50 lakh rupee capital gain will be exempt. Up to 50 lakh capital gain will be exempt. However, what is the time limit to buy the bonds? The time limit is within 6 months from the date of transfer. Within 6 months from the date of transfer, you have to buy that bond. Hence, in this section, capital gain account scheme is not applicable because it is just 6 months which is the time limit. That is why capital gain account scheme is not applicable. Now listen very carefully. In case of conversion of capital asset into stock in trade, no, capital gain is taxable only in the year in which the stock is sold. That is why the 6 months time limit should be taken from the date of sale of stock. And even in case of compulsory acquisition, 6 months time limit should be taken from the date on which the compensation is received by the government. Okay, but in this section deposit scheme is not applicable since the time period is just 6 months. Just 6 months. Now how to calculate the exemption? Exemption will be the capital gain account amount or cost of new asset, that is the bonds, whichever is lower. Okay, maximum 50 lakhs. Maximum 50 lakhs. More than 50 lakhs, assessee cannot claim exemption under this section. Now, I told you, right, the bonds have to be at least kept for 5 years. Bonds have to be kept for 5 years. Sir, within 5 years itself, if the bond is sold to some other person, or even if some loan is taken against the bond, then what will happen? Then, if new asset is converted into money within 5 years from the date of acquisition, then the exempt long-term capital gain will again become taxable in the year of such transfer or conversion. Then the capital gain which was already allowed as exemption will now become taxable in the year in which such bond is sold or money is taken on behalf of the bond. Okay, I hope you are clear. Next, let's discuss section 54F. When does 54F arise? 54F also allowed only for individual or HUF. When does 54F arise? When any long-term capital asset other than residential house is sold, and on behalf of that a residential house is being purchased. What happens? And for an individual HUF, if the individual or HUF is having any long-term capital asset other than residential house, and if he is selling that long-term capital asset and buying or constructing a new residential house, then this section will be applicable. What is the time limit for the new residential house? -1 +2 +3. That is from the date of transfer within 1 year before or 2 years after he has to purchase the house, or within 3 years after the date of transfer he has to finish the construction of the house. Only then this section will be applicable. Now listen. Is deposit scheme applicable? Answer is yes. So within the due date to file the return of income, if the amount is not invested, then he can put the amount is in capital gain account scheme. Okay. Now in this section, it is a very different section. Generally, it is expected that capital gain amount should be invested. But in this section alone, that is 54F, it is expected that the assessee should invest the entire full value of consideration. Entire full value of consideration. Sir, what if entire full value of consideration is not invested? In such case, proportionate exemption only will be allowed. How to calculate the proportionate exemption? So listen here. Proportionate exemption is equal to cost of the new house multiplied by capital gain divided by net consideration. Cost of new house multiplied by capital gain divided by net consideration. This will be the exemption. Now listen. This new house also should not be transferred at least within 3 years. If it is transferred within 3 years, then exempt capital gain will be taxable once again in the year of transfer of the new asset. Now let us discuss section number 54EE. Section 54EE. If any person is having any long-term capital asset, if that is transferred, and on behalf of that amount, if he is getting units of a fund that is notified by central government, then that unit of fund should be purchased within 6 months from the date of transfer of the original asset, maximum 50 lakh rupees. In such case, what will happen? Capital gain or cost of new asset, whichever is lower, will be exempt from tax. This also should not be transferred at least within 3 years. If it is transferred within 3 years, then the capital gain which was exempt earlier will become taxable once again. So these are the 6 exemptions. Now let us see some additional point for section 54F. For section 54F, there is one more condition, that the assessee should not own more than one residential house. Next, assessee should also not purchase any other residential house within the time period, that is 3 years, other than the new asset. If this condition is not satisfied, then also exempt capital gain will be taxable again in the year of purchase of or construction. So what they are telling, that while this transaction is happening, assessee should own maximum one house, and even after buying the new house, okay, first what did we see, that the new house should be kept at least for 3 years, and within this 3 years he should also not buy any other house, that is given in this section. Okay, so I hope you are clear with the exemption section also. Now lastly, let us discuss capital gain on depreciable asset. Section 50 deals with capital gain on depreciable asset. Firstly, let us talk about depreciable asset on which WDV method will apply. Sir, when will capital gain arise? Capital gain will arise in two cases. Case number 1 is where the selling price is greater than the WDV of entire block. Selling price is greater than WDV of entire block, and number 2, when all the assets of the block are transferred. When all the assets in the block are transferred. So only in 2 cases capital gain will arise in case of depreciable asset. How to calculate capital gain? Very simple. Full value of consideration minus, take the opening WDV plus additions. So full value of consideration minus opening WDV plus addition. Okay, you will find out the capital gain. Now this capital gain or capital loss is always short term. So if there is a depreciable asset and that is transferred, and if capital gain arises on the depreciable asset block, it will always be short term capital gain. However, listen here, though the capital gain is always short term, if the asset inside the capital gain, okay, was a long term capital asset, then you can take the benefit of section 54 EC or the other exemption sections also. You get my point? We saw many exemption sections before this. For those exemption sections, certain exemption are applicable only for long term capital asset. But I told you, if depreciable asset are sold, in such case the capital gain will always be short term capital gain, or capital loss will always be short term capital loss. But does it mean that they cannot get the benefit of 54 series exemption? Answer is no. If the asset inside the depreciable asset block was used for long term purpose, then they can get the benefit of exemption also. If you understood, well and good. If you did not understood, ignore. Okay, now let us talk about SLM method. SLM method is what? Straight line method. So straight line method, if it is followed, then 3 cases can happen when the capital asset is sold. First case is where selling price is less than the WDV. If selling price is lesser than WDV, then selling price minus WDV will be called terminal depreciation. This terminal depreciation is allowed as a deduction in PGBP head of income. It is allowed as deduction in PGBP head of income. Next case is selling price is greater than the WDV. If selling price is greater than WDV but less than the cost price, then selling price minus WDV will become balancing charge. This balancing charge is considered as income under PGBP under section 41. Okay. Next, third case. What is the third case? Selling price is greater than cost price. If selling price is greater than cost price, then there are 2 amounts that you have to calculate. Cost price minus WDV will be called balancing charge, and it will be considered as income under PGBP. And next one, selling price minus cost price will become capital gain. Selling price minus cost price will become capital gain. So listen here, in case of SLM method, capital gain will arise only and only if the selling price is more than the cost price. Selling price is more than cost price, and the amount of difference will become capital gain. There is no concept of capital loss for straight line method. Only capital gain will arise. The other cases are there, no? Wherever there is a loss, all that is covered in PGBP itself. You have to claim a deduction, or you can claim it as income, as the case may be. I hope you are clear with SLM method of depreciable asset also. Fine.
Okay, let's come to exemptions Kanna. So section 54, we had learnt about exemptions under section 54 series, so 54, 54B, 54D, etc. Now in section 54, which is capital gain on sale of residential property and used for residential purpose, and the new asset should also be a residential house property. In such case, what is the new provision? The new provision is that the maximum exemption has been limited to 10 crore rupees. Maximum exemption is how much Kanna? 10 crore rupees. It means what? The cost of the new asset maximum should be 10 crore. Sir, what if it is 100 crore? If it is 100 crore, the cost of new asset, if it is 100 crore, then you should calculate as only 10 crores. You get my point? In your capital gain calculation, if the cost of new asset is 100 crores, you should take as maximum 10 crores only and do the capital gain calculation. Similarly, sir, this CGAS, capital gain account scheme is there, no? In that also, the maximum amount allowed is 10 crore rupees. More than that, if you deposit in CGAS, that is capital gain account scheme, it will not be considered under Income Tax Act. You deposit, that is not a problem. But in income tax, you will not get any benefit for that deposit. Fine. Similarly, even in section 54F, when you do the calculation, Section 54F is what? You sell any long-term capital asset, and after selling, you use the entire money to buy a residential house property. Correct? One residential house. Not the capital gain, entire money. Here the concept is a little different. Now here also, this residential house that is to be bought, its value also can be maximum 10 crores. Maximum 10 crores. If the value of that house is more than 10 crores, you should consider only 10 crores. You get my point? And here also, in capital gain account scheme, the maximum amount is 10 crores. The government does not want to give benefit to super rich people who are having crores and crores of capital gain and escaping by selling one property and buying another property. They wanted to restrict this exemption only to the middle class, upper middle class people and to a certain extent of capital gain. They do not want to give this benefit for the higher amounts. Fine. So this change is there. And now let us discuss a brand new section, that is section 50AA, computation of capital gain in case of market linked debenture and specified mutual fund. Okay, market linked debenture and specified mutual fund. Firstly, let us know what is this market linked debenture and what is this specified mutual fund. Specified mutual fund, let us see. It is a mutual fund where not more than 35% of the total proceeds is invested in equity shares of the domestic company. See Kanna, there is a mutual fund. Okay, there are two types of mutual fund: equity mutual fund and debt mutual fund. Equity mutual fund means minimum 65% should be there in equity. Fine. And debt mutual fund means 65% should be there in debt. Fine. Now in this case, see here, a mutual fund where not more than 35% is invested in equity. So maximum equity percentage is how much? 35%. It means what? Minimum debt percentage is how much? 65%. Maximum 35 equity. It means what? Minimum 65 debt. It means specified mutual fund is nothing but a debt mutual fund. Where not more than 35% means max to max 35% is invested in equity shares. And how is this 35% calculated? This 35% is calculated by taking the annual average of the daily closing figures. So every day they will take the closing amount and they will take the average of the closing amount of all the days in the year, and then they will decide the percentage. So this is how the percentage is calculated. This is specified mutual fund. Now let us see what is market linked debenture. Market linked debenture is a security which has an underlying principal component in the form of a debt security and where the returns are linked to market returns on other underlying security or indices. Fine. It includes any security classified or regulated as a market linked debenture by SEBI. So it means what, Kanna? Market linked debenture is also debenture. Debenture means what? It is a type of security that represents a loan or a debt. Correct? But here what is different? Generally, if there is a debenture, the debenture will have an interest rate. Correct? Let's say 7% debenture, 8% debenture, 9% debenture. However, in case of market linked debenture, the debenture will not have a fixed interest rate. Instead, the interest rate will depend on the market condition. It will depend on market condition. Market condition means any other security in the market or indices. Indices means what? Example, Nifty or Sensex. All these are indices. Also, if SEBI is telling that a security is a market linked debenture, then you should also consider it as a market linked debenture. Now, let me give you an example. If you want, you can note this down also to have more clarity. Example, A Limited issues a market linked debenture which gives 10% return if the Nifty 50 does not fall by more than 20% during the tenure of the market linked debenture. If it falls, then no return will be given, only principal amount will be repaid. Let me explain. So this A Limited is there, no? It has given a debenture. Let's say the value of debenture is 1 lakh rupee. Okay, and it is given for 5 years. 5 years. Now what are they telling? If at all the value of Nifty 50 is what? It is an index. If the value of Nifty 50 goes below 20%, so let's say while issuing the debenture, the value of Nifty 50 was 20,000. Okay, the value of Nifty 50 was 20,000. Now what are they telling? The Nifty 50 price should not go down by more than 20%. 20% is what? 4,000. So it means what? During this 5 years, Nifty 50 should never touch 16,000. If it goes below 16,000, then this A Limited will not give any interest. However, if during this entire 5 years, not even in a single day, Nifty 50 goes below 16,000, then A Limited will give 10% interest. You get my point? Sir, what if there is no interest? It means that only principal repayment will be there. At the end of 5 years, you will get back the 1 lakh rupees, but you will not earn any interest at all. You get my point? Such type of debenture is called market linked debenture. Fine. Now, what happens now, Karna? This market linked debenture and specified mutual fund, okay, both of them are actually debt instrument. Specified mutual fund also contains minimum 65% in debt. Okay, maximum 35% equity means what? Minimum 65% in debt. Similarly, even this market linked debenture is a debenture. However, this specified mutual fund and market linked debenture are both traded in the stock exchange. For this mutual fund also, daily NAV will be calculated, correct? And for market linked debenture also, it can be traded in stock exchange. You can buy a market linked debenture from stock exchange. You get my point? It means what? It means that even though it is a debt, okay, the value of debt never changes. It will remain constant, correct? Since the incremental value is given in the form of interest. See here, if there is a debt, okay, will the value of debt increase? Answer is no. The value of debt will not increase. It will always remain the same because the debt value is given in the form of interest. This I have already explained you when I was explaining you why there is no indexation allowed on debentures and bonds. That time I had explained you this concept. Now listen here. Even though the value of debt does not increase, but still they are traded in the stock exchange. This market linked debenture and specified mutual fund, correct? They are traded in the stock exchange. Now, why will some person buy this from the stock exchange? They will buy this only because the price can increase or decrease in the stock exchange. It means what? The only intention of the person buying a market linked debenture or a specified mutual fund is that they can buy for a low price and sell for a high price. This is called speculation. This is called what? It is called speculation. It means you are not concerned about anything else. You just want to buy in a lower price and sell at a higher price. You are not interested to invest in the company. You are only interested to make profit on price fluctuation. The government wants to treat this speculation as business income. But since these both are capital asset, they cannot take it to PGBP. Okay, that is why they have introduced section 50AA. Now look here, section 50AA, transfer of unit of specified mutual fund or market linked debenture. Section 50AA provides for the computation of capital gain in terms of in case of transfer of unit of a specified mutual fund acquired on or after 1/4/2023. So this is applicable only if the specified mutual fund is purchased on or after 1/4/2023. Very, very important. This entire section is very important, Karna. I am expecting that a question will come in either May 24 or November 24. May 24 an MCQ might come, and in November 24 a full-fledged question can come. Fine. And market linked debenture. Section 50AA will have an overriding effect in spite of anything contained in section 242A, which defines a short-term capital asset. Now what are they telling? The section is telling that a specified mutual fund or a market linked debenture will always be considered as what? Short-term capital asset. Why? Because if they consider this as long-term capital asset, you will claim indexation, then your profit will reduce or capital gain will reduce and you will pay reduced tax. Correct? Hence, they are telling that whatever the period might be, it will always be considered as short-term capital asset, and it is overriding section 242A. So here also I want you to make a note. Come to section 242A, where we discussed about short-term capital asset and long-term capital asset in page number 10.8. I want you to note here period of holding concept. Note, as per section 50AA, specified mutual fund and market linked debenture are always considered as what? Short term. Please pause the video, write down the provision and then unpause the video. Okay? Done? So since it is only considered as short-term capital asset, the capital gain will also be called what? Short-term capital gain, and the tax applicable is normal rate of tax. Sir, how to compute capital gain? Capital gain is computed in the normal manner, Kana. First you have to take full value of consideration. Full value of consideration, it means what? Selling price of market linked debenture or specified mutual fund. Selling price. Then you can reduce transfer expense. Correct? Then you will get net consideration. From this net consideration, you can further reduce what? Cost of acquisition. This cost of acquisition, is indexation allowed? Answer is no. No indexation, since it is always short term. Cost is always what? Short term. After reducing the cost, you will get short term capital gain or short term capital loss. You get my point? So this is the concept. And sir, I told you that the government wants to consider this as a business. Since it is only speculation, there is no point of investment in case of market linked debenture, etc. That is why you might think that STT and CTT might be allowed. STT and CTT might be allowed. However, since this is capital gain chapter, STT CTT is not allowed as deduction. Here CTT will not be applicable, only STT will be applicable. So STT is not allowed as deduction. Nowhere in capital gain STT is allowed as deduction. Hence, even in this section, STT will not be allowed as deduction. So let me summarize this section once again. If there is a capital asset called market linked debenture or specified mutual fund. What is a market linked debenture? Market linked debenture is a debenture whose return is dependent on the market, or if it is called as a market linked debenture by SEBI. Fine. What is a specified mutual fund? Specified mutual fund is a mutual fund in which maximum 35% only should be equity. Okay, and it should be purchased on or after 1/4/2023. If you have such capital asset, then it is always considered as short term capital asset, and the capital gain also will be considered as short term capital gain, and it is subject to normal rate of tax. Okay, normal rate of tax. How will you compute capital gain? Take full value of consideration, reduce the transfer expense, and you will get net consideration. From this you should reduce the cost and you will get the short term capital gain or short term capital loss, and no STT is allowed as deduction in case of section 50AA also. Fine.
So with this, continuously we have seen all the different special cases in capital gain chapter. I hope you were able to revise it quickly, and there is loads and loads of concept involved in this particular video. So even if you did not grasp the entire concept within the first watching, I would recommend you to watch this video once again. If you want, you can speed the video or make the video faster and watch it. You will be able to understand clearly. After this, solve the questions in your study material. You will be good to go and you will rock in your examination. Wish you all the best, dear. See you in the next video. Till then, take care. Bye bye. Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the income from other sources chapter for CA Intermediate Income Tax Syllabus. But before beginning the revision, as usual, my request to you is to like this video, subscribe to this channel dear if you have not already subscribed, and also leave a comment if you find this video helpful, and share it with your friends because sharing is caring. Now without further ado, let us begin the revision. Income from other sources head of income is the last and the fifth head of income, and it is also called the residuary head of income. Residuary head of income means what? If at all there is an income that is taxable under the Income Tax Act, but it is not covered under any of the four other heads of income, then such income will be covered under the income from other sources. Okay. But apart from being a residuary head, there are certain incomes that are taxable only in income from other sources. For example, winnings income, dividend income, etc. Hence, if an assessee is earning dividend income, it will always be taxable in income from other sources. Okay. Now, like any other head of income, even income from other sources has a charging section and a computation section. The charging section is given under section number 56 and computation section is given under section number 57. Now let us discuss the concept by concept in income from other sources. Firstly, let us discuss the most important concept in income from other sources, that is section number 56 to 10. When does section 56 to 10 apply, sir? Kanna, 56 to 10 will apply when an assessee is receiving money, movable property or immovable property from any person without consideration or for inadequate consideration. In such case, 56 to 10 will apply. And fondly, that is pasama, we are calling this section as taxation of gift. In Income Tax Act, it is not written that this is taxation of gift. We are only commonly calling it as taxation of gift. Okay. But be clear with certain points. What are those points? Point number one, this section you should refer only if the money, movable property, immovable property that is received without consideration or for inadequate consideration is other than those covered in salary head of income and PGBP head of income. Hence, if the employer is gifting any amount or asset to the employee, then see the salary head of income. If a person is receiving any gift in the nature of business or profession or in the course of business or profession, then refer the PGBP head of income. Only if in those heads it is not covered, only then it will be covered under 56 to 10. That is point number 1. Then this section, that is 56 to 10, is applicable to all the assessees. It is applicable to all assessees. But in certain cases it will not be applicable. In certain cases it will not be applicable. So before learning this section, let us learn the exception of this section. Exception of this section. So what are the exceptions of 56 to 10? Let us study one by one. So first exception is transactions not regarded as transfer, but in that only certain transactions are exception to this particular section. What is transaction not regarded as transfer? Section number 47 that we learnt in capital gain chapter is transaction not regarded as transfer. There are many provisions, when amalgamating company is transferring to Indian Amalgamated, okay, resulting is transferring to demerged is transferring to resulting company, then preference shares are converted into equity shares. So for all those transactions, this 56 to 10 will not apply. Hence, when the transferor is giving the asset, capital gain will not arise. When the transferee is receiving the asset, 56 to 10 will also not arise. Hence, there will not be any tax for those transactions. However, only certain transactions are covered, certain transactions are not covered. In section 47, we learned that even gift is covered in section number 47. Hence, when a person is giving a gift from one person to another person, it is a transaction not regarded as transfer. That is why capital gain will not arise. However, when a person is receiving the gift, okay, the person who is receiving the gift must pay tax under 56 to 10. Hence, when gift is received, tax has to be paid under 56 to 10. Income will be considered. Okay. Next, if any gift is received from relatives, it should not be considered under 56(2)(10). Now, who are the relatives? See here. A relative of an individual is the spouse. Spouse means what? For a husband, the wife will be called the spouse. For a wife, the husband will be called the spouse. So, spouse, then brother or sister of the individual, brother or sister of spouse of the individual is also relative. Lineal ascendant and lineal descendant of the individual is a relative. Lineal ascendant means what? Parents, grandparents, great grandparents, etc. Lineal descendant means what? Children, grandchildren, great grandchildren, etc. So lineal ascendant is also relative. Lineal descendant is also relative. Similarly, lineal ascendant and lineal descendant of the spouse is also relative. Next, brother or sister of either of the parents of individual are also relative, but not of the spouse. So my parents brother or my parents sister will be my relative. Okay, so let me take the relative definition once again, very important. So for an individual, spouse is the relative, brother and sister of the individual, brother and sister of spouse of the individual. Lineal ascendant, lineal descendant of individual, lineal ascendant, lineal descendant of spouse of individual, then brother or sister of either of the parents of the individual but not of the spouse, and spouses of all the above will also be considered as individual. And in relative definition, no, one thing you have to be very clear. What is that one thing? That relationship is not vice versa. Relationship is not vice versa. It means what? If I am the relative of some other person, it is not necessary that they are also my relative. Okay. So listen here. I gave you an example also. For example, my father's brother is my relative. My father's brother is my relative. But so hence what will happen? If my father's brother is giving me a gift, it will not be taxable under 56(2)(10). However, for my father's brother, am I a relative? Answer is no. Nowhere it is written that brother's son is relative. That is why if I am gifting anything to my father's brother, then he will have to pay tax under 56(2)(10). That is why relationship is not vice versa. He is my relative, but I am not his relative as per the Income Tax Act. So this you have to be very careful. Then for a HUF, members of the HUF are relative. Okay. Now we know what is relative definition. If any gift is received from the relative, then it is totally exempt. It is not required to be taxable under 56(2)(10). Next, if any money, movable property or immovable property is received through inheritance or will, then also it is not taxable under 56(2)(10). Next, if any movable property, immovable property or money is received on the occasion of marriage, then also it is not taxable. However, remember that is only on the occasion of marriage, not on the occasion of marriage anniversary, birthday party, etc. Only marriage is covered in exception. Hence, on the occasion of my marriage, if someone is gifting me something, then I need not consider it as an income under 56(2)(10). Next, on contemplation of death. On contemplation of death means what? While a person is going to die, okay, on deathbed, if the person is giving any money, mobile property or immovable property without consideration to some other person, then in the hands of receiver, it will not be taxable under 56(2)(10). Okay. Next, if any gift is received from local authority, it is not taxable under 56(2)(10). Next, if a gift is received from an individual to a trust solely created for the benefit of relative of individual, then also it is not taxable under 56(2)(10). For example, for the benefit of my son, I have created a trust, and to that trust I am giving the money, movable property or immovable property. In such case, the trust need not pay any tax under 56(2)(10). There will not be any income under 56(2)(10). Next, section 1023C and 12AA. So if there is any organization that is registered under 1023C or 12AA, then to such organization, if we are giving the gift or they are giving us the gift, so to and from both are covered. For both transactions, there is no income under 56(2)(10). So even if they are giving me the gift, I need not pay any tax. If I am giving them a gift, they need not pay any tax under 56(2)(10). Next, other cases as may be prescribed. And there is one prescribed case if there is any immovable property received by a resident of unauthorized colony of Delhi. So if a resident of unauthorized colony of Delhi is receiving immovable property, then such immovable property need not be taxed under 56(2)(10). You get my point? So these are all the exceptions under 56(2)(10). I also gave you a code word to remember all these exceptions, which is TRIM CD Lab 1023C 1288 Delhi. So if you remember this mnemonic, you will be able to memorize all the exceptions. Now we have learnt the exceptions. Let us jump to the main section. So what does the section say? Firstly, let us talk about cash. Here cash does not mean physical cash. Here cash means money. So if money is received by a person, then the aggregate amount of cash received during the previous year, if it exceeds 50,000 rupees, then the entire amount is taxable. If the aggregate amount exceeds 50,000, entire amount is taxable. I gave you an example also. One of my friend gave me 30,000 during the year. Another friend gave me 25,000 during the year. So totally how much did I get? I got 55,000. Hence the entire 55,000 will be taxable. Since it exceeds the 50,000 limit, entire amount will be taxable. Now let's talk about immovable property. Immovable property means what? Land or building or both. If an immovable property is received without consideration, then see what is the stamp duty value. If the stamp duty value per transaction, so here you should not take aggregate value, you have to consider per transaction. If the stamp duty value per transaction is more than 50,000, then the stamp duty value will be taxable under 56(2)(10). Next, let us talk about inadequate consideration. Inadequate consideration means what? I am paying consideration, but that is not adequate. It is lesser than the stamp duty value. In such case, what you have to do? Listen here. You have to do step 1. 50,000 or 10% or 20% of the consideration, whichever is higher. 50,000 or 10% or 20% of the consideration, whichever is higher. When you have to take 10%, when you have to take 20%? Answer is generally you have to take 10% as the consideration. Generally 10%. However, in only one special case you have to take 20%. What is that special case? It is the case which is covered in section 43CA, which we have discussed in PGBP chapter. Capital gain chapter. PGBP section is there, section 43CA, in which if a builder is giving a residential unit to to the person who is receiving the residential unit, and if the consideration is up to 2 crores and if it is received within the time period that is prescribed under that section, then instead of 10% you can take 20%. So you have to link it with section number 43CA, which we have already studied. So in that case alone you have to take 20%. In all the remaining cases you have to take 10%. So take 50,000 or 10% or 20% of the consideration, whichever is higher. Then see, if stamp duty value minus consideration is more than the higher amount, if stamp duty value minus consideration is more than the higher amount, then stamp duty value minus consideration will be taxable under 56(2)(10). However, if it is lesser than the higher amount, then there is no income under 56(2)(10). So listen once again, what you have to do? 50,000 or 10% or 20% of the consideration, whichever is higher. Then take this higher amount and compare it with stamp duty value minus consideration. If stamp duty value minus consideration is higher, then the stamp duty value minus consideration will be taxable under 56(2)(10). If it is not higher, then it will not be taxable. Okay, very simple. Now let us talk about movable property. What is movable property? Only JAD-PAS BS, JAD-PAS BS is covered in movable property. All other movable property is not covered in 56(2)(10). What is JAD-PAS BS? Listen. Jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion and shares and security. Repeat once again. Jewelry, archaeological collection, drawing, painting, any other work of art, sculptures, bullion and shares and security. All these are movable property that are covered under 56(2)(10). Other than these property, no other movable property is covered. Hence, if an assessee is receiving any movable property which is not covered here, for example, he is receiving an electric vehicle or a car or a mobile phone or a watch or furniture or any movable property that is not covered here, then it will not be taxable under 56(2)(10). Only the movable property that is covered here will be taxable. Okay, that is point number 1. Now how to calculate the tax? Listen, how to calculate the income, let us see. If the movable property is received without consideration, then if the aggregate fair market value is more than 50,000, then the aggregate fair market value is taxable. I gave you an example also. Okay, one second. So see here, if I am receiving from my friend shares worth rupees 20,000, then one more friend is giving me gold bullion worth rupees 34,000. So totally how much value of gift that I have received? Answer is 54,000. Total it is 54,000 during the year. Since it is more than 50,000 rupees, hence the entire 54,000 will be taxable under 56 to 10. It will be considered as income under 56 to 10. You get my point? Now let us talk about an inadequate consideration. If movable property is received for inadequate consideration, then if the difference between fair market value and consideration is more than 50,000, then the difference amount will be taxable. Aggregate difference amount will be taxable. You get my point? So this is the concept of 56 to 10. I hope you are very clear. And also one more special point. See, I told you, no, we have to compare it with stamp duty value minus consideration. In such case, stamp duty value we have to take on which date? Generally, you have to take the stamp duty value on registration date. However, if on or before the date of agreement, if there is any full or part consideration that is paid through account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode, in such case you take the date of agreement. Okay. This is the same provision that we discussed in section 50C and 43CA. Fine. Now let us discuss the next part. Okay, one more thing I wanted to tell. See, listen here. Here also, if assessee is not satisfied with the stamp duty value, he can refer the case to valuation officer, and all those valuation officer points will be applicable that we had studied in capital gain chapter under section 50C. So that is applicable also to 56 to 10. Then 56 to 10 is applicable only if the asset is received is a capital asset. Hence, if someone is gifting me an asset, and if that asset is a stock, then I should not see 56 to 10, I should see PGBP chapter. Only if I am getting a gift and if that gift is a capital asset, I should consider 56 to 10. And then one more thing, if an amount is taxed under 56 to 10, then the value of that asset which is considered for 56 to 10 will become the cost of acquisition for future purposes. This also we have already discussed in capital gain chapter. Okay. Now next let's talk about taxation of dividend. So what is dividend? If the profit of a company is distributed to the shareholders, it is called as dividend. Dividend is taxable under income from other sources at normal rate of tax. Earlier dividend used to be exempt and all, but that and all is not applicable now. Now what is applicable? If dividend is received, it is fully taxable under income from other sources. However, there are 5 cases where the Income Tax Act will deem a transaction as dividend. That is, even though it is not a dividend, still the Income Tax Act will tell that it is a dividend. But be sure about one point, that this deemed dividend is only up to the extent of accumulated profit of the company. Accumulated of profit of the company. Sir, what is this accumulated profit? Accumulated profit means profit that gets accumulated over a period of time. That means the profit which is there in the hands of the company, only to the extent of that profit it can be considered as deemed dividend. Now, accumulated profit can be of two types: capitalized accumulated profit, not capitalized accumulated profit. Capitalized accumulated profit means brought to balance sheet, not capitalized means not brought to balance sheet. Okay. Now, there are 5 sections of deemed dividend: 222A, 222B, 222C, 222D and 222E. For the first 4 sections, 222A, B, C, D, for the first 4 sections, what will happen? The entire amount of accumulated profit, whether it is capitalized or not capitalized, both will be considered as deemed dividend. Both will be considered as deemed dividend. That is the maximum limit. However, in case of 222E, the amount only up to a maximum of accumulated profit that is capitalized will be considered as deemed dividend. So what did I say? Maximum deemed dividend can be accumulated profit. Accumulated profit. For the first 4 provisions, that is 222A, B, C and D, accumulated profit can be capitalized also, not capitalized also. But for 222E, we have to take only capitalized accumulated profit as the upper limit. Okay, so I hope you are clear. If you're not able to understand also, it is not that important. You can forget it, no problem. Let us focus on the concept. So firstly, let us discuss section 222A, A for asset. 222A, A for asset. So if any asset is distributed by a company to its shareholder, then when the shareholder is receiving the asset, that asset is deemed as dividend in the hands of shareholder, and the value of that asset should be considered as income from other sources, and the assessee has to pay the tax, but only to the extent of accumulated profit. Next, section 222B, B for bonus. So there are two types of transaction that is covered in section 222B. What is the first transaction? If there is any distribution of debenture stock or deposit certificate to shareholder. Debenture stock or deposit certificate to a shareholder. And second transaction is bonus shares given to preference shareholders. Bonus shares given to preference shareholders. In these two transactions, the person who are receiving the security, for them it will be considered as deemed dividend, and they have to consider it as income to the extent of accumulated profit of the company. You get my point? Next, section 222C, C for close. C for close. So 222C means what? A company is closing down, means it is liquidating. Hence, if any company is distributing the assets on liquidation, then to the extent of accumulated profit, the assets distributed will be considered as deemed dividend in the hands of the person who is receiving the asset. Okay. Next, section 222D, D for decrease in share capital. Hence, if any distribution is done by a company to its shareholders by way of reduction of share capital, then to the extent of accumulated profit, it will be considered as deemed dividend. So for example, there was a 10 rupee shares, it was decreased to 2 rupee shares, and balance 8 rupees is distributed to the shareholders as dividend. It is distributed to shareholders, it will be considered as deemed dividend. Now let us discuss about section 222E. When will 222E apply, sir? Answer is generally 222A, B, C and D. All these four sections applies to all the companies. It applies to all the companies. But 222E will apply only to closely held company or unlisted company. Closely held company or unlisted company, or in short, both of them together you can call it as company in which public are not substantially interested. Company in which public are not substantially interested, which is nothing but closely held company or unlisted company. So if there is a closely held company or unlisted company, and if it is giving loan or advance to a shareholder who is having 10% or more voting power, if closely held company or unlisted company is giving loan or advance to a shareholder who is having 10% or more voting power, then in the hands of shareholder, that loan will be treated as deemed dividend. That loan will be treated as deemed dividend, and he has to consider it as an income under income from other sources and pay the tax. Okay, it does not matter whether the loan is given at an interest rate or not, whether the loan is repaid or not, whatever it is, it does not matter. If a loan is given by a company to such shareholder who is having more than 10% voting power, such loan will be treated as dividend. You get my point? Similarly, even if a loan or advance is given to any concern in which the shareholder is having substantial interest, if the loan or advance is given to any concern in which shareholder is having substantial interest means what? 20% or more voting power, or 20% or more profit sharing ratio, as the case may be, then also such loan or advance will be treated as deemed dividend in the hands of shareholder. And also, if such company is giving loan or advance to any person for the benefit of the shareholder or on behalf of the shareholder, then also such loan or advance will be treated as deemed dividend. You get my point? Now, see, listen, but this deemed dividend only will be to the extent of accumulated profit, which is capitalized, as I already told you. Then even if loan is repaid or interest is charged at market rate, it will not make any difference in this particular section. However, listen here. Let us see exception to deemed dividend. Exception to deemed dividend. Exception number 1. If a loan or advance is given in the ordinary course of business of money lending, where money lending is the substantial part of business. So if a shareholder is receiving loan from the company and the main business of the company itself is giving loan, in such case, then the loan will not be treated as deemed dividend. Number 2. if there is a dividend paid by the company and that is set off against the loan or advance already deemed as dividend, that is covered in exception. So listen here. For example, I am the shareholder. Okay, a company has given me a loan and this loan is deemed as dividend in my hands. That is why I considered it as an income and paid the tax under income from other sources. Now later on, the company wants to give me actual dividend. So what did the company do? The company told me, you do not repay us the loan amount. You set off the dividend against the loan amount. Okay, and you keep it with yourself. Hence, now my loan is converted into real dividend. Now my loan is converted into real dividend. Hence, when my loan is converted into real dividend, should I pay tax on that real dividend? Answer is no. I need not pay the tax because I have already paid the tax while considering the loan as dividend. You get my point? If you're able to understand, well and good. If you're not able to understand, whoosh, rub it off your head, no problem. Next, buyback of shares will not be considered as dividend. And next, if shares are allotted to shareholders of a demerged company by a resulting company in course of demerger, then also it will not be considered as dividend. If there is any distribution under section 222C and 222D for preference shares, then it will not be considered as deemed dividend. So 222C and 222D does not apply to preference shares. You get my point? So this was the entire concept of dividend. I hope you were able to understand. Now let us jump to all the remaining concepts. Firstly, let us discuss section 56 to 7b, shares issued on premium. So if any shares of a closely held company or unlisted company, what did I tell? Closely held company or unlisted company, if it is giving a share to a resident shareholder, then what will happen? If the shares are given at premium means what? Price above face value. Premium means given at a price above the face value. Then income from other sources will be issue price minus fair market value. Issue price minus fair market value. So this is a tricky section. When will this section apply? Number one, it will the section will apply only if the company is a closely held company or unlisted company and it is giving the shares to resident shareholder, and if shares are issued at premium. Premium means what? A price above the face value. Price above the face value. However, what will be income from other sources? Income from other sources will be issue price minus fair market value. Okay, not face value, issue price minus fair market value. So while seeing the condition, you have to consider face value, but while doing the calculation, you have to consider fair market value. So be very, very careful. Next, section 56 to 11, compensation on termination of employment. See here, Kanna. Generally, compensation on termination of employment is covered in salary head of income because there will be employer-employee relationship. However, if there is no employer-employee relationship, compensation of termination of employment will be covered under income from other sources. For example, A is giving B 1 crore rupees to quit his job, but A is not asking B to come and join him. Hence, between A and B there is no employer-employee relationship, but this 1 crore is a compensation on termination of employment. Hence, that money will be taxable under income from other sources. So I hope you are clear. Now let us come to the next section, that is 115BB. 115BB is called tax on casual income. 115BB is a special rate of tax which is taxing casual income. Now what is casual income? Casual income means winnings from lottery, crossword puzzle, horse race, card games, any other games of any sort, or any form of gambling or betting. So what did I say? Lottery, crossword puzzle, horse race, card games, any games of any other sort, gambling and betting is covered under 115BB. So for all these winnings, tax is charged at a flat rate of 30% plus health and education cess and surcharge as applicable. Flat rate of 30% plus health and education cess plus surcharge as applicable, and this is a very, very strict section because against this income no expense is allowed, no allowance is allowed, no deduction is allowed under chapter 6A, even basic exemption limit is not allowed, and even no loss is allowed to be set off. What did I tell? No expense is allowed. So for example, if I'm earning lottery income and I paid some money for lottery tickets, okay, that lottery ticket expense also will not be allowed against the lottery income. Okay, so no expense allowed, no deduction is allowed, no allowance is allowed, chapter 6A deduction also not allowed, basic exemption limit also not allowed, and against such income no loss is also allowed to be set off. So very strict section. And while giving the income, the person who is giving that casual income should deduct the TDS also, that you link with the TDS chapter. Okay, rate of TDS is also 30%. Now let's talk about rent. Generally, rent is taxed under income from house property. However, if rent is not taxable, if rent is not from a house property, then it can be taxable under income from other sources if it is not PGBP. Okay, then composite income can also be taxable under income from other sources if it is not PGBP. And if I am subletting a house, it means what? I am not the owner of the house. Hence, the rent that I receive can be PGBP or income from other sources, as the case may be. Okay, next, key man insurance policy. I already told you, if employer is receiving the money from the insurance company, it is taxable under PGBP. If employee is receiving the money, it will be taxable under salary head of income. And if any other person other than employer employee is receiving the money, it will be taxable under income from other sources. Next, if director remuneration is received from board meetings, then it is taxable under income from other sources, that is sitting fees. Next, income from paper setting, paper checking, seminar fees to professor, etc., from a non-employer organization is also taxable under income from other sources. For example, I am a practicing chartered accountant, but Institute of Chartered Accountants of India is asking me to correct the answer sheet. To correct the answer sheet, for that they are giving me the money. Now, is ICAI my employer? Answer is no. They are not my employer. Hence, the money that I am receiving for this paper checking, etc., will be taxable under income from other sources. Fine. Now let's talk about family pension. Family pension means what? When the employee is no more, then the employer will pay the pension to the family. When the employee is no more, employer will pay the pension to the family. Hence, when the family member is receiving the pension, it is called family pension. Family pension is taxable under income from other sources, and against the family pension, deduction is also allowed. What is the deduction? Deduction will be 1/3 of family pension or 15,000 per annum, whichever is lower. 1/3 of family pension or 15,000, whichever is lower. However, you should link this family pension with the exemption chapter, where we learned section 10 clause 18, where I told you that if a family member of a gallantry award recipient is receiving family pension, then it is completely exempt. Okay. Next, interest income. In various other places, we have also discussed interest income. Like in salary chapter, we discussed interest from PPF, interest from RPF, etc. Then in exemption chapter, we discussed interest from Sukanya Samriddhi account, interest from NRE account, etc. So all those places I am not covering once again. Only the balance interest income I am covering it here. So if any interest is received on compensation or enhanced compensation of compulsory acquisition, what did I tell? Interest on compensation or enhanced compensation of compulsory acquisition, against such interest 50% is allowed as standard deduction. 50% is allowed as standard deduction. So for example, if government is giving me 1 lakh rupees as interest on compulsory acquisition, then on such interest 50,000 rupees I can claim it as deduction. Balance 50,000 only will become taxable. So 50% will be standard deduction. Next, section 10 clause 15. If interest is received on gold deposit bond of 1999, it is exempt. If it is received on deposit certificate under gold monetization scheme 2015, it is exempt. Interest from national plan certificate, exempt. Interest from capital investment bond is exempt. Interest on relief bonds of RBI is exempt. Then interest paid to non-resident by a IFSC unit, that is International Financial Service Center unit, is also completely exempt. Then if interest is received from post office saving bank account, then up to 3,500 per year it is exempt. And in case of a joint account, maximum exemption that can be claimed is 7,000 rupees. Now be very careful. When interest is received on post office saving bank account, then exemption is also given, and that is 3,500 or 7,000 as the case may be, and deduction is also available under section 80 TTA, 80 TTA and 80 TTB. In such case, what to do? First take the exemption, okay, and only on the balance amount you consider the deduction. Fine. So be very careful. All other interest income will be taxable normally, and even income from UTI and mutual fund is also taxable normally. Next, let's talk about deductions. First and foremost, If an income is taxable under income from other sources, then if an expense is relating to that income, it can be claimed as deduction. It can be claimed as deduction. However, there are disallowances similar to the disallowances that we have already discussed in PGBP. What are the disallowances? If TDS has to be deducted and TDS is not deducted, then 30% will be disallowed if the payment is to resident. Then if any excess payment is made to related party, then also excess amount will be disallowed. If payment is made about 10,000 rupees to a person in a day other than account pay check, account pay bank draft, electronic clearing system or any other prescribed mode, then such payment is also disallowed. Then similarly, where there is deemed profit under PGBP, similarly deemed profit of section 41(1), if it is not related to PGBP, it will be taxable under income from other sources. And one more thing, personal expenses will not be allowed under income from other sources. Let us talk about other deduction. If an income is exempt, then the expense related to that income will also not be allowed. This we have already studied in section number 14A. Next, against interest on compensation of compulsory acquisition, 50% is allowed as deduction. For family pension, once again I am telling, 1/3 of family pension or 15,000, whichever is lower, is allowed as deduction. Against winning income, no deduction is allowed. And now let me tell you new concept. For dividend income or income from units of mutual fund or income from specified company under 1035. Dividend income, income from units of mutual fund and income from specified company under 1035. If such income is received, then no expense is allowed other than interest expense. No expense is allowed other than interest expense. However, maximum interest expense that is allowed, that is also 20% of income. 20% of income. See, for example, listen here. For example, there is a person called Miss S. Okay, Miss S received a dividend of 10 lakh rupees. Okay, from a company. For investing in the company, she took a loan from the bank of 10 crores and this 10 crores she invested in the company. Now, on this 10 crore loan amount, she is paying interest of 1 crore. On this 10 crore loan, she is paying interest of 1 crore. So, how much is the dividend? The dividend is just 10 lakhs. How much is the interest expense? Interest expense is 1 crore. So, what will be the income that will be taxable under income from other sources? So, see here, first you have to take the dividend income, that is 10 lakhs. Against the dividend income, you can claim interest as expense. So how much is the maximum interest allowed as expense? Number 1, take the actual interest and take 20% of dividend, whichever is lower will be allowed. So what is actual interest? 1 crore. 20% of dividend is how much? 2 lakhs. Whichever is lower will be allowed as expense. Hence 2 lakhs is allowed as expense. So income from other sources will be 8 lakh rupees. So against a dividend, no other expense is allowed, only interest expenses allowed. That too, maximum 20% of dividend income. I hope you are clear. Next, if any salary is received by member of parliament or member of legislative assembly, it is taxable under income from other sources. However, daily allowance and constituency allowance is exempt. Next, generally awards that are received are taxable. However, certain awards are also exempt, that you link it with exemption chapter. If any agricultural income is received outside India, it might be considered in income from other sources. Next, if any royalty income is also received, generally it is considered in income from other sources. And also last point, advance money. If any advance money is forfeited, then we learnt in capital gain chapter itself that if it is forfeited on or after 1/4/2014, then in the year in which it is forfeited, it will be taxable under income from other sources. You get my point?
Now let us discuss the amendments in income from other sources chapter. Okay, in income from other sources, there is only amendment in section number 56 to 10, that is taxation of gifts. First amendment, that is in case of movable property. Okay, we learned that in case of movable property, this section is applicable only if the movable property is a jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion or shares and security. Now, one more asset has been added here, and that is virtual digital asset, which means cryptocurrency, Bitcoin, like Bitcoin, Ethereum, etc. So this also has been added in movable asset. However, this point is not there in CA inter syllabus, so you might also ignore, but still if at all question is asked, you will be able to answer. Fine. Now also there is amendment in exception of gift. Exception section. So first we learnt many exceptions where this section, that is 56.210, will not apply and the entire amount or asset that is received will be exempt from tax or will not be taxable. Okay. Now here two more points are added. That is point number 1. If the amount or asset is received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of family for illness related to COVID-19, subject to conditions notified by central government. So what are they telling? If an individual has incurred any expenditure for COVID-19 treatment for himself or for family member, and for this expenditure this individual is receiving any amount from any person, then that entire amount will not be subject to tax under 56.210. Hence it will not be taxable. You get my point? Now next point. By a member of family of a deceased person. Now let's say a person was suffering from COVID-19 and due to COVID-19 that person lost his or her life. In such case, if the family member is receiving money, then if the money is received from the employer of the deceased person, if employer is giving money, then there is no limit at all. Whatever money the employer is giving, entire amount will not be taxable under 56.210. Then if the person giving the money is not the employer, if it is some other person, then the maximum amount exempt is 10 lakh rupees. 10 lakh rupees. So if the amount given is more than 10 lakhs, then the excess amount will be taxable under 56.210. Up to 10 lakh rupees, it will be exempt under 56.210. In which case, where the person has died due to COVID-19 and family member is receiving the money, either from employer of the dead person or from any other person. Okay. Where the cause of death of such person is illness due to COVID-19 and payment is received within 12 months from the date of death of such person. So this amount received from employer or from any other person should be received within 12 months from the date of death. Okay. And other conditions notified by central government. So firstly, let us learn what is the meaning of family in this particular provision. Here family means spouse, children and parents, brothers or sisters if dependent on the individual. Okay. So what is family? Spouse, children and parents, brothers or sisters if dependent on individual. Then conditions I have given here. Condition notified by central government, condition notified by central government. Now what are those conditions? Let us see. So for conditions, first I would like you to pause this video, note down the conditions and then unpause the video and watch the explanation. Okay. So what are the conditions, Kana? Condition number 1, point number 1. Death should be within 6 months of testing positive for COVID-19. Hence the death should have incurred within 6 months from the COVID-19 positive report or from the date of clinically being determined as COVID-19. So the day on which it is determined that the patient is COVID-19, from that date within 6 months only the death should have happened. Point number 2. Family members shall keep a record of the following documents. A. COVID-19 positive report or medical report if clinically determined to be COVID-19 positive. Hence COVID-19 positive report should be there. And next, medical report or death certificate issued by medical practitioner or competent authority in which it is stated that the death is related to COVID-19. So two documents should be there. COVID-19 positive report and second document is medical report or death certificate where it is written that the death is due to COVID-19. So these two documents should be there in case of a deceased person for whom the family member is receiving the money. Okay. And then second point, statement of any sum of money received by a member of a family of the deceased person from the employer or other person on account of death due to COVID-19 should be verified and furnished in form A. So the family member who is receiving the money from either the employer or any other person, okay, for the death of an individual due to COVID-19, all the details should have to be mentioned and furnished in Form A. Okay, so if these conditions are satisfied, then what will happen? The amount that is received from employer, entire amount will not be taxable under 56(2)(10), and if the amount is received from other than employer, then up to 10 lakhs will not be taxable. Only the amount more than 10 lakhs will be taxable in the hands of family member. Okay, you get my point. So these two are the new exceptions added to 56(2)(10). Let us discuss the remaining updates in income from other sources chapter. First and foremost, there is a change in section 56(2)(7)(b) from May 2024 examination onwards. And what is that change? Now this section is applicable not only to a resident but also to a non-resident. So huge change that now angel tax is applicable not only to residents but also applicable to non-residents. Next, section 56(2)(13) has been introduced in the Income Tax Act, but this section we will discuss along with deduction chapter. So after the deduction chapter, there are certain changes in deductions also that I will be explaining, and then along with that I will be discussing this new section also. Fine. Now let's come to the next section, and that is section 115 BBJ. Please make this correction. Section 115 BBJ, tax on winnings from online games. Now online games winnings has also been included first and foremost in the income definition, and now there is a separate tax for the online games, but it is same as section 115 BB. Okay, that is the tax on winnings from lottery, crossword puzzles, etc. So whatever section 115 BB says, same way even for winnings from online games, all the similar provisions will apply. Let us go through the provisions quickly. First and foremost, this section applies to net winnings from online games. So whatever winning from online game is there, that will be covered under section 115 BBJ. Meaning of online game. Online game is a game that is offered on the internet and is accessible by a user through a computer resource, including any telecommunication device. So it can be mobile phone, it can be iPad, it can be laptop, it can be desktop, it can be any telecommunication device. And in that device, using the internet, you are playing a game, and on winning that game, you are getting a particular award or prize or any money. On that, tax is payable under section 115 BBJ. What is the rate of tax? It is flat 30% plus health and education cess and surcharge if applicable. Okay, 30% flat rate of tax. Next, is any expense allowed as deduction? No expense is allowed as deduction. No deduction is allowed. Okay, under chapter 6A, no loss is allowed. Basic exemption limit also you cannot set off. So all the restrictions which were applicable to lottery, same are also applicable to winnings from online games, and even the tax rate is same. Okay, so even in the special rates of tax, I have included the winnings from online games. There also you can note down. There also you need not note down, it is already given. Fine. 30% rate of tax. So for example, if any person is paying a game such as a PUBG tournament or a Fortnite tournament, or even in case of Dream 11, etc., whatever winnings is there, that will be taxable under this section. Okay, so that's it in income from other sources. See you in the next video. Till then, take care. Bye bye.
Hello everyone, I am CA Prateek and you are watching the revision lecture of the chapter Income of Other Persons included in Assessee's Total Income, which we fondly call it as Clubbing of Income chapter, okay, for the CA Intermediate examinations. So let us start with section 60 in the clubbing chapter. Section 60 says, if there is any transfer of income without the transfer of the asset, then income is clubbed in the hands of the transferor. Okay, wa? So if I transfer my income without transferring my asset, then the income will still be taxable in the hands of the transferor, that is in my own hands. This transfer can be revocable or irrevocable, it does not matter. Now let us come to transfer of asset. முன்னாடி என்ன பார்த்தோம்? Transfer of income. Now we are seeing transfer of asset. Transfer of asset la வந்து there are two types of transfer. There is revocable transfer and there is irrevocable transfer. Revocable transfer na enna sir? Temporary transfer. Irrevocable transfer na enna sir? Permanent transfer. Okay. So what is example of irrevocable? If I transfer my property to someone and I tell them keep the property, keep the income, keep everything, I don't want anything from this property, then it is called permanent transfer, which is irrevocable transfer. However, revocable transfer na enna? For example, I am giving my property to someone and I am telling them after 5 years you give that property back, or I am giving the property to someone and I am telling them give me the income from that property. In such cases it is called revocable transfer. So revocable transfer is the transfer, okay, one second. Revocable transfer is the transfer where the asset or the income from the asset comes back to the transferor because of any condition. Okay, so what are the example of revocable transfer? Let's see. Number one, where in the contract itself there is a provision for retransfer of whole or part of the income or whole or part of the assets back to the transferor. So if I am transferring an asset, okay, and in the contract itself I have written that the asset will come back to me, in such case it is called revocable transfer. Or I have transferred the asset and I have written in the contract itself that the income from that transfer or the asset will come to me, then also it is called revocable transfer. Next, if there is a transfer which gives the transferor to reassume the power over whole or part of the income or the asset, then also it is called revocable transfer. So if I am giving asset to someone and if I am telling them I have the power to come and take that asset back from you whenever I want, this is also an example of revocable transfer. So revocable transfer na enna sir? Temporary transfer பண்றது, or transfer பண்ணியாச்சு and income வந்து transferorக்கு திருப்பி கிடைச்சிரும். Such transfers are called revocable transfer. Whenever there is a revocable transfer, in such case the income from the asset is clubbed in the hands of the transferor. So income யாருக்கு கிடைக்கும்? Transfereeக்கு கிடைக்கும். But income மேல tax யார் pay பண்ணுவாங்க? Transferor pay பண்ணுவாங்க. ஓகேவா? Now there are two cases where even if it is revocable transfer, it will be considered as irrevocable for the purpose of Income Tax Act. What are they? Number one, the transfer is not revocable during the lifetime of the beneficiary or the transferee. For example, I am transferring my asset to my brother and I am telling my brother that till you die you can keep this asset with yourself. After your death this asset will come back to me. This is a revocable transfer, correct? However, in the Income Tax Act such transfers are called irrevocable transfer because during the lifetime of the beneficiary they can keep the asset with themselves. Okay, then one more example. If any transfer is made before 1/4/1961, that is before the Income Tax Act came into force, and which is not revocable for a period of 6 years, then also it is irrevocable transfer. Then now let's come to section number 64. First let us discuss about income of spouse. Okay, so first point, if remuneration in cash or in kind is received from any concern in which the assessee has a substantial interest, okay, or even the relative of the assessee has a substantial interest, in such case the remuneration received by the spouse will be clubbed in the hands of the assessee. Okay, substantial interest na enna sir? 20% or more voting power in case of company, and in case of other than company 20% or more profit sharing ratio. Okay, and relatives yaru sir? Spouse, brother, sister, lineal ascendant which includes the parents, and lineal descendant which includes children. Fine. So for example, if I am having more than 20% share in a partnership firm and my wife is receiving salary from that partnership firm, in such case the salary received by my wife will be taxable in my hands. It will be clubbed in my hands. So salary யாருக்கு கிடைக்குது? பொண்டாட்டிக்கு கிடைக்குது. So salary is received by the wife. However, who will pay the tax, sir? The poor husband is going to pay the tax. Okay va? I told you the reasons in class also. Because I am having the substantial interest, I can easily manipulate the money in that particular firm. So to avoid such practices, these clubbing provisions are in place. Okay. However, there is an exception. If my wife is receiving the salary and if she is having the professional or technical qualification for that job and she is receiving the salary appropriate for that job, in such case the income will not be clubbed in the hands of the transferor. Okay va? So if my wife is receiving the salary, if she is professionally or technically qualified, then income will not be clubbed. She will only pay the tax on the income. I will pay the tax on my own income. Okay va? So I hope you are clear with the provision. Now let us come to next point. Okay, one more point. If both husband and wife are having substantial interest in the same concern and if both are receiving the remuneration, then what will happen? In such case, before receiving the remuneration, see what is the total income of both husband and wife. Okay, wow. Then see whose income is greater. Okay, both the remuneration will be clubbed in the hands of the spouse whose income is greater. Okay, wow. So if me and my wife both are having more than 20% share in a partnership firm and if both are receiving the salary from that firm, in such case what will happen? If my income is higher, my wife's income is lower without counting the remuneration, then the entire remuneration will be taxable in my hands. Purida? Next. Asset transferred to spouse for inadequate consideration or without consideration. So if any asset is transferred without consideration or inadequate consideration to the spouse, then the income received from the asset will be taxable in the hands of the transferor. So if I transfer my asset to my spouse without consideration or for inadequate consideration, then the income from that asset will be clubbed in my hands. Similar provision we saw in house property, where if the house property is transferred from one spouse to the other for without consideration or inadequate consideration, then the income from then the transferor will become the deemed owner of the house property. This we studied in house property. Similar provision is there in clubbing also. Okay, wow. However, there is an exception. The exception is agreement to live apart. I told you that if any assets are transferred in an agreement to live apart, so for example, me and my wife are getting separated and I am giving the property to my wife without or for inadequate consideration, okay, as alimony or otherwise, then this clubbing provision will not apply. Okay. Another point. I told you that the relation should subsist. The relation should subsist both while transfer and while receiving the income. Okay. So while making the transfer also both should be husband wife. While receiving the income also both should be husband wife. Only then this provision will apply or else it will not apply. So before marriage itself, if I transfer to my fiance who is my future wife, then will this apply? Answer is no, it will not apply. Okay, wow. Then I also told you that a wife went to income tax department and told that my husband is giving me the property and I am giving consideration as my love. Is love not a valid consideration? Then I told you the case went till Supreme Court and Supreme Court told that love is a valid consideration but love is not adequate consideration as per the provisions of this section. Fine. Next. If any income is earned by investing such income, that is income from income. So if I have transferred an asset to my wife and my wife is receiving the income from the asset, it will be clubbed in my hands. Correct? Now, that income that my wife receives, she is investing in a fixed deposit and she is receiving interest from the fixed deposit, which is income from income. She is getting an income, from that she is earning even more income. Will this income, that is income 2.0, will this be income be clubbed? Answer is no, income 2.0 will not be clubbed. Exam la income 2.0 எழுதிராதீங்க. Okay va? Next. If transferred asset is used in a business, then the proportionate income from such asset will be clubbed. or if transferred asset is used as capital contribution, then proportionate interest on capital will be clubbed. However, for the proportion, you should take the first day of the previous year or the date of commencement of the business as the case may be. So if I transfer an asset to my wife and my wife is using that asset in her business, then the income from the business proportionate to that particular asset will be clubbed in my hands. Okay, wow. However, this proportion should be taken on the first day of the previous year, that is on 1st April, or if it's a new business, it should be taken on the first day of the business. Okay, so if business starts on 1st July and if I'm giving my wife gift of rupees 2 lakhs and she is putting it in the business on 1st July itself, then take the proportion from 1st July itself. Okay, next, transfer of assets for inadequate consideration to any person for the benefit of spouse. So for example, if I am transferring my asset to my brother and I am telling that the income from that asset will go to my wife, okay, in that case also the income that is received by my wife will be clubbed in my hands. Income is received by whom? By my wife, but tax is paid by whom? Tax is paid by me. Okay, so if transfer of asset for inadequate consideration to any person, any other person other than the spouse, and income is received by the spouse or any benefit is received by the spouse, then the income will be clubbed in the hands of transferor. Okay, now let's come to son's wife. Son's wife here is a daughter-in-law. Daughter-in-law. So similar to spouse. If any asset is transferred to son's wife for inadequate consideration, then the income earned from then the income from the asset is clubbed in the hands of the transferor. Okay, so if my parents, okay, are transferring any property to my wife, that is son's wife, then the income received from the property will be clubbed in the hands of my parents. It can be my father also, it can be my mother also. Okay, anyone if they transfer the property. However, if any income is received by investing such income, that is income 2.0, then such income will not be clubbed in the hands of transferor. And similarly here also, if the transferred asset is used in a business or transferred asset is a capital contribution, then proportionate income or proportionate interest on capital will be clubbed in the hands of the transferor. Okay, and here also, while making the transfer of the asset and as well as while receiving the income, in both the situation the relation should subsist. Okay, so that is while giving the property also son's wife relation should be there, and while receiving the income also son's wife relationship should be there. Next question, sir. Transfer of asset for inadequate consideration to any person for the benefit of son's wife. So if my mother transferred any asset to some other person, let's say A Limited, and the benefit is received by my wife, that is son's wife. In such case, the benefit received by son's wife will be clubbed in the hands of my mother if it is transferred for inadequate consideration. Adequate consideration na கேள்வியே வராது, எங்கேயும் கேள்வி வராது. No question arises if the transfer is for adequate consideration. Only if there is without consideration or inadequate consideration, all these clubbing provisions will apply. Okay, now let's come to income of minor child. If minor child is earning an income, the income will be clubbed in the hands of the parent whose total income is higher. Okay, whose total income is higher. However, if the income starts getting clubbed in the hands of one parent, it will continue to get clubbed in the hands of the same parent for the subsequent years. Okay, however, if the assessing officer wants, okay, if he feels necessary, he will step in and he will change the clubbing provision. So once the income is clubbed in the hands of one parent, it will continue in the subsequent years. However, AO, that is assessing officer, can club in the hands of the other parent if he feels necessary to do so. Okay, wow. However, if parents marriage subsist, this provision will apply. That is, both parents are living together, then this provision will apply. However, if parents marriage is not subsisting, that is both parents are living separately, then the income of the minor child will be clubbed in the hands of the parent who is maintaining the child. Okay, va? Who is maintaining the child. And I told you child includes legally adopted child and also stepchild. Fine. Now there is an exemption of rupees 1500 per child per annum for every child. Okay, so there is no limit of number of children. Fine. So if there are 3 children or 4 children, whatever, 1500 per annum per child is allowed as exemption. Okay, per child, but be careful, don't take the exemption together, calculate the exemption separately for each and every child to avoid silly mistake in the exam. Okay, fine. Now there are three exceptions. Okay, three exceptions. So there are three cases where the income of the minor child will not get clubbed in the income of the parents. The income tax will be paid by the minor child themselves. What are the three situations? Number one, manual work. If the minor child is doing manual work and getting the income from the manual work, then income will not be clubbed. Number two, income received because of the skill, talent, specialized knowledge or experience of the minor child. I gave you example of superstar singer. So if a child goes to superstar singer competition and because of their terrific singing talent, if they are receiving a cash prize, then that cash prize will be taxable in the hands of the minor child itself. Okay, it will not be clubbed in the hands of parent. And number three, child suffering from disability under section 80U. I told you that the child will get the benefit of deduction under 80U. Hence, if a child is suffering from disability under section 80U, then the income of such child will not be clubbed in the hands of the parent. So three exceptions: another manual work, skill, talent, specialized knowledge, experience, etc. And number three, child suffering from disability under section 80U. So in these three situations, if the income is earned, it will not get clubbed in the hands of the parent. The income tax will be paid by the children themselves. However, if an income is earned because of the special talent and if such income is invested and if income is earned on such investment, that is income is received from income 2.0. If income 2.0 is there, even though it is because of the income from special talent, it will still be clubbed in the hands of parents. Okay, wow. So income 2.0 will be clubbed. So this was about the income of minor child. I hope you are clear. Now let's come to HUF, Hindu undivided family. So if a property is transferred to a HUF, okay, by an individual without consideration or for inadequate consideration, then the income received on such property will be clubbed in the hands of the transferor. Simple, correct. Now let's see the next provision. If an property is transferred by an assessee to a HUF and the HUF gets partitioned, and on the partition the property gets shared between all the members of the family. In such case, the income received from the partitioned property of the HUF of the assessee himself and the spouse both will be taxed in the hands of the assessee. Okay, so for example, if I am having a property, I am giving the property without consideration to the HUF. Okay, then what is happening? HUF is getting partitioned. Okay, HUF getting separated, and me, my wife and all the other family members are receiving the share of the property. In such case, the income from my share of the property as well as my wife's share of property both will be taxed in my hands only. Okay, so if partition of property to the family, then income from the partitioned property to the individual himself and the spouse is included in the total income of the individual. I hope you are clear with the provision. Now let us come to the last concept, that is cross transfer. So if there are two transactions that are interconnected and seeming a part of the same transaction to avoid the taxes, then clubbing provision will apply. Okay, I told you that if I transfer my property to my wife, okay, the income will be clubbed in my hands, correct? So what will I do? I will transfer my property to my brother's wife. My brother will transfer property to my wife, okay, to avoid the clubbing provision and to save the taxes. Now because of this cross transfer provision, even this cannot be done. I gave you an example, okay, from the study material question itself. So Vasudevan gave 6 lakhs as gift to brother's wife. Brother gives 5 lakh as gift to Vasudevan's wife, Mrs. Vasudevan. Both invested the money in a fixed deposit at 9% per annum. Okay, 30,000 interest was earned by Mrs. Vasudevan and 36,000 interest was earned by brother's wife. Okay, in such case, is it cross transfer? Answer is yes, this looks like cross transfer. Now, the provisions are telling only the same amount can be cross transfer. Different amounts cannot be cross transfer. Hence, the lower amount will be considered as cross transfer. So, see, Vasudevan gave 6 lakhs as gift, but brother gives only 5 lakh as gift. So, which is the lower amount? It is 5 lakhs. So, 5 lakh will be considered as cross transfer amount, and this balance 1 lakh, okay, balance rupees 1 lakh will be considered as genuine amount. It will be considered as a genuine amount. So, the income on rupees 5 lakhs, that is the lower amount only, will be clubbed. Okay, fine. So, 30,000, that is the income of 5 lakhs, will be clubbed in the hands of Mr. Vasudevan and Mr. Vasudevan's brother respectively. So 30,000 will be clubbed in both cases, which is the lower value. Fine. So this is the concept of cross transfer. I hope you are clear with the provisions of clubbing. Keep practicing the questions so that you are thorough with the concepts. Okay. Keep preparing. Take care. Bye bye. Hello everyone, I am CA Prateek and you are watching the revision lecture for chapter 6, that is set off and carry forward of losses for CA intermediate examinations. Okay, so let us quickly start the revision lecture. I told you that this chapter is one of the easiest chapter as well as one of the most difficult chapter, because while learning it seems very easy, but while solving the question only you will get to know what is the difficulty. But as and when you practice the question, you will get the grip over this chapter. Okay, so what is set off and carry forward? I told you in class that when the assessee earns the income, then assessee has to pay the tax on the income. But when the assessee incurs the loss, will the government come and give the money to assessee? Answer is no. If the assessee incurs the loss, the assessee can set off this loss against the other income that the assessee earns. Okay, so if there is an income of rupees 10 lakhs and there is a loss of rupees 5 lakhs, both can be set off against each other, and only on the balance income the assessee needs to pay the tax. This is called set off. Now what is carry forward? Sir, when the loss is more than the income itself, for example, if the loss is 10 lakhs but the income available in the year is only rupees 2 lakhs, if you set off both each other against each other, then the remaining loss will still be 8 lakh rupees. This 8 lakh rupees can be carried forward to the next years, okay, and in such years it can be set off against the next year income. This is called carry forward of loss. Now we are going to study the rules relating to set off and carry forward. Firstly, let us study about section 70, intra-head adjustment. Sir, you know what is intra-state sales? It means the sales within the same state. Similarly, intra-head adjustment means the adjustment of losses within the same head of income. Okay, so first let us come to salary head. In salary head of income, you cannot get a loss, hence you need not see any rules. Now let's come to house property. In house property, can you get a loss? Answer is yes. So the loss under house property can be set off against the income from house property, and there is no restriction for such set off. Okay, so any unlimited amount of money can be set off against the income of house property if it is available during the year. Now let's come to PGBP loss. In PGBP, I told you that there are three types of losses. First is normal business loss. Okay. Then second is loss from speculation business, and third one is loss from specified business against under section 35 AD. That is those 14 businesses: cold chain facility for agricultural produce, etc., etc. Infrastructure facility, hotel above 2-star, hospital above 100 beds. You remember? So all those businesses. So if there is a loss from speculation business, it can only be set off against the profit from speculation business. If there is a loss from specified business, it can only be set off against the profit from specified business under section 35 AD. But however, other than these two, if there is any other business loss, it can be set off against any business income. Okay, within the same head, there is no restriction at all. So normal business loss can be set off against normal business income. It can be set off against profit from speculation business also. It can be set off against profit from specified business also. So there is no restriction at all. Okay. Then I told you about capital gains. In capital gains, there can be long-term capital loss and there can be short-term capital loss. Long-term capital loss can only be set off against long-term capital gains. However, short-term capital loss can be set off against short-term capital gain also. It can be set off against long-term capital gain also. There is no restriction for short-term capital loss within the same head of income. Okay, you get my point? Now let's come to income from other sources. Income from other sources, you have to differentiate between two types of losses. First is loss of owning and maintaining race horses. Okay, it can be set off only against the profit of owning and maintaining race horses. And if there is any other income from other sources loss, okay, that is other source loss, it can be set off against any income which is there in other sources. There is no restriction at all. Okay, so for other sources in loss, no restriction. However, if there is loss from owning and maintaining race horse, it can be set off only against income from owning and maintaining race horses. Even this other loss can be set off against income from owning and maintaining race horse. There is no uh, restriction. So basically, in intra-head adjustment, generally intra-head adjustment is fully allowed. However, only for four types of losses, intra-head adjustment is not allowed. Okay, first is speculation business loss, because it is allowed only against a speculation profit. Second, specified business loss, because it is allowed only against a specified business profit. Number three, long-term capital loss, because it is allowed only against long-term capital gain. And number four, loss from owning and maintaining race horses, because it can be set off only against the income from owning and maintaining the race horses. Now let's come to inter-head adjustment. Sir, sale from one state to another state is called interstate sales. Similarly, the set off from one head of income to other head of income is called inter-head adjustment. Okay. So first let us come to salary. In salary, you cannot have a loss, hence it is not applicable. Now let's come to house property. Okay, so house property loss, first you have to set off within the head itself. First you have to do intra-head adjustment. Then whatever is remaining, you can set off against any other head of income. So house property loss can be set off against salary, it can be set off against business income, it can be set off against capital gains or IFOS. Against anything it can be set off. However, maximum limit is 2 lakh rupees. Okay, so intra head adjustment, no maximum limit. So first do intra head adjustment, then on the remaining you do inter head adjustment, maximum 2 lakh rupees. After that also, if there is any remaining house property loss, you can carry forward such loss. Now let's come to PGBP. PGBP also similarly, I told you, normal business loss, speculation and specified. So speculation business loss and specified business loss, it is allowed only against speculation profit and specified profit. Hence, interhead adjustment not allowed for such losses. Now let's come to normal business loss. That is any PGBP loss other than those two losses. It can be set off against all the other head of incomes, no restriction, but except the head of salary. So PGBP loss cannot be set off against salary income. PGBP loss cannot be set off against salary income. However, PGBP loss can be set off against house property income, against capital gain income, against income from other sources also. Okay, so I hope you are clear. Now let's come to capital gain. Capital gain, I told you, sir, long-term capital gain is like Rajni. Short-term capital gain is like Vijay. Okay, so if Rajni movie faces a loss, Rajni can come to save it. Okay, if Rajni movie is facing a loss, Rajni will come to save the movie. Okay, however, no other star can come and save a Rajni movie. Only Rajni has the potential to save it. Similarly, if now let's come to short term capital loss. Short term capital loss, I told you, it is like Vijay. Okay, wow. If Vijay movie is facing a loss, obviously Vijay can save the movie. However, even Rajni, if he comes in the movie, he can save the movie. So Vijay movie, if it is facing a loss, Vijay can also save the movie. Rajni can also save the movie. So short term capital loss can take the help from, okay, can cover the losses with the help of short term capital gain also, long term capital gain also. However, uh, if Rajni or Vijay, both of them, if they are going to any other stars movie also, they can save the movie. So for example, if there is Power Star, okay, there is Power Star. So if Power Star movie is facing a loss, okay, then Vijay can come and rescue the movie. Even Rajni can come and rescue the movie, or both Vijay and Rajni can come and rescue the movie. So for example, if there is a PGBP loss, it can be set off against short term capital gain also, it can be long term set off against long term capital gain also, against both the incomes also. However, if Rajni movie is facing a loss, can Power Star come and save the movie? Answer is no. So if long term capital loss is there, okay, it cannot get help from any other head of income. Okay, I hope you are clear with the example. Now let's come to income from other sources. Income from other sources, I told you, horse race loss. Okay, it is not allowed to be set off against any income other than horse race income. Now let's come to other losses under other sources. So other losses can be set off against any other head of income, no restriction. So income from other sources, in intra head also no restriction, inter head also no restriction, but carry forward is not allowed. Intra head no restriction, inter head no restriction, but carry forward not allowed. Okay. However, horse race is allowed to be carried forward. Horse race loss is allowed to be carried forward.
Now, one thing you have to keep in mind that when it comes to the old scheme versus new scheme, that is the old scheme that the assessee can opt out versus the new scheme that is the default tax regime, in that when it comes to loss from specified business under section 35AD, it is allowed to be set off only in the old scheme. It is not allowed in the new scheme, that is 115 BAC. Hence, if the assessee is opting for new scheme under section 115 BAC, then set off of the loss from specified business is not allowed. Moreover, if there is any already existing loss, that also will lapse. It cannot be carried forward. Also, when it comes to house property loss, in section under section 115 BAC, you cannot do inter-head adjustment of house property loss. In old scheme, you can do inter-head adjustment up to 2 lakh rupees, but in the new scheme, you cannot do inter-head adjustment. Hence, first you have to do intra-head set off, and then directly you have to go to carry forward if you are choosing section 115 BAC.
Now let's come to the carry forward part. Okay. Carry forward part. So now generally if a loss is being carried forward to the next year, then after being carried forward, okay, it cannot be set off against the other heads of income. So after carry forward, inter head adjustment is not possible. However, only in case of unabsorbed depreciation, even inter head adjustment is possible. Sir, what is this unabsorbed depreciation? I told you in class that unabsorbed depreciation is the loss which even the income is not able to absorb the depreciation. I gave you an example also in class. So for example, if the income is 2 lakhs but the depreciation itself is 5 lakhs, okay, so depreciation itself is more than the income, in such case the 3 lakh rupees is unabsorbed depreciation and the balance amount will be the normal business loss, that is loss from PGBP. Okay, loss from PGBP. So if there is an unabsorbed depreciation, okay, first thing is it can be carried forward for infinite number of years. Infinite number of years. Second thing, it can be set off against any other head of income other than salaries. So it can be set off against PGBP, capital gain, okay, other sources, anything except salary head. This is unabsorbed depreciation. Now let's come to loss from house property. Loss from house property after being carried forward can be set off only against income from house property. It can be carried forward for 8 years. So till 8 years, if it is not able to set off against any income, then it will expire. Then normal PGBP loss. So normal PGBP loss after being carried forward can only be set off against income from PGBP. It can be carried forward for 8 years time. Then let's come to speculation loss. speculation loss can be carried forward. Even after being carried forward, it can only be set off against speculation income, and it can be carried forward only for 4 years. Okay. Then specified business loss. Specified business loss also, it can be carried forward. Okay. After being carried forward also, it can only be set off against the specified business income under section 35 AD, and it can be carried forward for infinite number of years, that is indefinite period of time. Then long-term capital loss, Rajni, it can be carried forward. Answer is yes, but after being carried forward also, it can only be set off against long-term capital gains. Okay, and it can be carried forward for 8 years time. Short-term capital loss can be carried forward. It can be carried forward and then set off against the capital gain income, that is short-term or long-term capital gain, and it can be carried forward for 8 years. Then loss from owning and maintaining race horses can be carried forward. After being carried forward also, it can only be set off against income from owning and maintaining the race horse, and it can be carried forward for 4 years. So generally the losses are allowed to be carried forward for 8 years. For 8 years. However, for two types of losses, the Income Tax Act gives the benefit of infinite number of years. Number one, unabsorbed depreciation, and number two, loss from specified business. So both of these can be carried forward for indefinite number of years. And there are two types of losses which the Income Tax Act wants to discourage. What are those two? Speculation business loss and horse race loss. So for both these losses, only 4 years is allowed as carried forward. Okay. After 4 years, it will expire. Okay. Then I told you, loss from other sources cannot be carried forward. However, only race horse loss can be carried forward. Next, let's come to winnings loss. If there is any loss from winnings means what, sir? Lottery, betting, gambling, award show, crossword puzzle, etc. So if there is loss because of any winnings, okay, it cannot be set off, it cannot be carried forward. You cannot set off, you cannot carry forward. Next, if there is any income from winnings, sir, there is any income from winnings, against such income, no expense is allowed, no loss is allowed. Even if it is winnings loss, then also it is not allowed. For example, gambling, after doing gambling, the assessee earned some income. However, the assessee also has a gambling loss. So can the gambling loss and gambling income be set off against one another? Answer is no, not allowed. The government wants to tax the entire amount of winnings. Hence, the government does not allow any expense. It does not allow any loss to be set off against such income. Similarly, if there is any unexplained credit, unexplained investment expenditure, etc., under section 68, 69, etc., which we studied, on which tax is levied in section 115 BBE. How much tax are? 60% plus 25% surcharge plus cess. So totally 78% tax. You remember the point? So on such income also, no loss is allowed to be set off. So you cannot set off any loss against such income. Okay. Then if an income is exempt, then you have to ignore the loss. I gave you example of agricultural loss. So agricultural income is exempt. Similarly, if there is an agricultural loss, you cannot set it off. You have to ignore such loss. Next. Section 80 says that all the losses can be carried forward only if the return of income is filed within the due date, except unabsorbed depreciation and house property loss. So house property loss and unabsorbed depreciation, if the assessee is having, then even if the assessee does not file the return on time, still he can carry forward the loss. However, if there is any loss other than unabsorbed depreciation and loss from house property, then it can be carried forward only if the assessee files the loss return within the due date to file the return of income. Okay. Next, sir, if the business is closed, can the loss be carried forward? Answer is yes, it can be carried forward. So, for example, if I have a clothing business and I had a loss from clothing business and now the business is closed, I can carry forward the loss. So, after 3 years, if I am having a shoe business, I can set off the loss which has been carried forward with the profit of the shoe business. Similarly, unabsorbed depreciation can also be carried forward if the business is discontinued. Even house property loss can be carried forward if the house property is no more. Okay. So you need not see any other condition, you just see the time limit, that is 8 years, 4 years, etc. Okay, then I told you if there is a PGBP income, how will you set off? First use it to set off the current year depreciation, then current year loss, then brought forward loss, and then finally if there is any brought forward unabsorbed depreciation, you can set it off. Generally in the set off carry forward of losses, there is no fixed way in which you have to set off or carry forward the loss. You have to see the method which is the most beneficial to the assessee, and you have to keep all the provisions in mind while solving the answer. Okay, so after seeing this revision lecture, solve the questions quickly. Okay, and wherever you are making a mistake, see the material, see the answer, and try to understand your mistakes. You will not go wrong in the exam hall. Fine. So see you in the next video. Till then, take care. Bye bye. Hello everyone, I am CA Prateek, and in this video we are going to quickly revise the chapter 6A deductions, that is chapter 7 for the CA intermediate examinations. Okay, so first and foremost about the chapter 6A deductions, I would like to tell that none of the chapter 6A deductions are allowed if the assessee chooses the new tax regime under section 115 BAC. However, only two deductions is allowed, that is section 80JJAA, which deals with the additional employee cost, and 80CCD subsection 2, which deals about the new pension scheme, etc. It is allowed as deduction even for the assessee if the assessee claims the new tax regime. Okay, now let us jump into the chapter. Firstly, deductions are of two types: payment based deduction and income based deduction. And in income based deduction also there are normal income based and certain income based deduction. Payment based deductions means what? Deductions is given based on the payment made by the assessee. Income based deductions means what? Deduction is given based on the income earned by the assessee. Okay, wow. Now first point about deduction is that deductions cannot exceed the gross total income. So if the gross total income is 5 lakhs but the deduction to be allowed is 6 lakhs, then how much is the maximum that will be allowed? Answer is 5 lakhs, because the total deduction cannot exceed the gross total income. Next, deduction is allowed only to a single person and only once. So in many places we are going to see deduction is allowed for themselves as well as family members. So for example, if there is LIC deduction, life insurance policy, if it is allowed for self as well as spouse, okay, then on the same amount the assessee themselves and on the same amount the spouse also, both cannot claim the deduction. So deduction can be claimed only by one person for a single amount and only once. Okay, wow. I hope you are able to understand. Now there is section 80AC. 80AC tells what, sir? No deduction is allowed, okay, under section 80IA to 80RRB. That is the income based deductions, etc. In your syllabus it is 80JJAA, 80QQB and 80RRB. So if a deduction is covered in the series 80IA to 80RRB, that is 80I, 80M, 80NOPQR. So all these deductions will not be allowed as deduction if they are not claimed in the return of income before the due date to file the return of income. Okay, so only if it is the return of income is filed within the due date, then these deductions will be allowed, or else it will not be allowed. Next, sir, chapter 6A deductions is not allowed on special rate income like a long-term capital gain under section 112, then long-term capital gain under section 112A, then short-term capital gain under 111A, then if you are getting any winnings income under 115BB or any undisclosed income under section 115BBE, etc., then on such special rate incomes you will not get the benefit of chapter 6A deduction. So the total income you have to divide into two parts. The first part is the part on which you can claim the deduction. Second part is the part in which you cannot claim the deduction. So on which you can claim deduction, only against such income you should reduce the deductions and then add back the income on which you cannot claim the deduction. Okay, I hope you are clear with the concept. I explained this to you in class in detail. So next, payment based deduction. First deduction is what, sir? Section 80C. Very important, very important. Okay, section 80C is deduction is is given for investment in some specified assets, and it is given only to individual and HUF. Maximum ATC deduction limit is 1,50,000 rupees. Okay. First ATC deduction we are going to study is life insurance premium. Life insurance premium is allowed as deduction if the payment of premium is made for self or relative. Okay, wow. Self means the individual himself, and relative means in case of individual it is spouse and children, and in case of HUF it is the members of the HUF. Okay. Then life insurance premium is allowed only up to the limits. What are the limits, sir? If the insurance policy is taken before 1/4/2012, then the limit is actual premium or 20% of the sum assured, whichever is lower. If the premium is taken after 1/4/2012 between 31st of March 2013, then for all the life insurance policies it will be actual premium or 10% of sum assured, whichever is lower. However, if a life insurance policy is taken on or after 1/4/2013, then if it is a normal person, then the insurance premium allowed will be actual premium or 10%, whichever is lower. If it is a person suffering from disease specified under section 80 DDB or 80U, then it will be actual premium or 15% of the sum assured, whichever is lower. So these are the deduction limits. However, if the insurance contract got cancelled within 2 years, then the entire deduction allowed earlier should be converted to income, and it will be deemed as income. Okay. Then we learned that receipts from life insurance policy you get exemption under section 1010D. So if any sum or bonus is received from a life insurance policy, then the entire policy amount that is received will be exempt if the premium was within the limits. If the premium was not within the limits, then the entire amount is going to be taxable. However, exemption under 1010D is not available for two types of life insurance. Number one, if the sum is received by a person, if a sum is received for a person under section 80DD, okay, 80DD, not DDB, 80DD. And number two, if a sum is received from keyman insurance policy, then that is also not exempt. Okay.
Later on, what happened? The Income Tax Act introduced a concept of ULIP, that is Unit Linked Insurance Plan or Unit Linked Insurance Policy. Okay, so in case of unit linked insurance policy, this is also not an amendment, this is an earlier provision only that I am taking, where if the premium is exceeding 2,50,000 rupees, or if the aggregate premium was exceeding 2,50,000 rupees in case of more than one ULIP, in such case also such ULIPs will be fully taxable under the Income Tax Act. And now the Income Tax Act, that is section 1010D, has brought in another condition. What is that condition? Let us read. If any policy is issued on or after 1/4/2023, here you can write issued on or after 1/4/2023. Then first let us read the provision, then I will explain. Exemption would also not be available if the amount of premium payable exceeds 5 lakh rupees for any of the previous years during the term of such policy. In a case where premium is payable by a person for more than one life insurance policy other than ULIP, and the aggregate of premium payable on such policies exceed 5 lakh rupees for any of the previous years during the term of any such policies, exemption would be available only in respect of those life insurance policy other than ULIP at the option of the assessee whose aggregate premium payable does not exceed 5 lakh rupees for any of the previous year during their term. So now a limit has been brought by the Income Tax Act in case of a normal life insurance policy also. And what is the limit? The limit of premium is 5 lakh rupees. So let me give you an example. Let's say there is a life insurance policy and the policy is issued on 1st of May of 2023. So is it on or after 1/4/2023? Answer is yes. And let us assume that the sum assured Sum assured is 1 crore. 1 crore rupees. Fine. And we will also, okay, let us keep the sum assured as 40 lakhs for the time being. 40 lakhs. Okay. And the premium payable every year, rupees 6 lakhs. Sum assured is how much? 40 lakhs. And premium is how much? 6 lakhs. Fine. Okay, we'll keep the sum assured as 1 crore so that you will not get confused with other section. Right? So sum assured is how much? 1 crore rupees. Premium is how much? 6 lakh rupees. Now what is the percentage? The percentage is actually only 6%. You get my point? 6% is the premium. So is it within the limits? Answer is yes. It is within the limits that we discussed earlier. So according to the earlier provisions, this entire 1 crore, if it is received by the assessee, it will be completely exempt from tax, or whatever maturity amount is there will be completely exempt from tax in under section 1010D. This was the earlier provision. But now what has happened? Now this 1 crore rupees has become taxable. Why it has become taxable? Because the premium is more than 5 lakh rupees. You get my point? Hence, the maximum premium, life insurance premium, can only be 5 lakh rupees. If the life insurance premium is more than 5 lakh rupees, in that case also, the entire maturity amount is going to be taxable. You get my point? Similarly, sir, what if there is more than one policy? Let us assume that there is a person, Mr. P. Mr. P is having 3 life insurance policies. Policy 1, policy 2 and policy 3. Okay. Let us assume for the time being that all these policy premiums are within the limit which is specified already. Okay. That is the 80C limits. Now we are only going to discuss the 5 lakh concept. The premium for policy 1 is coming to 2 lakh rupees. The premium for policy 2 is coming to 3 lakh rupees. And this premium for policy 3 is coming to 4 lakh rupees. Okay. Let us also assume that sum assured for this 2 lakh policy is 1 crore. Sum assured for this 3 lakh policy is rupees 2 crore, and sum assured for this 4 lakh policy is rupees 10 crores. Okay. So premium is given, sum assured is given. Now see here, Kanna, for any of the policy is the premium exceeding 5 lakh rupees? Answer is no. The premium is within 5 lakh rupee range, and also the premium is within the range that we had discussed in section 80C, that is 10% or 15% as the case may be. In both cases it is within the limit. So in all the cases it is within the limit. However, see here, the total premium is how much? Total premium is 2 plus 3 plus 4, which is 9 lakh rupees. Total premium is how much? 9 lakh rupees. Since the total premium is 9 lakh, which is more than 5 lakh, still the life insurance policy maturity or any amount received from the life insurance policy will be taxable. However, in such case, the assessee is having an advantage. What is the advantage? The assessee can choose which all policy he wants to get exempted, and the amount of premium of such policy should be within 5 lakhs. So for example, I can choose that I will exempt policy 1. If I exempt policy 1, then what will happen? 3 lakhs plus 4 lakhs will be 7 lakhs. So this entire amount will be taxable. Correct? I can also choose that I will get an exemption for both policy 1 as well as policy 2. For policy 1 and policy 2, what is the premium? The premium is 5 lakh rupees. Is 5 lakh within the limit? Answer is yes. So I can choose that policy 1 and policy 2 I will claim an exemption, since both combined the premium is within 5 lakhs, and I will treat policy 3 as taxable policy. You get my point? Now there is one more option. I can choose policy 3 as exempt. Since the premium of policy 3 is within 4 lakh rupees. But if I choose policy 3 as exempt, then policy 1 and policy 2 both will become taxable. Both will become taxable. Listen very carefully. This is very important concept. Both policy 1 and policy 2 will become taxable. Okay. Now, what is the most beneficial for the assessee? Should the assessee choose policy 1 plus policy 2, or should the assessee choose policy 3 as exempt? Answer is, in this case the assessee should choose policy 3 as exempt, because the sum received from life insurance policy is going to be how much? 10 crores. Whereas in case of policy 1 and policy 2, both combined also you are going to get only 3 crores. Okay, so choose this 10 crores as exempt, and on this 3 crores which is possibly going to be received, make it taxable and pay the tax, if at all an amount is received from life insurance company. You get my point? So like this, if the amount of premium aggregate is more than 5 lakhs, then the assessee can choose the premium up to 5 lakh rupees to be exempt. Such policies will be exempt and the remaining policies will become taxable. You get my point? I hope it is crystal clear. Now let us discuss how will it be taxed. First let us also go through the other provisions quickly. These are all old provisions only. This section will not apply to sum received by any person under 80DD and Keyman insurance policy. Keyman insurance policy we had discussed already. It is taxable under 3 heads of incomes based on the situation. So it is not covered under 1010D exemption. Then there is ULIP, which we had already discussed before itself. If ULIP, if the policy premium is more than 2,50,000 and aggregate is also more than 2,50,000. The same concept as we discussed right now, it also applies for ULIP, and in case of ULIP, the maximum limit is how much? 2,50,000. Fine. And in all the cases, if at all the amount from life insurance policy is received on death, then it is fully exempt. You get my point? So if amount is received on death, you need not see any condition at all. It is fully exempt. If other than death only, you have to see all these conditions. Fine. Now let us learn the new section that has come under income from other sources chapter, which is relating to this life insurance policy, which is nothing but section 56 to 13. Sum received by way of bonus from life insurance policy other than ULIP and Keyman insurance policy, which was not exempt under 1010D. Let us study the provision. So where any sum is received, including the amount allocated by way of bonus at any time during the previous year under life insurance policy other than the sum received under ULIP or Keyman insurance policy that is not exempt under 1010D, the sum so received as exceeds the aggregate premium paid during the term of such life insurance policy and not claimed as deduction under the provisions of the Act, computed in the prescribed manner, would be chargeable to tax under the head income from other sources. So basically, whatever policy, okay, which is not a ULIP and not a Keyman insurance policy and also not exempt under section 1010D will be taxable under income from other sources under this new section called 56 to 13. Okay. Now how to calculate the tax? First and foremost, you have to see whether the amount is exempt or not. If you have found out that the amount is not exempt, then you have to find out under which section it will be taxable. If it is falling under this section, that is 56 to 13, in such case, how to find out the income? The income is nothing but total amount received from the policy including bonus minus premium paid, the premium that you have already paid on which deduction was not claimed. Premium paid on which deduction was not claimed, because if you reduce the premium paid on which you had claimed the deduction already, then there is no point in reducing from the total amount because you have already taken benefit of that premium. So only the premium paid on which the deduction was not claimed can be reduced from the total amount. So let me take an example, Karna. There is a life insurance policy. Okay. Premium is equal to 10 lakhs. And let's say sum assured is 50 lakhs. Sum assured is how much? 50 lakhs. And also maturity amount. Maturity amount is 50 lakhs. For simplicity's sake, we will keep the maturity amount also same. Now this premium of 10 lakhs is nothing but 2 lakhs multiplied by 5 years. For 5 years premium was paid and the total premium was 2 lakh rupees. Okay. Now look here Ganna. Is this 2 lakh amount, okay, in this case this entire policy is exempt. I will change the sum a little bit. Let us keep this as sum assured as 15 lakhs and maturity amount also 15 lakhs. Okay. Now listen here. Is this 2 lakh amount within 10%? Answer is no. It is more than 10%. Hence this policy is taxable. 15 into 10% is how much? 1.5 lakhs. So what should be the maximum premium? The maximum premium should only be 1.5 lakhs. However, the premium is how much? 2 lakh rupees, and that is why what will happen, this entire policy is not exempt under 1010D and it will be taxable. Now how to find out the tax? Let us see. Now in case of this policy, every year will the assessee have claimed deduction under section 80C? Answer is yes. Let us assume that every year the assessee claimed 1.5 lakhs as deduction, because maximum how much it is allowed? 1.5 lakhs only maximum allowed. So 1.5 lakhs into 5 years is equal to 7.5 lakhs. You get my point? So here now let us calculate the income. Income under section 56 to 13. In this case, income is equal to maturity amount minus premium not claimed as deduction. So what is the maturity amount? 15 lakhs. And what is premium not claimed as deduction? Total premium is 10 lakhs, out of which 7.5 lakhs was claimed as deduction. So balance 2.5 lakh rupees is the premium not claimed as deduction. So here 15 lakhs minus 2.5 lakhs, answer is the income will be 12.5 lakhs. So this 12.5 lakhs should be added to income from other sources. You get my point? So I hope now you are clear how to find out the income from other sources, how to calculate the income under section 56 to 10. If you want, you can pause the video and note down this example. Fine. Now you can unpause the video. Now for you, I have made a separate special table by which you will be crystal clear how you should tax any life insurance policy. So first I want you to note down this table. I think 1 page space you have at the end of income from other sources chapter. In this page you can note down. Fine. Please pause the video and note down the table. Copy down this table in the page that is available. Then unpause the video. Done. Next. Please copy this part. Done. Now please copy this part, pause the video and finish copying. Done. Now lastly, please copy this part. Finished? Right. Now let us discuss this table. So what you have to do, if there is any life insurance policy First, you have to check whether the policy is within the limits specified under ATC. Okay, so if the policy is issued before 1/4/2012, it should be within 20%. The premium should be within 20% of sum assured. If it is 1/4/12 to 31/3/13, then 10%. And if it is issued on or after 1/4/2013, then in normal cases 10%, in disease case it is 15%. If the conditions are not satisfied, if the policy premium is more than the limit, then what will happen? Then the life insurance policy is taxable. Correct? It is not exempt under 1010D. If it is a ULIP, then it will be taxable under capital gain chapter, section 112. However, it is not covered in your syllabus, it is covered in CA final syllabus. So need not worry about that. If it is other than ULIP, then it will be taxed under section 56 to 13. We had just discussed this example a few minutes back. Correct? Other than ULIP, it will be taxable under 56 to 10. Now let us assume that the limits condition have been satisfied. Okay. If it is satisfied also, we have to see whether the policy was a ULIP or other than ULIP. In case of ULIP, you have to see whether the policy was issued before 1/2/2021. In such case, it will be exempt under section 1010D. If the policy is issued on or after 1/2/2021, then aggregate premium within 2,50,000 will be exempt, and aggregate premium above 2,50,000 will be taxable. Correct? If the aggregate premium is above 2,50,000, then you can choose certain policies, the total premium of which should be within 2,50,000, that can be claimed as exemption, and remaining policies will be taxable under section 112A. Okay, and this is also a part of CA final syllabus. It was removed from CA inter syllabus, so not a problem for you. Now let us discuss about the other than ULIP. In case of other than ULIP, I'm sorry, here you have to make a small change. If the policy is issued before 1/4/2023, then it will be exempt under section 10D, and if the policy is issued on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it will be exempt under section 1010D. If it is above 5 lakhs, then you have to choose the policies whose aggregate premium is within 5 lakhs. That will be exempt under section 1010D, and remaining policies will be taxable under section 56 to 13 as we discussed above. I think here equal to symbol is there. Let me just check this once. Just a second. Exceed. So here one more small change I would like you to make. If the aggregate premium is greater than 5 lakhs, and here you put equal to symbol. Fine. Less than or equal to 5 lakhs, remaining policies. And above also, I want you to make a small change. Aggregate premium is less than or equal to 2,50,000. In such case, no problem. If it is greater than 2,50,000, then policy is chosen. Here also you can write equal to symbol. Up to 2,50,000 exempt, more than 2,50,000 taxable. So this small change only. Now let me summarize once again, very important. So what you have to do, if you have a life insurance policy, you have to check whether it is within ATC limits. If it is within ATC limits, then only you have to proceed further. If it is not within ATC limits, then directly you know that it is taxable and you have to kandupudichify, or you have to find out the tax. Now, sir, what if it is within ATC limit? Then you have to check whether it is a ULIP or not a ULIP. If it is a ULIP, then 2,50,000 you have to see the limit. If the total premium is within 2,50,000, it will be exempt. More than 2,50,000 will be taxable under section 112A. Now let us talk about other than ULIP policy. If the policy is issued before 1/4/2023, then however it will be exempt. If it is on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it is exempt. If it is above 5 lakh, then up to 5 lakh you can claim as exemption. The remaining policies will be taxable under section 56 to 10. Got my point? 25 minutes discussion we have had on this topic. I hope you are crystal clear with the concept.
Now let's come to payment of tuition fees. Payment of tuition fees, okay, it is allowed only for maximum 2 children, okay, of an individual. Second, payment of tuition fees only is allowed, any other fees is not allowed. So for example, if any payment is made to a school or college, there will be many parts in the payment like lab fees, okay, donation, library fees, etc, etc. In that only the tuition fee component will be allowed as deduction, the others will not be allowed as deduction. Next, payment should be made to school, college, university or other institution. Private college not allowed, private tuitions not allowed, sorry, private college illa, private tuitions not allowed. Next, only if the institution is in India, then it is allowed as deduction. So if I send my children to abroad to study, then the tuition fees paid abroad will not be allowed as deduction. Okay, and remember, tuition fees is allowed only for children. Even if the assessee pays tuition fee for himself, it will not be allowed as deduction. Fine. Now let's come to repayment of housing loan, stamp duty, etc. Okay, sir, interest on housing loan is allowed as deduction under house property chapter under section 24B. However, the repayment of housing loan is allowed as deduction under section 80C. Okay, but there are some conditions. First condition is that the loan should be taken for the purchase or construction of the house, not for repair, maintenance, etc. And the house should be a new residential house property. What's a residential house property? And the loan should be taken only from financial institutions, etc. Okay, the list is given, you can read the list. However, if you see in house property chapter, the housing loan can be taken from anyone. Still the interest is going to be allowed. But in deduction chapter, only if you take it from the specified persons, then only the repayment is going to be allowed as deduction. Okay. So this was about the housing loan repayment. Now next, if any stamp duty or registration fees or any other expense is paid for the purpose of purchasing a house, then such amount will be allowed as deduction. However, please note, for this repayment of housing loan and also for stamp duty, registration fee, etc., there is one more condition, that the house should be there for at least 5 years. If the house is transferred within 5 years, then the entire deduction allowed earlier will be deemed as income. Fine. Now let's come to next point. Any contribution to statutory provident fund, recognized provident fund or public provident fund, and even approved superannuation fund, so all of them will be allowed as deduction under section 80C. This we have already discussed when we were seeing the salary chapter. Okay. However, when it comes to contribution to public provident fund, that is PPF, deduction is allowed if it is for self, and also it is allowed for family, and family is same as the family definition in life insurance premium, that is spouse and children. Remember, there is no dependent concept, only spouse and children. They can be dependent or independent, it does not matter. Fine. Next, 5-year term deposit. So 80C la wherein what else deduction is there? If a person deposits in a 5-year term deposit, for example, a 5-year tax saving fixed deposit in a bank or scheduled bank or post office, then such amount can be allowed as deduction. However, if the amount is withdrawn within 5 years, then the entire deduction allowed earlier will be deemed as income. Next, contribution to additional account, that is tier 2 account under NPS, new pension scheme. Now, the deduction for the NPS is allowed under section 80 CCD. However, only and only for central government employees, okay, they have the facility to deposit in tier 2 account of the NPS. If they deposit in tier 2 account for the period of 3 years or more, then they will get deduction under section 80C. Okay, 80C. That is in this section. Then what are the other accounts where deduction is allowed under section 80C? First, approved superannuation fund. Then next, unit linked insurance plan, that is ULIP of a mutual fund or LIC. Okay. Then notified pension scheme of mutual fund or UTI. Then approved annuity plan of LIC. Sukanya Samriddhi Yojana. Then senior citizen savings scheme. then any amount contributed to National Housing Bank. Then if you subscribe National Savings Certificate, that is NSC, then also you get deduction. You get deduction also for the interest on NSC. So if interest is received on NSC, first put it in the income column, that is income from other sources, and then you can claim it as deduction under 80C also. Then notified unit of mutual fund or UTI. Certain equity shares or debentures with the lock-in period of 3 years, if you are taking, then also you can get deduction. Then certain units of mutual fund. Then deposit scheme of a public sector undertaking or any authorities engaged in housing finance for residential houses, example HUDCO. Okay. Then any notified bonds of NABARD, any premium paid for a deferred annuity contract, or any salary deducted by government employer for deferred annuity. So all these amounts are allowed as deduction under section 80C, subject to a limit of rupees 1,50,000, and the amount is allowed only for individual and HUF, and in certain cases for the relatives also. Okay, so I hope you are clear with 80C. See the list thoroughly so that when it is mentioned in the exam, you are able to answer easily. Next, section 80CCC, that is contribution to pension fund of any insurer. For example, LIC. So if a person is contributing to the pension fund of any insurance company, then such contribution will be allowed, okay, to an individual up to a maximum of 1,50,000. Maximum 1,50,000. Remember carefully, contribution to pension fund of insurer is coming in 80CCC. Contribution to pension fund of mutual fund or UTI is coming in section 80C. Okay, pension fund of this one. Notified pension fund of mutual fund or UTI comes under 80C, and pension fund of any insurer comes under section 80CCC. Here also the limit is 1,50,000. Okay, and pension fund la only HUF can put the HUF cannot put the amount, so it is allowed only for individual. Now see, there is also another section called 80CCE. Okay, which is putting limit over limit. What is that section? The section is telling 80C, 80CCC, 80CCD subsection 1. Repeat again, 80C, 80CCC, 80CCD subsection 1. All these three sections combined, the maximum limit is only 1,50,000. So in 80C, the limit is 1,50,000. In 80CCC, the limit is 1,50,000. And in 80CCD, there is another limit, that is salary or 10%, whichever is lower, which we are going to study. All these three combined also, the maximum deduction that can be claimed is 1,50,000. Okay, so be careful. There are separate limits under all the three sections, and combined limit is 1,50,000. Okay, now let us see section 80CCD. 80CCD section gives the deduction to the assessee for the contribution to the pension fund of central government or Atal Pension Yojana or new pension scheme, which is also called National Pension System Trust. Okay, so in 80CCD there are three subsections: 80CCD subsection 1, 80CCD subsection 1B, and 80CCD subsection 2. 80CCD subsection 1 alone, it is included in 80CCE limit of 1,50,000. 80CCD 1B and 80CCD subsection 2, it is separate from the 80CCE limit, which means it can be claimed additionally. First, let us talk about 80CCD subsection 1. 80CCD subsection 1 is allowed only for the employee contribution to the pension scheme. Okay. If the employee contributes to the pension scheme, then 10% of the salary or the actual employee contribution, whichever is lower, will be allowed as deduction. Okay, what is the meaning of salary, sir? Salary means basic plus DA terms, that is the dearness allowance which forms part of retirement benefits. However, sir, is it possible that a person who is not in salary, okay, so who is not having employer-employee relationship, can such person also contribute to NPS? Answer is yes. So if a person other than a salaried employee, if such person contributes to NPS, that is National Pension System Trust or new pension scheme or Atal Pension Yojana, etc., then such person will get the deduction of 20% of the GTI, that is gross total income, or the actual contribution, whichever is lower. Fine. Next, there is section 80 CCD subsection 1B, which is also for employee contribution. Okay, and the maximum limit is 50,000. So 80 CCD 1 also employee contribution, 80 CCD 1B also employee contribution. Okay, and nowhere it is mentioned that 80 CCD 1 should be claimed first and 1B should be claimed second. Hence, you can claim it in any order. Okay, so hence, if there are so many deductions and 80 CCD 1B is also available, then claim 80 CCD 1B first and then claim 80 CCD subsection 1, so that you can get the maximum benefit. Okay. Next, sir, section 80 CCD subsection 2, it is available for employer contribution. If the employer is a central government employer, then the maximum employer contribution allowed as deduction is 14% of the salary. So hence deduction will be 14% of salary or actual employer contribution, whichever is lower. Then if it is other than government employer, then the maximum deduction will be 10% of the salary. Hence the deduction will be 10% of the salary or actual employer contribution, whichever is lower. Okay. And sir, what is special about 80 CCD subsection 2? 80 CCD subsection 2, it is also allowed, as I told you earlier in the starting of the chapter itself, it is allowed for the people who are opting for the new tax regime under section 115 BAC also. So that is some special point. And one more special point is that for this employer contribution, the employer is going to get the deduction under PGBP chapter under section 36. Okay, there also the limit is the same, 10% of the salary or actual employer contribution, whichever is lower. Here also salary means basic plus DA. There also DA terms. There also salary means basic plus DA terms. Okay. So in PGBP, the employer is going to claim the deduction. Under deduction chapter, that is chapter 6A deductions, the employee is going to claim the deduction. Okay. So if there is any employer contribution, first that employer contribution should be added to the salary and then you can claim it as deduction under chapter 6A deductions.
In section 80 CCD subsection 2, we learned that in case of a central government employee, the limit is 14% of salary for employer contribution. Now there is a small change that other than central government, even for state government employee, the limit is 14% of salary. You get my point? So now both central government as well as state government employees can take the benefit of higher limit of 14% of salary in case of employer contribution. Fine.
Then next, if any pension scheme is converted to annuity plan, then there will not be any tax on such conversion. However, if such annuity plan is closed or opted out, or if you receive any pension from the annuity plan, then it will be deemed as income. Then what about closure of pension scheme, sir? If the pension scheme is closed, then the amount received from the pension scheme, 60% will be exempt, 40% will be taxable. Okay. However, if the receipt of the pension scheme, it is received by the legal heir of the person who is dying. If the person has died and the legal heir is receiving the money, then it is fully exempt in the hands of the legal heir. Then section 1012B, section 1012B, if an amount is partially withdrawn from the NPS, okay, then if the withdrawal amount is up to 25% of the total employee contribution, then the withdrawal is fully exempt or else it will be taxable. Okay. Next, I also told, if any recognized provident fund or approved superannuation fund, if the amount in the recognized provident fund or approved superannuation fund, if it is transferred fully to NPS, then there will be no tax on such transfer. Fine. Then 80 CCE limit we have already studied. Now let us come to very important section 80D, that is medical insurance premium etc., and it is allowed for individual as well as HUF, individual as well as HUF, and it is allowed for relatives also. Who are the relatives, sir? Self, spouse, dependent children and parents. Self, spouse, dependent children and parents. Okay, wow. So parents need not be dependent. However, children, it is allowed only if they are dependent on the assessee or individual. Okay. Now for HUF, the relative means members. So if the HUF takes any medical insurance premium for the members, it will be allowed as deduction. Okay. Maximum deduction is 25,000. However, for an individual, there are two maximum limits. First limit is given for self, spouse and dependent children. Second limit is given for the parents. So 25,000 limit for self, spouse, dependent children. 25,000 limit is for parents. Okay, so total how much? 50,000 is the maximum. However, if any one of the persons, if it's a senior citizen, okay, if it is a senior citizen and his amount is spent on senior citizen, then the maximum amount is increased to 50,000 rupees. So if individual himself is a senior citizen, then maximum amount will be 50,000. Or if one of the parents is a senior citizen, then the maximum amount will be 50,000 in such case. Okay. Okay, so maximum amount will be 50,000 if there is a senior citizen. Similarly, even in the HUF, if one of the members is a senior citizen, the maximum amount for the HUF will be 50,000. Now, let us see what and all expenses are allowed as deduction. Firstly, if any medical insurance premium is paid, okay, it is allowed as deduction. Next, if any amount is contributed to central government health scheme or contributory health service scheme, it is allowed only for the individual, and it is allowed only if it is contributed for self, spouse and dependent children. It is not allowed if it is for parents. Okay. Then preventive health checkup is also allowed as deduction. Preventive health checkup is also allowed as deduction. However, the maximum preventive health checkup allowed is 5,000 rupees, and this 5,000 is included in the above limits that we discussed above. So you should see that limit also, that is 20,000, 50,000 as the case may be, and you should also see whether this 5,000 limit is satisfied, and this 5,000 is the total limit, that is for individual, self, dependent children as well as parents. So everyone combined maximum preventive health checkup is 5,000 rupees that is allowed. Okay. And I told you that any payment that we discussed in this deduction should be made in any mode other than cash. It should be made in any mode other than cash. However, preventive health checkup, it is allowed even if it is paid through cash. Preventive health checkup is allowed even if it is paid through cash. Now one more special point, sir. If there is a senior citizen and mediclaim is not available for the senior citizen, then even medical expenses will be allowed as deduction. Even medical expenses will be allowed as deduction. Okay. However, there is no separate limit for this medical expenses. It is included in the above limit of 25,000 or 50,000 as the case may be. Fine. Now, there can also be a situation where a lump sum amount of medical premium is paid for multiple years together. In such case, the premium allowed as deduction will be total premium divided by the number of years. So whatever the answer will be allowed as deduction. So if 80,000 rupees is paid as premium for 4 years, then 80,000 divided by 4, that is 20,000, will be allowed as 80D deduction in 4 years period. Okay, every year it will be allowed as deduction for 4 years. I hope you are clear with this concept. And this preventive health checkup 5,000 etc. only if you are able to solve the question, you will be able to appreciate the section. Okay, so please solve the questions after this. Now let us see 80G deduction. 80G deduction is given for the donation. It is allowed for all the SSEs. It can be AOP, BOI, company, whomever it is. 80G donation is allowed as deduction. Okay. However, in 80G there are 4 types of donation. 4 types of donation: 100% unlimited, 50% unlimited, 100% limited, 50% limited. Okay. So 100% unlimited category, in such category you will find all these types of organization: PM National Relief Fund, PM Armenia Earthquake Relief Fund, CM Relief Fund, Andhra Pradesh CM Relief Fund, National Children Fund, Defense Fund, etc. etc. So I have given you some keywords to identify what comes under 100% unlimited category. So if you find the wordings like PM or CM or national or state or army, defense, clean Ganga, Swachh Bharat, then all these types of organization are covered in 100% unlimited category. 100% unlimited category. Sir, 100% unlimited means what? It means whatever amount is donated to such organization, the entire amount will be allowed as deduction under section 80G. Okay, whatever amount is donated, entire amount will be allowed as deduction. There is no limit, no nothing. Now let's come to, and here there is also an amendment. Okay, be careful that PM cares fund is now included as a new option under 100% unlimited category. Now let's come to 50% unlimited category. In 50% unlimited category there are four organizations: Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation, and Prime Minister Drought Relief Fund. So Jawaharlal Nehru's daughter Indira Gandhi's son Rajiv Gandhi. So all these three plus Prime Minister Drought Relief Fund. So if you find the keyword as Prime Minister, only Prime Minister Drought Relief Fund is covered in 50% unlimited. All the other Prime Minister Fund will be covered in 100% unlimited category. Sir, 50% unlimited category means what? It means whatever amount of donation is donated to such funds, 50% of such amount will be allowed as deduction under section 80G. So even if I donate 1 crore rupees, 50 lakh rupees, that is 50% will be allowed as deduction. There is no limit for the amount of donation to be made. However, now let's come to the limited category. Limited category means what? The donation should be within the limits. The donation should be within the limits. So what are all covered in limited category? Let us see. First, let us see 100% limited category. 100% limited category, who and all are covered? There are two points. First point, government or any approved local authority for the purpose of family planning, promotion of family planning. Okay. Then second, any sum paid by a company as donation to Indian Olympic Association or any other association or institution as may be notified by the government for the development of infrastructure for sports or games or for the sponsorship of sports or games in India. I have given you the keywords family Olympics. So if it is for family planning or Olympic sports etc., then it is covered in 100% limited category. 100% limited category. So it means the 100% of the donation is allowed as deduction. However, the amount of donation should be within the limits. Now let us see 50% limited category. In 50% limited category, there are 5 points. First point, any institution or fund established for charitable purposes. Number 2, government or any local authority for utilization for any charitable purpose. Okay, other than family planning. If it is for family planning, it is covered in first point. That is 100% unlimited category. Then third one, any authority constituted in India for the purpose of housing accommodation, okay, or for the purpose of planning, development or improvement of cities, towns, villages or both. So basically for housing. And number 4, any corporation established by central government or state government for promoting the interest of minority community. Then number 5, for renovation or repair of temple, mosque, gurudwara, church or any other place of historic archaeological importance. So basically I have given you the keyword charity in temple and housing for minority. Charity in temple and housing for minority. That is, the keywords are charity, temple, that is temple, mosque, gurudwara, church, historical importance, etc. Then housing and then minority community. If one of these keywords are coming in the institution name, it means it is covered in 50% limited category. 50% limited category. It means that the 50% of the donation is allowed as deduction. However, the donation should be within the limits. Okay. Now, what is the limit? Let us see. Firstly, to find the limit is what, sir? Limit is 10% of adjusted total income. The limit is what, sir? 10% of adjusted total income. How to find adjusted total income? This adjusted total income is different from the adjusted total income that we study in 115JC, that is AMT. Okay, this is different, that is different. So how to find adjusted total income? Gross total income minus chapter 6A deductions except section 80G. Okay, and you should also reduce short term capital gain under 11A and long term capital gain under 112 and 112A. So all these after reducing it, you should also reduce if there is any 115BB income or 115BBE income, that also you reduce. Okay, after reducing all this, the amount you get will be called adjusted total income. Okay, you should take 10% of adjusted total income. Then step number 3, you should take sum of all the limit based donation. Sum of all the limit based donation. Then permissible donation will be adjusted total income, that is 10% of adjusted total income, or actual donation, whichever is lower. How much is allowed, sir? 10% of adjusted total income or actual donation which is in the limited category, whichever is lower. Okay. Now, when you find the total donation that is permissible, you have to give the first rank, that is first priority to the 100% donation category, and then second priority to the 50% category. Okay, here you have to be very careful that this limit is only for the amount of donation and not for the amount of deduction. So total donation should only be 10% of adjusted total income. So let's say if the total donation allowed is 1 lakh rupees, then you should give the first priority to the donation which is made to 100% category, second priority to the 50% category. So whatever there is in 50% category, you should take 50% of such amount. I would recommend you to solve the question so that you do not make silly mistake in the exam hall. Okay. Next, no deduction is allowed if cash payment is above 2000 rupees. Cash payment is about 2000 rupees, then deduction will not be allowed. And if donation is made in kind, then also the donation will not be allowed as deduction.
Very small change, easy change, that in this 50% unlimited deduction category, what you have to do, three funds have been removed in the act. Which are they? Nehru family, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, and Rajiv Gandhi Foundation. So if now donation is made to these funds, no deduction will be available, right?
Sir, in many places we are seeing that the payment should be other than cash. In 80D also we saw that the payment should be in other than cash. Here also maximum cash payment is 2000. So similarly, in all the chapter 6A deduction, you will be finding the wordings as any mode other than cash. So even bearer check is allowed, okay, even crossed check is allowed. All these modes are allowed, only cash is not allowed. Okay, however, only in 80JJAA, only in 80JJAA, that is additional employee cost, you will find the wordings as account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode. It means that if you are claiming deduction under 80JJAA, then you should only pay via prescribed modes. However, for the other deductions, wherever such condition is mentioned, if you are paying through any mode other than cash, it will be allowed as deduction. So this, it will help you to differentiate and it will help you to remember when you prepare for exams. Next, section 80DD. DD means what, sir? DD means disabled dependent. DD means disabled dependent. So this deduction is allowed to individual and assessee, not for themselves. It is allowed only if they are incurring any medical expenditure, okay, medical expenditure or any other expenditure like depositing in insurance, etc., for the purpose of their dependent relative. It is allowed to whom? It is allowed to individual or HUF if they are incurring any medical expenditure or they are depositing any amount for the purpose of their dependent relative. Sir, who is covered in relative definition? For individual, the relative means spouse, children, parents, brothers and sisters. Spouse, children, parents, brothers and sisters, and for the HUF it is the members, and the relative should be dependent on the individual. Okay, so remember that point. The condition is the assessee should incur any medical expenditure. It can be even for 10 rupees or 100 rupees or 1 lakh rupees, whatever it may be, any medical expenditure. Or if you are not incurring the medical expenditure, deposit any amount, okay, for the purpose of the dependent relative. It can be for insurance premium also. Now, if the disabled dependent relative is suffering from a normal disability, which is mentioned under section 80U, okay, normal disability, then the deduction will be flat 75,000 rupees. Okay, be very careful, not 75,000 or actual expense, whichever is lower. Flat 75,000 deduction. It means whatever expenditure it may be, you ignore it. You just take 75,000 and put 75,000 as deduction. And in case the disabled dependent relative is suffering from a severe disability means what? 80% or more organ damage. In such case, flat 1,25,000 will be allowed as deduction to the assessee irrespective of the expenditure incurred. Okay.
We saw that there are two conditions. Either of two conditions should be satisfied. So either medical expenditure should be incurred, or condition number 2, deposit should be made for the maintenance of such dependent relative. Okay. So now what is this deposit, sir? Listen here. For example, there is a person, Mr. A. Okay. And he has a disabled dependent, Mr. D. Mr. D is a disabled dependent relative of Mr. A. So what should Mr. A do? Mr. A should deposit money in a fund. Okay. If Mr. A is depositing any amount of money in the fund for the maintenance of this dependent disabled relative, in such case Mr. A will get the benefit of the deduction. Fine. Now what are the rules, Kanna? The rules is that from this fund money cannot be given to Mr. D until death of Mr. A or till the time Mr. A attains 60 years of age. So what did I say? Mr. A should keep depositing money in a fund. From that fund, the deposit fund, no benefit should be given to the dependent disabled relative till the death of Mr. A or the time when Mr. A receives 60 years of age. You get my point? If at all Mr. D is receiving the money from the fund before the death of Mr. A or before Mr. A receives 60 years of age, whichever is earlier, then entire amount of deduction allowed will be taxable. In such case, entire deduction that was allowed earlier will become taxable. If not, then no problem at all. If Mr. A attains 60 years of age or if there is death of Mr. A, then the money from this fund can be given to the disabled dependent relative. So what is the logic of this section? The logic is that till Mr. A attains 60 years of age, obviously Mr. A can take care of this relative, correct? So no problem at all. After Mr. A attains 60 years of age, then Mr. A will not be able to help. Hence, the money can be given from the fund to the disabled dependent relative and the disabled dependent relative will be able to manage and survive. So that is the concept.
Next, section 80U. Section 80U. Section 80DD we studied, it is for dependent relative. Okay, dependent relative. However, 80U is for the assessee himself. So only individual can claim section 80U. Okay, then all the other conditions are same as 80DD. The individual should incur any expenditure on himself for the purpose of medical treatment or deposit any amount for himself. Second, if the individual himself is suffering from normal disability mentioned under 80U. What is disability mentioned under 80U? Disability means any disease specified in Persons with Disability, Equal Opportunities, Protection of Rights and Full Participation Act 1995. You need not focus much on this. If it is coming in exam, it will be given that it is specified under 80U. Okay, so don't worry that much. So if the individual is suffering from the disease, if it is a normal disability, 75,000 allowed as deduction. If it is a severe disability, that means 80% or more organ damage, then 1,25,000 rupees is allowed as deduction. So for individual himself, he can claim under section 80U, and for The individual, for the purpose of their dependent relative, they can claim under section 80DD. 80DD. Okay, you get my point? Now let us come to section 80DDB. 80DDB is deduction for medical treatment of specified diseases. Medical treatment of specified diseases. Who is eligible, sir? Individual HUF are eligible, and same section is used for individual themselves as well as their relatives. Themselves as well as relative. Relative definition is same as section 80DD. What is the deduction allowed? Deduction allowed is actual expense incurred for medical treatment, or 40,000 in case of normal citizen, or 1 lakh in case of senior citizen, whichever is lower. And from this lower amount, you should reduce any insurance claim that is received or any reimbursement that is received by the employer, from the employer. Okay, so this you should reduce from the amount. The balance amount will be allowed as deduction. Okay, one more condition, medical prescription is compulsory for the disease. Now let me tell you one special point. Okay, that this dependent word is used only in the relative definition in section 80D series, that is 80D, 80DD and 80DDB. Okay, in all the other sections, if at all there is a relative definition, in such relative definition you will not find dependent word in it. Okay, so for example, in LI's life insurance policy, what is the relative definition? Spouse and children. Okay, you will not find the word as dependent spouse or dependent children in the definition. Hence, in exam, for any deduction other than 80D series, if you are getting the wordings in the question as dependent children, dependent parents, etc., just ignore it. Okay, and just see whether they are in the relative definition or not. In question, they will give you dependent only to confuse you. Okay, they will also give you minor children, major children, etc. That will also be given to confuse you, because in deduction chapter there is no minor major concept. Okay, so be careful while learning and keep all these tips in mind. Next, section 80E, interest on loan for higher education. Who is eligible, sir? Individual. So if an individual takes a loan for the purpose of higher education means what? Education after class 12. Okay, for the purpose of self, spouse, children, or student for whom he is a guardian. Who's a self, spouse, children, or any student for whom the assessee is a guardian. If the assessee takes a loan for the purpose of higher education, and the loan should have been taken from a financial institution or charitable organization under section 80G, then the interest on loan is allowed for a period of 8 years, or the actual period for which the interest is paid, whichever is lower. Okay, maximum 8 years the interest paid is allowed. Next, let us come to section 80EE, which is not that important, but still let me just quickly tell you. Who is eligible, sir? Individual is eligible. What are the conditions? Interest on housing loan will be allowed as deduction. Okay, the conditions are: loan should be for the purpose of acquisition of the residential house. Okay, residential house. Second, loan should be taken only from a financial institution or housing finance company. Value of loan should be up to 35 lakhs. Value of the house, that is the purchase price of the house, should be up to 50 lakhs. Then loan should be sanctioned only in the previous year 16-17, that is from 1/4/2016 till 31/3/2017. Then while taking the loan, the assessee should not own any house other than the house on which the loan is going to be taken. So assessee should not own any house while taking the loan. Okay, what is the amount of deduction, sir? It is 50,000 rupees over and above the interest allowed under house property chapter. So in the interest from housing loan, you will first claim under section 24B under the head income from house property. Okay, however in self-occupied property, how much is allowed? Maximum 2 lakh rupees. Okay, over and above the 2 lakh rupees, whatever interest is there, you can claim here, that is under section 80EE, but here also the maximum limit is 50,000 rupees. So I told you, if actual interest is 2,75,000, first claim 2 lakhs under 24B under house property chapter, then claim 50,000 here under section 80EE. After this also you will have 25,000 as balance. You can't do anything about it, just leave it. Okay, next period. no maximum period till the repayment continues, it is allowed as deduction. Now let us come to the important section, that is section 80EEA, which is important because there is an amendment also. So interest on housing loan is allowed as deduction. So there also interest on housing loan, in 80EEA also interest on housing loan. Who is eligible? There also individual eligible, here also individual eligible. What are the condition? First condition, loan should be for the acquisition of residential house. There also same condition, here also same condition. Next, loan should be taken from financial institution or housing finance company. There also same condition, here also same condition. Next, the stamp duty value of the house should be up to 45 lakhs. There what is it given? The value of the house, that is purchase price, should be up to 50 lakhs. Okay, here it is given that the stamp duty value should be up to 45 lakhs. Okay, there it is given that the value of the loan should be up to 35 lakhs. Here nothing is given about the value of the loan. Next, the loan should be sanctioned between 1/4/2019 till 31/3/2021. Earlier it was 2020, now it has been amended to 31/3/2021. That is previous year 1920 as well as 2021. This section is applicable. Okay. So there it was previous year 1617, here it is previous year 1920 and 2021. Next. Here also same condition, the assessee should not own any house before the sanction of the loan. Next, there the deduction was 50,000, but here the deduction is 1,50,000, and here also same. First you claim the interest, okay, in house property chapter, remaining interest you claim here up to 1,50,000 rupees. Okay, and if it is an LOP, you can claim the entire deduction in the house property chapter itself. But maximum loss that is allowed is only how much? 2 lakh rupees. Okay, so over and above the loss, if you are having any interest, then that interest you can claim here. Fine. Here also the period is the period till which the repayment continues. Now let us see section 80 EEB, that is interest on loan for purchase of electric vehicle. Okay, so if an assessee purchases an electric vehicle, and for the purpose of purchasing that electric vehicle, if the assessee takes any loan, okay, the loan should be from financial institution, and the loan should be taken between the period 1/4/2019 till 31/3/2023. Then the interest up to 1,50,000 is allowed as deduction till the repayment of loan continues. However, if this interest on loan is allowed anywhere else, it will not be allowed here. For example, if the electric vehicle is used for the purpose of business, interest on loan for the electric vehicle you would be claiming under PGBP chapter, correct? So if you are claiming deduction under PGBP, you are not allowed to claim the deduction here. So deduction will be allowed for one amount only one time. Okay. Next, section 80GG. Usually the people who are salaried employees will claim house rent allowance, okay, exemption under section 1014A. But what will happen to the people who are not salaried employees? They can claim the deduction here under section 80GG. So it is applicable to the people who are not covered under HRA. Okay. Now, if the accommodation is used for own residence, so what is allowed as deduction, sir? The rent paid is allowed as deduction, but there are some condition. First condition, the accommodation should be used as the own residence. Second condition, the assessee himself or the spouse or minor child or HUF should not own any other accommodation in the same area. Okay, in the same area. And then next, the third condition, the assessee should file a declaration of above along with the return of income. So first condition is what? The accommodation should be used for residence. Second condition, assessee, spouse, minor children or HUF should not own any other accommodation in the same area. Third condition, you should fill in the details along with return of income. Okay, if all the three conditions are satisfied, then the rent paid will be allowed as deduction. However, there are some limits. What are the limits? First one, actual rent minus 10% of the total income except section 80GG, or 25% of the total income, or 5,000 rupees per month, whichever is lower will be allowed as deduction. Okay, whichever is lower will be allowed as deduction. Now let us come to section 80 GGA. Okay, so usually if a person is covered under PGBP chapter and if the person contributes for the purpose of scientific research or rural development program, they can claim deduction under section 35 or section 35 CCA respectively. However, if an assessee does not have any PGBP income, but still if they contribute to scientific research or rural development, okay, as the case may be, they can claim deduction under section 80 GGA. Okay, so what are the condition? The condition is that donation should be made for scientific, social, statistical research, etc. approved under section 35 and rural development program under section 35 CCA. Okay, however, deduction won't be denied merely because after the donation the approval was withdrawn. So once the assessee donates, he should see whether the organization is approved or not. But after donating, if the organization's approval was withdrawn, okay, the deduction won't be denied. Still the deduction will be given. Okay, next, donation of more than 2000 rupees should be in any mode other than cash. So here also see, in any mode other than cash. Be careful with the wordings. Next, section 80 GGB and section 80 GGC. 80 GGB and 80 GGC both are for deduction for the donation to political parties. 80 GGB is allowed for Indian company. Okay, the entire amount contributed to political parties is allowed as deduction. We studied in PGBP chapter that amount contributed to political party is disallowed under PGBP chapter, but it is fully allowed under deduction chapter. So under chapter 6A deduction it can be fully claimed. And what about 80 GGC? 80 GGC is assessee other than Indian company, because Indian company is covered under 80 GGB. Then other than local authority, because local authorities are controlled by political parties, and then any artificial juridical person funded by the government. So all these three persons cannot claim deduction under 80 GGC. What is the deduction, sir? Here also entire amount donated to political party will be allowed as deduction, and in both the sections there is a condition that the donation should be in any mode other than cash. Fine. Now let us come to important section, section 80 JJAA, deduction for the employment of new employees. So first of all, who is an eligible assessee? Eligible assessee is any person to whom 44AB applies. That is, any persons whose turnover is more than 1 crore and who is having PGBP income. Okay, turnover is more than 1 crore and having PGBP income. Sir, what is allowed as deduction? The total salary into 30 percentage. So total salary into 30 percentage for the additional employees is allowed as deduction for 3 consecutive years. Okay, so total salary paid to additional employees into 30 percentage for 3 years will be allowed as deduction. Sir, who are additional employees? In case of an existing business, the additional employee means increase in the number of employees, and in case of the new business, the total number of employees employed during the previous year will be called additional employees. However, the payment made to the additional employees should be via account pay check or account pay bank draft or electronic clearing system or any other prescribed mode like credit card, debit card, net banking, UPS, IMPS, RTGS, NEFT, etc. Okay. Only in this section we are seeing such wordings: account pay check, account pay bank draft. All other places we have seen only any mode other than cash. Okay, so learn to differentiate. Now, sir, who and all are not covered in additional employees? 4 types of employees are not covered under additional employees. Number 1, any employee whose total salary given is more than 25,000 rupees per month is not considered an additional employee. Second, any employee for whom the government contributes to pension scheme as specified under Employee Provident Fund and Miscellaneous Provisions Act. Such employees are also not counted as additional employees. Number 3, any employee who do not participate in recognized provident fund will not be counted. It means any employees who participate in recognized fund only will be counted as additional employees. So it is compulsory for the additional employees to participate in recognized provident fund. Okay, and condition number 4, if the employee works less than 240 days, okay, and in case of assessee engaged in manufacturing of apparel, footwear or leather products, if the employee works for less than 150 days, then such employees will also not be counted as additional employees. However, if there is an employee, okay, who is actually employed during the last stages of the year, so he works for less than 240 or 150 days as the case may be. So if an employee works for less than 240 or 150 days, but in the next year if he works for more than 240 or 150 days as the case may be, then he will be considered as a new employee in the next year. Okay, he will be considered as an additional employee in the next year. Fine. Next, exclusion from emolument. Emolument means what, sir? Salary. So what and all should be excluded from the salary? Any contribution made by the employer to any pension fund, provident fund or any other fund for the welfare of the employee. And then, so that means employer contribution should not be counted. Okay. And then second thing, any lump sum payment paid to the employee at the time of termination of service. So if any bulk amount is paid to the employee during termination of service, such as superannuation fund, VRS, gratuity, etc., that also should not be counted in the salary. Okay. So other than these two, the total salary should be counted as salary. Next. Sometimes what happens, some business will just open a branch, they will shift their existing employees to a branch and they will tell that they are new employees. Sometimes what will happen, some business it will reconstruct itself, it will put a new brand name and all the existing employees it will move to the new brand name and it will tell that they are new employees. So both of this should not happen. Hence what they have told, the business should not be formed by splitting up or reconstruction of an existing business. Okay. The business should not be acquired by assessee by way of any transfer or reorganization like demerger, okay, amalgamation, etc. It is given. Then last but not the least, if 80JJAA deduction has to be taken, then you should take a report from an accountant. An accountant means chartered accountant, and such report should be submitted 1 month before the due date to file the return of income as per section 44AA. Earlier it was along with return of income, but now amendment is there. It means 1 month before the due date to file the return of income under 44AA. 44AB. 44AB only contains tax audit due date. So tax audit due date has changed. Similarly, here also there is a change. Okay. Now let's come to income based deductions. First, let us learn certain income based deduction. In income based deduction, I told you there are two types, certain income based deduction and normal income based deduction. So first we are going to learn certain income based deduction, that is 80QQB and 80RRB. Sir, what is 80QQB? 80QQB means deduction for royalty or copyright fees on certain books of literary, artistic and scientific nature. So if the assessee has written a book on literary or artistic or scientific subject, then if the person gives the right for the book and receives a royalty for the book, then the amount of royalty received will be allowed as deduction. Okay, so here deduction is allowed for the income that is received. Who is eligible? Resident individual is only eligible. What is the deduction allowed? Eligible royalty or 3 lakh rupees, whichever is lower. Sir, what is eligible royalty? If it is a lump sum royalty, then the total amount received will be the eligible royalty, and if it is not a lump sum royalty, then 15% of the value of the book sold will be eligible royalty. So first what you should do, first put the royalty amount as income, okay, then claim it as deduction. Deduction will be eligible royalty or 3 lakhs, whichever is lower. However, if royalty is earned from outside India, then make sure that the amount is brought into India in convertible foreign exchange within 6 months from the end of the previous year, or amount or the time allowed by RBI, as the case may be. Okay. Another condition is that certificate should be got from the payer of the royalty, that I am giving royalty of this much amount for this purpose, etc. Not a very important point.
Next, section 80 RRB. This is royalty received for the purpose of payments. So if any royalty received by the payment and the receiver is a resident individual, then the assessee can claim deduction of royalty received or 3 lakh rupees, whichever is lower as the deduction. And here also, if the royalty is received from outside India, the amount shall be brought into India in convertible foreign exchange within 6 months from the end of the previous year or time allowed by RBI, as the case may be. Okay. And royalty includes the sale of patent, but it does not include sale of the products, okay, made using the patent. So if patent right is given and amount is received, it is called royalty. However, by using the payment, if a product is made and if that product is sold, then such amount received will not be called royalty. Now let us come to normal income based deduction. This certain income based deduction, that is 80 QQB, 80 RRB, you should link it with AMT concept. So if these deductions come and if the adjusted total income is more than 20 lakhs, AMT is going to be applicable. Fine. Now let us come to 80 TTA, that is interest on saving bank account. So any individual or HUF can claim deduction for interest received on saving bank account with saving a banking company, cooperative bank or post office. What is the deduction? Interest received or 10,000 rupees, whichever is lower. So whatever interest is received, first include it in the income under IFOS chapter and then claim it as deduction, maximum 10,000 rupees under chapter 6A deduction, section 80 TTA. However, if it is a post office saving bank interest, then you know that under income from other sources 3,500 rupees is allowed as exemption. So first you claim the exemption, then on the balance amount you can claim the deduction. So I told you earlier itself, let's say interest from post office saving bank account is 15,000. So first claim exemption under IFOS chapter 3,500. Balance how much? 11,500. Okay, which will be included in the gross total income. Now while claiming the deduction, you can claim the actual income, that is 11,500 or 10,000, whichever is lower can be claimed as deduction under 80 TTA. Okay. Next, section 80 TTB. 80 TTB is the deduction allowed for senior citizen. So if the assessee is a resident senior citizen, then interest on deposit, not saving account, it is given deposit. So the deposit can be saving account, it can be fixed deposit, it can be recurring deposit, it can be any deposit. If the deposit is with the banking company, cooperative bank or post office, then the entire amount will be allowed as deduction subject to the limit of 50,000 rupees, 50,000 rupees or actual interest received, whichever is lower will be allowed as deduction. And if the resident senior citizen is claiming the deduction under 80 TTB, then for the same amount deduction should not be claimed again in section 80 TTA. Okay, for one amount only one time deduction will be allowed. And one more thing, this 80 JJAA that we discussed right now, it is allowed even if the assessee is adopting the new tax regime under section 115 BAC. Okay.
Now let us move to the next deduction, which is section 80 CCH. So when I was discussing salary also, I told you that section 80 CCH, along with that I will also discuss the salary provision, and also there is an exemption provision that also we will discuss together. So 3 sections we are going to study together right now, which is about Agnipath scheme. Agnipath scheme. Sir, what is this Agnipath scheme? Agnipath scheme is a scheme which is brought out by the central government, where the central government will recruit very young people in the army. Okay, and after recruiting them, I think the duration of them being in the army will be, I think, 4 years or something. I am not very sure about that, but the concept is that after recruiting, the central government will give them salary. Correct? Along with the salary, the central government will also contribute 30% of the salary to the Agniveer Corpus Fund. And similarly, whatever salary is given to the people, correct, to the employee, 30% of the employee's salary also will be contributed to the Agniveer Corpus Fund. And after the entire period is over, the total amount along with interest is given back to the employee. This is the concept. Okay, I'm not going very deep into what are the features of the fund, why the government has brought this fund, that and all you can obviously browse in the internet. I'm only discussing about the income tax aspect. So very simple. Let me discuss it in simple language. Firstly, I want you to pause the video and note down this table. Wherever you find space, please note down this table and then let me explain. Done? Okay. So Agniveer Corpus Fund, it is just a fund, like for example a provident fund, gratuity fund. Similarly, Agniveer Corpus Fund. In that corpus fund, the employee will contribute, employer will contribute. How much will they contribute? 30% of salary. Okay. Now, employee contribution is allowed as deduction under section 80 CCH subsection 1. So, under chapter 6A deduction, you can claim the employee contribution as deduction, just like PF. Okay. However, this deduction is only allowed in the old tax regime. It is not allowed in the new tax regime or default tax regime under section 115 BAC. It is not allowed. Now let us talk about employer contribution. Employer contribution, first and foremost, you have to add to the salary head of income. This only I was talking about when I was discussing salary chapter. So employer contribution to the Agniveer Corpus Fund will also form part of the salary under section 17. You get my point? After adding to the salary income, the same amount you can claim it as deduction under section 80 CCH subsection 2. Okay, entire amount you can claim as deduction, there is no limit. Fine. And this deduction is allowed even in the new tax regime. So it is allowed in both old tax regime as well as new tax regime. Fine. And now comes to maturity. And the amount of maturity including interest is exempt under section 1012C. Fine. So, and exemption also can be claimed under both old tax regime as well as new tax regime. So it is a very simple concept. Now if you just go to this page and you read all the provisions, you will easily be able to understand. It is very simple, nothing complicated about this section. The concept is similar to the provident fund or pension scheme, which we have already studied. Similar concept will apply here also to Agniveer Corpus Fund. Okay. So I hope you are clear.
So these were all the deductions. All the deductions, learn thoroughly and revise them again and again, by heart them, so that you are able to attend them easily in the exam hall. So keep learning, keep revising. See you in the next video. Till then, take care. Bye bye.
Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the provisions of TDS and TCS chapter for CA Intermediate Income Tax examinations. And before beginning the revision, as usual, my request to you is to like this video, subscribe to this channel and also share it with your friends, because sharing is caring. Now, let us begin with the revision. Sir, firstly, let us start with TDS. What is TDS? Kanna, TDS means tax deduction at source. It means where a person is making a payment to another person, and if such payment is covered in the TDS provisions, then the person who is making the payment is responsible to deduct an amount of TDS and pay it to the government, and only the balance amount should be given to the person who is receiving the payment. Later on, when the person who is receiving the payment is paying his or her taxes, then the amount of TDS can be set off against the tax, and only the balance amount needs to be paid to the government. This is the concept of TDS. In detail, we have learnt it in the classes. Now, the person who is making the payment will be called the payer. Person who is receiving the payment will be called the payee. Here, in TDS chapter, the payer is responsible to deduct the TDS. Hence, the payer will also be called the deductor, and the payee who is getting the payment will also be called the deductee. Okay. So payer is the deductor, payee is the deductee. Now, in this chapter, whatever sections that we are going to learn, in all the sections except section 194E, the payee is going to be a resident. Only for resident payee, all these sections will be applicable. However, for 194E alone, the section is applicable to a non-resident sports person or entertainer. It means it is applicable to a non-resident. Fine. Now let us come to the sections one by one. Firstly, I would like to tell that TDS is generally deducted on payment or credit whichever is earlier. Payment or credit, whichever is earlier. But the first section that we are going to learn is section number 192, which discusses TDS on salary. TDS on salary, and this TDS is deducted only on payment basis. So you should not see payment or credit whichever is earlier. You should deduct the TDS only on payment basis. It is applicable to the salary type of income. Hence, when the employer is paying salary to the employee, and if the salary is more than the basic exemption limit, if the salary is more than basic exemption limit, employer should deduct the TDS and balance only should be paid to the employee. Sir, what is the rate of TDS? Answer is rate of TDS is average rate of tax. It means what? You have to find out the tax on the entire income of during the year, then find out the average rate, and based on that average rate only TDS has to be deducted every month. We have learned this in detail in the classes. Now let us discuss some more points in the salary TDS. Firstly, employer shall consider other details of other incomes, deductions and TDS if furnished by the employee. So employee will give the details of any other income other than salary, like income from other sources, house property, etc. All those income details the employee will give to the employer. Employer has to consider that also while deducting the TDS. Number 2, employer, however, should not consider any loss other than house property loss. So house property loss can be considered while deducting the TDS, but any other loss should not be considered. Next, if there is more than one employer or if there is a change of employer, then furnish the detail to the current employer in form 12B. Then, so it means what? If the employer is changing from one person to another person, then furnish the details of the previous employer to the new employer. Correct? Or if there are more than one employer, then furnish the detail to one of the employers. Next, it is the employer's responsibility to obtain a proof of number 1, landlord's name, address or PAN number in case there is an HRA and if the rent is more than 1 lakh rupees. Point number 2, if there is leave travel concession, then take the evidence of leave travel concession expense also. Number 3, if there is an interest on housing loan, then also collect the details of the lender's name, address and PAN number. And lastly, if any investment is made under chapter 6A deductions, then for such investment take the evidence. Fine. So all these points also have to be considered by the employer while deducting the TDS for employee. Now let's come to next section, that is 192A. 192A discusses about withdrawal from employee provident fund account, and here also the TDS only has to be deducted on payment basis. TDS has to be deducted on payment basis. Sir, on what amount TDS has to be deducted? On any amount if the amount is more than 49,999. So it means what? If the only the amount is less than 50,000, no need to deduct the TDS. If the amount is 50,000 or more, here be very careful. If it is exact 50,000, TDS has to be deducted. If the amount is 50,000 or more, TDS has to be deducted. And one thing you be very clear Kanna, in the TDS provisions, except for two sections, that is 194N and 194Q, except for two sections, if at all there is a limit and if the income or the payment crosses the limit, then TDS has to be deducted on the entire amount. See, for here also, for example, if the amount of withdrawal from EPF is 60,000, then on the entire 60,000 TDS has to be deducted. You get my point? Next, sir, what is the rate of deduction of TDS? The rate of deduction is 10%, and the person who is receiving the payment, that is the payee, should also give the PAN number to the payer. If the PAN number is not given to the payer, then in case of 192A, TDS should be deducted at MMR. MMR. What is MMR? Maximum marginal rate, and in case of individual, the maximum marginal rate is 42.74%. This we learnt in detail in the basic concepts chapter. Next, TDS will be deducted for 192A only if the withdrawal is taxable. So if the withdrawal is not taxable, example, in recognized provident fund, if the withdrawal is made after 5-year period, then it is not taxable. In such case, no TDS will be deducted. However, if the withdrawal is taxable, then the TDS will be deducted at 10% on the amount of 50,000 or more. Okay. Next, section number 193, interest on securities. For interest on securities, the TDS rate is what? 10%. TDS rate is 10%. Now let us see the various limits and exemptions. Firstly, if the interest exceeds 5,000 rupees, is more than 5,000 rupees in case of debentures of a public company paid to a resident individual or HF by account pay check. So if three conditions are satisfied, what are the three conditions? the debenture, it should be a debenture of a public company. It should be paid to a resident individual or HUF. And number 3, it should be paid through account pay check. In such case, if the interest is up to 5,000 rupees, no need to deduct the TDS. If it exceeds 5,000 rupees, then only you have to deduct the TDS. Next, number 2, TDS should be deducted only if interest exceeds 10,000 per annum in case of 8% saving taxable bond 2003, 7.75% saving taxable bond 2018, floating rate saving taxable bond 2020. So in these 3 cases, what you have to do? You have to deduct the TDS only if the interest is more than 10,000 rupees. Now let us see various cases where TDS under 193 is not applicable. So on all the government securities that we discussed, other than these 3 securities that we discussed before, no TDS has to be deducted on government securities. Next, national savings certificate, no need to deduct the TDS on interest. Next, national development bond, national defense bond. Then if there is a 6.5% gold bond or 7% gold bond, then in such case up to 10,000 rupees no need to deduct the TDS. If it is more than 10,000, deduct the TDS. So in your notes, this 10,000 limit will not be written. Please make this small correction in your notes. So in case of 6.5% gold bond and 7% gold bond, up to 10,000 rupees no need to deduct the TDS. More than 10,000, deduct the TDS on the entire amount. Okay. Then if there is any security of central government or state government other than what we discussed above, no need to deduct the TDS. Then for listed demat securities, no need to deduct the TDS. If there is a debenture of Power Finance Corporation Limited and Indian Railway Finance Corporation Limited, no need to deduct the TDS. Next, if interest is paid to, hence if the payee, that is the person receiving the payment, is LIC, GIC, insurance company, then in such case no need to deduct the TDS. Okay, so this was section number 193. Now let us discuss section number 194. Section 194 discuss about dividend including deemed dividend. So for dividend and deemed dividend, when the person is receiving the dividend, it is taxable in income from other sources, correct? Hence, when the person who is making the payment of dividend should deduct the TDS at 10%. Deduct TDS at 10%. However, no TDS is required if the dividend is given to an individual in any mode other than cash up to 5,000 rupees per annum. So what is the total amount? Up to 5,000 rupees per annum. If the dividend is given to an individual in any mode other than cash, then no need to deduct the TDS. Then one more thing, no need to deduct the TDS if dividend is paid to life insurance company, corporation, general insurance corporation, subsidiaries of LIC and GIC, or any other insurer. In such case also no need to deduct the TDS on dividend. Next, let us discuss section number 194A. 194A talks about interest other than interest on securities. So interest on securities we discussed in 193. Now we are discussing interest on other than securities. Okay. What is the TDS rate? TDS rate is 10%. Is there a limit? Answer is yes. If the interest amount is up to 5,000 rupees, no need to deduct the TDS. Interest amount up to 5,000, no need to deduct the TDS. Also, this limit will become 40,000. Okay, and 50,000 in case of senior citizen. For what type of payment? If the interest is received on time deposit from banks or cooperative bank or post office, and also interest paid by cooperative society with turnover or gross receipts greater than 50 crores given to its members. So what did I tell? There is a limit of 40,000, and in case of senior citizen the limit will become 50,000. When what will happen? If interest is given on time deposit, that is fixed deposit etc. of a bank, cooperative bank or post office, and also if a cooperative society whose turnover or gross receipt during the previous year is more than 50 crores, if such cooperative society is paying to the member, then it has to deduct the TDS. However, up to 40,000 or 50,000 as the case may be, no need to deduct the TDS. Okay. Next, if bank has a core banking system, then the limit of 40,000 or 50,000 will be applicable per bank. If the bank is not having core banking system, it will be applicable per branch. Fine. Next, in case of interest on compensation paid by insurance company awarded by motor accident claim tribunal, then the limit is what? 50,000. Up to 50,000 no need to deduct TDS. Above 50,000 deduct the TDS. Then one more thing, see here, this section is covered in hijack provision. See, there is no concept of hijack provision in your institute study material. We have only developed it for your class. It was given to me by my guru CA Anish sir. This hijack provision. What is hijack provision? It means that in section number 194H, 194I, 194J, 194A and 194C, in all these 5 sections, what will happen if there is an individual or HUF whose turnover or gross receipts in the business or profession, as the case may be, does not exceed 1 crore or 50 lakhs, then such individual or HUF need not deduct the TDS. You get my point? What did I tell? If an individual or HUF whose gross receipts or turnover or gross receipts in business or profession does not exceed 1 crore or 50 lakhs, as the case may be, in the preceding previous year, then they need not deduct the TDS. They did not deduct the TDS in section 194H, 194I, 194J, 194A and 194C. Now we are discussing 194A. So here also hijack provision will apply. It means that individual or HUF who are covered in this provision need not deduct the TDS. Okay, on any amount. So they need not deduct the TDS no matter what the interest is. Fine. Now next one, no TDS on following interest. So no need to deduct the TDS if interest on loan is given to bank, cooperative bank, financial institutions, LIC, UTI or any insurance company. If a partnership firm is paying interest on capital to partners, then no need to deduct the TDS. If government is paying interest on income tax refund, then no need to deduct the TDS. If interest is paid by cooperative society with turnover of gross receipts up to 50 crores, then no need to deduct the TDS. If it is more than 50 crores, then they have to deduct the TDS, and for that also there is a limit of 40,000 or 50,000, as the case may be. If interest is paid by primary agriculture credit society on deposits made with them, no need to deduct the TDS. Interest on saving bank account, no need to deduct TDS. Interest on zero coupon bond, no need to deduct TDS. Okay, in zero coupon bond there will not be any interest also, but on the discount amount also no need to deduct the TDS. Okay, then from interest on national saving certificate, national skill development fund, deposit with housing and urban development corporation, that is our HUDCO, then Kisan Vikas Patra, post office monthly scheme, post office recurring deposit or any other notified scheme of central government, no need to deduct the TDS. Interest on fixed deposit in the name of Registrar General of India, also no need to deduct TDS. Then if interest is paid to minor child, if they have filed the declaration under Rule 37BA, no need to deduct TDS. Then interest on capital gain account scheme given to legal heirs, okay, when the holder is deceased, then also no need to deduct the TDS. So in all these cases, no need to deduct TDS under section 194A. Now let us come to the next section, that is 194B and 194BB. 194B and 194BB are both applicable on, okay, winnings from betting, lottery, gambling, crossword puzzles, card games and winnings from horse race, etc. In both these sections, the TDS rate is what? 30%, and here also TDS has to be deducted only on payment basis. Only on payment basis. But however, there is a exemption limit. What is the limit? Up to 10,000 rupees of winnings, no need to deduct the TDS. Only if the amount is more than 10,000, TDS has to be deducted at flat 30%. Flat 30%. Now, sometimes what happens? Winnings are given in kind. For example, a person is giving a car to another person as a winnings. However, when the person is giving the car, he cannot split that car into 30% and pay to the government. Hence, if the person is not having money to deposit the TDS, what he should do? Listen here. If winning is in kind and cash is not available to deduct the TDS, the payer should make sure that tax is paid by the payee before releasing the payment. So the person who is receiving the gift should pay the taxes to the government. Only then that winnings should be given to the person who is receiving the winnings. You get my point? Next, let us discuss section number 194C, payment to contractors. So for payment to contractors, what is the TDS rate? TDS rate is 1% in case of payee being an individual or HUF. If the payee is other than individual or HUF, the TDS rate is 2%. So if the payee is individual or HUF, 1%, other than individual or HUF, 2%. And here also, listen, hijack provision will apply. That is 194H, 194J, 194I, 194A and 194C. Now we are discussing 194C, and here there is a special point in hijack provision. What is that point? Generally, for individual or HUF whose gross For individual or HUF, if the turnover or gross receipts as the case may be is more than 1 crore or 50 lakhs in case of business or profession, then such individual or HUF need not deduct the TDS. Correct? However, in this section alone, this hijack provision is also applicable to AOP and BOI also, association of person and body of individual. Hence, in case of 194C, if the person who is deducting the payment is an individual, HUF, AOP or BOI, and if their turnover or gross receipts as the case may be in case of business or profession is up to 1 crore or 50 lakhs, then such individual HUF, AOP or BOI need not deduct the TDS if their turnover is up to 1 crore or 50 lakhs in the preceding previous year. Okay. Then what is the exemption limit for TDS? See here, if single payment is up to 30,000 rupees and aggregate payment is up to 1 lakh rupees, then no need to deduct the TDS. So TDS should be deducted only if a single payment is more than 30,000 or aggregate of all the payments during the financial year is more than 1 lakh rupees. We saw various examples also in class. Next, listen here. If a contract is of a personal nature, then also individual and HUF need not deduct the TDS. Next, no TDS if payment is made to a contractor in a transport business owning up to 10 vehicles at any time during the financial year and he furnishes a declaration with PAN. Firstly, let us discuss what is contract. Contract means advertising, broadcasting, telecasting, carriage of goods and carriage of passengers other than railway. Hence, if payment is made to railway, TDS need not be deducted. Okay. Then catering, customized manufacturing using customer material or customer associate material. So, for example, I am giving a material to some other person and using that material I am asking that person to make a customized product and give me, then I have to deduct the TDS on the making charges. Similarly, even if my associate is giving the material and I am receiving the customized product, even that case also I have to deduct the TDS. Okay. So that is also included in the contract. So what and all is included in contract? Advertising, broadcasting, telecasting, carriage of goods, carriage of passengers, catering, customized manufacturing using customer material. Okay. And contract also includes subcontract. Now, carriage of goods and passengers is included in TDS, correct? In 194C. Now, in case of transport business, there is an exemption to deduct the TDS. Sir, what is the exemption? Listen here. If the contractor is owning only up to 10 vehicles at any time during the financial year and he furnish a declaration that he is owning only up to 10 vehicles and he is also mentioning his PAN number in the declaration, then for such transporter no need to deduct the TDS under section 194C. You get my point? So for transporter various benefits are given. Firstly, we discussed in PGBP chapter in section number 40A3. Generally, if cash payment or payment through other than prescribed modes is made to a person in a day more than 10,000 rupees, you remember, then it is not allowed. However, in case of transporter alone, it was 35,000. Then we also discussed the presumptive income under section 44 AE. The benefit of such presumptive income is given to a owner of goods carriage who is owning up to 10 vehicles during the previous year. And similarly, here also we are studying that for such people, that is the owner of a goods carriage who is owning only up to 10 good vehicles during the previous year, for them also no need to deduct the TDS if they are giving a declaration. Okay. Next, in case of job work, TDS shall be deducted on the value excluding material if the material is mentioned separately in the invoice. So if you see the invoice, if material is mentioned separately and job work charges are mentioned separately, then deduct the TDS only on the job work charges. However, if it is not mentioned separately, then deduct TDS on entire amount. Okay. Next, no TDS if contract is incidental and compulsory to the transaction. So if contract is incidental or compulsory, it means what? For example, transport charges is charged of 10 lakh rupees along with the petrol sales of 5 crores. So for petrol sales of 5 crores, it was an incidental transaction. In such case, no need to deduct the TDS. Next, TDS is applicable on payment made by a client to the advertising agency. However, it is not applicable on payment by advertising agency to news channel. So see here, if a client is giving 10 lakh rupees to ad agency, then the client has to deduct the TDS. Now this ad agency will reduce its commission and it will pay balance amount to the news channel for displaying the ads. Now on the same transaction, no need to deduct the TDS once again. Hence on this 9 lakh rupees, TDS will not apply. You get my point? Next, TDS is applicable on payment by TV channel or broadcaster to a content producer if the program is as per their specification and copyright is also transferred. If not, no TDS. So I give you an example. If Sun TV is approaching Lycra Productions, now Lycra Production is making a TV serial as per the requirement of Sun TV, then Sun TV should deduct the TDS. Okay, and also giving the copyright to Sun TV. Next, what is one more example? If Lycra Production is already having a TV serial, the rights of that TV serial which is already made, if it is giving to Sun TV, in such case no need to deduct the TDS under 194C. So these were the provision of 194C. Now let us discuss section 194D, that is insurance commission. So when an insurance company is giving commission to an insurance agent, it will deduct the TDS at the rate of 5% and limit is what? Limit is 15,000. So up to 15,000 no need to deduct the TDS. If it is more than 15,000, deduct TDS on entire amount. Next, section 194DA talks about maturity or bonus amount of life insurance policy. So if life insurance policy is matured or bonus is given, then TDS has to be deducted at payment basis. On payment basis under section 194 DA, the rate of TDS is 5% and it is not applicable if maturity amount is less than 1 lakh rupees. Hence, if the maturity amount is exact 1 lakh or more than 1 lakh, TDS has to be deducted. If it is less than 1 lakh, no need to deduct the TDS. Next, calculate the TDS only on the income portion. So total money minus total premium is equal to amount on which TDS has to be deducted. Okay. Then one more point, if the TDS is exempt under section 1010D, no need to deduct the TDS. Okay. And also in Keyman insurance policy, no need to deduct the TDS. Next, section 194E. So this is the only section which is applicable for a non-resident payee. Okay. So for whom and all it is applicable? If a person is a non-resident sports person, sports association or entertainer. In such case, TDS has to be deducted when the payment is made at 20.8%. Why 20.8%? It is 20% plus 4% health and education cess. Kanna, generally when a payment is made to a non-resident and if TDS has to be deducted, along with the TDS rate, health and education cess and surcharge also, as the case may be, has to be deducted. So there are only two sections that you are going to learn where health and education cess and surcharge also will come including in the TDS chapter. What are those sections? Firstly, we learned section number 192, that is salary. So in salary TDS also, health and education cess and surcharge will be included in the TDS, and this next section is 194E. Here also, when a payment is made to a non-resident sports person, sports association or entertainer, health and education cess and surcharge has to be included in the TDS. You get my point? Next, National Savings Scheme, section number 194EE, which speaks about National Savings Scheme. So if the amount of maturity that is given from National Savings Scheme is 2,500 or more, then TDS will be deducted at 10%. TDS will be deducted at 10%. No need to deduct the TDS if amount is paid to the legal heir of the depositor. Next, section 194F. If a mutual fund will repurchase its own units, then it will deduct TDS at 20%. Next, 194G. When the lottery ticket agent will receive commission on sale of lottery tickets, then the lottery company will deduct TDS at 5% on amount more than, if the amount is more than 15,000 rupees. So up to 15,000, no TDS. If more than 15,000, TDS on entire amount at 5%. Next, section 194H. 194H talks about any commission or brokerage. Hence, for commission given by insurance company to agent, you have to see 194D. If the commission is given from a lottery company to lottery ticket agent, you have to see 194G. And for other commissions and brokerage, you have to see 194H. In 194H also, TDS rate is 5% and limit is 15,000. So if any commission or brokerage is more than 15,000, TDS has to be deducted at 5% on the entire amount. Okay. However, this provision is section 194H. Hence, it is covered in hijack provision. It means what? If there is an individual or HUF and if their turnover or gross receipts as the case may be in business or profession is up to 1 crore or 50 lakhs as the case may be in the preceding previous year, then such individual or HUF need not deduct the TDS under section 194H. Okay, and also no TDS on brokerage on any stock exchange transaction, commission given to underwriters, brokerage on public issue, etc., paid in case of securities. Also, if commission is paid by BSNL or MTNL to its PCO franchisee, then also no need to deduct the TDS. However, nowadays PCO is very rare. Then one point I would like to tell for you to remember the provisions easily, that is in case of 194D, 194G and 194H, all the three sections talk about commission, and in all the three sections the rate of TDS is 5% and the limit is 15,000 rupees. So it will be easier for you to remember. Next, section number 194I, which speaks about rent. So rent, in case of plant and machinery or equipment, if it is given for rent, the rate of TDS will be 2%, and if land and building or furniture or fittings is given on rent, then the rate of TDS is 10%. 10%. Next, if the rent is up to 2,40,000 rupees per owner, no need to deduct the TDS. Be very careful. The limit is per owner, not per property. Hence, if I have taken a house on rent, okay, and the total rent is 4 lakh rupees, but there are two joint owners, so I am paying rent of 2 lakh rupees each to each joint owner. Should I deduct the TDS? Answer is no, because the limit of 2,40,000 is not per property, it is per owner. So be very careful. Next, if rent is paid to the government, no need to deduct the TDS. Next, if TDS is applicable on non-refundable deposit, advance rent received and also arrears of rent. So TDS is also applicable on non-refundable deposit, advance rent and arrears of rent. If rent includes municipal taxes, no need to deduct the TDS on municipal taxes. Next, landing and parking charges which is paid by airlines to an airport is not considered as rent, it will be considered as contract. Next, if any cooling charges is paid to cold storage, it is not considered as rent, it is considered as contract. Next, one-time lease will also not be covered under 194I. And last but not the least, 194I is also covered in hijack provision. That means if there is an individual or HUF who has the turnover or gross receipts as the case may be in case of business or profession up to 1 crore or 50 lakhs in the preceding previous year, then such individual or HUF need not deduct the TDS. Okay. Next, section 194IA. It speaks about transfer of immovable property. Transfer of immovable property, which means land and building other than rural agricultural land, because rural agricultural land is not taxable at all, hence it is not included. What is the rate of TDS? Rate of TDS is 1%. Rate of TDS 1%. Next, what is the limit? Limit is less than 50 lakhs per transaction, and here be very careful. The limit is not per year, it is per transaction, and also the limit is less than 50 lakhs. Hence, if it is exact 50 lakhs, TDS has to be deducted. TDS has to be deducted. Okay. Next, actual consideration should be considered and not the stamp duty value. So here be very careful. We have studied sections like section 50C, section 43CA, section 56.210, etc., where we have to consider the stamp duty value instead of full value of consideration. Correct? In those sections you considered stamp duty value, but in case of TDS, when you see the limit of 50 lakh rupees, do not see the stamp duty value. You should see only the actual sale consideration. Okay. Next, the sale consideration also includes amount like club fee, parking fee, advance fee, electricity or water supply fee, maintenance fee, etc. Okay. So by whatever name called, if consideration is received, TDS has to be deducted on such consideration also. TDS is not applicable if transaction is covered under section 194LA. In 194LA, we will discuss about compulsory acquisition. In such case, TDS will not be applicable under 194I because it is applicable under 194LA. Okay. Now let us discuss section 194IB. Sir, section 194IB also discusses about rent. We already discussed section 194I, which is also about rent. Here there is section 194IB. This is also about rent. Then what is the difference? I told you about hijack provision, correct? It means individual or HUF whose turnover or gross receipts is not more than 1 crore or 50 lakhs need not deduct the TDS, correct? Now, such individual or HUF have to deduct the TDS. The person who are covered in hijack provision have to deduct the TDS if they are covered under section 194 IB. Okay. So who have to deduct the TDS? An individual or HUF who is not covered under 194I has to deduct the TDS under 194 IB. When will TDS be applicable? If the rent is up to 50,000 per month, TDS is not applicable. But if it is more than 50,000 per month, TDS will be applicable. Here you have to see the per month rent. Okay, not the entire year rent, per month rent. So what is the time of deduction? Generally, the time of deduction is payment or credit, whichever is earlier. However, here the time of deduction will be the credit of the last month of the year or last month of tenancy, or payment of last month of the year or last month of tenancy, whichever is earlier. Hence, TDS is deductible on the entire year rent. For all the months it has to be deducted. However, TDS has to be considered for the entire month rent, but it has to be deducted only on the last month. So for example, listen here. If rent is 60,000 per month from 1/4/2021 to 31st of March 2022, then what will happen? In every month, no need to deduct the TDS. Just come to the last month and consider 5% for all the 12 months together, which is 36,000, and deduct the TDS and pay the balance amount only to the person who is receiving the rent. Okay. Now, what happens? We will study section 206 AA, where it is given that if PAN number is not submitted, then TDS has to be deducted at 20%. In such case, if the rent itself is not sufficient to deduct the TDS amount, then the maximum TDS amount will be the amount of rent. So here, listen, if as per section 206 AA, if the payee does not furnish the PAN number, then TDS shall be 20%. Correct? However, if the deduction of TDS cannot exceed the total rent of the last month, so maximum TDS can only be the total rent of the last month. Okay, next section 194C. It talks about specified agreement under section 45(5)(a). Specified agreement under section 45(5)(a). The rate of TDS is 10%. Sir, what is this specified agreement? It is nothing but joint development agreement. This you should link with the capital gain chapter. So if at all there is a joint development agreement and the builder is paying any amount in cash, then on that cash amount TDS has to be deducted at 10%. Okay, next section 194J, very important section. There are 5 types of payments that are covered under section 194J. Number 1, fee for professional service. Number 2, fee for technical service. Number 3, royalty. Number 4, non-compete fees. Number 5, director fees. So what and all are covered? Listen very carefully. Fee for professional service, fee for technical service, royalty, non-compete fee, director fees. For all these types of payments, the TDS rate is what? 10%. TDS rate is 10%. However, TDS rate will be 2% for specific types of payments. For what and all? First and foremost, if a payment is made to a call center, TDS rate is 2%. Second, if the payment is fee for technical service, then also it is 2%. And if it is royalty in case of sale or distribution or exhibition of cinematographic films, then also TDS rate will be 2%. So in what and all cases 2% TDS? Number 1, if payment is made to call center. Number 2, if the payment made is fee for technical service. And number 3, if the payment made is royalty for sale, distribution or exhibition of cinematographic films. Okay. Now, what is the limit of TDS? The limit of TDS is 30,000 per annum. So up to 30,000 per annum, no need to deduct the TDS. If it is more than 30,000, deduct the TDS on entire amount. However, be very careful. This 30,000 per annum is a separate limit for each and every type of category. Okay. So for professional service, the limit is 30,000. For technical service, the limit is 30,000. For royalty, there is another limit of 30,000. Then for non-compete fees also, there is another limit of 30,000. But for director fees, there is no limit. For director fees, there is no limit. So even if 1 rupee director fee is given, TDS has to be deducted on that 1 rupee also. Next, no TDS on royalty or non-compete fees or director fees if the payment is made by individual or HUF. So if individual or HUF is making the payment of royalty, non-compete fee, director fee. In such case, no need to deduct the TDS. And this section is also covered under hijack provision. Hijack provision. It means what? If there is any individual or HUF whose turnover or gross receipts, as the case may be, in case of business or profession, does not exceed 1 crore or 50 lakhs. In such case, 1 crore or 50 lakhs in the preceding previous year. In such case, they need not deduct the TDS under section 194J. Then now what we are studying, if there is an individual or HF, they have to deduct the TDS only for professional service and technical service. No need to deduct the TDS for royalty, non-compete fee, director fees. Okay. Then one more thing, if there is an individual or HF and if they are paying a professional fees for personal purpose, professional fee for personal purpose, then also no need to deduct the TDS. So in three cases, individual and HUF need not deduct the TDS under section 194J. Okay. Next, royalty includes software rights. And what is professional service? Professional service means all the professions that are included under section 44AA. And here it also includes sports professionals. Okay. Next, section 194K. 194K talks about income of units of UTI and mutual fund. So on such income, TDS will be deducted at 10% if the amount is more than 5,000 rupees. Okay. Next, section 194LA. 194LA speaks about compulsory acquisition of immovable property other than rural agricultural land. So if compulsory acquisition compensation is given, the government will deduct the TDS at 10% and then pay the balance amount to the payee. However, here up to 2.5 lakh rupees during the year. 2.5 lakh rupees during the year. If the payment is there, then no need to deduct the TDS. Only if it is more than 2.5 lakh rupees, deduct the TDS at 10%. And here compensation includes enhanced compensation also. Next, section number 194M. 194M speaks about contract, commission or professional service. Sir, we have already discussed the contract under 194C, commission under 194H and professional service under section 194J. Then why are we seeing this here? Answer is, there are certain individual and HUF who are not covered under those sections. That is hijack provision, the person who is giving a contract for personal nature or professional service or personal nature, etc. They were not covered there, correct? Such individual and HUF will be covered in this section. Okay, but this section will apply only if the amount of payment is more than 50 lakh rupees. So up to 50 lakh rupees, no need to deduct the TDS. If it is more than 50 lakh rupees for all the types of services combined, then you have to deduct the TDS at 5%. TDS at 5%. So for example, Mrs. X paid a brokerage of 6 lakh rupees, 5 lakh rupees for architect service and 40 lakh rupees for contract of construction to the same person who is Mr. Y, that is the builder. Now, individually it is not more than 50 lakhs, but if you combine all the three of them, what will be the amount? 6 lakhs plus 5 lakhs plus 40 lakhs. So total is how much? 51 lakhs. Since the total amount is more than 50 lakhs, TDS has to be deducted under section 5% at 5% on the entire amount. Okay. So I hope you are clear. Now let us discuss section number 194N. 194N. So 194N is applicable on cash withdrawal in cash withdrawal in excess of 1 crore rupees from bank, cooperative bank and post office. So if there is a cash withdrawal of more than 1 crore rupees, then TDS will be deducted at 2% only on the excess amount. Only on the excess amount. So on the first 1 crore, no TDS to be deducted. Only on the excess amount, TDS will be deducted at 1%. And here also TDS will be deducted only on payment basis. Okay. Now, one more special point. If certain conditions are satisfied, then there will be a different type of TDS. Okay. What are the conditions? If the payee, that is the person who is withdrawing the money, has not filed his return of income for all the 3 assessment year relevant to the previous year for whom the time limit under section 139(1) has expired in the preceding year, then it will apply for the returns of then TDS should be deducted as follows. So listen here. If while deducting the TDS, the bank notices that the person who is withdrawing the money has not filed his income tax return for the 3 years for which the due date is over, in such case, the TDS will be deducted as follows. 2% on withdrawal above 20 lakhs up to 1 crore and then 5% on withdrawals above 1 crore. Okay, so here there is a slab rate of TDS. How is the slab rate? Up to 20 lakh no TDS, above 20 lakh up to 1 crore 2% TDS, above 1 crore 5% TDS. This slab rate of TDS will be applicable only to a person, okay, if the person has not filed 3 income tax returns for which the due date is already over. Okay, you get my point? I hope you are clear. Next, TDS is not applicable if the person who is withdrawing the money is a government, bank, cooperative bank, post office, business correspondent of banks or cooperative bank, white label ATM operators, or any other notified person. And 3 types of persons are notified. Who are those persons? Number 1, authorized dealer, agent of authorized dealer, sub-agent of authorized dealer, full-fledged money changers licensed by RBI. They need not for if they are withdrawing the money, TDS need not be deducted. Next, if commission agent or a trader operating under agriculture produce market committee, if they are withdrawing the money, need not deduct the TDS. Next, if cash replenishment agencies or franchisee agents of white label ATM operators are withdrawing the money, then also no need to deduct the TDS. In detail, we have discussed the meanings of all these terms in the classroom itself. So this is section number 194N. Let us start with section number 194O. Section 194O deals with the payment made by e-commerce operator. E-commerce operator. Firstly, let us understand the 3 terms, that is e-commerce, e-commerce operator and e-commerce participant. What is e-commerce? E-commerce means a supply of goods or service or both, or including digital products over a digital network. So if any goods, services or both, or any digital product is given through a digital network, it is called e-commerce. Next, who is an e-commerce operator? An e-commerce operator is a person who manages the digital or e-commerce, the digital or electronic facility or platform for e-commerce. For example, Amazon or Flipkart. Who is the e-commerce participant? E-commerce participant means a person who is residing in India, selling goods or services or both, including digital products through the network. Hence, the person who is selling through Amazon or Flipkart will be called e-commerce or participant. The seller is called e-commerce participant. The platform is called e-commerce operator. That is, Amazon will be called e-commerce operator. Okay. Now, if an e-commerce participant is selling through an e-commerce operator, then while paying the payment to the participant, the operator has to deduct the TDS at 1%. Hence, Amazon has to deduct the TDS at 1%. However, if e-commerce participant is not giving the PAN number, then TDS has to be deducted at 5%. It should be deducted at 5%. Okay. Here, now let's see the conditions. If 3 conditions are satisfied, no need to deduct the TDS. If 3 conditions are satisfied, no need to deduct TDS. What are those 3 conditions? Let us see. One second. Listen. Condition number 1. If the e-commerce operator should be an individual or HUF. Condition number 2. The gross amount of goods or services or both should be up to 5 lakhs per year. And number 3. E-commerce participant should furnish the PAN or Aadhaar to the e-commerce operator. If these 3 conditions are satisfied, then the e-commerce operator need not deduct the TDS. Next, TDS is applicable on gross amount and not on the net amount. So on the gross amount of sales through Amazon, the TDS will be applicable, not on the net amount after deducting the commission, shipping charges, etc. There will be a net amount, no? That you should not consider. You should consider the entire value. Next, TDS is not applicable if the amount received by e-commerce operator for hosting advertisements or providing any other service not related to the sale of goods or services. So Amazon might also provide some other services like advertising, etc. On such services, TDS will not be deducted under 194O. Okay. Next section, if TDS is deductible under 194O, it cannot be deducted under any other section. So if 2 sections are clashing, then you have to consider 194O. Don't consider the other section. Next, TDS is not applicable on securities or commodities that are traded to the recognized stock exchange. Next, TDS is not applicable on electricity, renewable energy, energy saving certificate which is provided by power exchange. Next, TDS payment gateway are not required to deduct the TDS if e-commerce operator is deducting the TDS for the same transaction. Payment gateway means what, Kana? The person who is providing the gateway for payment. Okay, for example,
CC Avenue or Razorpay, etc. So see, for example, what happened? The customer will give the payment to Razorpay. Razorpay will give the amount to Snapdeal. Snapdeal will give amount to Mr. P, that is the e-commerce operator. Okay, e-commerce participant. Hence, listen here. Snapdeal, when the payment is given, so when the Snapdeal is giving the payment to the e-commerce participant, Snapdeal will deduct the TDS. Hence, Razorpay need not deduct the TDS on the same transaction. You get my point? Next. Now let us discuss section number 194P. 194P, TDS by specified bank. So if many conditions are satisfied, then the bank will deduct the TDS. What are the conditions? Number 1, this TDS is applicable only to resident individual whose age is 75 years or more. Okay, for other resident individual it is not applicable. Next, it is applicable only if the individual is having pension income and no other income except interest received or receivable from the account maintained by such individual in the same specified bank in which he is receiving the pension. So for example, a person is there, he is receiving his pension in his ICICI bank account. ICICI bank account. In such case, he should also be receiving only interest income, that also only through ICICI bank. Only in such case this section is going to apply. Okay. Next, individual will have to submit a declaration in form 12 BBA. So the individual, that is a resident whose age is more than 75 years, will have to give a declaration to the bank in form 12 BBA, in which the individual will be writing that I am having only pension income and interest income. Both the incomes are coming in ICICI bank only, and these are my deduction details under section 80C, 80D, etc. Now you itself collect the TDS by yourself. Okay. So if this declaration is given by the senior citizen, then what will happen? The bank will compute the income and tax of the individual after considering all the deductions under section 80C to 80U. They will consider the rebate under section 87A, and also while receiving the pension, if any TDS is already deducted on the pension, that TDS also they have to consider. After considering this, whatever is the balance tax payable by that individual will be deducted as TDS under section 194P. Okay. If the bank is deducting TDS under section 194P, then that resident individual need not file his income tax return. He is exempt from filing his income tax return. Okay. If conditions are not satisfied, the normal provisions as usual will be applicable. Next, section number 194Q, TDS on purchase of goods, and this has come into effect from 1/7/2021. So what happens now? If goods are purchased, then the person who is making the payment for purchase has to deduct the TDS. So every buyer who is responsible for paying any sum to a resident seller for purchase of goods or value or aggregate of such value more than 50 lakh rupees during a previous year, then is liable to deduct TDS at 0.1 percentage on the sum exceeding 50 lakh rupees. So listen here, what will happen if a buyer is buying goods of more than 50 lakh rupees, then on the amount in excess of 50 lakh rupees. So it means for the first 50 lakhs no need to deduct the TDS, only if the amount is more than 50 lakhs, on the excess amount alone deduct TDS at 0.1 percentage. 0.1 percentage. Okay. Now, this deduction is to be made on payment or credit, whichever is earlier. Next point, TDS under section 194Q is not applicable if TDS is deductible under any other provision, or TCS is collectible under section 206C except section 206C 1H. Hence, if any other TDS section will apply, then this TDS section will not apply. And also, if there is any TCS section, okay, other than 206C 1H, then also that section you have to see, don't see this section. Fine. This priority once again I will tell you in the end of this particular video, you will be able to understand. Next, listen. Hence, if both 194Q and 206C 1H that we are going to study are applicable on the same transaction, then 194Q will be applicable. Don't apply 206C 1H. Next, buyer means a person whose turnover or gross receipts from a business was more than 10 crores in the immediately preceding previous year. Hence, if a person's turnover, okay, was more than 10 crores in the immediately preceding previous year,
only such person need to deduct the TDS. Others are exempt from this section or need not deduct the TDS. Buyer does not include any person who is notified by central government. Now see here, there is a transition provision, correct? The TDS is applicable from 1st of July 2021. So here we have to be very careful. While calculating the limit of 50 lakhs, you have to calculate from 1st of April onwards. But however, while calculating the TDS amount, you have to calculate from 1st of July onwards. So you have to be very careful. In detail, we have seen the examples in the classes. You will be able to understand. Next, TDS is applicable on purchase value, hence it is net of GST. TDS is not applicable on GST amount. So if there is 100 rupees plus 18 rupees GST, TDS will be applicable on only 100 rupees. It is not applicable on 18 rupees GST. Next, if PAN of the payee is not available, then deduct TDS at 5%. Generally, TDS rate is 0.1%. However, if the payee is not giving the PAN number, then deduct the TDS at 5%. Okay. Now listen. This section is also not applicable if transaction is done through recognized stock exchange. Next, this section is not applicable in case of a non-resident buyer, except where non-resident buyer is having PE in India and purchase relates to that particular PE. PE means what? Permanent establishment. So, to a non-resident, 194Q will be applicable only if that non-resident is having a permanent establishment and the purchase of goods is related to that permanent establishment. In other cases, a non-resident need not deduct the TDS. Next, if seller's whole income is exempt under Section Income Tax Act, then TDS will not be applicable. If buyer whole income is exempt, then TCS under Section 206C1H will not be applicable. Okay. Next, in the year of incorporation, this TDS section will not be applicable. So this was the TDS section under 194Q. You have to be very thorough since it's a fairly new provision.
Now let us discuss section number 194R, that is benefit or perquisite in the course of business or profession. So when a person is giving a benefit or perquisite in course of business and if it crosses 20,000 rupees per annum, then on the entire value TDS has to be deducted at 10%. What is the TDS rate? 10%. However, this section is covered in hijack provisions. So now hijack will become what? Hijack R, because 194R is also covered there, which means if there is an individual or HUF whose turnover or gross receipts in business or profession, as the case may be, is up to 1 crore or 50 lakhs in the preceding previous year, then such individual or HUF need not deduct the TDS. You get my point? And one more special point, like 194B and 194BB, if at all the the benefit or perquisite is given in kind and there is no cash to pay the TDS, then the deductor has to ensure that the deductee has paid the TDS to the government and then only the person can release the benefit or perquisite. You get my point? I hope you are clear.
Next, this we have already studied, but I am revising once again. Generally, TDS is deducted on payment or credit, whichever is earlier, but for certain sections alone, it is deducted only on payment basis. What are those sections? Section 192, which discusses about salary, 192A, withdrawal from provident fund, 194DA, life insurance policy, receipts, 194LA, compulsory acquisition, 192 and 192BB, that is winnings income, 194, that is dividend income, 194N, that is cash withdrawal. So for all these sections, TDS will be deducted on payment basis. Next. Okay. After deducting the TDS, the deductor is required to pay only the net amount to the deductee. Hence, the TDS deducted is also considered as income of the deductee. So here you should not get confused. So see here, if Mr. A is responsible to pay Mr. B 1 lakh rupees as interest. So what he will do? He will give 90,000 rupees to Mr. B and 10,000 rupees, that is 10%, he will give to the government as TDS. Correct? So now what is the income of Mr. B? Income of Mr. B will be this 90,000 rupees plus the 10,000 rupees. So income is how much? Income is equal to 10,000, 1 lakh. Hence, what I am trying to tell, this TDS of 10,000 will also be included in the income of Mr. B. Mr. B will not, cannot tell that I have not received this 10,000, that is why it is not my income. Like that, Mr. B cannot tell. Okay. Now, let's see section 206AA. Section 206AA. If the payee does not furnish the PAN number to the payer, then TDS has to be deducted at rate as per the section or 20 percentage, whichever is higher. So higher rate of TDS if there is no PAN submitted by the payee. What is the higher rate? Rate as per section or 20 percentage, whichever is higher. However, in case of 194Q and 194O, it is not 20 percentage, it will be 5 percentage. We have already discussed. And in case of 192A, it will be maximum marginal rate. This also we have already discussed. And in 194IB also we already discussed that the TDS amount cannot exceed the last month rent. TDS amount cannot exceed last month rent.
Now let us discuss section number 206AB and 206CCA. 206AB relates to TDS and 206CCA relates to TCS. So what happens is that if TDS or TCS, in case of TDS or TCS, if payee or collectee has not filed the income tax return for the last previous year for which the due date is over before the current previous year. So for example, what is happening? Let's say for previous year 22-23, we should see whether the TDS should be deducted or not. So which previous year return we should see? Previous year 2021. Because for 2021 only, the due date of filing of income tax return will be over before 22-23. So in previous year 2021, we should see number 1, whether the TDS or TCS was more 50,000 or more. 50,000 or more. If it was 50,000 or more, we should also see whether the person for whom the TDS is being deducted or TCS is being collected has filed their income tax return. So whether it is filed or not. If they have filed their income tax return, no problem. But if they have not filed their income tax return, then the TDS or TCS will be twice the TDS or TCS rate or 5%, whichever is higher. Twice the rate or 5%, whichever is higher. Okay. However, this section is not applicable for section 192, which relates to salary, 192A, which relates to employee provident fund withdrawal, 194B and BB, which relates to winnings, because already for winnings TDS is 30%. Why to do it at twice the rate? Okay. Then 194IA, IB and and M. 194IA, 194IB and M, which relates to immovable property, rent, which is the special section for rent, and special section for commission, professional fees and contract. Okay. And then also cash withdrawals. So for all these sections, this section will not apply. For remaining all the TDS sections, this section will apply. So if the return for if the due date for income tax return is over before the previous year, and in that year if the income tax return was not filed and TDS or TCS was above 50,000 rupees in that year, then in this year, that is the previous year 22-23, TDS or TCS will be twice the rate or 5%, whichever is higher. Okay. And also this section is not applicable to a non-resident who is not having a permanent establishment in India. I hope you are clear.
Next. All these small provisions you learn from the material itself. Now let us discuss other provisions. What is the due date to make the payment of TDS? Due date to make the payment of TDS is 7 days from the end of the month of TDS, and in case of March month alone, it will be 30th of April. Okay. In case of TCS, it is always 7 days from the end of month of collection of TCS. Next, due date of filing of TDS return. For the first quarter, that is quarter ending on 30th June, the due date is 31st July. For TCS, the due date is 15th July. For the second quarter, it is 31st of October. For TCS, it is 15th of October. For the third quarter, it is 31st of Jan. For TCS, it is 15th of Jan. For the fourth quarter, the TDS due date is not 30th of April, it will be 31st of May. That means 1 month extra is given for the last quarter. Okay. And for TCS, it will be 15th of May. Next, due date to furnish TDS certificate. So the person who is deducting the TDS has to furnish TDS certificate to the person from whom he has deducted the TDS. For salary, the TDS certificate due date is 15th of June, and for other than salary, it is within 15 days from the due date of furnishing the TDS return. Next, for section 194IA, 194IB and section 194M, there are some special provisions. Generally what happens when TDS is deducted, the person who is deducting the TDS has to get a TAN number, that is tax deduction and collection account number. Using this TAN number only, he is going to file his TDS returns, okay, and give the TDS certificate. But for 3 sections, TAN number is not required. PAN number itself is enough. That means permanent account number itself is enough. What are those 3 sections? 194IA, that is immovable property. 194IB, that is the person who is paying the rent other than 194I, and then 194M, that is contract, commission, and professional service, which are not covered under the other sections 194M. So for these 3 sections, there is a different method to deduct and pay the TDS and file the TDS returns. So what is that method? Let us see. First and foremost, no TAN is required for the person who is deducting the TDS under 194IA, 194IB, and 194M. The payer can deduct the TDS using the PAN number itself. TDS has to be deposited within 30 days from the end of the month in which it was deducted. So normal due date won't apply, special due date will apply. What is the special due date? 30 days from the end of the month in which the TDS was deducted. And for the return also it is the same due date. For payment also same due date, for return also same due date. Okay. And return is form 26B in case of 194IA, 26QB in case of 194IA, 26QC in case of 194IB, and 26QD in case of 194M. It is the income tax form, TDS form. TDS certificate shall be submitted to the payee within 15 days from the due date to furnish the TDS return. Okay. Hence, the due date to furnish the TDS certificate is what? Within 15 days from the due date to furnish the TDS return. Okay. So these are the special provisions for 194IA, 194IB, and 194M. Next, let us discuss what will happen if TDS is not deducted or not paid. If TDS is not deducted or not paid, then the person who is required to deduct the TDS will become assessee in default. However, the person can escape if the person who is receiving the payment, okay, is a resident and he has paid the taxes and furnished the return of income, and he has included the amount of payment in the return of income and also gets a certificate from a chartered accountant. So if these 3 conditions are satisfied, then the deductor will not be considered as assessee in default. However, from the date of deduction till the date of filing of return by the payee, interest has to be paid at 1% per month or part of the month. Okay. The same provision we have also discussed when we were discussing disallowances in PGBP chapter. Okay. You have to link with that. Now, interest for delay in deduction or payment of TDS. So if TDS deduction or TDS payment is delayed, then interest will be applicable. What will be the interest? First, if TDS is deducted or deducted but not paid, then in such case, simple interest at 1% per month or part of the month of late deduction. That is, from the date on which TDS was deductible till the date on which TDS was deducted. So from deductible till the TDS was deducted for the entire period, 1% per month or part of the month. Next, 1.5% per month or part of the month, okay, in case of late payment. Hence, from the date on which the TDS was deducted till the date on which the TDS is paid. The date on which TDS is deducted till the date on which TDS is paid. You have to calculate 1.5% per month or part of the month for non-payment of TDS. Okay, or TCS as the case may be. Next, 234E, fee for default in furnishing TDS return. If TDS return is not furnished on time, then late fees has to be paid at 200 per day till the default continues. However, maximum fees cannot exceed the TDS amount. So it is 200 per day or amount of TDS whichever is lower.
So firstly, let us discuss the changes in salary TDS, that is section number 192. So there is no major change as such in this section. There is only one update. What is the update, sir? In this section, actually we are going to learn in the next video that now the tax rates have been changed. Okay, so now the new tax regime has become the default tax regime, and the old tax regime has become the optional tax regime. So the Income Tax Act has switched both the tax regimes. That is why now the employer should ask each and every employee before deducting the TDS which tax regime the employee is going to choose. Whatever tax regime the employee chooses, under that tax regime TDS has to be deducted. You get my point? Sir, what if the employee does not choose any tax regime? In such case, the employer will deduct TDS under the default tax regime, that is section 115 BAC. So if employee does not choose the tax regime, employer should deduct tax under default tax regime. Wherever you find space, you can note this small point down. We will also discuss the same when we will be discussing section 115 BAC in the next video. Okay, now let's come to the next provision, section 192A, which is relating to withdrawal from EPF, the TDS that is deducted on withdrawal. Earlier we learned that if PAN number of the person who is receiving the payment is not given, then TDS will be deducted at MMR, that is the maximum marginal rate. However, now the MMR provisions have been removed, so the normal provisions which is relating to other sections of TDS will also apply to section 192A. So let us discuss in section 206AA. In section 206AA, it is given, right? If PAN is not mentioned, then what will happen? In this section, I have given a special point relating to 192A. You please strike this point off. Fine. So for 192A also, the normal provisions will apply if the PAN number is not mentioned by the payee. So this is a small amendment. Now let's go to the next amendment, section 193. Section 193 deals with TDS which will be deducted on interest on securities. In that, we had earlier studied that if it is a listed demat security, then no need to deduct the TDS. However, now this exemption has been removed. Hence, even if it is a listed demat security, TDS will be deducted. Okay, so this is one update. Please make the change. Now let's come to section 194B. Section 194B relates to winnings from lottery, crossword puzzles, card games. Correct? Now what has happened? There are a few changes that have been made in the section. What are the changes? Now the section specifically mentions betting and gambling also. So if there is any winnings from betting and gambling, that also will be covered under this section, that is 194B. Earlier also we had studied like that also, but now it is very specific that even if there is betting and gambling, 194B TDS will be applicable. Then in 194B, now online games have been removed from the section. Sir, why it has been removed? Because there is a separate section now for online games, which we will be discussing after this. So online games will not be a part of section 194B. And one more small change is that now the limit has been changed to aggregate of 10,000. So limit is 10,000 only kana, but now it has become aggregate of 10,000. So earlier what used to happen is that, for example, there is a lottery company. Okay, there is Mr. A. Let's say earlier, I am talking about earlier, what used to happen. If a person, Mr. A, won two lotteries, one lottery of rupees 6,000 and another lottery of rupees 6,000. Is there any need to deduct the TDS? Answer is no. No need to deduct TDS since the amount is within 10,000. Here also no need to deduct the TDS. But now, what we should see, what is the aggregate? If the aggregate amount throughout the year is more than 10,000, what is the aggregate amount? 12,000. So if the aggregate is more than 10,000, TDS has to be deducted. Okay. So that change is there in this section. Minor change, but it has a major impact. Now let's come to the new section, Puttam Pudiya section, section 194BA, that is TDS on net winnings from online games. Okay, so if there is any winnings from online games, we have already studied the tax rate on that, which we studied in the income from other sources amendments. Now we are discussing the TDS on winnings from online games. So TDS rate also, like the tax rate, is 30%, and here the TDS is deducted at the end of the financial year. It is deducted in between also and at the end also. We will discuss how. Okay. First and foremost, in this section there is no limit. There is no limit. So from online games, even if a person is winning 100 rupees, TDS has to be deducted on 100 rupees. You get my point? Sir, now what is this online game, sir? Online games, to understand this income, you have to understand three terms. Okay? Online gaming intermediary, user, and user account. Sir, what is online gaming intermediary? Online gaming intermediary is an intermediary that offers one or more online games. So it is only the portal, or it is only the website or platform in which a person can go and play the online games. For example, Dream 11, PUBG. I have already discussed these sites. Then, sir, who is the user? The user is only the gamer kana, the person who is playing the game and winning. So any person who accesses or avails any computer resource of an online gaming intermediary is the user. And what is user account? User account is the account of a user registered with the online gaming intermediary. With the help of that account only, the user is playing the games with the online gaming intermediary and winning the prize money or any prize or gift. Okay, on this price only TDS has to be deducted. What is the rate of TDS? Rate of TDS is 30%. Is there any limit? The answer is there is no limit. Who will deduct the TDS? TDS will be deducted by online gaming intermediary. On whom the TDS will be deducted? The payee, that is the user. Okay. So now, in case there is withdrawal from the user account during the financial year, tax would be deducted at the time of such withdrawal on net winnings comprised in such withdrawal. In addition, tax would also be deducted on the remaining amount of net winnings in the user account as computed in the prescribed manner at the end of the financial year. So now what are they telling? There are two ways in which the tax is going to be deducted. Number one, the tax will be deducted on net winnings. Net winnings. Okay. So sometimes the player wins a game and sometimes the player loses a game. Let's say, for example, a player put in 100 rupees. Okay. Then after putting in 100 rupees as fees, he won 200 rupees. He also lost 80 rupees. In one game, he won 200 rupees. He also lost 80 rupees. So what is his net winnings? The net winnings is 120. So this is only the concept of net winnings. Very logical. You have to apply your common sense. You will get the answer. So that is net winnings. Now how will the TDS be deducted? See Kanna, this net winnings is there, no? This will be showing in the user account. User account. Let us keep this net winnings example as 12,000. For example, the net winnings is 12,000. So in the user account, it will be shown as 12,000. Let's say the user now decided on 31st of May 2023 to withdraw 5,000. The user decided to withdraw 5,000. Then what will happen? When the user is withdrawing the money and transferring the winnings to his bank account, then the gaming company or the online gaming intermediary should deduct the TDS and balance only should be given to the user. So when the user is withdrawing 5,000 rupees, what will happen? TDS of 1,500. Okay, 30% of 5,000 is how much? 5,000 into 30% is 1,500, correct? 1,500 TDS will be deducted and balance money, that is 3,500 only, will be transferred to bank. Are you able to get my point? So when the person is withdrawing the money, TDS has to be deducted. Next, so now what is the balance amount, sir? Balance amount is 7,000. Now let us assume that this user has not at all withdrawn the money from his account and this money is lying in the user's account as on 31st of March 2024, that is in the year end. So whatever net winnings is there in the user account in the end of the year and the user has not withdrawn that amount, then on such amount also TDS has to be deducted and paid to the government, that is at the end of the financial year. So in this 7,000 balance also 30% TDS will be deducted, okay, which is I think 1050. So 10, am I correct? Let me check. Sorry, 2100. 30%, that is 2100 TDS will be deducted and this 2100 has to be paid to the government, okay. The dates on which we have to pay to the government is as usual like the other TDS sections, in that there is no change. Now this point we have already learnt similar point in 194B and BB. What is that point? If the net winnings is wholly or partly in kind and cash is not available to deduct the TDS, then payer shall make sure that the tax is paid by the payee before releasing the payment. So I had already taught you in that section, if winnings is given in kind, then if there is no cash available to deduct and pay the TDS, then what should the person giving the winnings do? The person should ask the receiver to first pay the tax to the government, and on showing the proof only the winnings can be given to the person. This is similar to section 194B and 194BB, which we already studied. So let us summarize section 194BA quickly. Sir, on what is 194B applicable? Answer is winning from online game. Who has to deduct the TDS? Online gaming intermediary. Who is the payee? The user is the payee on whom the TDS will be deducted. Now, is there any limit? Answer is no. There is no limit. How will the TDS be deducted? On every drawings the TDS will be deducted, and whatever net winnings is there balance in the account as on 31st of March 2024, that is year end, then TDS has to be deducted on that. So this is the section, very simple, sweet and short. I think there is no complication in this, but important from the exam point of view also. Now let's come to the next section, Karna. That is section 194N. So here also one small change. In 194N earlier, that is cash withdrawal, okay, from the TDS deducted on cash withdrawal, correct. In that we had learnt the limits. What was the limit? The limit was up to 1 crore, no TDS used to be deducted. Now for cooperative society alone, that 1 crore limit has been increased to 3 crores. 1 crore limit has been increased to 3 crores. And even when it comes to the other cases, that is earlier we used to see that if the return of income has not been filed, then 2% up to 1 crore was the case and 5% above 1 crore was the case. Here also the limit has been increased to 3 crores in case of cooperative society. Okay. Next. Okay. In section 194R and section 194Q, earlier we had learnt the big circulars, no? There were many FAQs, frequently asked the questions, which was released by CBDT, but now they have been removed from your syllabus. So no need to overcomplicate these sections. In simple way, if you learn, that is enough. Next. Okay. Now let's come to section 206AB, which is relating to TDS, and 206CCA, that is relating to TCS. Okay. So this is what the TDS provision in case of non-filers, the person who have not filed their return of income in the last previous year. For them there is a different rate of TDS, higher rate of TDS, also higher rate of TCS, which we had studied earlier. But now there is one exception in this section, extra exception. What is this exception? The exception is that now this section is not applicable on a person who is not required to file the return of income for the previous year. Very logical, because earlier we had discussed if the return of income has not been filed, then the TDS will be or TCS will be at a higher rate. However, what if the person was not at all required to file the return of income? Then why to punish such person? Hence naturally now that person is coming in the exception category. If the return of income itself was not required to be filed, then you can deduct the TDS normally or collect the TCS normally. No need to follow this section. Okay.
Next. Now let us discuss about TCS. TCS means tax collection at source. Tax collection at source. So what is difference between TDS and TCS? TDS is tax deduction at source, TCS is tax collection at source. In TDS, the payer is the deductor, hence the payer is required to deduct the TDS. However, in TCS, the seller, that is the payee, the person who is receiving the payment, should also collect the TCS from the person who is giving the payment. Next, generally it is deducted at payment or credit, whichever is earlier. It is deducted when the payment is payable by the buyer or actually paid by the buyer, whichever is earlier. Okay. Here also there are certain exceptions. There are certain exceptions. Now let us see the different types of applicability and rates of TCS. Firstly, in case of alcoholic liquor for human consumption, scrap, coal, lignite and iron ore. For all these items, TCS is 1%. Next, for timber, forest produce except tendu leaves, TDS rate is 2.5%. For tendu leaves, TDS rate is 5%. Sorry, TCS rate is 5%. Next, if the person is granting lease or license etc. of a parking lot, toll plaza or mine or quarry, in such case the TCS rate is 2%. Next, if there is any receipt of consideration on sale of motor vehicle of value exceeding 10 lakh rupees per vehicle, then TCS rate is 1%. Next, in section 206C1G, if there is any remittance outside India above 7 lakh rupees, or if there is a overseas tour package, in such case 5% TCS. Then in case of 206C1H, which we are going to discuss, 0.1% TCS. So these are all the TCS rates. TCS however will not be applicable if the buyer is a government or embassy or consulate or high commission or institution as per the United Nations Act of 1947. Okay. Next, if first three items, that is this alcoholic liquor, scrap, coal, lignite, iron ore, timber, forest produce and tendu leaves, if all these items are consumed for personal purpose, then TCS will not be applicable. TCS will not be applicable. Then TCS is not applicable if buyer is a resident and furnisher is a declaration that goods are used in the manufacturing or power generation. So if buyer is furnishing a declaration that the goods are used in manufacturing or power generation, in such case TCS will not be applicable. Next, here also there is a provision where TCS is applicable at double rate or 5%, whichever is higher, if PAN number is not furnished by the person making the payment. Okay. Now let us discuss section 206C1F. In 206C1F, that is TCS on sale of motor vehicle, what did we learn? That TCS is applicable on consideration received on sale of motor vehicle of value more than 10 lakh rupees. So value, if per vehicle is more than 10 lakh rupees, TCS has to be collected from the seller, okay, along with the sale consideration. At what percentage? Percentage we already studied. It is 1%. 1% TCS. Next, TCS will be collectible only on receipt basis. TCS is collected only on receipt basis. TCS is not applicable if sale is made from a manufacturer to a dealer. That is B2B sales, TCS is not applicable. Only for business to consumer sale, TCS will be applicable. Then TCS is applicable only per vehicle transaction, not on the full consideration during the year. This limit of 10 lakh rupees should be calculated per vehicle and not the aggregate amount. Hence, if I am purchasing 10 cars worth rupees 8 lakhs each, so total amount is how much? 80 lakhs. Should TCS be collected? Answer is no. No need to collect the TCS under 206C1F. Next, if 206C1F does not apply, only then 206C1H will apply. 206C1H will apply. Now let us discuss section number 206C1G. TCS on remittance outside India or sale of tour package with effect from 1/10/2020. So listen, when there is an authorized dealer who is receiving an amount of more than 7 lakh rupees in the previous year from a person who is remitting the amount out of India under LRS scheme of RBI, that is liberalized remittance scheme. In such case, he is required to collect the TCS at 5% in excess of 7 lakh rupees. So up to 7 lakh, no need to collect TCS. Only on amount excess of 7 lakhs, collect the TCS at 5%. Okay. The limit is to be calculated per dealer. Per dealer. So listen here. Okay. So for example, if there is a person who is giving rupees to an authorized dealer and collecting the dollars to send the dollars outside India. In such case, up to 7 lakh rupees, this authorized dealer need not collect the TCS. On excess of 7 lakh rupees, he has to collect the TCS at 5%. Okay. Next, if the remitted amount is out of an educational loan taken from a financial institution, then the TCS rate will be 0.5% instead of 5%. Generally, TCS rate is 5%. However, if the remittance is through a financial institution, is through an educational loan taken from a financial institution, then the TCS rate will be 0.5% and not 5%. Next, this section is not applicable if buyer is liable to deduct the TDS for the same transaction. Hence, if TDS is applicable, then on such transaction, this section, that is 206C1G, will not be applicable. Now, this section, that is 206C1G, is also applicable on Overseas Tour Program Package, OTPP, Overseas Tour Program Package. It means where there is a visit to any country or countries or territories outside India, including expense for travel, hotel stay, boarding, lodging, other expense, etc. So in case of overseas tour program package also, TCS has to be collected at 5%. Okay.
Now let's come to very important change, that is 206C1G, and here you are stuck in the transition provision. That is for May 24 and November 24 examination, it is compulsory that you have to learn the old provisions also, you have to learn the new provisions also, because in between the year the section has changed. Okay, so here we are discussing on TCS on the remittance outside India as per the LRS scheme, that is liberalized remittance scheme. Fine. Now a table is given below. In that table only the changes have been discussed, but what I will do is I will leave that table to you. You read that table so you will be able to understand. I am going to give you another chart, and from that chart I am going to teach you. So please, first and foremost, pause the video and copy down this chart from the screen. Okay, pause the video and copy down this chart. Done. Now let's discuss. So 206C applies to two kinds of persons. One, to authorized dealers, and second, to overseas tour program package. Okay, firstly let us discuss authorized dealer. What was the earlier provision and what is the new provision? First and foremost, when it comes to education loan nokanna, there is no change at all. Earlier also and now also, up to 7 lakh rupees there was no TCS required to be collected. Above 7 lakh rupees, 0.5% TCS. Now let's come to other than education loan, the education expense other than education loan and medical treatment outside India. Correct? Earlier also same provision, now also same provision. Earlier up to 7 lakh rupees, no requirement of TCS. Above 7 lakh rupees, 5% TCS. Now also it is the same. So where is the change, sir? The change is in the other types of payment. Okay, so whatever for other types of payment, if you are getting foreign exchange from the authorized dealer, then what was the earlier provision? The earlier provision was that up to 7 lakh rupees, the authorized dealer will not collect any TCS. Above 7 lakh rupees, the authorized dealer will collect 5%. However, from 1/10/2023 onwards, the authorized dealer will collect 20% TCS. This is one change. Now let's come to overseas tour program package. In overseas tour program package, earlier what did we study? Earlier we studied that there is no limit at all. Whatever per amount is received from the tour provider, 5% TCS will be collected. But now the provisions have changed. What are the provisions? Earlier it was 5%. So up to 30 of September 2023, what was the provision? Whatever amount it is, 5% TCS will be collected. But from 1/10/2023 onwards, the new provision is that up to 7 lakh rupee, 5%, and above 7 lakh rupee, 20% TCS will be collected. So the people who are going to a tour through overseas tour program package and spending more than 7 lakh rupees have to pay 20% extra as TCS. Okay, and there is one small point, and that is in case of international credit card transaction, these international credit card transactions are not covered in liberalized remittance scheme. Hence, on those credit card transactions, the TCS will not be collected. Okay, this is one small note. So this also you have to note down. Fine. So now I want you to go through this table, and you will have even more clarity, and this chart will be enough for you to have absolute clarity in this section and to attempt any question.
Next, section 206C1H, TCS on sale of goods and not services. So in case of sale of goods, every seller who receives an amount as consideration on sale of goods on value or aggregate of value exceeding 50 lakh rupees during the previous year, at the time of receipt, that means on receipt basis, he should collect from the buyer a sum of 0.1 percentage of the sale consideration exceeding 50 lakh rupees. So what did I tell? If there is any seller, and seller means a person whose turnover or gross receipts from business was more than 10 crores during the preceding previous year. Hence, if there is any person who is a seller, and for such seller the turnover was more than 10 crore rupees in the preceding previous year, only then such seller will be liable to collect the TCS. Now how to collect the TCS? If the consideration received from sales is more than 50 lakh rupees, then only on the excess amount, that is on the amount more than 50 lakh rupees, the seller should collect the TCS at 0.1 percentage. Okay, and here TCS is applicable only on receipt basis, in 206C1 in 194Q we learnt about purchase of goods. There we learnt the TDS should be deducted on payment or credit, whichever is earlier. However, in this section it is only on receipt basis. Okay, in that section, that is 194Q, we studied that it will be on the amount net of GST, but in this section the amount will be including GST, because you have to consider only the consideration, you should not consider the sale value. Okay, who is a buyer? Buyer is any person who is purchasing the good but does not include central government, state government, local authority, high commission, legation commission or trade representative, person importing goods. Okay, and also exports. So on import and export, this section, that is 206C1H, will not apply. Next, this section does not apply on sale of service. So it will apply only on goods. It is not applicable on services. It is not applicable on export of goods. Next, if buyer is liable to deduct the TDS, then this section will not be applicable. Hence, if TDS is applicable, this section, that is 206C1H, will not be applicable on sale of goods. Next, if there is any section of other section of TCS which is applicable, then this section will not apply. Now let me tell you about the order of priority. See here, if there is any transaction in which two or more TDS or TCS provisions are clashing, then for which TDS or which TCS provision you should consider, let us see. Firstly, you should consider the TDS sections other than section 194Q as the first priority. Hence, if TDS other than 194Q is applicable to a transaction, then take TDS itself. Don't consider any other section. Next, second priority should be given to TCS other than section 206C1H. It means what? If TCS under section 206C1H, other than 206C1H and 194Q and 206C1H, if all the three are applicable to the same transaction, you should consider TCS other than 206C1H. Okay, so for example, 206C1F and 206C1H are applicable on the same transaction, then which one you will consider? You should consider this, you should not consider this. You get my point? Next, rank 3 will be given to TDS under section 194Q and rank 4 will be given to 206C1H, which is last priority. Hence, if in the same transaction there is 194Q and 206C1H, then what will you consider? You have to consider 194Q. Don't consider 206C1H. TDS will be applicable, TCS will not be applicable. Okay. TCS is not applicable on any securities traded through recognized stock exchange. TCS is not applicable on electricity, renewable energy and energy saving certificate provided by power exchange. Also, If any fuel is supplied to non-resident airlines at an Indian airport, in such case also TCS will not be applicable. TCS is applicable only on sale consideration received. Hence, the sale amount you should ignore. You should see what is the consideration received, and on such consideration you also have to collect the TCS. Okay. Next, since only consideration is considered, no need to make any adjustment of GST, sale return, discount, etc. So you need not see what is the sale amount, what is the GST amount, what is the sale return, what is the discount, etc. etc. Just to see what is the amount that is received. If the amount received is more than 50 lakh rupees, then on the excess amount you have to collect the TCS at 0.1 percentage. Okay. Now, if buyer does not submit the PAN number, TCS rate will be 1 percentage. Generally, it is 0.1 percentage, but if buyer does not submit the PAN, it will be 1 percentage TCS. So these are all the TDS and TCS provisions that we have covered. Now remaining is what? Advance tax and interest. This advance and tax and interest I am not covering in this revision lecture. I have already made a half an hour video, that is TDS, TCS and advance tax chapter part number 7, which will be available on my YouTube channel. That video, if you are seeing, you will be thorough with the advanced tax interest provisions as well. I hope you were able to revise this TDS TCS concepts on time. So keep preparing, keep revising. See you in the next one, dear. Till then, take care. Bye bye. Hello everyone and welcome to the video. In the previous videos we had discussed in detail about the TDS provisions as well as the TCS provisions. Okay, we are done with that, and now let us start with advanced tax provisions and also interest calculation, which are small concepts. We will cover it very soon. Okay, in this video. Firstly, what is advanced tax? Advanced tax means any tax paid in the financial year immediately preceding the assessment year. What is the financial year immediately preceding the assessment year? It is nothing but previous year. So if any tax of the previous year, if it is paid in the previous year itself, then such tax is called advance tax. Okay. Now who and all are liable to pay advance tax? Okay. Before that, let us see who is not liable to pay advance tax. First thing, if a resident senior citizen who is not having PGBP income, if there is a resident senior citizen not having PGBP income, then such senior citizen need not pay advance tax. So for all the other assessees, they have to compulsorily pay the advance tax. Okay. However, if the advance tax itself is 10,000 or less, okay, sorry, if the advance tax itself is less than 10,000, then no need to pay advance tax. If the advance tax liability is less than 10,000, no need to pay advance tax. However, if it is 10,000 or more, then you have to compulsorily pay the advance tax. You get my point? So, resident senior citizen need not pay advance tax if they do not have PGBP income. For all the other assessees, they have to compulsorily pay the advance tax if their advance tax liability is 10,000 or more. Now, how to calculate advance tax liability? Very simple, Kanna. Like normal tax calculation only, you have to calculate advance tax also. Very simple. No separate formula, no nothing. You know how to normally calculate the tax, correct? On the slab rate, 0 to 2,50,000 no tax, up to 5 lakh rupees 5 percentage, up to 10 lakh 20 percentage, more than 10 lakh 30 percentage. Then add health and education sets, surcharge, rebate, relief, etc. etc. And finally, if there is any TDS or TCS, that also you reduce. Finally, what amount you are getting, it is called advance tax. Normally, income tax is calculated on the exact income, advance tax is calculated on the estimated income. Since it is paid during the previous year itself, so during the previous year the assessee might not be knowing what is the exact income which is going to be earned by him, hence he is going to estimate the income and pay the tax on estimated income. Okay, so very simple, tax on the total estimated income minus rebate or relief plus education cess, and you have to reduce TDS or TCS. You also reduce the plus surcharge also you put, plus surcharge. Fine. Now, due date to pay the advance tax. So first and foremost, if any assessee has opted for presumptive income under section 44 AD or 44 ADA, okay, which we studied in PGBP chapter, remember, if those presumptive income are opted, then advance tax has to be paid only in a single installment
of 15th March. On or before 15th March, entire amount of tax, okay, has to be paid as advance tax on or before 15th March. Okay, so generally tax is payable only in the assessment year. However, all the assessees should pay their entire tax as advance tax itself. Okay, so 44 AD and 44 ADA. The same point of advance tax I have linked there also in that particular section. If you go to 44 AD ADA and you see the provision, you will get to know. Here also you write link chapter 4C. Okay. Now, what about the other assessees? What about the other assessees? Assessees other than mentioned in 1 above. They have to pay the advance tax in 4 installments. 4 installments. On 15th June, they have to pay 15 percentage, 15th September 45 percentage, 15th December 75 percentage, and on or before 15th March 100 percentage advance tax. Kanna, on 15th June, how will I know what is going to be my income during the year? It is very difficult, but however, we have to estimate what is going to be the total income. On that estimated income, we have to calculate the tax. On that tax, 15 percentage has to be paid as advance tax. Okay, for example, as on 15th June, I am estimating that my tax is going to be 1 lakh rupees. Okay, I'm estimating that my tax is going to be 1 lakh rupees estimated tax. On this estimated tax, I have to pay how much? 1 lakh into 15 percentage, which is 15,000. Okay, so on 15 June, I am estimating that my tax during the year is going to be 1 lakh rupees. First, you have to estimate the total income. On that, you have to calculate the tax. Now, I am not doing that much. Directly, I am telling you the tax amount. Okay, tax amount, let's say if it is 1 lakh. Now, let us come to 15th September. In 15th September, no, I feel that my tax is only going to be 90,000 rupees. I feel that my income is reducing day by day. So during the year, during the entire year, my income is only going to be 90,000 rupees. So how much should I pay? I should pay 90,000 into 45 percentage, which is how much? 40,500. 40,500. But Kanna, I have already paid 15,000, correct? Since I have already paid 15,000, I can reduce that amount and I have to pay only the balance. That is 25,500. So I paid in the first installment, how much did I pay? 15,000. In the second installments, how much did I pay? 25,500. Now let's come to third installment. Third installment is 15th December. On 15th December, now I have a strong feeling that my tax is going to be 1.5 lakhs because income has started increasing. I have a strong feeling that tax will be 1.5 lakhs during the year. So now how much should I pay? 1.5 lakhs into 75 percentage is equal to how much? 1,12,500. Okay. However, we have already paid how much? We have already paid 40,500. So now how much should we pay? We only have to pay 72,000. You only have to pay 72,000. You get my point. Now, when it comes to 15th March also, I estimate that my tax is going to be 1,50,000. Because 15th March, we will almost know what is going to be our tax liability because only 15 days are left during the year. So, 1,50,000 into 100 percentage, I have to pay as advance tax. So it will come to 1,50,000. But however, already we have paid how much? 1,12,500. So balance only we have to pay, which is 37,500. So hence, like this, at each and every installment we have to estimate our total income we have to calculate the taxes. From this taxes we should reduce the TDS TCS if there is any, and on the balance amount we have to calculate 15 percentage, 45 percentage, 75 percentage or 100 percentage as the case may be, and pay it to the government. Already if there is any advance tax that is paid, that we can reduce, and only the balance amount we have to pay it to the government. You get my point? This is the concept of advance tax. Now let us see the other points. Income shall be estimated at every date of payment, which I already told you. 15th of June, September, December and March. Every date we have to estimate our income. Any amount paid as advance tax on or before 31st March is treated as advance tax paid. Kana, the due date to pay the advance tax is 15th March. But here it is written that if any money is paid on or before 31st March, it will be treated as advance tax. Why is it so? I will tell you in a few minutes. Okay. If any assessee does not pay any installment before the due date, he is deemed to be assessee in default. If assessee does not pay it before due date, he is deemed to be assessee in default and he has to pay the interest on the advance tax. Okay. Next. If any unexpected income arises after the due date of any installment, then advance tax payable on such income can be paid in the remaining installments or by 31st March of the previous year if no such installment is remaining. That is why 31st March is given. So, unexpected income. What is unexpected income? Unexpected income means capital gains, winnings income, PGBP income which arises for the first time, and dividend. I have given greater than 10 lakhs, you please strike it off, just dividend. Okay. Capital gain, winnings, it can be any winnings. Okay. Winnings from lottery is just an example. It can be any winnings. PGBP income which arises for the first time, and dividend. So such incomes are there, no? It is not possible to estimate before itself. When it comes suddenly. Hence it is called unexpected income. So if any unexpected income is coming after the due date, then the advance tax on such unexpected income you pay it in the remaining installments. Or if let's say unexpected income itself came on 18th March, okay, however advance tax installment is over, correct? In such case the advance tax on the unexpected income can be paid on or before 31st of March. That is why it is given 31st of March also will be treated as advance tax. Okay, so you should estimate the income step by step. Okay, and you have to pay the advance tax. However, if there is any unexpected income because of which your income is increasing, on that increased income you can pay the advance tax in the remaining installments, no problem. Okay, so if there is any unexpected income because of which the income is increasing, and if you are paying the increased advance tax in the remaining installment, no need to pay any interest. Okay, no problem. Next, if entire amount of advance tax is paid on time, then interest under 234B and 234C shall not be applicable. So no interest will apply. If you pay your advance tax on time, 234B interest and C interest need not be paid. Now comes the question, what is this 234B, 234C interest? So with this we will jump to interest calculation. Okay, let's first come to section 234C interest. We will go in reverse order. Okay, 234C interest is the interest for deferment of advance tax. If the advance tax is not paid within the time frame, then interest has to be paid on the shortfall. Okay, firstly let us see the people who have chosen presumptive taxation. If the people who have chosen presumptive taxation, they need to pay 100% of the amount as advance tax only in a single installment on or before 15th March. Correct? Hence, if they are not paying the entire amount, or if they are paying only less amount as advance tax, then on the difference, that is advance tax payable minus advance tax already paid, they have to pay interest of 1%. Okay, 1% under section 234C, 1% interest. Why 1%? Because it is only 1 month. 15th March is the due date. Okay, so till 31st March they have to pay only 1% interest, that is 1 month. What if what about the interest after 31st March? What about the interest after 31st March? It is not covered in this section, it is covered in the other section which we will study. Fine. Now let's come to the assessees who do not opt for presumptive taxation. Okay, if the advance tax liability is itself less than 10,000, then interest and all will not apply. No need to pay advance tax, no problem. But if it is 10,000 or more, and if advance tax is not paid correctly, then interest will apply. Firstly, 15th June is the due date by which advance tax of 15% has to be paid. If 15% is not paid, okay, if only less is paid, then on the shortfall, that is advance tax payable minus advance tax paid, simple interest has to be paid at 1% per month for 3 months, okay, from the shortfall of 15%. Similarly, 45% installment 1% per month for 3 months. Similarly, for 75% also this will allow, this will be there. And for 100% installment also same provision, simple interest at 1% per month for 3 months. However, see, in June month it is very difficult to estimate my total income, correct? Very difficult. Hence the act is telling that instead of 15 percentage, even if you pay 12 percentage, no problem, at least pay 12 percentage, at least you have to have been paid 12 percentage, at least you should have paid 12 percentage, then no problem. If it is even below 12 percentage, then for the shortfall from 15 percentage itself, pay the entire amount as interest. Similarly, before 15 September we have to pay how much advance tax? 45 percentage. But the act is telling, see, on September very difficult to calculate the estimated income, very difficult to calculate the estimated tax, because who knows what is going to happen in future. Hence, even if the advance tax paid is up to 36 percentage of the final tax, then no need for any interest. If it is even below 36 percentage, then we can't do anything, pay tax, pay interest on the shortfall. Okay, now let us see the practical example how this interest will apply. I'm going to quickly explain. See, here look, final amount of tax is what? Let's say the final amount of tax came to 1,50,000 itself. Final amount came to 1,50,000 itself. Now, in the first installment, now how much I should have paid? How much I should have paid? 1,15,000 into 15 percentage, which is 22,500. But how much I actually paid? I actually paid only 15,000. Now, first see whether this 15,000 is at least 12 percentage. How to calculate 12 percentage? 1,50,000 into 12 percentage. It is how much? 18,000. If I would have paid the advance tax of at least 18,000, then this interest section will not apply. However, since my advance tax was even below 18,000, no, now advance tax interest has to be paid on the deferment of tax, shortfall of tax. Now how to calculate the shortfall? Shortfall is 22,500, which should have been paid, which was advance tax payable. This is payable, and 15,000, which is the actual advance tax paid, minus 15,000, which is how much? So difference is only shortfall, which is 7,500. So 7,500 into 1% into 3 months, I have to pay it as interest under section 234C into 1% into 3. So the interest will be how much? 225 rupees. You get my point? So interest will be 235 rupees. Now let's come to the next installment. In next installment, how much is payable? What is the final tax? Final tax is 1,50,000. 1,50,000 into 45 percentage is how much? 67,500. 67,500 should have been paid. But how much I did pay? I paid only 40,500. Firstly, let us see it is within the flexible category or not. What is the flexible category? It is 36%. So 1,50,000 into 36% is what? 54,000. 54,000. Had this installment been at least 54,000, no, escape, no need to pay the interest. But since it is even below 54,000, now we can't do anything. Interest should be paid. What should be the interest amount? See, first you should calculate the difference. What is the difference? 67,500 minus 40,500, which is 27,000. 27,000 into 1% into 3 months, which is how much? 810 rupees interest should be paid under 234C. Okay. Now let's come to third installment. In third installment, they have to pay 75 percentage. How much is 75 percentage? 72,000. Sorry, 1,12,500. How much have they actually paid? 1,12,500, which is perfect. So no interest applicable. Similarly, they had to pay the entire amount on or before 15th March. How much did they pay? Yes, they paid the entire amount, hence no interest applicable. You got my point? Now, one more point let me clarify. See, here we saw that interest is payable at 225 rupees and 810 rupees. If this interest is coming due to unexpected income, if this interest is coming due to unexpected income, then interest will not apply. If it is not due to unexpected income, then interest will apply. You got my point? I hope with the help of this example you are clear with 234C interest. Now let us jump to 234B. 234B. Interest on non-payment or short payment of advance tax. So this is also for non-payment or short payment of advance tax, but here let us just see when will it apply. If no advance tax is paid, or if advance tax paid is less than 90 percentage of the assessed tax, less than 90 percentage of the assessed tax, only then 234B interest will apply. You get my point? See, for here example, I took this example, no? Had I paid total, how much is the tax? 1,50,000. 1,50,000. If I had paid 1,50,000 into 90 percentage is how much? 1,35,000. If I had paid 1,35,000 at least as advance tax, the tax is coming at 1,50,000. If I would have paid at least 90 percentage as advance tax during the year, then 234B interest will not apply. 234B interest will not apply. Only if it is less than 90 percentage, 234B interest will apply. You get my point? So what am I trying to tell? In this case, which I already told you, if the advance tax that I would have paid during the year, if it was 1,35,000 or more, then I need not pay 234B interest. 234C interest will however be applicable. 234B interest I need not pay. Okay. If it is less than 1,35,000, then compulsorily I have to pay 234B interest. Now, what is 234B interest? ROI means not return of income, it is rate of interest. Okay. Rate of interest is simple interest at 1% per month or part of the month, and it is amount of assessed tax minus amount of advance tax from first day of the assessment year till the date of filing return of income. Till the date of filing return of income. So in this case, let us assume that the advance tax paid was 1,30,000 advance tax. Let us assume that the actual tax is 1,50,000. Is the advance tax less than 90 percentage? Answer is yes. So will 234B interest apply? Answer is yes. 234B interest will be applicable. it will be applicable for 1% per month or part of the month till the return of income is filed. So let's say if I filed the return of income on 31st of July 2021, then the interest will be applicable from 1/4/2020, that is first day of the assessment year, till the date of filing return of income, that is 31st of July 2021. So how many months? April, May, June, July, 4 months. So 20,000, that is the shortfall, into 4 into 1%. You get my point? It will be the interest under 234B. How much is the amount? 800 rupees. 800 rupees should be payable as interest. So if the advance tax was 1,30,000 during the year, and if the actual tax is coming to 1,50,000, then on the difference amount, firstly, if the advance tax is within 90%, no problem. If it is only less than 90%, then interest will apply. The interest will apply from 1/4/2020 till the date of filing the return. Let's say the return is filed on 31st of July 2021, then interest will be for 4 months at 1% per month or part of the month, that is 800 rupees. Okay, got my point? Now let us come to 234A interest. 234B and C both are related to advance tax. Okay, 234C is when advance tax is not payable within the year, and 234B relates to the next year. Fine. Now 234A. 234A is interest for delay in filing return of income. So if return of income is filed late, then two things will happen. First thing, 234A interest will apply, and then 234F fees will also apply, which we will study in some time. Okay. So when will 234A will apply? When return of income is filed, or return, if no return of income is filed, or return of income is filed after the due date. What is the rate of interest? You please write here rate of interest itself, so that you don't get confused. Okay. Rate of interest is what? Simple interest at 1% per month or part of the month on tax, actual tax minus TDS minus advance tax, from the next day following the due date of the filing return of income up to, if the return of income is filed, then from the due date till the date of filing return of income. If the return of income has not been filed, then from the due date of filing return of income till the date of assessment, interest should be paid at 1% per month or part of the month. On what amount interest should be paid? Actual tax minus advance tax minus TDS or TCS. If at all there is any amount, then on such amount interest should be payable at 1% per month for part of the month, from the due date to file the TDS return till actual date of filing TDS return. Okay, got my point? Interest under 234A is not applicable on self-assessment tax paid on or before the due date of filing return of income. So if entire tax is itself paid on or before the due date, then this interest on 234A will not apply. So this 234ABC timeline, how will it be, you know? Okay, let's say 1/4/2020. Here there is 1/4/2021. Okay, then let us keep this as 1/4/2022. So previous year is 2021, assessment year is 2022. If any amount, there is a delay during this period, okay, or sorry, and due date is 31st of July, due date is that 31st of July, and date of return of income, actual date of filing return of income, let's say it is 31st of October. 31st of October only return of income was filed. Then, you know, for this period 234C interest will apply. For this period 234B interest will apply, and for this period 234A interest will apply. You get my point? This is the timeline for 234A, B and C. So 234C is during the year itself, 234B is from the next day of the previous year till the actual date of payment of tax. Okay. till the actual date of payment of tax, no? So it is not till the due date. Let me just confirm it. Okay, till the date of filing return of income only. Till the date of filing return of income. So 234B tax is till here, and then 234B is not till here. 234B is till here. Okay, so this is the timeline. 234C is during the year, 234B is till you file the return of income, and 234A is from the due date till you file the return of income. Okay, 234C is for the shortfall in advance tax. 234B also is for the shortfall of advance tax. However, if the shortfall is if the advance tax paid is 90% or more, then no need to pay the 234B interest, and 234A interest will apply if the return is filed after the due date, and it will be applied on the tax paid minus the advance tax minus the TDS or TCS if any. So only on the balance amount this will apply. Only on the balance amount the 234A interest will apply. If you want, you can draw this timeline for your future reference. Now let's come to section 234F, last section in this particular chapter, fee for default in filing return of income. If return of income is not filed within the time limit under section 139(1), then fee payable shall be 5,000 rupees if return of income is filed on or before 31st December, and 10,000 rupees in any other case. If total income is up to 5 lakhs, the fee payable shall only be 1,000 rupees. So what they are telling, let's say the due date to file the return of income is 31st of July. Okay, if the return of income is filed after the due date, let's say if it is filed on 31st of August, then on the income tax you have to pay 234A interest. Okay, however, you also have to pay late fees. What is the late fees? 5,000 rupees under section 234F. So you have to pay 5,000. Now 31st of December also went by. Let's say if you are filing the return of income only on 31st of January. 31st of January only you are filing the return of income, then you have to pay late fees of 10,000 rupees. Then you have to pay the late fees of 10,000 rupees to file the return of income. So if you are filing the return of income late, then the assessee has to compulsorily pay the late fees under section 234F. The fees will be 5,000 rupees if the return is filed on or before 31st December. Okay, if it is filed after 31st December or if it is not filed at all, then the fees will be 10,000. You get my point?
Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video we are going to quickly revise the special income tax rates for assessment year 24-25. Then we will revise the special surcharge rates, and lastly we will also discuss section 115 BAC, which is the new tax regime. Okay, so firstly let's come to special tax rates. Sir, what is so special about these special tax rates? The special thing is that this tax rate is mentioned in that section itself. Because of this, whether the assessee is choosing old tax regime or new tax regime, it does not matter. The tax rate will remain the same. Okay, so these special tax rates we had already discussed in different revision lectures. Now we are discussing once again, so I am just brushing up very quickly. So firstly there is section 115 BBE, which taxes undisclosed source of income, which is what? Unexplained money, investment, expenditure, bullion, jewelry, etc., under section 68 to section 69D. So what is the tax rate? The tax rate is 60% plus 25% surcharge plus 4% health and education cess. Next tax rate is under section 115JC, which talks about alternate minimum tax, that is AMT. First and foremost, AMT is only applicable to old tax regime and not applicable to new tax regime. You should also remember that if there is new tax regime under section 115 BAC, which is the default tax regime now, then old AMT credit also will lapse. Okay, so what is the AMT rate karna? AMT rate is 18.5%. In case of cooperative society, it is 15%, and in case of International Financial Service Center IFSC, it is 9%. Then let's come to capital gain. In capital gain, first section is section 111A. 111A deals with short-term capital gain. Short-term capital gain in case of transfer of equity shares in a company, equity-oriented fund and business trust. There are some other conditions also which we had discussed with that section. So what is the tax rate? The tax rate is 15%. Then section 112A. Similarly, there is for long-term capital gain on transfer of equity shares in a company, equity-oriented fund and business trust. The tax rate is how much? 10%. However, it is 10% above 1 lakh rupees. So on the first 1 lakh rupees, there will not be any tax. Above 1 lakh rupees, there will be tax at 10% only under section 112. So all the other remaining long-term capital gain is covered under section 112, which tells that the tax rate is 20%. So 112A is 10% above 1 lakh rupees and 112 is 20% for general long-term capital gain. Then we discuss section 115BB, which discusses winnings from lottery, crossword puzzle, races including racehorse, card games of any other sort, betting and gambling. For this, the tax rate is how much karna? It is 30%. Okay, and there is a new section, that is 115BBJ, that is net winnings from online games. In this case also the tax rate is 30%. Now when it comes to section 115BBE, 115BB and 115BBJ, you have to be very careful since these are some negative type of taxes. That is why no basic exemption limit is allowed for the individual or HUF. Then no loss is allowed to be set off, no deduction is allowed, and the loss is also not allowed to be carried forward. So these you have to be very, very careful. Next, let's talk about buyback. Firstly, what is the tax rate on how to calculate the value of income? It is tax on buyback price minus issue price. So the income is what? Buyback price minus issue price. And what is the tax rate? It is 20% tax plus 12% surcharge plus 4% health and education cess. So this covers all the special tax rates. Now let us discuss the special surcharge rates. Sir, what is this special surcharge rate? Special surcharge rate means for certain incomes like dividend, 111A, 112 and 112A, the surcharge is capped at 15% only. The surcharge cannot go more than 15% for these types of income. So how you are going to calculate the surcharge karna? Firstly, see if the total income is more than 2 crores or not. If the total income is not more than 2 crores, you need not see this section at all. You calculate normally. Okay, the surcharge you calculate normally. But if the total income is more than 2 crores, then you have to divide the total income into two parts karna. What are the two parts? The first part is dividend, 111A, 112 and 112A income. That is first part. And second part is income other than dividend, 111A, 112 and 112A. Now see the income which is other than dividend, 111A, 112 and 112A. If it is up to 2 crores, then on the entire income the surcharge will be 15%. Now if the income other than dividend, 111A, 112 and 112A is more than 2 crores but up to 5 crores, then on the normal income the surcharge is 25%, but on the dividend, 111A, 112 and 112A income, the surcharge will be 15%. Similarly, if the income other than dividend, 111A, 112 and 112A is greater than 5 crores, then on normal income the surcharge will be 37% in case of old tax regime, 25% in case of new tax regime. Okay, 37% in case of old tax regime, 25% in case of new tax regime, and in case of dividend, 111A, 112 and 112A income, it will be how much? 15%. Here you can keep it 37/25. 37 in case of old regime, and 25 in case of new regime, that is 115 BAC. Fine. So this is done. Now you might all get a query that in case of dividend income, it is very difficult to segregate because dividend income is also taxed at normal tax rate. So in such case, for dividend alone, you have to find out proportionate surcharge. How to calculate proportionate surcharge? I have given you an example. Now in revision lecture, I am not going to be discussing that. So you can take a you can pause the video and you can take a screenshot of this page to understand the example if you want. Fine. Now let me come to the very important part, that is section 115 BAC. So Kanna, for every taxpayer there are two tax regimes, the old tax regime and the new tax regime. Old tax regime is only the normal provisions or the normal tax rates. This normal tax rate only I had discussed in the first revision lecture. Now in this revision lecture I am going to discuss the new tax regime, and now this new tax regime is very important because this new tax regime has become the default tax regime. Karna, default tax regime. And what is the section that deals with new tax regime? It is section 115 BAC. Section 115 BAC. So now the new tax regime is the default tax regime and old tax regime has become the optional tax regime. New tax regime is default and old tax regime is optional. Okay, so now let us study what is given in the new tax regime. What is the major difference between old regime and new regime? In old regime, the tax rates are high, but the exemption and deduction is also high. But in the new tax regime or default tax regime, the tax rate is a little bit low, but certain exemptions and deductions are not allowed in the default tax regime. So now let us discuss what are all the tax rates in the default tax regime and what are all the exemptions and deductions that are not allowed in the default tax regime. So firstly, for whom and all this default tax regime is applicable? It is applicable to individual, HUF, AOP, other than cooperative society, BOI and AJP. So individual, HUF, AOP, BOI and AJP, whether they are resident or non-resident, default tax regime is applicable to them. Okay. However, to cooperative society is not applicable, Karna, because for them there is a separate tax regime. Okay. Now, is this default tax regime applicable on special rate of income? Answer is no. It is only applicable on the incomes that is other than special rate of income. So what and all we discussed before, that is 111A, 112A, etc., that will all remain the same as it is. It will not change. So for all the normal incomes, what is the tax rate? Up to 3 lakh rupees, no tax. Up to 3 lakh rupees, no tax. And here be very careful, here there is no senior citizen, super senior citizen concept. Okay, so for everyone up to 3 lakh rupees, no tax. Above 3 lakh rupees, up to 6 lakh rupees, 5%. Above 6 lakhs, up to 9 lakhs, 10%. Above 9 lakhs, up to 12 lakhs, 15%. Above 12 lakhs, up to 15 lakhs, 20%. And above 15 lakhs, 30% tax. Now be very careful, there is no 25%. After 20, there is directly 30% tax. So that you have to be very careful. So this is the tax rates. Sir, what about surcharge? Surcharge is same, Karna. In the old tax regime as well as new tax regime, surcharge is same. However, the 37% surcharge is not applicable to the default tax regime. So maximum surcharge is how much? 25%. So if the total income is above 2 crores, the surcharge will be 25%. Okay, now let us quickly see what are all the deductions and exemptions that are allowed in the old tax regime but not allowed in the default tax regime. Okay, so first is section 10 clause 5, that is leave travel concession, which we studied in salary chapter. Then section 10(13)(a), house rent allowance, also not allowed. Then section 10 clause 14, the special allowances that are given in section 10 clause 14 are not allowed, but 4 allowances are there which are allowed as exemption in both old tax regime as well as new tax regime. What are those 4? Transport allowance, conveyance allowance, travel allowance and daily allowance. Come on, say once again. transport allowance, conveyance allowance, travel allowance and daily allowance. These 4 allowances are allowed as exemption both in old tax as well as new tax. Okay, so there is no change. Next, section 10 clause 17, daily allowance given to or constituency allowance given to MP or MLA. So this is not allowed in the default tax regime. Then section 1032, minor exemption also not applicable in the default tax regime. Then section 10 clause AA, the exemption for or deduction for special economic zone not applicable for default tax regime. Then in section 16, that is salary chapter, there are 3 deductions, correct? Standard deduction, entertainment allowance and professional tax. So entertainment allowance is not allowed in default tax. Professional tax also not allowed in default tax regime, that is section 115 BAC. But standard deduction, that is 50,000 rupees, it is allowed in both old tax as well as new tax. Okay, so this is a change, be very careful. Now let's come to house property. Section 24B, interest on housing loan is not allowed as deduction in respect of self-occupied property in case of 115 BAC. So in the new tax regime, for self-occupied property alone, interest on housing loan is not allowed. Sir, what about let out property? For let out property, interest on loan will be allowed as deduction in both old tax as well as new tax. That there is no change. Next, section 32(1), additional depreciation also not allowed under new tax regime. Now let's come to scientific expenditure. Scientific expenditure also, deduction in respect of in-house research is allowed as deduction in both old tax as well as new tax. However, contribution is allowed only in old tax, not allowed in section 115 BAC. Let me tell you once again, all the contributions are not allowed in section 115 BAC. But what about in-house research? In-house research is allowed in 115 BAC also, it is allowed in old tax also. Now let's come to section 35 AD. Section 35 AD, that is specified business, this deduction also not allowed in new tax regime. Also, if there is any loss related to section 35 AD, you cannot carry forward under the new tax regime. That also you have to be very careful. Then in income from other sources nokanna, there was a family pension deduction. Earlier it was not allowed, but now that also is allowed as deduction. So they are making this new tax regime more and more lenient and friendly for the assessee. So family pension deduction is allowed under both old tax as well as new tax. Next, what about chapter 6A deduction? Chapter 6A deductions are not allowed under new tax regime. Under 115 BAC, chapter 6A deductions are not allowed. However, certain chapter 6A deductions are allowed. What are they? They are contribution to NPS under section 80 CCD subsection 2, that is employer contribution. Then Agniveer Corpus Fund under section 80 CCH subsection 2, and lastly the 80 JJAA for new employees, there is deduction, no? That is also allowed. So 3 deductions are allowed: 80 CCD subsection 2, 80 CCH subsection 2, and then 80 JJAA. These 3 deductions are allowed in both old tax as well as new tax. All the other deductions, 80C, 80D, 80U, 80G, etc., all those are only allowed in the old tax, not allowed in the new tax. Fine. Now let us talk about set off and carry forward of losses. In set off and carry forward of losses kanna, when it comes to the house property head of income, you cannot do interhead adjustment under the new tax regime. In old tax regime, you were able to do interhead adjustment up to 2 lakh rupees, but in new tax regime, you cannot do any interhead adjustment. Okay. And what about additional depreciation? Additional depreciation is not allowed in what about additional depreciation? Listen here, Kanna, if there is any unabsorbed depreciation, okay, this unabsorbed depreciation can contain both normal depreciation as well as additional depreciation. I already told you that normal depreciation is allowed in both old tax as well as new tax, but additional depreciation is not allowed under section 115 BAC. So what about the loss that is because of additional depreciation? This additional depreciation also, loss also cannot be carry forward. But this is a depreciation, correct? This additional depreciation would have resulted from reducing the cost of capital asset, correct? Only if there is a capital asset, okay, there is a WDV. From this you would have reduced the additional depreciation, and after that only this additional depreciation is a part of unabsorbed depreciation. Unabsorbed depreciation, correct? So now, since this additional depreciation cannot be carried forward, hence you have to add back this additional depreciation in the opening WDV. So additional depreciation cannot be carried, in short, additional depreciation cannot be carried forward, hence whatever additional depreciation is there in the unabsorbed depreciation, that has to be added back to the opening WDV of the fixed asset. Okay, it is not that important. If you are able to grasp it, well and good. If not, don't worry, just ignore it. Next, now let's talk about rebate. Okay, so rebate, like in the old tax regime, in the new tax regime, that is 115 BAC, also rebate is allowed. But in the old tax, rebate is allowed only up to 5 lakhs, but in new tax the rebate is allowed up to 7 lakh rupees, up to 7 lakh rupees. And how much amount of rebate is allowed? Answer, it is 25,000. So up to 25,000 for resident individuals having a total income of up to 7 lakh rupees. So how much is the rebate? 25,000 or actual tax, whichever is lower. 25,000 or actual tax, whichever is lower, for resident individual having a total income of up to 7 lakh rupees. And now in this rebate concept, there is marginal relief also. Hence, if the total income is up to 7,27,770, if the total income is up to 7,27,770, then you have to apply this step also. What is the step? First, you have to find out what is A. A means total income minus 7 lakhs. Then you have to find out what is B. B means income tax on total income. Then if B is greater than A, then rebate is equal to B minus A. If B is greater than A, then rebate will be how much? B minus A. This will apply only if the total income is more than 7 lakhs, but up to 7,27,770. Then you have to find out the marginal relief for rebate also. Okay, I have explained this concept in detail in the amendment lecture. So if you are not able to understand in the revision, please go back to the amendment lecture. You will be able to quickly grasp the concept. Fine. Next, additional points for section 115 BAC. The section 115 BAC has now become the default tax regime. So by default, now you have to file the return of income under section 115 BAC, that is the new tax regime. But if the assessee want to shift out of the new tax regime and go to the old tax regime, then also the assessee can do that. If the assessee does not have any PGBP income, then every year the assessee will get the option to shift out of the new tax regime. So this year, if I am in the default tax regime, I can be in the default tax. Next year, if I want to shift out, I can shift out also. After that, if I want to come back to the default tax regime, I can come back also. It will not be a problem. But what if there is PGBP income? If there is PGBP income, that is income under the head profit and gains of business or profession, the assessee will have the option to shift out of the old tax regime only once. And if they exercise the option to shift out, they cannot come back to the new tax regime. However, if they do not satisfy the conditions and come back to the default tax regime, they will never be able to shift out of the default tax regime once again. So for example, listen here. For previous year 23-24, let's say the assessee is having PGBP income. Okay, now the default tax regime is what, Kanna? It is 115 BAC. The assessee feels that 115 BAC is not beneficial. I want to go to old tax regime. old tax regime. So if the assessee is going to old tax regime, he can do so, no problem. But after this, lifelong the assessee has to continue in old tax regime only. Okay, so one time they can shift out, after that lifelong they have to be under old tax regime till they are having PGBP income. Fine. Now sir, what happens is, let's say in previous year 26-27, now they feel that they want to come back to new tax. In such case, they can come back to new tax regime only once. Only once. And if they come back to new tax once, they will never be able to shift out once again. With this, matter is over. Okay. So if the assessee is having PGBP income, then they have an option to shift out only once. If they shift out, they have to stay in the old tax regime. But if they choose to come back to the new tax regime, they will never be able to shift out once again. So this is the provision. Now, if there is an employee wants to opt out of section 115 BAC, he can intimate his employer every previous year. Now listen carefully. Whenever there is an employer-employee relationship, there is salary income, correct? And if the salary income is more than the threshold limit, then the employer will deduct TDS. Normally, employer should ask the employee about the tax regime. If the employee is telling default tax regime, TDS should be deducted under default tax regime. If the employee is telling old tax regime, then TDS should be deducted under old tax regime. Sir, what if employee is not telling anything? In such case, employer should deduct the TDS under the default tax regime. That is the new tax regime only, employer should deduct the TDS. Fine. Now later on, let's say employer is deducting the TDS under default tax regime. But while filing the return of income, the employee wants to change the regime. Can the employee change? Answer is yes, employee can change, no problem. Okay. So these are the points. Now let us discuss some other sections quickly. Section 115BAA deals with domestic companies. So now we discussed old tax regime and new tax regime no karna. That was for individual HUF, AOP, BOI and AJP other than cooperative societies. Now we are going to discuss the new tax regime for all the different other types of persons. But for that, only if you know the basic rates, it is enough. You need not know the entire detailed section. It is not a part of your syllabus. Fine. So for domestic companies, the new tax regime is under section 115BAA and it is only for, and what is the tax rate? The tax rate is 22% tax plus 10% surcharge plus 4% health and education cess, which is effectively 25.168%. Then there is section 115BAC, which is a special section for domestic manufacturing companies, including generation of electricity. If it is set up on or after 1/10/2019, then they can opt for a concessional tax rate of 15% tax plus 10% surcharge plus 4% health and education cess. Effectively, it is coming at 17.16%. Okay, so very beneficial. Then there is a new section called section 115BAE. This section is for resident cooperative society. For whom? Resident cooperative society. They can opt for concessional tax rate at 15% plus 10% surcharge plus 4% health and education cess. So this will also be effectively 17.16%. But this benefit will only be given if they are manufacturing and they commence the manufacturing on or after 1/4/2023. Okay, and before 31/3/2024, then they can opt for this section, that is 115BAC. Then there is another section called 115BAD, which is for other cooperative society. So if there is a resident cooperative society other than the above, they can opt for concessional tax rate of 22% plus 10% surcharge plus 4% health and education cess, which is effectively 25.168%. So for both domestic company as well as resident cooperative society, the provisions are similar. If they are not in manufacturing, it is 22% plus surcharge plus cess. if they are a new company or new cooperative society which are engaged in manufacturing, then it is 15% plus surcharge plus cess. Fine. Now one more last special point. If any royalty and fee for technical service is received by a foreign company from the government or Indian concern in accordance with agreement made between 1961 to 1976, that is royalty agreement. It is a very old provision which is now no more relevant, but I am just telling you in case of MCQ. Okay, and between 1/3/1964 and 31/3/1976, then the tax rate is 50%. So royalty and fee for technical services in case of these specific agreements is taxed at 50% if it is received by foreign company from the Indian government or Indian concern. Okay, so these are all the provisions. I hope now you are thorough with all the provisions and you will be able to rock in the examinations. நல்லா படிங்க, எக்ஸாமில் செஞ்சிருங்க, எக்ஸாமுக்கு அப்புறம் எனக்கு மெசேஜ் பண்ணுங்கள். ஓகே, விஷ் யூ ஆல் த பெஸ்ட் ஆஃப் லக். டேக் கேர். பை பை.